$50 million US. So we're going to watch Rink on the back of that deal making. Rheinmetall, meanwhile, is detailing the cost hit from the German cancellation of that naval contract, about 300 million euros. Morgan Stanley says it's actually reassuring. We'll see the reaction to that. And UK warehouse stocks in focus as well, with the expected incoming Prime Minister, Andy Burnley, suggesting he could raise taxes on some of those warehouse operators here in the UK. Anna.
Big picture, we've come through a few risk events this week, haven't we, Tom? We heard from Kevin Walsh in the middle of the week, and that was something the market was focused on because we simply haven't heard very much from him. A little more dovish than expected maybe there. Then we got the non-farm payrolls data, which was much more weaker than expected. Does all of that add up to a more positive backdrop for global stocks, for US stocks? That's only one of the questions that the market was asking itself yesterday as we pushed out those hike expectations. Where does that leave us for European stocks this Friday morning? Well, just a touch stronger at the moment, at least, up by 0.2% on the Stoxx 600. The FTSE 100 up by 0.3%. So eking out some gains on this Friday, the 3rd of July, Tom. Looking for some of the movers that you mentioned to see whether we get any movement there. The DAX not yet open. We'll be looking to see whether that outperforms. The futures picture had suggested we might see outperformance on the German market. What are you seeing on the sectors? On the sector breakdown, let's start with tech, because that took a hit yesterday in the session. It ended lower by about 2% in the European session as a sector. Right now, tech is amongst the best performers across the sectors, up 0.9%. Top of the list, though, is basic resources. We've seen higher prices for gold and silver, and that has been aided, of course, the upside coming through in terms of prices on a slightly weaker dollar and expectations of possibly fewer rate hikes from the Federal Reserve. So basic resources as a sector is rallying today, up close to 1%. Tech getting 0.8%. Utilities also up 0.7%. On the downside, consumer stocks taking a bit of a knock, down 0.4%. Healthcare, which was the best performing sector yesterday and by some margin, with gains of 3% yesterday as a sector, is currently down just 0.2%. So maybe a little bit of profit taking across healthcare. That is the picture right now. Most sectors in positive territory across the benchmark, gains of 0.3%. Okay, yeah, still waiting for that DAX to open. We will keep our eyes on that. US futures, as you've been mentioning, looking increasingly strong, ready for Monday, perhaps. Let us turn, though, in the meantime, to what's going on in the individual companies. Airbus is up by 2.4%. We had that story earlier on today around Airbus deliveries. ASML is also stronger, up by just over 2%. So that's an interesting one on the tech front. And to the downside, Novo Nordisk and some of the luxury names. We actually saw in the middle of the week some of those luxury names not doing too badly. And so maybe there's some rethinking there. LVMH down by 0.7%. The heavily weighted, of course, over on the French market. And speaking of France, let's return to Aix-en-Provence, the economic conference taking place in France. Central bankers are gathering, finance ministers. We just heard from the French finance minister, business leaders, economists, and investors, all thinking about the European growth outlook, thinking about inflation, interest rates. We're joined now by Ludovic Soubrun, who is the CIO and chief economist at Allianz. Ludovic, very nice to have you with us. Thank you for braving the heat of Aix-en-Provence this time of year to talk to us. So I wonder what you take away from this week as we go into the second half of the year, Ludovic. We've had the Sintra conference, we've had that weakness in the non-farm payrolls story out of the US, and a lot of quick rethinking about just how many rate hikes we're going to get here in Europe and in the United States. How does that position us then for the second half of this year?
I think it's quite an interesting situation. You mentioned central bank to start. I think the ECB was the only one really to deliver a hike. It was an insurance hike. But as we look into the numbers now, it looks like it's done. They cannot do much more. At the same time, the Fed is really on the opposite direction. The non-farm payroll was actually soft. But I still think inflation peaking above 3.7%, and there is still this AI, fiscal, and energy-fueled economy. So I guess the Fed may have to hike in September. So that's really the divide, I would say, between Europe and the US. And of course, the good news is that the inflation is being repriced very fast in the market. So I guess Hormuz seems to be behind. So there is still a scarring effect. It takes time. The economy is still paying the price of the war, but it's looking much better today than it was a couple of weeks ago.
Do you think we're in a bubble in AI-related trades, Ludovic? Is that the thinking over at Allianz? And are you concerned that it bursts? Some people are worried about higher interest rates. You just referenced the Fed there. Some about regulation. I wonder what your thinking is around the AI story.
Look, my concern is mostly on the ancillary things happening on AI. I think there is a very strong, it's a renaissance-like moment for the economy. AI is really going to change the service economy. But I see things that are weird. First, of course, the debt expansion loop that is creating these monetized CapEx type of moments. We see actors that are very, some of them, Apple, Microsoft, not doing much, and others doing too much. We see a lot of psychology around this AI. We don't really know what is going to be the adoption and the impact on the real economy, but the market is already being very optimistic, especially on productivity gains, when it's going to be a bit of a hybrid situation. So for me, that's where I see the signs that there is a bit of exuberance. The good news, I would say, is that markets are seeing that. When you look at the corporate spreads in this sector, especially the hyperscalers, they tend to be a bit more cautious than before, and I think that's a good news. Would it be enough? We will see, because I still see the CapEx in the US, skyrocketing.
So you don't see complacency in the markets when it comes to the AI trade then, Ludovic?
I don't see complacency on the debt market. On the equity market, I think it's really strong. I for example, think that the emerging market equity stocks are looking much better because of the semiconductor, important chain, link in the supply chain. But in the US, I think the markets have been extremely strong. I don't know if it's a bubble territory. It's not enough to call it a bubble. It's really about the many factors. The investigation is more about what comes around that looks a bit strange, especially on data centers, for example, when you look at the risk of obsolescence of some of these data centers. When you look indeed into this monetizing of the CapEx type of move, if you issue debt to pay your shareholders, that doesn't look very good to me. So that's the type of signs we're looking at. Yeah. So on the bond side, I think there is still a lot of vigilantes. On the equity side, I still think it's, it seems like the sky is the limit, and of course that is something that is not the case, yeah?
Is this a better moment for European equities?
I think European equities clearly can do slightly better. I think they have stronger fundamentals, especially when it comes to the debt side, when it comes also to now the energy crisis being behind. The problem, as we know, is that everything is about the AI dividend. And so the European companies are left with adoption. I think what happened with AI, our AI, your problem, not to quote Jim Connolly in a bad way, our dollar, your problem. I think it was good news that Fable 5 and Mythos were now available again. Will it be enough? Can Europe really be the strongest adopter and differentiate itself? I doubt it. I think it's going to be a bit of a fragile, I would say, way for the equity markets in Europe and for companies that are listed in Europe to benefit from the AI dividend, but it's certainly going to be a tailwind.
You're in Aix-en-Provence, Ludovic. We've just been hearing from the finance minister over there, and we've been hearing about, we've been talking about the fiscal story, and I wonder whether that's going to take the agenda or lead the agenda for Europe in the second half of this year and into next year. How concerned are you about the recent widening in spreads that we've seen on France?
Look, I mean, the main job that this government has to do till the election is really to maintain this 5% upper ceiling for the deficit. That would be a way to reassure markets. And I think they've been doing a great job at it, including by doing under-indexation of some of the tax cuts on wages in spite of the inflation and so forth, right? The problem comes with the law of finance for 2027, because that's the one that's going to be the caretaker law before a new government comes to place in 2027. And so markets will be looking at this. But if you look at it, it's an election wall. Italy, Greece, Spain, France, everybody is into this election mode. And so everybody will be looking at what is the fiscal impetus And what is really the room to maneuver that those leaders have when markets have been looking at, the rates market especially has been looking at, do you spend for investment, or do you spend for maintenance, which is mostly the social protection cost? And we've seen that has been a big differentiator across countries. Germany is running a 4% deficit this year, which is quite huge if you think about German standards. So of course everybody's looking at what the others are doing with their fiscal, especially Italy, especially France, and I would say also the UK.
Ludovic, so on the spreads, I mean, we've been looking at French 10-year over Germany at 79 basis points. As we approach an intense period for French politics, what's the kind of spread level that we should be looking out for? What would be a concern for you or get your attention over at Allianz?
Yeah. I think there is depending on the candidates that really crystallize towards the end of the year, I think we're going to see a slight widening of the spreads to the Bund by another 10 to 20 bips. That's very possible. I think then, of course, the main question is whether there is, and this is what everybody has as a nightmare scenario, a bit the extreme right and the extreme left going to the second round. I don't think this is the most likely scenario, but in that case, two parties are very profligate, and we have been running, spread scenarios that could be widening by as much as 150 bips, 180 bips, mostly because there is this question from both parties on how they will behave when it comes to Europe. And the ECB will be there maybe to save the day, but not for political reasons. And so that's a bit where the spread scenario could really go haywire. That is clearly not the central case. The central case is a bit of skirmishes on what is really priced in and what can governments do in 2027. And we're talking maybe about a 20 bps widening, which is something that actually markets, especially bond investors, would like very much, because that would then give them an entry point for the OAT.
Do you think Andy Burnham has learnt the lessons of the UK's own fiscal challenges and the gilt sell-offs that we've seen under previous Prime Minister Truss? Do you think that lesson has been learnt?
I think everybody has learned this lesson, Tom. I can tell you there is not one conversation about the risk of a Truss moment from the US to France to Germany even is talking about the Truss moment. I think that was really interesting epidermic reactions on market. I think now the question is, can politicians overcome this fear to do something that is meaningful for their people, especially the centrist parties? Because the populist parties on both sides, they're over-promising and under-delivering, right? So the centrists need to find and walk this tight rope, and that's the main issue now with politics, especially in Europe, and I would say it would be the case with the US after President Trump. Yeah.
Yes, I mean, Andy Burnham argues that his advisors argue that if the bond markets become convinced that the growth story for the UK can really change, then maybe bond markets will put up with some, not higher borrowing, but at least taking that on. I mean, Ludovic, does that hold water to you? Do you think that bond markets are ready for a step change in growth to be the narrative?
I think quality growth has always been a bit the mystery of bond market, right? What is spent that is seen as something that is yielding to higher growth and hopefully not so much inflation, or at least good enough inflation that it crowds in capex, especially from firms and from families. I think this is the ultimate policy goal. I do believe that this is everybody's attention. So especially when it comes to investment in the production versus untargeted social assistance versus, this guns versus butter debate between defense and social protection. That's the type of things and trade-offs that most prime ministers, most leaders have to face to make sure that markets buy the story of a multiplier effect with a well-spent additional euro, additional pound. It's something that is hard to sell, but I think this is the way that they have to walk if they want to get something out of their time in office.
Yeah, something for the second half of the year. Thank you, Ludovic. Ludovic Soubrand, Chief Economist and CIO over at Allianz, joining us from Aix-en-Provence. And more coverage coming from Aix. Don't miss a conversation with the Banque de France Governor, Emmanuel Moulin. That's at 10:40 a.m. London time.
Let's get back to the markets now, the core six, and see what the performance is like, again, on a generally decent day, relatively decent day for European stocks and record highs yesterday. ASML performing very well, so adding the points across the index, up 1.8%, the Dutch company, and Schneider Electric also gaining 1%. On the downside, you've got some losses coming through from Rheinmetall as it details the costs to that contract cancelled, of course, over in Germany, and Novo Nordisk down 1.5%. Let's get more on some of the individual stocks on the move and bring in Louise Moon. Louise.
Morning, Tom. So first up, we're turning to Stockholm. Absolutely soaring here, this stock up over 15%. That's after they settled a lawsuit related to brain guards. That's really soaring into the green over in Stockholm. Sticking with the sector, we are looking at Reckitt back in London. Reckitt, let's take a look at their shares. Only up slightly into the green. Now, that's after they were cleared in the US. One of their lawsuits surrounding their unit, Mead Johnson, over their infant milk formula. So that's one of the lawsuits in a whole host of them. So it's cleared, positive, but a lot to get through, both for Reckitt and for one of their rival companies as well. So it's only slightly ticking into the green as a result of that. Now, next we're looking at Rank Group over in Germany. Shares up over 2%. So into the green, another positive move for them. That's after they've just bought a UK defence firm called David Brown, giving them more access to the naval sector. Of course, this adds to this spending of defence, and Rank Group already, their shares have tripled since their IPO in 2024. So a bit of positive news for them. And then finally, ending on Craneware. Let's take a look and see how their shares are doing. Down, slumping over 21%. Previously halted this morning and now down over into the red. That's despite seeing, that is as they're seeing their full year earnings below expectations. So really weighing on that stock here in the UK.
Louise, thank you. Louise Moon with those stocks on the move. Coming up, private credit in focus. Managers are locking up investor cash as they face another wave of redemption requests. We'll have more next. This is Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI. That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersachi in El Ola, Saudi Arabia, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
welcome back. This is the opening trade. We've got some data out of Spain. Our first chance to look at the Spanish PMI numbers for the month of June, and they've come in really strong. So if you look at the composite number, 53.3, that's well into expansion territory. The services number, even more so, 54.2, and they're both well above the survey, which for both was around the 50 mark or 51 mark. So strength in Spain. Let's bring in Jana Randau, who reports on economics and the ECB from Frankfurt. She's back from Sintra. She's been all over the European growth story, the European monetary policy story. And so I'm interested how this Spanish PMI story fits into all of that then, Jana. I mean, Spain has not been the epicenter of concern around the European growth story with the war in the Middle East. So maybe that's also important context. But there's some strength coming through in at least one part of the Eurozone growth story.
Yeah, it's quite impressive, actually. I didn't expect that to happen this morning. Now, Spain, of course, is in a way the poster child of the Eurozone economy, has been for a very long time, recording solid growth, while Germany and France and the likes are really struggling. And we're seeing that at full force this morning with these PMI figures. Partially, of course, because Spain, has strong fundamentals, but also because of the changes we've seen in peace negotiations between Iran and the US. We've seen that in other data as well. A lot of hope, a lot of confidence that things are turning, things are improving. We saw some upward revisions to manufacturing figures in France and Germany earlier this week. Suggests that firms are, confident that the outlook is improving. We've seen IFO climbing. Of course, that's the main German business confidence indicator. So overall, and the ECB President Christine Lagarde said that as well in Sintra, since you mentioned it, that risks to growth, to inflation have become more balanced since policymakers last met to raise interest rates, as a matter of fact. So things are looking, in the right direction, even though of course, a lot remains in the unknown, and it's far from, story's far from over.
Yes, Jana, and as you talk about the ECB, which of course you know intimately, Christine Lagarde maybe uses this, maybe she leans on this data to reinforce the case that hike that they made earlier this year was the right decision. She's been driving home that message again, and maybe the data, arguably the data of today, supports that view.
Yeah, I mean, it's tough when you, as an ECB, raise interest rates and then data falls in the right direction and seems to suggest that inflation is coming down, growth is strengthening, and the scare may not have been so great, and they're cautioning against that, of course, saying yes, we are seeing positive signs. But equally, a lot of damage has been done, and it'll take time for businesses, for consumers to adjust to what happened, to digest what happened. And of course, we don't know if the truce holds, what happens if the Strait of Hormuz, key passageway for oil and gas shipments, if that stays open. So a lot of uncertainty still, despite all the positive signals. So yes, the rate hike in June was solid, was robust, as policymakers like to say. And I don't think they've all given up on further action. Also, July looks unlikely. That's only 3 weeks away now. But September is still very much in the cards. We spoke to a lot of policymakers in Sintra over the past days, and it seems they are far from sounding the all clear. They have their eyes on inflation. It's still above the 2% target. So for now, it looks like more will even come from the ECB later this year.
Okay, September is still very much live then for the ECB. Jana Randau in Frankfurt with the reaction, the context around the data and how to think about what we've been hearing from Christine Lagarde. Jana, thank you. Meanwhile, private credit funds are facing a relentless wave of investor withdrawal requests, forcing managers to trap over $14.5 billion of capital to protect their portfolios. For more, let's bring in Bloomberg's senior reporter, Celeste Brown, who covers this for us. So managers locking up more funds, redemption requests increasing. What is the state of play right now, and how concerning is it for the private credit space?
Yeah, I mean, we're in the second wave of redemption requests. First started in the first quarter, and you're seeing, I think basically what you're seeing, my take of it is the funds that benefited most from the retail explosion over the past few years are the ones that are now suffering the most. And so the likes of Ares and Apollo and Blue Owl, who've really kind of pioneered retail, bringing retail investors into the private markets, are the ones that are now having to kind of shut the doors and institute caps. So it's kind of an interesting moment. I mean, I don't think this is going to end soon. I mean, I think we will see, I mean, certainly people think that they will see successive quarters as they just try to kind of calm the nerves of the judiciary retail investors.
And Silas, how do we judge success here for these credit funds? Is it just capping redemptions and holding the line, or is it not actually receiving that many redemptions, so you don't have to impose the cap, you don't have to reinforce the cap? What does success look like for these credit funds?
I think it's quite impressive when they don't have to do the cap. And there's been a few, I mean, so Goldman and Oaktree have been outliers in terms of actually saying their redemptions fall in this quarter. I think for the industry, as long as the performance remains relatively robust, which it has so far, I think this is more of a kind of technical issue with retail investing. If the performance starts to drag and you see more credit blow-ups and kind of more stress in the industry, that's when I think it becomes much more of an issue.
Okay, so it's the quality of those underlying assets and whether or not that becomes an issue. You talked about the retail investor and how that different funds are affected differently because they've sold a lot of these products to the retail investor, and successfully. Do you think on the back of all of this, after these next few quarters, that maybe we see more redemption requests, at the end of all of this, we get a rewired private credit space that has maybe less exposure to retail?
Yeah, because I think what I said at the start about the funds that benefited most from the retail boom are now the ones that are suffering. I think to dig into that, people think of retail investors as just one sort of single composite thing. Yeah. And actually what we've noticed that there are some that are very flighty and some that have kind of stayed the distance. And I think as we analyze this, as the dust settles, we'll notice that there's a kind of hot money area of retail that I think people pushed into through RAAs and through, and
RAA being
I don't know the acronym, but they're these registered investors that go out and kind of sell products to sell products to kind of high net worth and mass affluent people. And I think to the extent that was a kind of aggressive sales pitch over the last 3 or 4 years, that really helped grow the assets in the industry. And I think that's where the kind of pressure valve is.
Yeah, so that might be where, as you say, where the pressure builds. What about the pressure? You said it depends on the underlying assets. So what's the latest signal we're getting then, Silas, as to whether the underlying assets are doing okay? I mean, credit spreads for listed credit seem to be pretty tight still, and we had a moment of worrying about higher interest rates, but this week that's slightly being pushed out, slightly fading. What do the underlying assets then look like? Famously, there's a lot of software in these baskets.
Yeah, so in terms of like new deals, frustratingly for the industry, the leveraged loan market and the high yield bond market, the institutional traded debt markets are very strong at the moment, very tight. So a lot of, if there's any M&A happening, a lot of it is flowing through to the kind of traditional forms of leveraged debt. So that's frustrating. Number two, yes, there is a kind of relatively high degree of concentration in software, and what's tricky, I think, for fund managers is the software industry remains relatively robust in terms of earnings growth, but there's just this nagging feeling, which I think is backed up by certain, certain evidence to suggest that there will be some value destruction there. But that takes quite a long time to play out.
It does take time, and it's a conversation, no doubt, that is still to be continued then. Silas, thank you very much. Bloomberg's Silas Brown with the latest on private credit markets. We will talk about this and other themes with Piers Hillier, Jupiter Asset Management CIO, joins us to discuss his outlook for markets in the second half of the year. We'll get to that next. This is Bloomberg.
to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Every weekday, Bloomberg puts a spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players on major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is the opening trade, 30 minutes into Friday's session. We are without our friends in the United States as they celebrate 250 years. And so this is the European equity market picture. It doesn't look too bad, actually. The US session was kind of two different stories in one. Overall risk sentiment was buoyed by the weakness of the non-farm payrolls report and pushed out expectations of a Fed hike. But we still saw some concern around tech stocks and semiconductors in particular. Then into the Asia session, that kind of turned around. We saw some positivity around tech stocks. So all of that adding up to some positivity for European equity markets. And interesting to think where we've been this week, Tom. We started this week possibly more convinced we'd get imminent Fed rate hikes than we end the week. So maybe that is positive for risk assets.
That could be another catalyst as we look at European stocks. Building on the record gains of yesterday, volumes are down, likely tied to that US holiday, of course, currently down at 25% versus the 20-day average. So that's the volumes picture. The breakdown then across the benchmark stock 600 is this. You are seeing the majority of members in positive territory so far in the Friday session, 419 gaining so far, 163 in negative territory. Let's flip the board and have a look at some of the leaders then. Interesting in the shipping space as we think about the trade dynamics that are coming through, but also the Strait of Hormuz. Maersk getting an upgrade from Goldman Sachs, and so that stock is posting a very strong session so far, up 3.5% from Elon Musk. Abivax, this stock is up about 50%, this week. They came out with a new drug at the beginning of this week, and so that momentum, the optimism around that stock continues in the session today. Gains of almost 5%. Infineon linked to the revival, at least for now, in the tech trade, and you're seeing that strongly, of course, in the Asian session, or you have seen that strongly in the Asian session, adding to upside, up 1.2% for Infineon, the Germany listed company, of course. Let's flip the board and have a look at what's happening on the downside. You've got some defense names, you've got some software names, and you've got some caution around alternative asset managers. Craneware, software exposure to the US healthcare space, and that is being hammered, currently down more than 23%. That's on an earnings story. Rheinmetall detailing the hit coming through from the contract cancellation by the German government around that potential build-out of Navy ships. We know that's not happening anymore, and they've quantified the cost. That stock is down 1.7% on the back of that news. And then EQT with a warning around, and from one of the analysts around these alternative asset managers and downgrading their view on EQT. So that stock is currently down 1.3%, Anna.
Tom, let's get an update on some of the other stories we're covering this morning. Bloomberg understands that US President Donald Trump and his allies are renewing a push to reshape the Federal Reserve. Top officials have been actively exploring ways to remove Fed governors to clear the way for the president's own picks. The Supreme Court recently blocked an attempt to fire Governor Lisa Cook, of course, but she remains, according to our reporting, a target. Some leading European powers now accept that ships transiting the Strait of Hormuz will have to pay fees to Iran and Oman. According to Bloomberg reporting, the prospect of some sort of service fee is now, quote, a given. The US and Gulf Arab countries, meanwhile, continue to insist that Iran and Oman cannot impose charges of any kind for the use of the Strait of Hormuz. And Anthropic is reportedly in talks with Samsung to be a manufacturing partner for a custom artificial intelligence chip. According to reports in The Information, the company's plans are at an early stage. The news comes as AI companies aim to diversify their supplies of chips to meet surging demand for their services. Tom.
Well, we closed out the first half of the year this week, and despite the geopolitical pressures, equity markets around the world rocketed higher. We spoke to guests this week about where they see performance going from here.
Volatility is still there and uncertainty is still there. And in this environment, for me, it makes sense to be quite nimble and also not to take big bets either way. But when the market throws you opportunities.
As long as the earnings continue to be good and to broaden out, I think we'll get continued gains through the second half.
It's still good to be exposed to tech about at the market weight of tech, and to look maybe to give more emphasis to other sectors. We are looking for a little bit of a broadening here.
We can talk about the AI losers, but actually beyond that, there's lots and lots of sectors, whether it be things like healthcare, whether it be things like staples, which are trading at sort of valuations you haven't seen for a very long time. So, you know, at this point, if you get a little bit of that momentum coming out of those tech stocks, is there a lot of value elsewhere? And I think there probably is.
Even though valuations are stretched, even if you take kind of the worst case scenarios, this rally could still have another year to run before you then saw a turnover.
The second half of the year could mark a positive momentum for Europe. Now, I think we have to keep in mind, if we look a bit further down the line, that we're going to move into 2027, and at some point people will start worrying about French election and other political issues potentially in Europe. So I think it's going to be a short trading window for Europe.
Well, here to give us his perspective is Piers Hillier, CIO at Jupiter Asset Management. Piers, good morning. Happy Friday. Further upside for global stocks?
I think so, and I think the important thing, quite a few of those guests really commented on, is in some ways a rotation into some of the other sectors. So we've kind of been led in the first half of this year, partly sort of hyperscalers to start with, and then as the CapEx piece starts to get deployed, the beneficiaries of that CapEx effectively have rallied very sharply in Q2. I think, you know, in coming in to talk to you this morning, there was a degree of caution from our perspective in terms of running a sort of ahead of themselves. So the logic there, the earnings revisions and everything else justified that, and even you see a slight nominal rating. I think our perspective from here is actually, you know, we see the second order effect feeding through into markets. Valuations beyond that cluster actually still look relatively attractive, and particularly sort of outside of the US, global valuations remain attractive.
Because we've seen that rotation story kind of rear its head and then it gets pulled back in again. But you're convinced that that rotation theme continues and broadens out and gains more traction in the second half?
My observation really is ultimately markets will respond to earnings and earnings revisions. The resolution, whether we have a resolution in the Gulf or not, is an interesting topic. But you clearly see sectors responding to that, and what's happening in terms of trade is starting to improve. I think the interesting thing about your point on the levy there in the Gulf, if that actually does happen, to me, actually get a capex pull through. So most people didn't know anything about the East-West pipeline in Saudi Arabia until this happened, and then they suddenly realised it wasn't really being utilised because it made no sense to do that. You could ship it was much easier. If levies are going to start to happen, one, I think that's a real political loser for Trump, because what was the point of going to do this? The second thing is that actually, are we going to see a growth in capex where people are going to try and mitigate that risk? You've got sort of indications of Canadian capex in terms of building an oil pipeline out to Vancouver to support China. You're going to see more use through Panama, Venezuela coming on board. So in some ways, I think the Iranians and the Omanis need to think quite carefully about how much of a levy do you want to apply. We know that tariffs essentially had a big knock-on effect when Trump announced them before, and my sense is that actually a degree of caution in terms of where that goes, because you know, economics 101, if the cost of supply over here is more expensive, I'll find supply over here. Demand is the key moderator.
Okay, and that will be interesting if there is a sort of stickiness to prices for energy as a result of more tariffs or taxes or whatever they end up thinking about. That would be interesting for Europe, certainly.
Yep.
Thinking about the US and how the growth story plays out there, then, Piers, it's been interesting because, yes, it was the hyperscalers, then it was some of the semis, and that's a more global story, isn't it? The memory companies, more global than just a US story.
Yeah,
although the US set to benefit from the AI rollout, I guess. Where does all of that leave small caps? More pinned to the real US economy, I suppose.
Yeah, and I think it's a really good question because we've been so obsessed in some ways by that part, and markets always tend to respond to earnings. That's a critical driver. I always want to just make sure that cash flow is actually following earnings. That's a sort of the reality check, and that's certainly been true in small caps. And I think most people have missed actually small caps have been outperforming the larger parts of the market now for almost a year. And it's kind of gone unnoticed. You very kindly built this chart for me this morning, but I thought it was just interesting to highlight. And what is this telling you? Essentially, small caps is a macro trade. It's really a reflection of your expectations around interest rates. So it started underperforming in 2021 as interest rates started to go up globally, started to inflect as we felt we reached the peak in rates, had a few wobbles in Q1 with the Iran intervention, but actually the underlying fundamentals are there. And we have a really interesting global smaller companies ETF where we're excited about the opportunity set in that part of the market.
And does the AI story, when it starts to filter into those smaller companies, is that something to be excited about from a well, you say it's all about earnings, so from an earnings perspective?
Yeah, and I think that we talked about sort of Europe relative to the rest of the world. You saw a little bit of it in Q1, which is the second-order beneficiaries of that CapEx story starting to play through. Companies you wouldn't naturally thought of, like Prysmian, a sort of cable provider. A lot of the infrastructure supporters to the build-out of data centres. You saw a bid for Segro in the UK, with Prologis looking potentially to come in and try and deal with that marketplace. And I think I was interested talking to a sort of chemicals analyst in the benefit of the pull-through in terms of how do we see further innovation into the chip space. There are a lot of chemical leaders in Europe that are potentially beneficiaries of that as well.
I just want to be clear on the hyperscaler story then, because that underperformance has been there, at least in the last month or so, around that theme that they're spending and it's the picks and shovels that gain, and some of those other component makers that see the upside. Does that continue, or do hyperscalers look attractive to you right now? Because the drop has been there, and year to date for some of these names, and double digits for some of the big names in the hyperscaler space. Yeah. There comes a point, maybe, when that starts to look attractive for some.
That's the classic thing, isn't it? Is really just to understand what that order effect is. I suppose if I go back and everyone talks about bubbles, and ultimately you only know when you've had a bubble is when you passed it. Yes. So for me, what I really look at, what's changed in some ways, and we've been long-term actually investors into the hyperscalers as actually capital light businesses, highly cash generative and disciplined. The big delta really in the last 18 months has been that switch essentially from effectively cash generative to cash consumptive. So the first order effect effectively was raising debt. You're now starting to see them coming to raise equity. And if you remind yourself, that's kind of the profile we went through in 1999-2000 as the transition from cash generation to cash consumption. And at some point, the cost of capital starts to catch up. And I think for me, that's the one, if I put up sort of what's a warning light out for the second half of the year, is that if inflation remains high, and there's a real push and pull in that space at the moment. You've got PMI stronger in Europe today, but you had actually jobs weaker in the US. But there's a lot of refi risk to come through, starting really in the second half of this year, feeding over the next 2 to 3 years, as those who really refied back in 2021 and corporate IG and crossover tends to be 5 to 7 year in tenor, we're walking into that refi wall. So I sent you through a piece around the private credit side of things. So some of the companies in the US, why are they underperforming? It's not just a software story. It's going to be a refi story in the second half of the year. So if rates start to come down, then actually some of that pressure comes off and you can see those bounce. But fundamentally for me, it's that transition from super low rates, which we hadn't seen transmit as much. You didn't see in the US because essentially mortgage rates are fixed, the 30-year term structure, so there's no pressure there. But if you look at the shorter dated financing, so auto loans, credit cards, etc., student debt, they're all accelerating in terms of default risk now. So if rates come off in the second half of the year, and that's going to be really important to watch from here, if that doesn't happen, we do have that pressure that comes through. So you've got the chart up there, which highlights the underperformance of the likes of KKR, the likes of Apollo and Ares, who have been beneficiaries of that carry trade, and that's unwinding. It's not just a gating thing. That's really important too, but ultimately the second half is really watch what happens with that refi risk.
So it's not just gating and the private credit, it's also wider. It's about refinancing risk, as you point out, as rates might or might not go higher. Let me ask you about UK assets. And are UK assets on alert? I mean, I suppose European assets might be on alert for politics in 2027, but the UK dimension to that, is it gilts that are on alert? Is it things that could be taxed that are on alert? We just heard last night from Andy Byrne talking about the possibility of taxing warehouse companies. What's in focus for you when it comes to UK assets?
Look, I mean, it's a fantastic question. So the gilt market really is trying to work out, and it depends on who becomes the next chancellor in terms of where we see the evolution from here. So you'll bid at the front end, in some ways the gilt curve, there's a nice pull through there in terms of where we are, but the long end is totally unloved. DB pension schemes, essentially are no longer really buyers of the long end. So
do you think rightly unloved?
Well, yeah, but the reality is, when you're uncertain, you think of some of the capex, or at least the investment decisions that are being made on behalf of us. The reality is that most of those are not converting into actual real growth or productivity. I think the market will wake up to that. So a real incentive to grow as part of a new industrial structure and a strategy really would actually, I think, help markets backdrop from here. But actually, I sort of, when I joked on the way in, a sort of a letter to Mr. Burnham, dear Mr. Burnham, actually you can help yourself. The UK, if you take this to G7, is the smallest investor in its own domestic market to any other of the G7 members by a huge distance. The US is over 60% of its assets in its domestic markets. Australia, almost 40%. We are less than 3%.
Well, and this is something that the Labour government has been trying to fix already, hasn't it?
Yeah. But the rest of the world thinks the UK is cheap, because if you think about the number of bids we've had for UK companies, I mean, our market shrinks essentially because the rest of the world thinks we're great value. We talked about Segro earlier, Prologis bidding for that. You've had Tate & Lyle, Nuveen bought Schroders. I won't go on, but it just makes a point that actually the world thinks the UK market's cheap. Private markets think the public market of the UK is cheap. If the government puts some form of help, and it's incentives that markets respond to, not sticks. Telling us to invest in the UK is not the answer. Incentivise us to invest in the UK, and we will come.
Okay, something tells me they might be listening, looking for ideas.
I hope so.
Piers, thank you very much. Piers Hillier, CIO of Jupiter Asset Management, with his letter to Mr. Burnham. Coming up on the programme, we'll stick with the UK theme, in fact. I wonder whether Mr. Burnham is going to be watching the football very late on Sunday, early Monday morning. Pubs will be able to stay open well into the early hours for England's World Cup match against Mexico. We will get more next. This is Bloomberg.
Being called an ideological lunatic or a bunch of left-wing nut jobs?
I've been called worse things than that.
You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it, when you're hot on the trail of something, you know that it's very exciting. What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it paradise ahead or Gattaca?
Maybe somewhere in the middle.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television. Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Welcome back to the opening trade. Happy Friday. We are 48 minutes into today's session. You're seeing some modest gains coming through for European stocks, up around 0.3%, but that is in the context of record highs for European stocks yesterday and outperforming the S&P 500 year to date right now. That is the picture across European stocks. The CAC is currently flat. The DAX putting in a slightly better performance, up 0.4%. And here in the UK, the FTSE 100 at 10,673, adding 20 points.
Let's start on stocks then in our next conversation. Bloomberg Markets Live strategist Adam Linton joins us to think about where we are on these global investment themes then, Adam, as we go into this weekend. European stocks enjoying a moment in the sun, you say. This is rotation. Rotation means lots of different things to different people, doesn't it?
Yeah.
But does it mean everybody buying healthcare? And is that good for Europe?
Yes, I think kind of what we've seen is kind of seen a reversal of the Iran conflict pattern, whereby US was leading, had Asia, that was positive, Europe negative, and then since early June we've seen a reversal of that. So Europe's now lead the way. We've got lower for US equities and Asian equities, and obviously bounce back from Europe. It was hit most by the conflict, but then also tech is a key differentiator here. So much lower gearing towards Europe in tech, and if you look at the rally under the hood for Europe, in the initial stages of this leg higher since about June 11th-ish, it was relatively narrow at the start. It was mainly just financials and industrials driving things. But now what we're kind of seeing is increased breadth. So we're seeing 8 of the 11 GIC sectors contributing. We're seeing a turnaround for consumer staples and healthcare. And European stocks continue to punch out record highs. And what's going to be a really key month for tech going forward is a key differentiator for Europe.
Okay, and the energy price story is a factor, as you say, and the rate story as well. I mean, Christine Lagarde saying that the decision to hike earlier this year was not a mistake. We were hearing from our colleagues in Frankfurt saying that the ECB it's probably could still be live for September. So I guess my question is, does the rate story continue to benefit European stocks, or if they hike again, is that a headwind, or do European equities look through that?
I think they'll probably look through it, because I think my view on rates is we're probably in for a little spell of sideways trade at the moment. We've kind of seen obviously the ECB tighten policy, but what we've kind of seen from them as well is that they're leaving this one hike potentially on the table. I think the dovish remarks from Lagarde were her speaking off script a little bit, and the market's still clinging on to this belief we could see a hike at some point from the ECB and the BOE, rightly or wrongly, and I think that'll take probably quite a while to unwind. So I think for European yields, if you look at the German 2-year yield, it's about 2.5%. We've probably got a bit of a floor under that now, unless anything big happens in the US. But at the same time, there doesn't really appear to be much of an upward bias unless anything dramatic happens between US and Iran. But I think the market's really discounting that at this point.
Okay, Adam, thank you very much indeed. Adam Linton with a take there on how to think about the record rally for European stocks and the rates environment. Here's what else to think about for this weekend, though. Wimbledon continues, of course, so all the tennis action in southwest London. We keep across that, of course, or you should be keeping across that. The World Cup, of course, the knockout stages. We're building up here, at least with our bias, to England versus Mexico on Monday. But lots of great action, including from France over the weekend. It's the 4th of July, of course, in the US. Happy 205th. And this is one that no one wants to miss. Taylor Swift's wedding. Apparently it's going to cause some congestion in New York. So that's happening this weekend. I think Anna Edwards got a ticket.
Well, maybe. I mean, point of order, I should just say happy 250th, not 205th. You just knocked...
Did I say 205th?
You just knocked 45... Yeah, you knocked a good half-century off their age.
Thank you.
Yes, I thought it was a public holiday for Taylor Swift's wedding. Apparently that's not the case. It's July 4th, but it isn't July 4th. That's tomorrow. It's actually Friday the 3rd of July. But there's a lot of football ahead, a lot of sports ahead, but a lot of football. Speaking of football, the UK Prime Minister Keir Starmer says that pubs will be able to stay open for the England World Cup match taking place at 1 a.m. at UK time on Monday. Yes, 1 a.m. He made this announcement in a post on X.
We're making sure that pubs can stay open on Monday morning, early on Monday morning, for the England game. So I know lots of people are making their plans. If you're planning to watch it in the pub, that is great, and it's really good for pubs as well. So come on, England.
His message for the nation. Sam Unstead is with us, co-editor of our Markets Today blog. He's trying to go out as Mr. Fun, it seems, isn't he? I mean, I do want... So this is going to be good news for pubs, I suppose, to take the Bloomberg good for business line. Which business is it good for? It's going to be good for pubs, even on a Sunday night.
Yeah, it will be good for pubs. No question about that. You know, this is obviously not a time of day. They're not only allowed to sell to and quite literally extending their opening hours by 4 or 5 hours at least. So yes, it is good. We have, though, we went back as the World Cup was starting on the Markets Today blog into how much of a boost do pubs actually get from major tournaments, and obviously it's a bit dependent on the timing. In this case, as you mentioned, it's going to be 1 a.m. because it's being held in the Americas. When they're in Europe, there is more of a boost because the time match up much more clearly. But actually, it tends to be very short term. It's a very quick boost. It also depends a little bit on whether England win and continue going on. The further they go, the better it is for pubs. But generally, this is a pretty fleeting boost for the pub sector. But even so, it's a pub sector that's been beaten down quite a bit, so it may well help.
Win or loss, Anna's concerned about productivity.
On Monday.
On Monday.
Yeah.
I mean, is that a real...
Yeah,
is that a real concern?
No, it is. It is. You do see, again, like they're very fleeting, but you do see little patterns, in the economic data where you get a little bit of a loss of productivity either way. Whether it doesn't really matter what hours it's in either, because very, very often.
Are you going to get up at 1 a.m. to watch the game, Sam?
Well, look, Tom. I mean, I'm off next week, so I am considering the logistics of how I would do that.
Really.
That's it. Everyone is considering, aren't they? Let's see which side of this fence everyone falls down. I don't know where. Keir Starmer's excited about people going to the pubs. Don't know where Andy Burnham's going to be watching the game. But thinking about Andy Burnham and what he means for the UK economy, we haven't heard much about his key appointments, but we've heard a bit about where there might be some wiggle room on tax.
Yeah.
So, yeah, I'm here to take the fun out of this conversation, clearly, because I've been talking about productivity on Monday and now talking about this. But, I mean, is this a story that is attaching itself to UK assets just yet?
Well, to an extent. So Andy Burnham has floated this idea about around business rates. Now, business rates have been sort of pilloried by the bricks and mortar community here for 15 years.
And by every government. They talk about how they'll reform them.
Yep, and they did begin doing that in the 2024 budget. Nothing has really come of that as yet, and obviously now we have a change of government, so we'll see what happens there. But this is reforming business rates or cutting business rates for pubs and high streets, and then taxing more on warehouses. So particularly, he's sort of mentioning logistics warehouses. But it kind of illustrates the trade-off that has to happen here, because he's also when you're talking about warehouses, logistics warehouses are not really the ones being built now, it's data centers. And so if that's going to happen, if there's going to be a change in the way that those are treated, beyond the business rates environment, it sort of raises this question of, the investability is when you've got this huge amount of AI money coming in. That's not, but it's worth mentioning, he's not the Prime Minister yet, and these things are all very much speculation. So at the moment, we don't quite know, but it does just illustrate how much you're going to have to take from one place and give it to another.
Sam Unstead, co-editor of our Markets Today blog.
On a Friday.
Enjoy your weekend and your week off as well. No doubt Taylor Swift's part of your weekend.
That's where he's going.
Plans. That's where it's off to secretly. He did get the invite.
Yeah.
We're heading into the weekend, of course. If you hadn't noticed, be sure to catch up on the Bloomberg Weekend newsletter. We bring you a collection of interviews, ideas and stories that explore the fascinating places where finance, life and culture meet.
The Taylor Swift wedding, perhaps. That is it for the opening trade. The Pulse is up next. I'll be here with the Pulse from London. Francine is in Aix-en-Provence, so she'll be bringing us some key interviews there as well. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative. Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI. That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Stocks rebound after 2 days of a tech-led sell-off as traders trim bets on Fed rate hikes after a weak U.S. jobs report. Bloomberg understands that President Trump and his allies are renewing a push to reshape the Federal Reserve, with the governor, Lisa Cook, still a target. Also coming up.
We're live at the Rencontre Économique of Aix-en-Provence in the south of France. We'll be speaking to policymakers and politicians to see the path ahead.
Let's have a look at where we are on these assets for you this morning at 9 o'clock then here in London, without the United States today because it is a holiday in lieu of July the 4th. But that said, NASDAQ futures are interesting. They are up by 1%, as you can see, even though they're not trading today. But we have European equity markets, we'll show you those in a moment, which are getting some modest gains. Dollar yen, interesting, really interesting. Yen weakness in the last couple of sessions, 160.81, partly data driven. Is it driven by intervention? Gold in focus, and Brent crude at 71.81, pretty flat. Actually, let's have a look at the European equity market map. The European map then showing you that we've got these modest gains across European stocks. The CAC 40 is pretty flat. The DAX is getting the best of the gains, up by 0.4%. So let's get things started.
Newsmakers and market movers. This is The Pulse.
Good morning. Welcome to The Pulse. I'm Anna Edwards in London. Francine Lacroix is with us in Aix-en-Provence, as we just saw. More from Francine on the ground in a moment. Let's get back to the big macro story of, well, the week, arguably. U.S. hiring has slowed sharply in the month of June, even as the unemployment rate fell, curbing some of the momentum in the jobs growth this year. The Trump administration, however, is remaining positive about the overall performance of the U.S. economy.
So I think this is a really strong, healthy job market, and that this was a little bit on the other side of expectation, but the trend over 3 or 4 months is consistent with our view that, again, that we were growing about 3% and that we're going to have a better second half of the year as those factories turn on the lights.
Let's bring in Bloomberg Markets Today editor Morwenna Coniam to give us the market's perspective on this. Good morning to you, Morwenna. So we've got the positive sort of political spin, I suppose, from Kevin Hassett there. How are markets seeing these numbers? The big thing seemed to be a pushing out of expectations around the Fed, and it was positive for risk assets.
Absolutely. We saw a rally in treasuries with yields coming down, particularly at the shorter end of the curve, which is more sensitive to rate hikes. What we really saw was a paring back of bets on when a Fed rate hike would happen. There is still one expected this year, but that's now looking potentially not until December compared to October. And in terms of the actual next meeting, which is this month, we're only seeing about a 20% chance now, down from about a 30% chance of a hike. So there was quite a significant shift, and it was a shorter day for treasuries yesterday. So that does also potentially, skew, I think, the reaction. We saw the dollar weakening, and that's still the case today as well.
Yeah, and thinking about what it means to the Fed then, so there's that pushing out of expectations around a Fed hike. Is this a challenge for Kevin Warsh, or this is actually maybe what he wants to see? He doesn't want to see an overheating labour market. He doesn't want to see that pushing up inflation any further, perhaps.
No, it's definitely quite reassuring, because the concern had been that things were heating up too fast. I think oil prices also do play quite a significant part in this. They've really eased off and that's reduced the inflationary pressure. That makes it a lot easier to justify not hiking, which I think with all the political pressure on the Fed as well from Donald Trump at the moment, that is probably quite advantageous. I think it makes it easier to say that the economy is growing, but steadily, that there's nothing we need to do here, and I think that probably makes it easier for him. It was overall quite a good report for him, if not necessarily for the labour market, particularly younger people in certain pockets where we did see an actual slowdown.
Okay, Morwenna, thank you very much. Bloomberg Markets Today editor Morwenna Coniam on the data picture out of the US. Sticking with newsflow stateside, Bloomberg understands that the US President Donald Trump and his allies are renewing a push to reshape the Federal Reserve. Top officials have been actively exploring ways to remove Fed governors to clear the way for the president's own picks. The Supreme Court recently blocked an attempt to fire Governor Lisa Cook, but she is still apparently a target.
Get her off.
How would you do it at this point?
By winning the case. They send it back, not based on the merits, they send it back on process and procedure. So we'll start the process, and we'll do perfect process and perfect procedure.
We're joined now by Bloomberg's chief Asia correspondent here in London, though, Ros Matheson, and keeping an eye across all of this global news flow. Ros, good morning to you. So what is driving President Trump's efforts here? He's wanted to reshape the Fed. He's got a new Fed chairman in the shape of Kevin Warsh, but he seems to think his job is not yet done, despite what we heard from the Supreme Court this week.
Well, that's right. And we also know that Donald Trump doesn't always like to let certain things go. And he's certainly got a particular view when it comes to Lisa Cook and also to Jerome Powell, who he believes should be vacating the Fed entirely. And he does still want to reshape the Fed further. He wants to look for further opportunities, further vacancies to potentially look to install or try and install people who he feel might be more amenable to his view about where interest rates need to be. And again, as we're just hearing, like he wants those lower, lower, lower all the time, despite whatever the economy or inflation is saying. So he still wants to find a way to try and get rid of Lisa Cook. He says he's going to look for different avenues to do that. The reality is whatever happens is still going to run into those legal challenges. It's going to get bound up in the courts again. But he's looking for any way to continue to build the Fed into what he wants it to be. And that's really about looking for ways to remove people he thinks might be roadblocks to that.
Yes, and putting his own people in. So do we have any understanding, Ros, yet of who the people are, the types of candidates who might be successful in getting these jobs at the Fed if and when they become available? I think I was reading the Treasury Secretary might be scouring for candidates.
Well, that's right. The opportunity here is at the Atlanta Fed, so one of the regional Fed jobs, and who's going to be installed there. Of course, in theory, the regional Fed presidents are appointed by their local board of directors with sign-off from the Fed board, so they're a bit removed from that centralized process. But obviously, we could see that the nominations for that, the candidates, were being interviewed at pace until about May, and then things slowed down. So now Kevin Warsh has come in, and it's going to restart. So perhaps with his his careful eye on who they might be looking at. We know they've interviewed a ton of candidates for it. Rebecca Patterson from the Council of Foreign Relations, for example, Michael Summerlin, who was an advisor on the economy under the Bush administration. We know from our own reporting there's a sense they want someone with a corporate background, someone who comes from business. Perhaps they think they might have a more amenable view again about where interest rates need to be. But obviously what they've done is they've slowed it down to allow Kevin Walsh to come in. Now he's in, he's going to be keeping a particular eye on this, obviously, in terms of who might be suitable.
Okay, Ros, thanks very much. Bloomberg's Rosalind Matheson with the latest on the reshaping of the Fed. Let's put all of this together and think about where we are on global stocks. Stocks rebounding after the sell-off this week. That's the story of the moment, the story of today. We're joined now by Koku Agbublua, who is the Global Head of Economics, Cross-Asset and Quant Research at SocGen CIB. Nice to speak to you, Koku. Very good to have you on the programme. So I wonder where this leaves us this week, what we've learned in terms of the stocks picture heading into the second half of the year. Do we feel a bit more positive about it after pushing out expectations of rate hikes, or is that not material to your view? What have you learned this week?
I think this week has shown how resilient the market has been. And if you look at the Kalecki equation, it says corporate profits is equal to budget deficit, business investment, plus net export minus household savings. All of these are essentially pointing to the right direction in the U.S. You have the OBA, the One Big Beautiful Bill, etc., the CapEx investment on AI, etc. So they are pointing out to a pretty an interesting boom, not of prices, but of earnings and profit margins. And I think the market is simply catching up to this incredible alignment of stars in the U.S. equity market.
And you think that is still the story out of the U.S.? Because we've been watching how hyperscalers have underperformed other stocks. Certainly, it's become a more global narrative, hasn't it? Where the gains of AI will be accumulated. You just have to look at the gains that we've seen on memory companies in South Korea to see that. But you still then are positive about the tech story in the US.
Absolutely. I think the AI theme is broadening. So if you think about the numbers, you have $800 billion being invested in CapEx to build data centers. But if you have to think in terms of the global TAM, so the total addressable market for AI. So some quick estimate, rule of thumb numbers, the global GDP is around $120 trillion. Total labor income share of GDP is roughly 50%. So that's $60 trillion. And if you think about jobs that AI can disrupt, so this is knowledge workers, is 30% of that 60 trillion. So $18 trillion. So let's assume AI has 10% market share. That would be $1.8 trillion to be compared with the 800 billion. So US companies have had a long time where they were doing share buybacks and dividends, etc., not doing any CapEx. And now they're going through a process where the return on invested capital of this CapEx is higher than their cost of capital, and the market is assuming that will pay off in the next couple of years. And you can already see that. Look at agentic AI being more token intensive, etc., etc.
Okay, so we can tell a positive story about how AI is going to boost productivity. Maybe it takes out some jobs, but if it takes out as many jobs as you just suggested, Koku, where does that leave an economy that is very consumer driven?
Yeah, so I think Paul Tudor Jones has made this point that I find pretty interesting, is that no man is better than a machine, but no machine is better than a man with a machine. So I think the opportunity for increasing productivity through reskilling people, and you see that with any sort of industrial revolution, the ability to do more, and also looking at other use cases, so robotics, autonomous vehicles, etc., etc. So I think I'm more optimistic on the ability of the labor force to reskill itself. And let's not forget one thing. There's a risk if you take the human out of the loop of compliance, legal, regulation elements, and ultimately having the human in the loop is something that will make sure AI is used productively at sort of societal level.
Okay, I was devastated for a moment. I feel much better now. Koku, thank you very much for that. So let's go back to the broadening story. There are lots of ways you can think about broadening or rotation. You can think about the AI trade broadening and rotating into other parts of AI, or you can think about broadening market gains in completely different sectors. But still there might be an AI dimension, like healthcare, for example, areas where Europe can do pretty well. So how do you think about the broadening broadening benefits beyond the sort of initial first mover gainers?
I think the broadening benefit is essentially being expanded industrials, the material sectors, energy, for example. The renewable angle is also something that is booming in the sense after what we've gone through with the Strait of Hormuz. I sort of think that this is, if you look at small caps outperforming large caps, you see that phenomenon. Europe is also a great opportunity given all the need to invest in its autonomy. If you look at the Letta and the Draghi report, these are mega trends that are not going to stop in the short term. So, I mean, to sort of conclude, you could think of the quote by the great philosopher Rocky Balboa, who said, it's not about how hard you hit, it's about how hard you can get hit, but keep moving forward. And this pretty much is the lesson of risk assets over the past sort of 2 years, from the tariff debacle to the Iran situation, and yet we're still powering forward.
Is there a boxing metaphor in investing? You have to be light on your feet, I suppose, right now. Is that important?
Absolutely. This is the Muhammad Ali angle, so float like a butterfly and sting like a bee. But my favorite one is Mike Tyson. Everyone has a plan until they get punched in the face.
Yeah, that seems really appropriate right now. There are so many plans being punched in the face by AI and the fast developments that we are seeing there. So all of that sounds like there's lots of opportunity in it, Kokou, for investing, and you've been through some of those. Are we going into a higher interest rate environment, a higher inflation environment, and does that threaten to undermine any of the exciting investments of the future that you might be thinking of?
Yeah, so I think growth is diverging across countries, but there's a common theme around inflation that is sort of uniting all of the central banks. So you could see the ECB raising interest rates. The probability of a second hike by the ECB in September is down to 40%. The US was close to 50%, now it's down to 40%, because there was this argument that Kevin Walsh made that AI could sort of reduce wage inflation, but it is inflationary in the short term. So I think inflation is clearly above the central bank target, and I think it will ultimately depend on the situation in Iran with the US.
Yeah.
The metaphor I like to use here quickly is the three-body problem, which is a problem in physics. So you had two planets orbiting against each other. You have a perfect predictability. If you have three planets with gravitational pull, it is called deterministic chaos. It's unpredictable. So this is a metaphor for US, Iran, and Israel with the Lebanon situation, etc. So within the next 60 days, we'll have to see if they find an agreement on uranium or the toll fees on the Strait, and whether we have the risk on the Strait of Bab el-Mandeb, which is at the bottom of the Red Sea with the Houthis in Yemen, etc. So the situation remains highly unpredictable.
It does, and that's one area of potential volatility. I mean, I guess I was asking about inflation because I was also thinking about an increasingly regionalized world.
Yep.
Is that also part of the AI narrative, or just the global paradigm that we're in right now?
That's a very good point, because there's a sovereignty element on data centers for countries. So Europe has to have its plan. Asia is going very fast. The US, obviously. So I think if we get more deglobalization, then you lose the sort of economies of scale that globalization has brought so far. So this is clearly one of the risks, and we'll have to see how central bank respond to that.
Okay, Kokou, thank you so much. Really thought-provoking stuff for a Friday. Kokou Agbubloa from SocGen, Global Head of Economics Cross-Asset and Quant Research. Coming up on the programme, Philippe Aghion will be with us, who won the Nobel Prize for Economics for his work on creative destruction. Wondering if he's just listening to that conversation. We will discuss the future risks to global growth with him next. This is Bloomberg.
Your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Technology
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
This is The Pulse. I'm Anna Edwards in London. Francine Lacroix is on the road. Let's get to her in a moment. She's thinking about the ECB because fresh from their difference of opinion on future rate hikes at the ECB symposium, central bankers and policymakers are in France and they're gathering at Aix-en-Provence, the economic forum that takes place there. Francine is amongst them and she's back with us now with the guest. Francine.
Anna, thank you so much. We are here at Aix-en-Provence for the Rencontre Économique, and I'm delighted to be joined by Philippe Aghion. Of course, he is a Nobel Prize-winning economist. Mr. Aghion, thank you for joining us. As
Very
always,
nice to
now
meet
we're going
you.
to talk about tech, we're going to talk AI, but actually, what do you see symptomatic as a concern for Europe? We worry about inflation, but actually what happened with the Strait of Hormuz has limited inflation, or it's coming down.
Yeah, of course. I never thought that Hormuz would trigger the equivalent of the global financial crisis. I knew that it would induce a small increase in inflation and a growth slowdown and a slowdown. And that's what it did. I mean, of course, when the price of oil goes up because you have the Hormuz crisis, of course, it means that the production costs go up. And production costs going up, of course, price go up. I mean, that induces inflation automatically. And it induces also a reduction in growth because both on the supply side, the input costs increase, right. And of course, and you don't get as much oil as you need, and therefore production is somehow disrupted, and also people have to spend more on gasoline and petrol and less on other things, and so so that of course that depresses the demand, and right. Those forces concur to reduce growth a little bit. But I never thought it would go beyond 1% increase in inflation or 2% and a 1% decrease in growth rate. You see what I mean? And that's exactly what happened. And now that you had some kind of an agreement, even if it's not a true complete agreement, inflation will go down and growth will slightly resume.
Monsieur Aghion, talk to me a little bit about AI and tech. This is what you're known for. Are you worried that actually it will reshape our economies, especially in Europe? What does it mean for productivity and jobs?
Alors first, you have Europe. It's clear that after a period of catching up between 1945 and 1985, per capita GDP of Europe was catching up partly with US per capita GDP. But then since the late 1980s, again, Europe is losing to the US. Because the US, they went into high tech, they went into the biotech and the IT revolutions, and Europe failed to enter those revolutions. We remain stuck in mid-tech incremental innovation, and that's why we lost to the US. Okay, but
Can we catch up?
And AI is an opportunity for Europe to resume growing faster. You see what I mean? But we need growth. AI has a high growth potential because it's easier to produce goods and services. It's easier to produce new ideas with AI. And now that we need to harness this power. So we need a true industrial policy in Europe. Europe has, in the name of competition policy, Europe has precluded industrial policy. We need to go really fully in industrial policy, defense, AI.
But Europe doesn't have the hyperscalers. Europe doesn't have the LLM models. So how can Europe actually harness the AI compared to the US that seems to have everything?
Well, I will tell you what we have. I mean, Europe, first, we have a lot of savings. You know that there's much less saving in the US. We need to make sure that European savings are invested in large part in Europe, okay? We have talents. We have very good mathematicians, researchers, a lot of breakthrough innovations worldwide, cite European research. We have cheap energy. That's very important. In France, we have, nuclear energy. That's great. And we have very cheap energy. So we have values. We carry democracy and freedom more than the US, and we have a better social model. AI will mean job creation and job destruction. You need a good flex security system to accommodate that. In Denmark, when you lose your job, for 2 years you get 90% of your salary. The state restrains you and helps you find a new job. We are much closer. We are in Denmark, but other European countries who are closer to Denmark than the US is. And so we have a social model as well that will better accommodate the job creation and job destruction induced by AI.
Monsieur Aguillon, you've been, of course, one of the closest advisors to Emmanuel Macron as president over the last 10 years. We're looking at French election in April of next year. What do the French people want when it comes to fiscal and also taxes?
Now, what the French want, I will tell you what they want. They want to make sure they are part of the process. They know we face challenges. The AI, the new geopolitics, the value chains are being reshaped, the resilience becoming the driving force of value chains now worldwide. They know that they have to face this challenge, but they want to make sure that it will be all together, that nobody will be left out. So you need a new De Gaulle. You need someone who will say, look, education, no matter your social origin, you will get good education, good health. If you lose your job, we are there to help you, retrain you, help you find a new job. We need industrial policy. We need sovereignty. And that's the Gaullian agenda. We need a new De Gaulle.
But who is that? Who is that person?
Yesterday, the Prime Minister spoke like a new De Gaulle.
You believe that?
That's what other people see. I can't say he's the only one, but yesterday was a very important moment. Yeah. He never said he would be a candidate, but he spoke like a new De Gaulle.
Monsieur Aguillon, can you actually, have growth and think about growth differently with all of the policies and all of the investment in education, whilst at the same time actually sticking to the rules that the EU has set?
I will tell you, the EU has to change its economic doctrine. We used to say, well, deficit should not go beyond 3% of GDP, putting in the same basket pensions spending and investment in growth. We can no longer do that. We have to adapt to have new way to implement the Maastricht Treaty. Second, in the name of competition policy, we precluded industrial policy, sectoral state aid. We have to stop that. We need DARPA. We need the equivalent of the American Defense Advanced Project Agency in Europe. And we need to have an industrial policy which is in line with competition policy. We can reconcile the two. And three, we need the savings. We need to make sure that they will be invested in Europe. We need more venture capital, more institutional investment, and more long-term funding of research, of basic research. Those things we need. And that gets you to Draghi, to Letta, and to the Bocconi report.
Are we closer to, very quickly, are we closer to actually putting some of the things that they put in their reports?
I will tell you something. I don't know if it will be done. Well, there is the 28th regime, all the discussion on the 28th regime, which is, I think, very positive. Anybody wants to do a new kind of unicorn can benefit from a regime which is the 28th regime, not go through all 27 regulations, country. And then the other thing is that I believe that a lot will happen with coalition of the willing. You will have countries that are leading the game. France has to be among the leaders. I can see Germany, I can see the UK, because the UK wants to get back to us. Maybe Sweden, maybe Italy, I hope. But it has to be a coalition of the willing, to have joint DARPAs, to have joint institutional investors, to have joint markets for high-tech, to give more to the European Research Council so that the European Research Council can fund labs, not only individuals. And that I think we can do. I'm very optimistic.
Philippe Aguillon, thank you so much for your time today. That is it for now from Aix-en-Provence. Anna will be back. And of course, we're speaking to the Veolia chief executive. And then we have the big exclusive interview with the new Banque de France governor.
Francine, thank you. Francine Lacroix there with the Nobel Prize-winning economist Philippe Arion. As she says, she will be back shortly. She'll be speaking to the Banque de France governor, also speaking to the CEO of the French utility Veolia. I see utility stocks, the best-performing sector in Europe today, as European stocks make modest gains, up by 0.3% on the stock 600. We'll be back with more from Aix-en-Provence shortly. This is Bloomberg.
We are dealing with supply issues, and so therefore fertilizer, the planting season, food security is high up there, but so too is fuel and energy. So yet again, as we had with Ukraine, the energy crisis, the food crisis, the cost of living, and that kind of fiscal space needs to be created for countries that are going to be dealing with the debt crisis. They are still repaying their debts. Inflation will result in interest rates that will put many countries in jeopardy on the debt issue. So we're looking to find solutions here from the IMF, from the World Bank. There have been many offers of the windows and facilities that could be put at the disposal of countries. But I think at this stage we need scale. Many countries are still recovering from the previous shocks, and some of those crises are not over yet.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
Good morning. Welcome to The Pulse. Welcome back to The Pulse. I'm Anna Edwards in London, and these are your top stories. Stocks rebound after 2 days of a tech-led sell-off as traders trim bets on Fed rate hikes after a weak U.S. jobs report. Bloomberg understands that President Trump and his allies are renewing a push to reshape the Federal Reserve, with Governor Lisa Cook still a target. And Bloomberg learns that some European countries have accepted that ships transiting the Strait of Hormuz will now have to pay fees to Iran and Oman. Now, the French Finance Minister, Roland Lescure, has told Bloomberg that he will push for a finance bill for next year that brings a further improvement in the French public finances. He was speaking at the Aix-en-Provence Forum with Bloomberg's Caroline Conan.
We must have a budget, because the alternative is not really a go. If we don't have a budget, we have what we call a special law, which more or less freezes the budget compared with last year. That means that spontaneously the deficit is going to increase, and spontaneously we're not going to be able to put more things in action, more policies that are going to be pro-growth or pro-business. So, yeah, it's not an option. We have a hung parliament, as you know, 11 different political groups, so we have to convince a majority to vote it. I think that reason will prevail. I know that some of those guys see themselves as a president. I don't think they want to inherit a situation that would really lead them to waste their first year. They probably want to be efficient. They probably want to be able to correct the budget if they don't like it. So the most likely, I hope, scenario is we have a budget, it's not perfect, but we've managed to vote it, and then debate can happen for the big election.
But we've seen obviously what happened to the former Prime Minister the past couple of years, Michel Barnier, François Bayrou, both ousted because of the budget. Are we going to see a similar situation? Can you actually cut the deficit at the moment, given we still have a fragmented parliament?
Well, we did. We did last year. As you know, we were 5.8 in 24, 5.1 in 25. This year is more difficult because we've had a crisis. Hopefully it's over. But the Iran crisis had a big impact on growth, on inflation, and very likely on public finance. We're having a big meeting next Tuesday. We call it the Alert Committee with all the stakeholders, so parliamentarians, trade unions, company representatives, also the representative from local authorities to discuss this. We want to assess the state of the economy, assess the dynamic of public finance, and hopefully commit everyone to making the efforts we need to do to keep public finance under control.
So what's your target for deficit cuts next year? Because this year obviously targets 5%. Are we going to reach that? And next year, what is the target?
So we're going to do everything we can to reach, or to be as close as possible to 5%. We're still in the midst of assessing the impact of the crisis. There's lots of uncertainty. I think the third quarter is going to be key. As you know, inflation has receded in France and elsewhere in Europe. You know, this is the time for recovery. And I hope that households, companies, everyone's going to just get together to make sure we have growth. And if we do have growth, hopefully we'll have a better outcome on public finance. But it's still very uncertain. I want 5%, and I hope we will reach 5%.
For next year?
For this year. And I want to make sure that next year we have a budget that brings us below 5%. This is still in the air. We have to work on our budget. This is the work of this summer. We're going to present it by September. But this is what I'd like to have, and this is what I hope we're going to have.
The French Finance Minister there, Roland Lescure, with his hopes for the French economy. Let's stick with the coverage from Aix-en-Provence, where Francine Lacroix is standing by again with another guest. Francine.
Thank you so much, and I'm delighted to be joined by the Chief Executive Officer of Veolia, Estelle Brachlianoff. Thank you so much for joining us. Look, I mean, there's a lot to talk about: inflation, energy. I also want to talk about biomethane. But if we start with the record heat wave that we've seen across Europe, what does it mean for your company?
I guess, you know, this is quite striking that probably today the temperature in London is higher than what we have in Aix-en-Provence, which means that, you know, the entirety of Europe is realizing that climate change is happening, and it's not just something in the future. We live it in our blood, unfortunately, and in our flesh. So which means that the big debate is not only about how do we fight against climate change, but as well how do we adapt to climate change. And adaptation to climate change, there is a very quick jump into water, because this is the first consequence of climate change. It's on water. Drought followed by floodings at times, you know, extreme events, and that's exactly why we have to cherish water. And probably one day we can get rid of oil, but probably not of water.
But when you look at water and actually water demand for Veolia, do you see that increasing significantly already in the next couple of quarters, or will it take longer?
Oh, it's very immediate, you know, when you have a big, you know, like heat wave, you know, people consume more water, but it's the same for agriculture, irrigation, for instance, and same for industries in the same time. That's why what we do is try to avoid as much as possible to have to limit and restrict the usage of water. And that's why cherish water, it means what? It means avoiding wasting water, and finding new sources of water, regenerating it, recycling wastewater, for instance. So we have a series of solutions we can develop. They are ready. We know it works. We've learned them from the south of Europe, and now the northern part of Europe is learning how to live with those heat waves and adapt to climate change.
Talk to me a little bit about inflation, because we've seen this, of course, massive war between the U.S. and Iran that led to inflation going up because of the price of energy. Does that complicate your life a lot?
front. So I would start with making the link between your first question and the second one, if I may. The Strait of Hormuz and war in Iran. The first thing is, we are very present in the Middle East, in particular because we are the leader worldwide of desalination technology. So we operate a lot of plants in the Middle East, and they are a critical resource in the Middle East, where up to 90% of the water comes from desalination, seawater desalination. So they are protected with Patriot missile around them. So we have to visualize it. This is not abstract. Water is absolutely a critical resource. And it is the same in Europe, but of course in the Middle East it's an obvious one. When it comes to inflation, Veolia is very protected because we are, one, a multi-local company, so we are present in the Middle East, but in 45 countries. And two, our contracts are very well, indexed. So the higher the cost base, at one point we're reflecting back into the cost we charge to our customers.
It's going to be a big 12 months for France going forward because of the presidential elections.
I thought you were talking about football. Sorry.
I mean, football, yes, and most of us are behind France, although I shouldn't say because I'll get the wrath of many, many other guests. But when you look at a lot of the presidential candidates that are here actually in INEX, what do French companies need?
The first thing is some type of stability and vision, which is what all companies need to invest in France and in other countries. Then invest in the future, so invest in infrastructure to make our country more resilient, to make our country even less dependent from importing things. That's why, to be able to recycle water, to be able to recycle strategic minerals, to be able to find new sources of energy locally as opposed to importing fossil fuel, all that contributes to strategic autonomy. So I guess I would have a wish for the presidential election that securing critical needs is in the agenda of the various candidates, because it's absolutely critical for the country to thrive, for the economy to be competitive, and even for the defense in a broader sense.
Yeah, how much do you worry about deficits?
Deficit, of course, is a big subject, and it should be. But I would distinguish between the debt, which is here to pay, in a way, operating costs, as you would say it in a company, which will be social expenses, versus the debt, which will be here to invest in the future of the country, in education, in critical infrastructure, like I said. And I guess, we should have a different type of approach of the two types of debts, because, one will bring wealth and competitiveness over the long term, and it's absolutely critical we invest in that as well as in innovation and AI, for instance.
But do you think this is one of the main pillars that actually will decide the next French election, or will it all be immigration and other matters, more social matters?
I guess I was told one day by non-French people, you French are only about politics, never about the economy. And usually we have some type of striking back to, yes, the economy is stupid. I don't know if France is like that, but there will be probably a lot of debate about the economy, the debt. But in my opinion, it should be a lot about where do we invest, as opposed to only how much we invest and how much can we afford it. Where do we invest? Again, to secure the future of the country.
Talk to me a little bit about biomethane. So this is one of the big hopeful things that actually France and other countries should get in, but it's not viable without government subsidies.
This is a very good example. When I say strategic autonomy and securing critical resources, energy, we don't have any, oil and gas in France. So we import, in particular, some fossil fuel, but there is a lot we can replace by local source of energy. Biomethane that we produce out of waste and wastewater is one, and a lot of bioenergy which can locally be sourced. Right. This is a reservoir which is largely untapped, not only in France but in Europe. At the European scale, it's 400 gigawatts. 400 gigawatts, just to give you an idea, it's 400 nuclear tranches, so it's massive. And it's a third of the import which we could replace by this type of energy. So what does it need to be happening? We need a clear vision at the country level of, we want to develop, say, 10, 20% of biomethane in that case in the next 5 or 10 years, and have a stable vision over the various governments which can change, and a little bit of subsidies, but it's more a signal, political signal, which will be stable over the time than only public money. Usually you can go without public money if you have a stable signal economical signal, a price one, which is stable.
But are you confident that this is that direction will be taken?
I'm a fighter and optimistic at the same time. I'm not an optimistic by definition, so I always fight for what I believe should be, like the priorities.
Thank you so much for joining us today. That was, of course, Estelle Brachlianoff, the Chief Executive Officer of Veolia. With that, Anna, I'm going to send it back to you. In London, it definitely has a bit of an economic festival vibe here in Aix.
Yes, I guess that's, Friday in the sun. Francine, thank you very much. Francine Lacroix there with the Veolia CEO, and they were talking there about energy prices, which takes us on to the next conversation very nicely. Bloomberg has learned that some leading European powers now accept that ships transiting the Strait of Hormuz will have to pay fees to Iran and to Oman. The US and Gulf Arab countries continue to insist that Iran and Oman cannot impose charges of any kind for the Hormuz Strait. Let's get now to our Bloomberg Horizons Middle East and Africa anchor, Abir Abu Omar, who's got the latest news flow on this subject. Abir, good morning. So why do some countries think that fees are inevitable? Why is the European contingent kind of coalescing around that view?
Good morning, Anna. Yeah, I mean, they seem to have fallen in line with what Iran has been saying over the past couple of months or so. Iran has been adamant on establishing these tolls once the 60-day period of negotiations with the United States is over. And so these countries behind closed doors, this is a Bloomberg scoop from yesterday, suggesting that countries in the EU, but also Gulf Arab countries in the region, have kind of succumbed to the fact that this will be the new reality, the new paradigm of the Strait of Hormuz is going to be tolls established once the negotiations are over. What we know from our sources is that countries in the EU, or some countries in the EU, are at least telling the Omanis and the Iranians to not discriminate against ships based on their nationality. Gulf Arab countries and the leaders there in public are opposed to this toll or this system that will start charging ships. But behind closed doors, they also are discussing this new mechanism that will probably see charges coming out of their ships and tankers. And you could really see countries in the region, the richest ones in the region and the biggest oil exporters, Anna, Saudi Arabia, the United Arab Emirates, doubling down on other shipping routes. That includes the Red Sea for Saudi Arabia, that includes the port of Fujairah up north for the United Arab Emirates. And it really just goes to show that Iran has said over the past few months, again, that it will toll the Strait of Hormuz, that it wants to do it with Oman. But if Oman does not agree to the terms that Iran sets out, then Iran said that it is going to do it with or without the blessing of the Omanis. The U.S. obviously, on the other hand, says that it is completely unacceptable to toll the Strait of Hormuz. But we haven't seen a lot of pushback beyond that from Secretary of State Marco Rubio, Anna.
Okay, we'll see if we get that then. Abir, thank you very much. Bloomberg's Abir Abu Omar in Dubai. Now, President Trump has said that he will, quote, handle Cuba after Iran. Washington has maintained a blockade on Cuba since the strikes, but the campaign has been ramped up under President Trump, with the island nation suffering widespread shortages of fuel, food and medicine. Bloomberg Originals has been looking at whether Cuba's authoritarian government will bend to Donald Trump's will.
What's coming next for Cuba? Capture and kill is still an option?
I just can't tell you that. We've got options all over the map.
Perhaps no other nation epitomizes Cold War politics more than Cuba.
When you look for a country that's, let's say, punched above its weight on a global stage, Cuba should be on the list.
Cuba and the United States, by default of their geography, have always had some kind of economic relationship. When we had prohibition in the United States, Cuba became a haven for American tourists.
Cuba is just 90 miles south of Florida. It's in the heart of the Caribbean. It's been seen as kind of a strategic platform for U.S. rivals.
The U.S. has had a broad trade embargo on Cuba since shortly after the revolution in the 1960s.
Cuba is ruled by a single party, the Cuban Communist Party, and it controls the legislature, controls the military, controls all facets of society.
Socialismo o muerte. But the socialist idealism that birthed Cuba has ground to a halt, literally running out of gas.
There is a dire jet fuel shortage in Cuba as the U.S. is moving to cut off the country's oil supply.
Crippling blackouts and a teetering economy have
have sparked unrest on the island.
We have an unprecedented degree of suffering on the island.
The Trump administration has taken a hard line.
Cuba has always posed a national security threat.
Tonight, the Justice Department unsealing an indictment against former Cuban President Raul Castro.
Will Castro actually face this prosecution?
The message the indictment sends to the Cuban government is that the U.S. is serious.
Amid the upheaval, many are looking for change, and some see opportunity.
Realmente me gustaría que Cuba pudiera realizarse.
2 million plus Cubans that live abroad. They have a genuine desire to see their country prosper and the people prosper and move forward into a different direction.
Some highlights there of a documentary. Subscribers can watch that full documentary right now on the Bloomberg terminal or Bloomberg.com. Coming up on the program, how the Ukraine war is hurting Russia's space ambitions. We will have more on today's Big Take story next. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
This is the Pulse. I'm Anna Edwards here in London. Let us talk once again about private credit. Private credit funds are facing a relentless wave of investor withdrawal requests, forcing managers to trap over $14.5 billion of capital to protect their portfolios. For more, we're joined now by Neil Callanan, who leads our private companies coverage here at Bloomberg. So to bring us up to speed with what is the latest then here, Neil, we've got these private credit funds facing, this is now the second quarter of demands for their money back from investors in these private credit funds, and they're trying to hold the line. So what's the latest on this story in the second quarter?
Yeah, it's more of the same, really. Managers had done a great job in the last few years of asset gathering. They had convinced people that it was a great time to allocate money to private credit through these BDCs. And what we're finding is a lot of that money is hot money. It's not money that's used to being in products like this. And it's seeing the headlines about AI and what's going to happen with software and panicking and trying to pull money. And that's a continuation of what happened in the first quarter. But it now looks like, similar to what happened post-Brexit with property funds in the UK, that this is going to be a 2-year story at this stage in order for people to make those redemption requests and meet them over time.
Okay, so you've got these big redemption requests coming in, and then as a result, you see gating and companies say, no, you can't have all that back. It's going to take 2 years, not just 1 quarter, to return all this money if that's what you... So that's the latest thinking. So are there funds then, private credit funds, that are handling this better than others? The ones who are maybe not facing such high redemption requests, not having to gate the funds? Where's the outperformance?
Yeah, we're really going to start to see manager differentiation in terms of the performance now. So the people who went heavily into software, we're going to find out if they made the right decisions on those loans and whether their returns are going to justify the risk they took. Obviously, because these are credit, all the equity has to be wiped out before they start to take losses. So then you're really starting to see how badly things can go within this sector. But at the same time, there are managers who have not had the same level of requests as other managers. So you have the contrast between one of the Blue Owl funds, which is very software focused, where redemptions are at 38%, whereas some of the likes of Oaktree and Goldman Sachs, their funds have fallen below the 5% threshold. And that just shows you that the retail market is not homogenous, that there is big differences between that money. Goldman obviously had a probably more diversified portfolio than many of them. And then Oaktree, its reputation over the years has been that it's a steady investor, and then it does well in periods of dislocation and volatility, like now, and that it's a counter-cyclical investor. So as you would imagine, they seem to be doing better in terms of the redemption requests, at least for now.
And I suppose all of this really hinges on the underlying credits involved here and whether the software sector is going to be eaten up by AI or not. And that's still, there's a lot of different thoughts out there and some differentiation to be done within the sector, perhaps.
Absolutely. What we're seeing is some of the BDCs are having to sell loans to get liquidity, and some of those loans are finding buyers at very good prices comparatively. Slight discounts, but not massive discounts. But the fear around that is that they're selling off the good loans first because there's a market for that, and what's left is going to be worse. And that's why, again, it may take 2 years before we really see the full outflow from this.
Okay, Neil, thank you very much. Thanks for joining us. Neil Cannan, who leads our private companies coverage here at Bloomberg. Now, as mentioned ahead of the break, Russia's efforts to create its own version of Elon Musk's internet satellite network, Starlink, is the subject of today's Big Take story. Some 6 years after SpaceX began launching its network, Russia's first batch of satellites finally went into orbit in March, but by June, one of them had reportedly already failed. President Putin called the initial launch, quote, absolutely insufficient, and soon after, the Russian leader's plans for space possibly suffered another blow, with Ukraine announcing an attack on a space communication center near Moscow. So far, so complicated for the Russian space journey. Let us bring in Bloomberg's Tony Halpin, who leads our Russia coverage and can give us some details on this Big Take story then. Tony, it's a complicated story, an interesting deep dive into the space sector. What are the challenges then facing the director of Russia's space agency? Let's put ourselves in his position.
Yes, I mean, Dmitry Pakhanov is very young for this environment. He's just 40 right now, and he leads an agency which has a history of firsts. During the Soviet period, it was the first satellite in space, the first man in space, the first woman in space. But in recent decades, Russia has fallen far behind, and it's his task really to try and revive those glory years by doing things like emulating Musk in low-orbit satellites, by trying to find ways that Russia can get reusable rockets to launch satellites, and to engage in projects like deep space exploration, which is years behind. But it's a huge challenge. I mean, just as you've noted, the Starlink model that he's following, there are more than 10,000 Starlink satellites in Elon Musk's network, and Russia currently has launched just 16.
Okay, so yes, so perhaps some more political pressure then on those in this sector coming from the Kremlin. How much is Russia's war in Ukraine affecting the space ambitions that Russia has then?
Yes, it's having a huge effect. I mean, quite apart from strikes on infrastructure that you mentioned, the fact that they're even talking about and building a low-orbit satellite network is largely driven by the fact that Russia doesn't have that. It's been piggybacking until recent months on Starlink, and when that network was switched off, its forces on the front line were left severely handicapped, and as a result, they've tried to accelerate this program. They're years behind on things like reusable rockets. That's been important because they've lost an awful lot of customers for whom they used to launch satellites rather cheaply as a result of the war. So they're facing a funding crunch, a technology crunch, and that's made all the more difficult by the kind of isolation that they're experiencing because of the war.
Tony, thanks very much. Thanks for the update. Bloomberg's Tony Halpin with the Big Take story. And you can read the full Big Take story on the Bloomberg terminal. Coming up later from X, we've got an exclusive interview with the new Bank of France governor. That's Emmanuel Moulin. He'll be speaking with Francine Lacqua for his first TV interview since taking office last month. That conversation is at 10:20 a.m. UK time, so in around 25 minutes' time. Let's have a quick, as we bring this hour of programming to a close, let's have a quick look at where we are on the European equity market story. We are entirely flat, giving up some of the earlier gains. Pretty evenly divided between sectors going higher and lower. Utilities, autos and parts, those are sectors going higher, a diverse range of sectors up to the upside today. We do see a bit of underperformance by the French market, down by 0.2%. Up next, Bloomberg Brief. Have a good weekend, everybody. This is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Ahmed, only on Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, succession starts now.
I'm Francine Lacqua, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacqua. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacqua. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Welcome to Bloomberg This Weekend. I'm David Burke.
I'm Lisa Mateo.
And I'm Christina Raffiti. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It is 10 a.m. here in London and 5 a.m. in New York City, where markets are closed for the 4th of July holiday. Good morning. I'm Caroline Hepker. This is Bloomberg Markets. Now for our top stories. The yen showing some strength as traders brace for holiday intervention risk. The currency touched its weakest level in 40 years earlier this week. Worries over the AI trade easing. Stocks rebound after 2 days of tech-led sell-off as traders trim bets on Fed rate hikes after a weak US jobs report. Bloomberg learning that President Donald Trump and his allies are renewing a push to reshape the Federal Reserve, with the governor, Lisa Cook, still a target. Now, Bloomberg's Natalia Krasnovich joins us now for a closer look at the markets this morning. Natalia, great to see you. How has the rotation story moved? Has it actually got more room to run, Natalia?
Yeah, so we do see that we saw a pretty solid sell-off in momentum stocks in the U.S. When I spoke with the sources, they told me that On the one hand, there is no specific catalyst for that sell-off because exposure across momentum stocks got so elevated and stretched, so people are taking some profits off the table. We also, when we look at positioning across hedge funds, we see that some of them are started to sell TMT stocks. They move into cyclical corners of the market. This is also part of this rotation story. Another part of that is outperformance across small cap stocks. This is also in part related to short covering or healthcare M&A. So we see this rotation continuing. But overall, U.S. stocks gained closer to the end of the trading session, especially yesterday, because now traders are trimming back expectations that the Federal Reserve will hike interest rates following that jobs report.
Yeah, absolutely. It was much weaker than we'd expected. Dow Jones, though, ended at a record close yesterday. In terms of the second half of the year, which is what everybody is focused on, do you think that what is the outlook going to be for the second half of the year?
Yeah, so again, when we talk to sources and ask questions about what is the most important part of this equation right now, yes, some people are concerned about higher for longer rates in the U.S. However, fundamentals and corporate earnings is still the #1 story in the U.S. And when we look at what analysts expect for the upcoming earnings season, expectations are still really high. The S&P 500 is expected to post about 23% earnings growth for the second quarter. This is still a really, solid expectation. So again, fundamentally, this is a very bullish sign for the U.S. stock market. And then technically speaking, when we look at positioning across different types of investors, retail traders who have become really one of the biggest driving forces for the U.S. stock market, they are still very bullish. They are very active. When we look at data from Citadel Securities, for example, we see that in May, in June, trading activity was way above historical average. And they also still have a lot of money to deploy because cash balances across U.S. retail traders are very elevated.
Okay, how do you think we're going to be set up for next week? Obviously, today is a holiday, so it's going to be much quieter around the world. It has been already pretty quiet. How do you think we're set up for next week? Again, as we are still really digesting that jobs report that we had out yesterday.
Exactly. So we may see that investors will engage again in tech stocks because we already saw that the options market is telling us that some traders are buying call options on semiconductor stocks, the biggest AI names. So potentially we may see a short-term rally at least, but we have to keep in mind that we are approaching July and August, which can be a slow season, and when volumes are thin, sometimes moves in the stock market can be really, exacerbated, and sometimes people, traders, institutional investors, they trim positions during the summer, like holiday months. So we will see. Maybe we will get some short-term volatility at least.
Well, we're starting with the long weekend now, aren't we? Thank you so much. Bloomberg's Natalia Niadyevich, who is joining us this morning. Thanks a lot. Well, now, for a broader look at the markets, we have with us James Lord. He is the head of FX EM strategy at Morgan Stanley. Really good morning to you, James. Thanks so much for being with us. Look, I think we're on watch for Japanese intervention into the yen markets this morning. Are you expecting that to happen today? There's been a lot of anticipation that maybe it would happen on a US holiday. What's your thinking there?
Yeah, I mean, we don't really forecast intervention per se, but I can very well understand why the market is so focused on this. I mean, it wasn't that long ago where we had the intervention from the Ministry of Finance in Japan. It had a temporary effect. Dollar yen has moved back up. I think up until the news that we had earlier this week that was telling the market that maybe the authorities were having a slightly different approach to their intervention, a bit more uncertainty. Before that point, the market was very much attentive to the kind of tone that was coming out from officials, how there used to be in the past this sort of ladder of escalating rhetoric around intervention, that the more forward the tone was, you could sort of see like when intervention might be more imminent. If they're moving to a different approach where you sort of don't have that same level of guidance, then it becomes much more uncertain about the timing. But clearly, thin markets, as you and Natalia were just talking about, thin liquidity, I can well understand why traders and investors are a little bit attentive to that today. All I could say really about dollar yen and how it should behave around intervention is that if we did see intervention, I think the market would be quite quick to buy dollars back. I mean, at the end of the day, intervention does not change or affect the fundamentals of an exchange rate. Free-floating exchange rates are driven by fundamentals over time. So if the dollar is strong, if there's good US data, if there is strong risk appetite in markets for which the yen is often used as a funder, then I think you would see dollar yen start to drift back up again. So that is increasingly the approach, I think, to buy the dollar back or sell the yen after you see that intervention.
Yeah, we know that Japanese authorities have said that they're not going to telegraph their intervention. At least they have signalled that, haven't they? Okay, Morgan Stanley is among a handful of more sceptical banks, though, when it comes to seeing continued dollar strength. I wonder how that US jobs report affects your thinking about that going forwards, the strength of the US dollar.
Yeah, well, it encourages us that we're on the right track with the view, really. I mean, markets had become quite enamored with the US dollar, good data, fairly hawkish Fed, in the FOMC, and you've seen a lot of dollar buying from a lot of our client base. We have not been chasing the dollar higher because ultimately we don't think the Federal Reserve is going to be hiking rates this year. This is a key call from Morgan Stanley's US economics team that the Fed is going to be on hold this year and even cut rates in the first half of next year, which is much more dovish than the market pricing. So, since the FOMC report, we've had, much lower oil prices. Yes. Chairman Walsh referred to the lower inflation risk that has materialized over the last few weeks in the Sintra panel. And we've had this weakish jobs report. So I think all of that helps us to think that we're on the right track with the Fed call. We've got obviously an important CPI report coming up, the June CPI report ahead of the July FOMC. So that will be a really important piece of data to see the path forward. But we're quite comfortable with our sort of fairly neutral view on the dollar at the moment and looking for an opportunity to sell it, really.
Yeah, we're about 10 days out from that US inflation report, as you say. Emerging market currencies gained against the dollar after that jobs report. What does this new Fed pricing in the markets around fewer hikes to come actually mean for emerging market central banks?
Well, we like EM currencies. From a sort of bottom-up perspective, fundamental perspective, policy credibility perspective, and also from a top-down risk appetite, global growth perspective, both of those two things are helpful for EM. You mentioned EM central banks, and I think a key anchor for the asset class for EM currencies is the growing credibility, I would say, of EM central banks, that you don't have the same sorts of conversations as we used to about tolerating higher than above target inflation that we used to have in some EMs. But now I would say that policy credibility is very strong for EM central banks, and that's really helpful for the asset class.
Okay, what are your top picks then for the second half of the year in emerging market currencies, especially given that if you look at the MSCI Emerging Market Fixed Income Index, actually you've seen it largely wipe out the gains that it had for the first half of the year. So what are your picks for the second half of this year?
Yeah, so fixed income is, obviously yields have gone up, so that's been unhelpful for total returns. Currencies are kind of just about hanging in there, and there have been some very strong performers, particularly in LATAM, particularly in Central Europe, Hungarian forint, Turkish lira. So we like BRL, we like Colombian peso, we like Turkey, and we like Hungary. Those are probably the core markets that we like from an FX perspective. One thing that we've been talking a lot to clients about, though, is whether they should be diversifying the funding mix. Should you just be long these currencies against the US dollar, or given the uncertainty about the Fed cycle, maybe you should just be diversifying and positioning by short the G3. So you could do dollars, euros, yen, diversify the mix. Actually, that improves the carry that you have because funding in euros and yen is cheaper than funding in dollars, and it lowers the volatility profile of your portfolio as well by taking that more diversified approach. And it allows you to just sort of focus on the EM story. So you pick that basket of currencies that you like, diversify the funding. And I think that would largely sort of insulate you against the sort of dollar cycle.
Okay, really briefly, you mentioned oil prices. They dropped 25% in June. Just lastly, on that central bank point around emerging markets, how have they handled that massive swing, a huge jump up and then a ramp down?
Yeah, I mean, I think a lot of EM central banks were very quick to sort of highlight the risk to inflation as oil went up, and many were ready to hike, many to ready to defend, tighten liquidity as necessary. But I think, now, and there is still a reasonable amount of risk premium for rate hikes priced into a lot of the front ends of EM curves. But I think now that oil prices are back down, if it sort of stays there, we've got a little bit of risk as the ceasefire ends in the middle of August. We'll see what happens after that. But I think, there is quite a bit of supply coming to the oil market clearly now. And if oil prices stay around these levels, I think EM central banks will be quite relieved about that.
Yeah, absolutely. Those 60 days, the deadline coming up in August. James, thank you so much for speaking to us. Really good to have you in the studio. James Lord of Morgan Stanley. Thank you so much. So now to the other stories, though, trending on the terminal this morning. US President Donald Trump and his allies are renewing a push to reshape the Federal Reserve after the Supreme Court blocked an effort to fire Governor Lisa Cook. Top officials and outside allies are exploring ways to remove members of the Fed's Board of Governors to clear the way for more of the president's own picks. Michael Barr says that the Micron rally has reached historically extreme levels. In a Substack post, the Big Short investor wrote he is shorting the stock, claiming its recent gains have been driven by AI hype and investor FOMO rather than fundamentals. New York City officials are preparing the city for Taylor Swift and Travis Kelce, who are expected to host a celebrity-studded event tonight at Madison Square Garden with about 1,000 guests. The couple have reportedly donated $26 million to local and national charities ahead of their wedding. Recipients include the Food Bank for NYC and Dolly Parton's Imagination Library. So let's take a quick check of the markets this morning. So looking at European stocks, largely unchanged here in Europe. We had seen a record high for European stocks only yesterday. Meanwhile, the Bloomberg Dollar Spot Index sees a weaker dollar down about 0.1%. Of course, the weak US jobs report, lower oil prices has really challenged the expectations for Fed rate hikes, and that has weighed on the dollar. It could well see its worst week since April. And then just lastly, no cash treasuries trading today. So I brought up some European bonds for you. European bonds selling off yields for German bonds actually relatively flat at the moment, 2.93 for those benchmark 10-year government bond yields in Europe. So those are the markets. Coming up, the SpaceX IPO breaks records. We will hear from Charles Schwab CEO Rick Wurster with his outlook for future IPOs. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
There are always problems on Earth. There are always problems on Earth. There are always things that we wish to be better, that we want to solve here on Earth, and we should solve them. But there also have to be things that get you excited about the future, that make you glad to wake up in the morning, because you can't wait to see what happens next. And that's the future that SpaceX wants to bring to you.
That was the SpaceX CEO Elon Musk with his vision for the company. The SpaceX market debut shattered records, becoming the largest IPO ever and setting the tone for future market debuts. Bloomberg's Anne-Marie Jourdain spoke to Charles Schwab CEO on the outlook for the IPO markets.
And so you're seeing tremendous interest in AI-related names and the space names. I think it comes from the retail investor being able to touch and feel the level of innovation in our economy. And I think clearly they're holding names that are doing, stocks that are doing well with really strong fundamentals. Exactly what the returns will be, only time will tell.
This was like a Super Bowl moment for financial markets, and we learned that there were war rooms. You set up various ones, and you increased your team. Can you just give us some color? Where were you during all of this? What was the vibes like in these war rooms that you set up?
It was a pretty amazing event in that it was one of the top 5 most active days for our clients in the 50-year-plus history of the firm. And if you think about all the market events we've had over those 50 years, for the IPO to crack the top 5 is pretty unbelievable. We had 140,000 clients call in live. We had lots of digital engagement. It was impressive to see, and our teams were fully staffed, ready, and able to handle our clients' needs that day. It was wonderful to see the teamwork and the effort that went into making this a success on our side.
How do you think this is going to establish potentially what's next when it comes to other mega IPOs like Anthropic and OpenAI?
Hopefully it establishes retail having a really strong presence at the table. I think it's wonderful for the retail investor to be able to participate in something like this. So I hope this IPO establishes that. I think it also establishes an incredible level of interest among our client base for new and innovative technologies and being able to participate them. We recently closed a deal with Forge, which allows our clients to invest in pre-IPO companies. And so I think that the interest around these new ideas and emerging companies is quite high and will only continue.
Charles, Rick, the point that you just made is actually really important, given the fact that people know that increasingly the value is being created before the IPO when companies are still private. Do you think that some of these IPOs will expedite the efforts to get access to retail investors into private markets through a whole host of different ways?
I do think it will expedite it because people will have interest in getting in earlier because these companies are waiting far longer to go public. And so there's a lot of value being created while they're private and people want in.
That was Charles Schwab President and CEO Rick Wurster there. Well, let's get a quick check on the markets now, shall we? With the United States closed for a holiday, let's look to the European stocks, which are higher this morning on the Stoxx 600. We saw a record close yesterday, so it looks like 2 days of gains. Lots of attention, though, on the declines for the semiconductor index over in the US, the SOX, which dropped over 2 days, 12%. But as I say, markets shut for the holiday in the United States. The Bloomberg Dollar Spot Index at the moment is slightly softer. We're down this morning. And looking at those German yields here in Europe, you're seeing yields nudging a little bit higher. The weak US jobs report, lower oil prices, really challenging expectations of Fed rate hikes. So that has weighed on the dollar. No cash treasuries trading. So we've seen something of a European bond sell-off this morning. So that's where we stand. Nasdaq futures are also up today. That's a look at the markets. Coming up, semiconductors reported their strongest quarter ever, but investors are questioning whether the rally can continue. We'll discuss next. This is Bloomberg.
anything we do in Africa is going to be more risky than the U.S. I think the approach we want to take is how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation is a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend. This is Bloomberg Television. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Welcome back to Bloomberg Markets. I'm Caroline Hepker. Chip stocks posted their best quarter ever, driven by insatiable demand for AI equipment. But after recent jitters sent these stocks tumbling, investors are wondering how much further the rally can go. Bloomberg's Matthew Bloxham joins us now for more on this. So just tell us firstly, Matt, what is behind the rally that we've seen in terms of these chip stocks?
Yeah, and it's been quite the rally. Philadelphia semiconductor index maybe up around 100% this year. Most of that in the second quarter. And it's kind of really this kind of second wave, if you like, of AI that's coming through, and this huge investment we're seeing from the big hyperscalers in AI infrastructure, and the realization that actually memory chips in particular are a massive part of that expansion. And that, you know, I guess this has caught the semiconductor industry a little bit unawares, and that they haven't had enough capacity to kind of really deliver against the demand that's out there.
Yeah, absolutely. So some questions really about the sustainability of this trend. Matt, we're going to have to leave it there. Thank you so much for being with us. Yeah, it's brief, but I really appreciate you coming on the set. Matthew Bloxham there taking us through a brief look at, well, the AI demand. Coming up, we're going to hear from the Honeywell Aerospace CEO on the company's spin-off from Honeywell International. This is Bloomberg. So let's have a look at the markets briefly before we leave you. So the European market seeing some gains this morning on the stock 600. We saw a record high yesterday. We're seeing, well, eking out a little bit more of a gain this morning. Remember, US stocks are closed for the holiday today. And the weak US jobs report, lower oil prices mean that we have come off in terms of rate hike expectations on the Fed. We're only pricing in about 50 basis points of hikes by March of next year. Looking at the dollar, of course, all of this is weighed on the dollar. That is slightly lower on the Bloomberg Dollar Spot Index. No cash, no treasuries are trading in the US. So looking at those German yields, 292 for German bond yields this morning. That is where we are on the markets. We'll be back with more updates on the markets in just a moment. This is Bloomberg. Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
It is 10:30 a.m. here in London and 5:30 a.m. in New York City, where markets are closed for the 4th of July holiday. Good morning, I'm Caroline Hepker. This is Bloomberg Markets. Here are our top stories. The yen showing some strength as traders brace for holiday intervention risk. The currency touched its weakest level in 40 years earlier this week. Worries over the AI trade easing. Stocks rebound after 2 days of tech-led sell-off as traders trim bets on Fed rate hikes after a weak US jobs report. And Bloomberg learning that President Donald Trump and his allies are renewing a push to reshape the Federal Reserve, with the governor, Lisa Cook, still a target. Well, let's think about the markets this morning. Bloomberg's Natalia Nijevic joins us this morning to look at what's happening. Markets, of course, are closed in the United States. Stock futures looking quite positive, pretty flat in Europe. Just give us an overview of what's happening in markets today.
Yeah, so we do see that the Nasdaq 100 futures are up by almost 1%, slightly above that level. Actually, traders are now scaling back expectations for rate hikes, which is positive for the U.S. stock market. We also saw a pretty solid sell-off across some of the biggest tech stocks. So maybe some investors are thinking that maybe it's time to go back and come back to some of those AI-exposed stocks. Now, Europe, as you mentioned, relatively slightly higher for the European stocks. Of course, we are keeping an eye on oil prices. So as of now, we see that Brent crude is trading up by 0.3% after a pretty solid, again, sell-off in the past couple of days.
Yeah, absolutely. We're still counting down, aren't we, to in terms of the kind of peace negotiations between the US and Iran. How is all of that playing out in oil markets? We're starting to see more barrels come out of the Strait of Hormuz. How are markets thinking about this? I mean, we've come back down, way back down, haven't we, for oil prices?
Exactly. Yeah, so we see that supply through the Strait of Hormuz is accelerating, which can be bearish for the oil prices, right? So we saw that Citigroup analysts, for example, say that Brent crude price for Brent crude can be somewhere between $60 to $65 per barrel by the end of this year. But again, there are still so many unknowns. But as of now, we see that expectations for lower prices are kind of getting more popular across Wall Street strategists right now. So we'll see how this plays out. But definitely, yes, supply is picking up.
Yeah, well, we saw a 25% drop in terms of oil prices just in the month of June. So that's a real massive retracement, isn't it? What individual stocks are you watching today, Natalia?
Yeah, so it's a pretty quiet day. As we know that the U.S. stock market is closed. However, we do see some movers. So, for example, Stellantis shares declined. The car maker was downgraded, HSBC. Analysts are concerned concerned about cash outflows, and they also say that there is a potential need for destocking. So analysts are saying bloated U.S. inventories and weak market share development are pointing to another need to destock. And by the way, the stock is down by almost 50% on a year-to-date basis. We know that the environment overall across the auto sector is not as great right now. Another stock that I'm watching is Myers. So that stock is up today. It was raised to neutral from sell at Goldman Sachs, and now analysts are saying that they are turning less negative on 2027 supply and demand outlook. They say that slightly later and shallower acceleration in new capacity growth is expected to be in 2027. And then finally, EQT. So we see that Citigroup analysts, they are still cautious on European alternative asset managers, and they say that AI represents fundamentally different challenge for those type of stocks. And EQT, by the way, is down by almost 23% year to date.
Okay, Natalia, great. Thank you so much. Bloomberg's Natalia Niedziewicz joining us. Thank you so much. Now, since its spin-off from Honeywell International, shares of Honeywell Aerospace have seen double-digit gains. CEO Jim Courier joined at the close to discuss the path forwards for the company.
We're not seeing any decline in the air travel business that affects our portfolio, but I think it's important to understand when we think of commercial aerospace as part of Honeywell Aerospace, there's the commercial air transport section, which is airlines and airline traffic, OEM production rates, but as well as business aviation, where we have a very unique positioning with our products and technologies in business aviation. So half of our OEM business is actually business aviation. The other half is commercial air transport. Our commercial aftermarket business, which is what you're referring to in terms of airlines and flight travel and the like and flight hours, 60% of that is commercial air transport. 40% of it is business aviation. It's truly an underappreciated aspect of Honeywell Aerospace as to how much exposure we actually have in business aviation. And what we've seen as a result of the conflicts and the rising fuel prices is actually an uptick in flight hour traffic for business aviation.
Well, Jim, you mentioned that, being a standalone business, completing this spinoff, you can really just focus on your strategy, not necessarily being part of a conglomerate here. You also see a bunch of sell-side notes coming out, initiating coverage of you as a standalone. And Jefferies in particular points out that now you have a chance to run the M&A playbook. You've shut the books on the first day of trading. Where would you say M&A falls on your priority list? Is that something that you're evaluating?
Yeah, so as we discussed at our Investor Day in early June, there's 4 pillars upon our capital allocation strategy. First and foremost is investing capital into our factories and into the supply base to unlock additional capacity within the industrial supply base because we have so much demand for all of our products in commercial and defense. So that number one priority for us. The more we can unlock, the more we can deliver on the $19 billion of backlog that we have, which is up 20% year on year, indicative of how much demand there is for our products and technologies. So that first and foremost is our top priority. Unlocking the supply base, increasing capacity, and deliver for our customers and for our shareholders in that regard. Specifically around M&A, that's number 2 on our priority list. And if you think about what we did when we acquired 2 companies back in September of 2024, Case and Civitanavi, they fit into a very specific framework. First and foremost, technology differentiation. It's what Honeywell Aerospace has been founded upon, is being innovators and differentiating with our technology. So you must have differentiated technology and servicing a demand that's high growth in excess of the growth that we're seeing in our business today, which will outgrow what the market growth is right now for Honeywell Aerospace. If you have those 2 elements, then we look at who are you serving today? Are they the same customers? Are there synergies between what the target company may be doing and what Honeywell Aerospace is doing? And then the 4th piece of that rubric is really around, can we scale you greater than how you can scale yourself? And if you think about those 2 acquisitions that we did in September of 24, they hit all 4 parts of that rubric, and particularly on the scaling front.
That was Honeywell Aerospace CEO Jim Courier. Now, coming up, inflation worries are top of mind for central bankers around the world, and our very own Francine Lacroix speaks with special guest Emmanuel Moulin, Banque de France governor, about his outlook for it. That's coming up. This is Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Oh, hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up. Sorry.
This is Bloomberg Markets. I'm Caroline Hepker. On Wednesday, central bankers from around the world spoke on a policy panel in Sintra in Portugal. They talked about the thorn in all their sides, inflation.
The second round effect is probably going to take some time. What I'm really focused on is the indirect effects.
The origin of the shock being higher oil prices, I mean, to the extent you believe that there is now a truce and the prices will go down.
We're not into forward guidance, but we are into framework guidance, which means that it's important that the markets, the analysts, the people understand our reaction function.
Even though now, like fuel prices are falling, what we need to look at is how the 4 months of energy cost increases percolate into food inflation and into services inflation in particular.
So the origin of the shock has disappeared, more or less, before we see second-run effects. I mean, there will be some, so that makes it, I think, relatively easy. We might need another hike, but I mean, in all likelihood, and that's of course what the market is pricing, but not as much as we thought in June.
We always say we are data dependent. We have our next Governing Council meeting end of July. Then we will have new data again. We will look at how the situation looks like. Decline in the oil prices now, of course, is from an inflation point of view definitely good news.
That's where we're going to have to calibrate our rate path, but I'm not concerned. I mean, I think this is more than doable.
So, as inflation concerns continue to weigh on policymakers, our own Francine Lacroix is in Aix-en-Provence. It looks glorious down there. She has a special guest to continue the discussion. Hello, Francine.
Good morning, Caroline. It is quite special, actually, in Aix-en-Provence. It's a little bit hot, but we're not going to complain, as it's kind of the festival of the economy. I could not be more delighted to speak exclusively now to the Banque de France governor, the newly minted Banque de France governor, Emmanuel Moulin. Monsieur Moulin, thank you so much for joining us on Bloomberg. Talk to me a little bit about inflation. So this is the one thing that the ECB, of course, looks at day in, day out. We had some inflation figures earlier this week that were a touch below expectations. Does it make your job easier?
Well, it certainly is going to make our job easier. It's true that we've been hurt by supply shock, which increased price of energy. And the point for us is that it doesn't go through, all the prices in Europe. But I think we had good news about oil and the reduction in the price of the Brent. So it makes our job maybe a little bit easier. We'll see when we meet next time in July.
What are you expecting for July? Will it be a more difficult decision than June was?
No, I mean, we are not into forward guidance, so we'll decide when we'll be there. But what we see is that at this moment and at this juncture, we are in a good position, and the balance of risk is in the right place.
I know you worry about services inflation. What can you tell us about services inflation?
Well, service inflation has been, energy is feeding into services, obviously, because they are transport, airfares, logistics, which are heavily impacted by the price of oil. But the fact that the oil price decreases will I think soften the inflation on services. But it's still, what we see is that we are above our target. And so I think the decision we made in June was the right one, because we had inflation above our target on our horizon. But the good thing also is that, we do scenarios. So we look at different scenarios and forecasts. We had a severe scenario, base scenario, and a milder scenario. And the fact that we have this scenario makes us much more comfortable on our decisions.
So where are we in the scenario factor?
Well,
is it base
we will have new forecast in September, but I think, we are comfortable in our base scenario, and, and the news on what's happening in the Strait of Hormuz is globally good news.
Overall, we were in Sintra together, Portugal, for the ECB forum. A lot of the governors were worried that there'd be second-round effects. Do you expect the decision-making of July, but also September, just to be more difficult?
I don't think so. I think that we made sure in our communication that we were not entering into a new cycle of hikes. So we took this decision in June, which was perfectly legitimate, and now we will decide meeting by meetings and data dependent. So we'll see where we are in July and in December, but we've made no commitment for these two meetings.
Governor, talking about data, so Banque de France has a lot of great data looking at small and medium enterprises, inflation. Like, what are you seeing in the last month? Well, we've seen, what we've seen is really soft growth. This is not very dynamic. Unfortunately, we had not a very good Q1. We see industry doing pretty well, thanks to investment in defense in particular, and in energy, electricity, and also the boom in AI. We see services much softer and construction much softer. So we don't expect a sharp increase in growth in Q2, but we'll see. We'll see. I think the fact that we have less pressure on the oil price is also good news. So it might make growth a little bit higher than we expect. So you've been in charge for just over a month. Yes. What's been the biggest surprise? Well, I knew part of the job, but monetary policy is a very serious job. We use a lot of data. We look at really a big set of data. We look at different scenarios. We have very, technical and in-depth discussion at the table of the Governing Council. We act as Europeans, not as national governors, as Europeans, and we take, the best decision in that context. I mean, how do you look at AI in the future, what it means for, first of all, inflation? Is it automatically inflationary in the shorter term because of CapEx, and then disinflationary? That's what we think. Now in the short term, it's mainly inflationary because you have large capital expense, so it's an increase in demand, and mainly in the US for the moment. Then we can expect that it might be deflationary because of productivity gains, but it will take some time before we see that, because we need adoption. We need that AI fits through all the production process in companies.
not only generative AI, but really changing the way we produce and we manage our companies. So it will take some time.
What are some of the data points that you look at? I know you look at, services inflation, wages coming up. Is there something that you see as more indicative?
We look at a broad set of data. So we look at, inflation. We look at core inflation. We look at services. We look also at inflation at products that are not linked to the energy to see if there is, broad-based inflation. We look at wages. We don't really see second round effect at the moment. And we look also at expectation because they are key in terms of our credibility.
And when you look at some of those figures overall, I mean, how is AI going to change what you look at in terms of models?
Well, I think, we'll be able certainly to analyze a much broader set of data. And what we need is also to make sure that we can have real-time, assessment. I was listening to Kevin Walsh that he was saying that we always look at data, which are historical data and which are in the past. And we need to project ourselves in the future and see, we do forecast, but we need also to try to gather a very broad set of data in order to make the best decisions.
Governor Mouna, I mean, France is going to go through a big year. The next 12 months will be very crucial because there's going to be a presidential election.
Yeah.
Do you worry about a market event, kind of, bond spreads moving as we've seen in the past?
Really, we've had a minority government for quite some time now. We had some difficulties to pass the budget, but we have a budget for 2026, and we've seen, the spreads very stable. And we have no issue in terms of auctions of our debt. We have solid demand. We have very good bid-to-cover ratio. So I think, we need to make sure that we stick to our commitments and the government sticks to its commitment in terms of reduction of the deficit, but I don't see a market event at the moment.
I mean, would the ECB stand ready to act if there was a market event?
I'm not into political fiction, and we are doing scenario for forecast, but not for, for political events. So, we are following the situation, but, I think we're in a good shape at the moment.
Governor Mouna, just a final question. I mean, in the next 3-4 months, what will your priorities be as you kind of find your feet?
I'll have, priorities will be obviously our monetary strategy and to make sure that, inflation goes back to our target. That's our first priority. My second priority is monetary sovereignty and payments. And we need to make sure, that we remain sovereign in terms of payment, that we embrace innovation. And that's what we do with the digital euro that has been voted in Parliament, and the Banque de France will be, at the forefront in order to develop the digital euro.
But what is the biggest question actually for the digital euro? Because we don't know whether it comes in a portfolio, a wallet. There's so many questions.
Well, there are so many questions, but it's going to be an electronic bill, so you will be able to pay with an equivalent of cash in all, between citizens, in shops, in e-commerce, etc., which you cannot do at the moment with your cash. You have to go through either, a US provider, Visa, MasterCard, or Apple, or these companies. We will have really, central bank money, which will be available to all the citizens in the digital world.
Governor Emmanuel Moulin, thank you so much for joining us. Of course, that's it for now. We'll have plenty more from X, and that was the Banque de France governor, the newly appointed Banque de France governor, Emmanuel Moulin. With that, Caroline, I'm going to send it back to you in London.
Lovely. Thank you so much. That is Bloomberg's Francine Lacqua there. Excellent. Thank you so much for bringing us that interview. Right, let's get a quick check on the markets for you today. Yes, the US markets are closed, but there's still some things to think about here in Europe, where you see stocks actually are rising on the Stoxx 600. We saw, of course, the South Korean Kospi and a big rally in Asia overnight. Now, the Bloomberg Dollar Spot Index is weakening this morning. We had those much softer than expected US non-farm payrolls figures figures out yesterday, and that has cut the expectations for Fed rate hikes this year and into next year. Then looking at the European bond space, no US cash treasuries trading, of course, today. European bonds selling off just a little bit, really across a lot of the sovereign bonds in Europe, but I've just got the German 10-year yield there, so we're up by about 2 basis points. That's a look at the markets for you. Coming up, much more here. This is Bloomberg.
up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Bringing you up to the minute news whenever and wherever it happens. I'm Chevrian in Seoul, and this is Bloomberg.
This is Bloomberg Markets. I'm Caroline Hepker in London. Now to the top stories trending on the terminal this morning. US President Donald Trump and his allies are renewing a push to reshape the Federal Reserve after the Supreme Court blocked an effort to fire Governor Lisa Cook. Top officials and outside allies are exploring ways to remove members of the Fed's Board of Governors to clear the way for more of the president's own picks. In sports, Spain delivered a dominant performance in the World Cup to beat Austria 3-0 and book a place in the round of 16. Spain set to face Portugal after its 2-1 victory over Croatia. So that's a bit of the sports news for you. Let's get a quick check on the markets in the next part of the programme. Coming up, Bloomberg Markets with Guy Johnson.
some people have written that your bank, Revolut, is worth $75 billion. Have you ever thought of taking your organization public?
Well, the way I think about it, we kind of will be ready probably in 2 years' time. But then again, depends on how good the market is.
Since you don't have an IPO, how do people who work for you make some money? Do you make a market for people to sell their shares internally?
Yeah, so we do secondaries every 1 or 2 years when people can sell a certain portion of their stocks to external investors.
So you've done secondary sales for your employees, so employees can then get some liquidity. Do you expect before you go public you'll do any more of those, or are you just going to wait till you go public before you liquefy any more stock?
Yeah, I think so. We might do secondaries as well before we do IPO, because we do it every 1 or 2 years, so we might do secondary as well.
All right, well, if anybody wants to sell their shares to me, let me know. And have any investment bankers told you why they're the best to do the IPO for you?
Yeah, obviously every single one is the best.
Everyone is the best. You're not in a rush to do it. You don't need the money.
So we're a bank, and then for the bank it's super important to have trust, and then public companies are trusted more compared to private companies. So that's the reason.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in Al Ula, Saudi Arabia, and this is Bloomberg.
Morning, how you doing? Welcome to Bloomberg Markets. I'm Guy Johnson. I'm in London. As we know, US markets are closed today. It is the 4th of July holiday, but obviously it's the 3rd of July. We'll get to the 4th of July tomorrow. What do you need to know? What have we got coming up for you? Stocks rebounding after a 2-day-led tech sell-off. Traders trimming bets on Fed rate hikes after that weak US jobs report we saw yesterday. So let's talk about what we are understanding about what is going on right now. Bloomberg is learning that President Donald Trump and his allies are renewing a push to reshape the Federal Reserve. That's also in focus, with Governor Cook still the target, and the heat dome has settled over the United States East Coast, pushing New York City to its hottest day since 2012, with temperatures in Central Park spiking to 100 degrees Fahrenheit. I think for the rest of the world, that's about 38, so that's quite hot. But yeah, 100 I think is about 38. Anyway, let's do some more translation and figure out what is happening with these markets. You have a equity market here in Europe that is up. The Nasdaq is certainly having a fairly solid session thus far. We're up by 1%. Brent is also a little bit positive, but the dollar, unsurprisingly, after what we saw yesterday with payrolls, a little weaker this morning. Natalia Knezovic joining me now for a closer look at what is happening. What is happening?
So we see that European stocks are now trading at a record high. The Nasdaq 100 futures are up by almost 1% because we saw that steep sell-off across semiconductor stocks. So the Philadelphia Stock Exchange Semiconductor Index lost about 11% in just 2 days. So people are coming back potentially if we don't get any crazy headlines over the weekend, we expect the market will open much higher on Monday.
But momentum is losing momentum.
Exactly. So that's a big story right now. We saw steep sell-off in momentum stocks. When I asked traders what's been happening, they said technically there is no big catalyst for that, but exposure got really elevated across momentum stocks and people are just taking profits. If you look at WTF function on Bloomberg Terminal, factors to watch, we see that momentum is the best performing factor across 11 or 12 tracked by Bloomberg. The worst performer is volatility, low volatility factor. So huge gains, people are taking profits, and It's also important to know that hedge funds who had really great performance over the past quarter, long-short global equity fund managers posted the biggest gain in history. I'm citing data from Goldman Sachs trading desk. So some of those fund managers, they just don't have to chase this rally, and they're taking profits potentially ahead of like slow season, July and August.
Someone's coming. There already appears to be here, very much in New York. Natalia, thank you very much indeed. Natalia is going to be with us throughout the morning, keeping us updated on what we need to know with these markets. In terms of what is going on the central bank front, focus has shifted from Portugal to France. Central bankers, policymakers who were at Sintra are now in Aix-en-Provence for the Economic Forum, of course, fresh off the back of that ECB event. Let's head there now, and we're going to speak to BNP Paribas Chief Economist Isabel Mateos Ilago, who joins us to talk about what we need to know. Isabel, first of all, what was your takeaway from Sintra? What was the sense that you got from that event in terms of where policy is going next, both for the ECB and the Fed?
Hi, good morning, and thanks for having me. So I think Sintra was a good week for central bankers. There was good news on Fed independence, and there was good news on inflation, with the latest figures certainly for the Eurozone coming in weaker than expected, and inflation expectations coming down generally more quickly than could have been feared. And so you sensed, I think, a palpable relief from central bankers, while at the same time they don't declare victory yet. They remain on their guard, but I think the tone was distinctly less hawkish than what we heard at the June policy meetings, and I think appropriately so.
Okay, why appropriately so? What do you think happens next?
Because I don't think inflation is going to drop like a stone. It's not going to drop in a straight line or very, very quickly. We've had a bit of instant relief with energy prices coming down very fast and back now where they were prior to the onset of the war. But the reality is the problems haven't gone away. The normalization of both oil transit and oil production is going to take a couple of quarters at least. And so we're not sure oil prices are going to stay where they are. In fact, we see a good probability that they're going to tick up a little bit from here. As well, let's not forget that a lot of the disinflation that we saw in Europe in the June data came from administrative measures which are going to expire this month, and so we could see inflation tick up, in fact, in places like Germany and Italy. And then there could be other shocks, concern around food prices which could reappear. And so I think even though for now we've seen some relief and we're still not seeing really strong pressures of inflation going beyond energy and the energy adjacent sectors, it would be too soon for central bankers to lower their guard and say, okay, we can go back to where we were. So I think they're going to wait. It's still our base case that the ECB will deliver an additional rate hike in September, but it was noticeable how the Governing Council members who spoke in Sintra left the door wide open to not doing this additional rate hike. And similarly, the other central banks who spoke were, I think, again, appropriately cautious at this stage.
Isabel, just a few minutes ago, Francine was talking to the Bank of France governor at Aix. He says he doesn't see second round effects at the moment, and he's pointing to very, very low growth. Is that low growth factor, do you think, going to be enough to dissuade the ECB from doing more?
Well, I think we have to see. So growth in France certainly was very weak in the first quarter. We think the second quarter is actually better based on different nowcasts, our own and others. Q2 should be better. And growth in the rest of the Eurozone is actually not that weak. So even in fact the ECB forecast is tracking for growth on a full year basis just under 1%. So maybe in some compared to other countries it's weak, but for Europe I think it's not weak enough that the ECB could say it's too weak, we need to cut interest rates. I think, in fact, it's the kind of growth and the last PMIs, by the way, also showed that manufacturing remains in expansion, and the deterioration in services that we had seen earlier is stabilizing. Consumer confidence is stabilizing. So I don't think this is the kind of environment where the ECB would think, oh, we need to cut. And in fact, it's the kind of environment where being at a neutral interest rate, which is where they are, seems pretty appropriate.
Okay, 57,000 jobs yesterday on US payrolls. Is that enough to keep the Fed, is that weak enough to keep the Fed on the sidelines? The market is still pricing hikes.
And so are we. Look, when you say is it weak enough, look at what happened to the unemployment rate. The unemployment rate came down. And in fact, we expect it's going to keep trending down between now and the end of the year. And that's because the break-even rate of job creations is, in our estimation, not very far above zero. And so 57,000, yes, it was a lot lower than the consensus expectation, but it's enough to keep the labor market tight, and it's enough, therefore, in our view, for the Federal Reserve to have to tighten policy sooner rather than later. And we, in fact, expect they will deliver 3 rate hikes over the course of the next 12 months. And for now, we think starting in December, but, you know, I think if we had had a very strong payroll closer to 130 or above, then I think July would have been a very, very live meeting, probably less so now. But in my mind, the case for rate hikes from the Fed is undiminished by this payroll report.
Where does 3 take us? Does 3 take us to restrictive, or does 3 keep us still neutral? Like, it feels like we're accommodative now. Maybe 3 takes us into neutral. Where would that position us, do you think, in terms of the setting of monetary policy in the United States?
Well, if you think of, you know, the pre-AI boom estimates of what neutral is, I think you're right. I would agree with you. It would take us to slightly restrictive. I think there's an ongoing debate which has been further fueled by Kevin Warsh's arrival on the Fed. That look, maybe we are going to have a productivity boom thanks to all this investment in AI. If that's the case, then neutral will be going up. So I guess we'll need to see what the task force on that topic comes up with. But based on the reaction, the behavior of the economy, it's very clear that that policy is not restrictive currently, and 3 would take us closer to neutral or a little bit restrictive, which is what you need given inflation is well above target and has been well above target for over 5 years now.
Can I just pose a slightly complicated question to you? At the moment, AI is inflationary. It looks inflationary. It appears to be inflationary. And clearly, therefore, it needs to get cheaper if we're going to deliver the kind of productivity that everybody is hoping for, including Kevin Warsh. If we were to see the stock market rolling over because the AI bubble bursts, would the Fed therefore want to rescue the stock markets and prop up prices, or would it want that to play out so you get the productivity benefits of the AI story at a cheaper rate more quickly?
Well, a couple of points here. First of all, I thought it was very, very meaningful that when he was asked about the inflation impact of AI on the policy panel, Kevin Warsh, even though so far he'd been mostly, including during his confirmation hearing, saying, you know, AI is going to be disinflationary, he was actually very clear that for now we're seeing the impact of AI on the demand side, and that any productivity boosting impact was not policy relevant on a 6 to 9 month horizon. So I thought that was a very important signaling that he gave. Now, to your question of, you know, does the Fed need to rescue the market after the bubble bursts? Look, every single technology revolution that we've had over the last 100 years, there's actually some really interesting chart in the recent BIS report that every time you have a bubble, you have overinvestment, and then the bubble burst, but you still get the productivity benefits. So I think the two facts are, you can totally disentangle them. Now, I think also we're in the build-up phase. You could think of these as overlapping phases. You have the build-up, and then, you start having the productivity gains. There's no absolute necessity, there's no mathematical necessity for a collapse at some point, but it's true that historically this is what happened. But the really important point is, even if the market collapses, you still get, for the economy as a whole, you still get the productivity benefits.
Isabel, enjoy eggs, enjoy the Luberon. It's a nice place to hang out. Thank you very much indeed for being with us this morning. Isabel Mateos-Ilago of BNP Paribas at the Aix-en-Provence Economic Forum. Thank you very much indeed. Let's get you a quick update on what else you need to know. What are the big stories that we're watching? Here is your Bloomberg brief. The US President, Donald Trump, and his allies are renewing a push to reshape the Federal Reserve after the Supreme Court blocked an effort to fire Governor Lisa Cook. Top officials and outside allies are exploring ways to remove members of the Fed's Board of Governors to clear the way for more of the president's own picks. Private credit funds are facing a relentless wave of investor withdrawal requests, with second quarter exit requests exceeding those of the prior quarter. More than $14.5 billion worth of investor capital is trapped at over a dozen funds, compared with $8.6 billion that shareholders were able to get back. And Michael Burry says the Micron rally has reached historically extreme levels. In a Substack post, the Big Short investor wrote he is now shorting the stock, claiming its recent gains have been driven by AI hype and investor FOMO rather than fundamentals. Okay, you're up to speed. That was your Bloomberg brief. Quick market check just to tell you what we've got right now. This is the picture. US futures are positive by the tune of 0.3%. The dollar is up versus the yen, but we are watching that very, very carefully. It is basically balanced, and Brent is slightly big. But remember, the US markets are closed today, and as a result of which we have very light volume pretty much across all assets today. What are we going to do next? Bloomberg's Paul Wallace will be joining us very shortly. We'll get an update on the US-Iran peace talks, and we'll get a sense of kind of where they are going next. We'll do that in a moment. This is Bloomberg.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
17 minutes past the hour. Welcome back. You are watching Bloomberg Markets. I'm Guy Johnson in London. The United States markets are closed today, so there's plenty to talk about elsewhere. The European Central Bank certainly making a lot of news over the last few days. Officials there saying the inflation shock from the Iran war, they don't believe is over yet. Chief economist Philip Lane sat down with Bloomberg's Francine Lacroix at the ECB Forum on Central Banking in Sintra, Portugal, to discuss the modest increase in confidence levels that we are starting to see as oil prices begin to abate.
For the economy, it's only been, a few weeks. So clearly what's changed is the oil market, and that is moving quite a bit in the weeks since we've made our decision. And so let's see how that percolates across the economy. So what we have seen is in terms of confidence indices, there has been some improvement, but not a return to the pre-war levels. So it's not the case that there's been this very rapid rethinking of how investors and consumers feel. I mean, I think probably they need to see this current peace agreement convert into something more durable. And as you know, every day there's, plus and minus signals. And that needs to settle down, I think, before consumers and investors take a more decisive revision of their views.
I mean, this is really the concern, right, is that we're not really sure what these ongoing talks will bring. Madame Lagarde yesterday was really talking about no forward guidance, but scenarios. So with these ongoing talks, are we closer to the milder scenario or base scenario?
So I think the most important fact that we see is right now the oil prices reverted to pre-war levels. But the view of the market in terms of 2027 and 2028 is that it will be well above pre-war levels. So in other words, over the next couple of years, maybe because around the world, energy firms, governments will want to rebuild inventory, that maybe demand for oil for restocking purposes will keep the oil price high compared to the pre-war level. So from our point of view, it's very welcome that we see this decline in the price of oil, but in terms of the overall inflation impulse, the fact that we do have maybe for a couple of years oil prices above the pre-war level, that essentially is a cost-increasing impulse to the economy.
So it's very clear that the ECB wants everyone to know that the last hike was not an insurance hike. Will the next hike be an insurance hike?
So I think it's important that we are clear on our terminology, if you like. So as President Lagarde said last night, we feel that the June decision was a robust decision, that we looked at it from every angle, and even from the angle which we did anticipate of having, if you like, this more rapid decline in oil prices. Even under that kind of more rapid normalization, it made sense because of 4 months of high oil prices to raise the rate from 2 to 2.25. What I think it's important to say is as we go forward, as we evaluate the kind of pros and cons of different rate decisions, we will be, if you like, mainstreaming the concept of how does this decision look like under uncertainty. Now, for me, I would reserve the phrase insurance hike to a situation where there's a tiebreaker, that maybe you could at least stay where you are, maybe you could hike, and the risk considerations will push in one direction. But that was not the June decision. That was a clear decision, robust across a wide range of scenarios.
Yeah, I mean, given the wide range of scenarios and the uncertainty and the second round effects, is it better to hike in July or September?
Well, again, the way you phrase that question is maybe overly narrow. So what I would say is, before we get to the second round, I mean, for me, the second round effect is probably going to take some time. What I'm really focused on is the indirect effects. So even though now, like, fuel prices are falling, what we need to look at is how the 4 months of energy cost increases percolate into food inflation and into services inflation in particular. And that channel is maybe where there's still uncertainty. And it's essentially the tension between these many firms have been absorbing higher cost increases for a number of months, whether they can recover those cost increases by raising prices, or whether, especially in the context of now the fuel prices reversing, it's absorbed in profit margins and there's less by way of the indirect effect. And only after that can you start to have a vision of how strong the second round effects on wages might be, which would be later this year and into next year.
So you're telling me my question is too narrow because you could not hike at all?
I think, as you very well know, we're very much committed to basically going one meeting at a time, to not boxing ourselves in by kind of speculating about rate decisions and essentially focusing on, at the time of the meeting, when we look at everything, what makes sense.
That was, of course, the ECB's chief economist, Philip Lane, speaking with Francine Lacroix in Sintra at the ECB's policy forum, talking about the impact that this rapid drop in oil prices is having in terms of policy. Let's talk about whether or not those oil prices are going to stay down. Peace talks between the United States and Iran are temporarily paused. Tehran beginning a week of mourning, of course, for the former supreme leader, Khamenei. President Trump told reporters Wednesday there was progress between the two countries in negotiations. Joining us now, Paul Wallace, on the latest on this story. Paul, where are we as we go into this weekend? Where do the talks currently stand?
Hi, Guy. I think compared to a week ago, we're at a less tense phase of these talks. A week ago, we were kind of in the middle of a couple of days or 2.5 days of clashes between Iran and the US that started when Iran fired on a ship going through the Strait of Hormuz, and then the US retaliated, and then Iran struck US military targets or targeted them in places like Bahrain and Kuwait. Those tensions have eased somewhat, and the two sides had talks in Qatar at the beginning of the week that involved Jared Kushner, Donald Trump's son-in-law, and Steve Witkoff, his main envoy for the Middle East. And those, broadly speaking, those talks did the job of getting the sides to sort of step back and say, okay, let's keep things calm over Hormuz for now, and they will continue their talks. This is to get a permanent peace deal. They're meant to take only 60 days and resolve really complicated issues like the future of Iran's nuclear program and the future of its highly enriched uranium, and of course the management of the Strait of Hormuz. It will probably take longer than 60 days, but I think where we stand right now is that things aren't so tense, but they've got huge problems they still need to resolve.
Paul, thanks for the update. Greatly appreciate it. Thank you very much indeed. Paul Wallace joining us from Istanbul. Quick check on where we are with markets as we figure out what is going to come next. This is the picture we currently find ourselves with. As you can see at the bottom of the screen, Brent crude not doing very much today. Still north of 70, kind of 72 area. Dollar yen is one to watch as well. We've got light volume that we are seeing in global FX with the United States out. Is this an opportunity for the Japanese to intervene? Equities are broadly higher. You're looking at a picture here in Europe, 0.2%. US futures are up 0.3%. We'll get a sense of where we go next with Cameron Dawson, New Age Wealth. We'll get her take on what we are looking at and what the second half of the year is ultimately going to look like. She will join us next. This is Bloomberg.
Look at the more successful economies in the region. The key to their success is continuity. But the way our constitution is written, it actually encourages a lack of continuity. And that's a problem. The terms for local government is 3 years. When I first became a congressman, it takes you a few months to learn the business and to make your connections, the network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Hi, Basia. Welcome back. You're watching Bloomberg Markets. I'm Guy Johnson. US markets, as we know, are closed today. It is the 4th of July weekend. It has started on the 3rd of July, and obviously the festivities with the 250-year anniversary will continue throughout the weekend. Markets look, therefore, a little bit calm. S&P futures are up 0.3%. Dollar yen, keep an eye on that. Are the Japanese going to intervene? That is certainly what we're watching for, and we will discuss that with Jane Foley a little bit later on from Rabobank. Brent's also not doing very much. We're keeping an eye on that. Stock 600 flat here in Europe. The dollar is slightly weaker after the payroll data we saw yesterday, and the gold price is up a little bit after the payroll data that we saw yesterday. So what do we need to know? Let's find out in more detail. Natalia Knezovic joining us around the desk. What do we need to know?
So we need to know that the S&P 500, as you mentioned, are up, but NASDAQ 100 futures are up much.
Yeah, by around 1%.
Exactly, by about 1%, again, following the jobs report, and then also looks like some traders are coming back to beaten down semiconductor stocks. Now, in the energy space, we see that Brent crude is flat today, flat for the week, but we see that some strategies are becoming more bearish. For example, Citigroup now expects that oil for Brent price will be somewhere between $60 to $65 per barrel until the end of the year. And then in the LNG space, we also keep an eye on that. Qatar appears to be sending the first LNG tanker through the Strait of Hormuz since in about a week. So this is also a positive development.
Single stocks?
Couple movers. It is a quiet day. However, we have, for example, Stellantis shares are down by almost 1.5%. We saw that HSBC downgraded the stock, said that analysts are concerned about cash outflows and potential need to destocking, and the stock is down by almost 50% since the beginning of the year. Another one is Maersk. Shares are up by almost 2% today. So it was raised to neutral from sell at Goldman Sachs. Analysts are more positive right now on supply and demand mismatch. And then finally, Samsung shares are up by almost 8%. The information reported that Anthropic is in talks with Samsung to produce custom AI chips, and it is also an interesting note from Citigroup analysts. They are cutting a long position on Korea's Kospi index. They say that the fear is when semiconductor stocks peak, the overall market could peak as well.
Yes, that certainly seems to be a reasonable expectation at the moment. Natalia, thank you very much indeed. Natalia Knezovic will be back very shortly. But let's get another perspective on what we are seeing with this market. New Edge Wealth CIO Cameron Dawson looking ahead to the second half of 2026, writing, quote, "The market catalysts are great now, but they won't last forever. Timing, unfortunately, is everything." Okay. She joins us now. Let's get a sense of where we are going. Cameron, great to see you. Timing is everything. Talk me through the timeline.
Yeah. Well, it's such a challenge as we look into the back half of the year, as we think about the
drivers that propelled this market higher, at least through April and May. We certainly saw such powerful returns that ended up turning very choppy as we got into June. And what's fascinating is even though the overall market, the S&P 500, was down slightly in June, what we saw was actually a lot more breadth. So fascinatingly, more names ended above their 50-day moving average at the end of June than at the start of June. And that gets to the point of that we're seeing these big starts of leadership rotations. You have some last shall be first kind of rotations, things like healthcare doing better, financials doing better, European stocks doing better. And then now we're having this introduction of volatility within the semiconductor trade. The challenge with that timing aspect of things is that semiconductors through the first half of the year accounted for 75% of the return in the S&P 500. So we really need to see that trade continue to have some momentum to it. We think in order to make those price targets of 8,000, 8,100, 8,200 even by some strategists by the end of the year. So in the near term, we wouldn't be surprised to see more volatility as we progress, at least through July.
Cameron, I'm reading a lot at the moment about an earnings bubble, i.e. the expectations on earnings are going up simply too fast right now. What do you think of that view?
Yeah, well, I think that we have to consider that there's been an incredible, powerful uplift to the semiconductor side of things. You've seen a 90% uplift in the 12-month forward earnings estimates for the SOX index over the course of the last 9 months. And that has been driven by the fact that you've seen a huge increase in hyperscaler CapEx. This whole dynamic here is that we went into the year expecting 30% growth for hyperscaler CapEx. We're now running at 90% growth. That delta of an increase in an extra 60% growth is being pushed into the semiconductor complex where they have limited supply. And simply what you're seeing now is a huge amount of operating leverage where you've seen 18 percentage points of extra operating margin for the stocks over the course of the last 6 months. So the big question is whether or not that margin is sustainable. If you see hyperscalers pull back on CapEx even just slightly, those margins peak, those earnings thus peak, and then overall S&P 500 earnings likely are at a peak, at least in the near term. So we've been asking the question, given this huge uplift in earnings that we have seen, are 2027 earnings likely the highest we'll see in the next couple of months on a forward basis?
Okay, so say they are, and we start to see maybe a roll-off. What I don't get at the moment is that people are talking to me about the broadening out of the trade. It's kind of simple. You rotate out of tech and you rotate into the rest of the S&P, for instance. What I'm wondering, though, is whether or not if tech goes down, if the semi-sector goes down, doesn't it just drag the rest of the market down with it? And that broadening out, yeah, it's going to be a story that might protect you, but it's a relative trade versus an absolute trade. Absolutely, on the absolute trade, everything goes down in that scenario.
Yeah, it creates a big challenge for a cap-weighted index where you now have semiconductors as nearly 19% weight in the S&P 500. You go back 15 years ago, that was a 2% weight. So the path forward for the cap-weighted S&P 500 is highly sensitive to semiconductors and, of course, the broader technology complex, as well as the broader Mag 7 complex. I think that's really important to note is that one of the reasons why you saw the cap-weighted index down in June and yet a new high in the equal weight S&P 500 is because of the dead weight that the hyperscalers and overall Mag 7 placed on the index. So you could be in an environment where you certainly have a last shall be first kind of market. Things, as I mentioned, healthcare, financials, et cetera, do better. The market might look more broad, but on a cap weighted basis, it's actually just flat to slightly down. The big thing, though, that we've seen over the last couple of years is that every time we get a little bit of this broadening, this hope rally that we'll see some of these other areas participate in the rally, they've been rather short-lived. They've had 1 to 2 month lives, and then you've seen them give back all of that relative performance. And the key reason for that is simply they just haven't had the earnings. So the one place where there has been the earnings has been tech. So if tech earnings start to roll over, it's not necessarily that you're going to see healthcare or financials earnings do a lot better. So it raises the question if you could see kind of broader volatility, not just sort of this short-term rotation.
Okay, let's factor in something else. What are you plugging in terms of rate hikes?
Yeah, well, I think let's start where the market is expecting. The market still has a 120% chance of a hike by the end of the year, so 1.2 hikes. We find it hard given the data that we got in the U.S. yesterday on the labor market side of things, where job additions were much lighter than expected. Yes, you got a lower unemployment rate, but it was just because of falling participation rate. We don't think that that kind of labor data necessarily suggests that there's a lot of urgency to hike rates. And as we look forward over the next couple of months, we're going to see some of the inflation data come off the boil, at least on the headline basis, because of the fall in oil prices and falling gasoline prices that we've already had. So we think that if headline inflation is falling, it's really hard for the hawks at the Fed to necessarily argue that they have to be hiking rates because of a slight uptick in something like super core services inflation, that core services ex housing, where we have seen some uplift. So our base case is a hold through the end of the year. Of course, if we see another inflation shock or re-lift up in some of the momentum in the labor market, you could see some of those hikes get priced back in. But we think that we might be close to, or at least a couple weeks ago, peak Fed hawkishness, and we could find ourselves in a situation where we're pricing out those hikes as we move through the summer months.
But no cuts.
No, we don't think that this supports cuts. The data doesn't suggest that the labor market is screaming for cuts. You still have inflation data that is well above the 2% target. And at the end of the day, even though we've seen some financial market volatility, financial conditions are still very easy. We have huge flows into very risky parts of the market. Leveraged ETFs, options volume all suggest that there is ample liquidity. Yes, you've seen some rise in interest rates that suggest that there's some of the markets doing the tightening for the Fed. But at the end of the day, this is not a labor market that's falling off a cliff.
Okay, let's put this all together. If you were to see the stock market going down, let's say that the S&P falls by 15-20%, would that be enough to deliver cuts? Or is the underlying economy at the moment strong enough to survive the stock market dropping by 15-20% and the Fed doesn't have to do anything?
Yeah, I think that's a really fascinating question, because one of the reasons we think this U.S. economy has been so resilient is because of the wealth effect and because of the soaring stock market. And I think the question that I would add to that is that it's not just a drop in 15-20%, it's how long it lasts. If it's a very short drop where people don't see it on their statements at the end of the month, and you have a quick rebound like we had after Liberation Day or after the start of the Iran war, that kind of hit to the market is unlikely to dampen growth. But if you see a drop in the stock market that is protracted, you get to that 15-20% down, but it happens over a longer period of time, there is precedent that could weigh on consumer spending. That happened actually in the 2000s. There was a strong correlation between the path of the equity market in the early days of the 2000s bear market and overall consumer spending. So the wealth effect has been very powerful in supporting consumers, mostly because they've had negative real wage growth. So they've been having to dip deep into their pockets, and looking at things like stock market balances certainly has helped. If that starts to turn in the other direction, then the positive feedback loop that has supported markets and the economy could turn into a negative feedback loop, but it has to last for a while for it to matter.
Cameron, thanks for joining us this holiday. We really appreciate it. Love the spacesuit as well. Cameron Dawson of New Edge Wealth, we greatly appreciate it. Okay, let's get you up to speed what else you need to know. Here's your Bloomberg brief. Iran hosting foreign officials from key backers, including China and Russia, this weekend for the funeral of former Supreme Leader Ali Khamenei. Beijing will be represented by the deputy leaders of its top legislative body, and Russia by former President Dmitry Medvedev, who is now deputy chairman of the Russian Security Council. Some in the Labour Party here in the UK are worried that Andy Burnham risks repeating the mistakes of not being prepared for government as he delays key personnel decisions. It was a mistake, some would argue, that Keir Starmer made. Burnham won't announce key appointments until after the selection process for the party's new leader formally concludes, which could give new ministers a slim window to prepare, i.e. he's not Prime Minister yet. He doesn't want to name a cabinet because he's not Prime Minister yet, but that will leave him little time. New York City officials are now preparing the city for Taylor Swift and Travis Kelce's, who are expected to host a celebrity-studied event tonight at Madison Square Gardens with around 1,000 guests. The couple have reportedly donated $26 million to local and national charities ahead of their wedding. Recipients include the Food Bank for New York City and Dolly Parton's Imagination Library. And that is your Bloomberg Brief. Quick check on the markets just to tell you what is happening. We are looking at a market that is very quiet today, understandably, given the fact that it is the 3rd of July, i.e. effectively it is the 4th of July holiday that we are watching. So we're seeing quite cautious markets, but keep an eye on what is happening, things like the dollar with dollar yen. Everybody's anticipating that we could see maybe some action coming through from the Japanese authorities, who will take advantage of the thin liquidity. What are we going to see next, or what are we going to talk about next? The heat wave hits the US coast hard, reshaping plans for some 4th of July celebrations. We'll find out what's been affected next. This is Bloomberg.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the 3rd floor or the lobby. You actually have to start in the basement.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
47 minutes past the hour. Welcome back. You're watching Bloomberg Markets. I'm Guy Johnson. This 3rd of July. Let's talk about some of the corporate news that we are paying attention to this morning. Since its spin-off from Honeywell International, shares of Honeywell Aerospace have seen double-digit gains. Its CEO, Jim Courier, joined the close to discuss the path forward for this new company.
We're not seeing any decline in the air travel business that affects our portfolio, but I think it's important to understand when we think of commercial aerospace as part of Honeywell Aerospace, there's the commercial air transport section, which is airlines and airline traffic, OEM production rates, but as well as business aviation, where we have a very unique positioning with our products and technologies in business aviation. So half of our OEM business is actually business aviation. The other half is commercial air transport. Our commercial aftermarket business, which is what you're referring to in terms of airlines and flight travel and the like and flight hours, 60% of that is commercial air transport. 40% of it is business aviation. It's truly an underappreciated aspect of Honeywell Aerospace as to how much exposure we actually have in business aviation. And what we've seen as a result of the conflicts and the rising fuel prices is actually an uptick in flight hour traffic for business aviation.
Well, Jim, you mentioned that, being a standalone business, completing this spinoff, you can really just focus on your strategy, not necessarily being part of a conglomerate here. You also see a bunch of sell-side notes coming out, initiating coverage of you as a standalone. And Jefferies in particular points out that now you have a chance to run the M&A playbook. You've shut the books on the first day of trading. Where would you say M&A falls on your priority list? Is that something that you're evaluating?
Yeah, so as we discussed at our Investor Day in early June, there's 4 pillars upon our capital allocation strategy. First and foremost is investing capital into our factories and into the supply base to unlock additional capacity within the industrial supply base because we have so much demand for all of our products in commercial and defense. So that #1 priority for us. The more we can unlock, the more we can deliver on the $19 billion of backlog that we have, which is up 20% year on year, indicative of how much demand there is for our products and technologies. So that first and foremost is our top priority. Unlocking the supply base, increasing capacity, and deliver for our customers and for our shareholders in that regard. Specifically around M&A, that's #2 on our priority list. And if you think about what we did when we acquired 2 companies back in September of 2024, Case and Civitanavi, they fit into a very specific framework. First and foremost, technology differentiation. It's what Honeywell Aerospace has been founded upon, is being innovators and differentiating with our technology. So you must have differentiated technology and servicing a demand that's high growth in excess of the growth that we're seeing in our business today, which will outgrow what the market growth is right now for Honeywell Aerospace. If you have those 2 elements, then we look at who are you serving today? Are they the same customers? Are there synergies between what the target company may be doing and what Honeywell Aerospace is doing? And then the 4th piece of that rubric is really around, can we scale you greater than how you can scale yourself? And if you think about those 2 acquisitions that we did in September of 24, they hit all 4 parts of that rubric, and particularly on the scaling front.
That was, of course, the Honeywell Aerospace CEO, Jim Courier. Okay. It is hot in America. It is hot in New York. It is very hot in New York. We've got this heat dome that has settled over the East Coast. It's pushing New York City to its hottest day, we think now, since 2012. The soaring temperatures are disrupting the start of the long holiday weekend. Let's talk to Bloomberg's Miles Miller, who's in New York, about what is happening here and what could happen or not happen. Miles, first of all, how hot is it? How hot is it going to get this weekend? And what's on and what's off?
Yeah, we had a situation yesterday where the temperature reached the highest level in 14 years. We have quite a number of celebrations because, of course, New York plays a big role in America's 250th birthday. We've got the Parade of Tall Ships that starts today in earnest. We've got the ball drop in Times Square happening several times across all New York time zones, starting at 10 this morning. And with that comes the crowds. But it is so hot in New York. We had really taxing situation on our energy grid with a number of blackouts in small communities here. But of course, we're going to be hosting a large part of the celebration of the country's 250th birthday. We'll have the fireworks on both sides of both rivers here in Manhattan. And then again, that parade of tall ships, which means that a lot of people from around the world are going to be here in New York and are going to be really hot. It's not just New York, of course. It's also going to be in D.C. and in Philly, too, for these celebrations. We have learned that Philly is going to scale back their celebration because of that. Will the celebration on Capitol Hill that is normal for 4th of July actually go on as planned? It's unclear. All these cities are making these changes in real time because it is just simply too hot.
Yep. Too hot to handle. So my next question is, does Madison Square Gardens have air conditioning?
All right, so let's talk a little bit about Madison Square Garden, right? The air conditioning, where I was at Madison Square Garden for one of the Knicks watch parties, and then after the Knicks won, I was there for a taping with some of the big Knicks fans, right? The AC works well. The issue is downstairs on the track level. Yesterday it was 140 degrees, which meant trains that were trying to get out of Penn Station, which is connected to Madison Square Garden, couldn't get anywhere. I think you're asking because of the wedding that is very top secret. I think the AC was working really well last night for folks like Jack Antonoff, who went to this rehearsal dinner.
Yeah, so we're talking about Taylor Swift's wedding here, basically, and I'm wondering whether she is going to be disrupted by the weather, and it doesn't sound like she is going to be. How much disruption is it, though, causing within the city?
Oh, it's causing a lot of disruption, right? Whenever we see temperatures reach these levels, we have issues with the energy grid. We have issues with people being able to, run their AC, at a good level. And that is going to be the crux of the issue in these next couple of days with this heat wave. How do you manage all these folks coming in and out for a big wedding, for the World Cup, and to see the big ships and the fireworks with this extreme heat? In a number of these places, you can't bring in water bottles and all that kind of stuff. You got to have sort of these plastic water bottles. And then, the price goes up when it's a special event. So, people coming out should really figure out how to be patient and how to keep cool in the best way they know how.
Stay patient, keep cool, and stay hydrated. You make a good point. Miles, great stuff. Thank you very much indeed. Miles Miller joining us on how hot it is this weekend in New York. Europe and the United States certainly facing heat issues right now. There's a lack of heat in the market right now, and the reason for that is quite simply the fact that we do have the United States out today for the 4th of July celebrations, a particularly big celebration, obviously, with 250 being notched up by the United States. And that means that we're seeing very, very light volume. Equity markets aren't really doing very much today. Keep an eye, though, on what is happening in particular with the dollar-yen trade. We are watching very carefully to see what happens and to whether or not we get some intervention. We've seen a little bit of volatility already in dollar-yen this morning, but we are watching to see whether Japanese authorities take advantage of the light volume, maybe to intervene, to put in a near-term top for dollar-yen. Anyway, we'll discuss all of this next, plus also the AI trade. Fawaz Chowdhury of Horizon Global Partners is going to be joining us. We'll talk geopolitics with Tina Fordham of Fordham Global Foresight. That's all coming up. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
I've been called worse things than that.
She owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. You know, when you're hot on the trail of something, you know that it's very exciting. What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it Paradise ahead or Gattaca?
Maybe somewhere in the middle.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Welcome back. You're watching Bloomberg Markets at noon in London, 7 a.m. in New York. We've got a lot to talk about, so let's get you updated this 4th of July weekend holiday. What are we going to be doing? We're going to need to talk about Asian stocks. They're climbing, along with most of Europe. The yen strengthening past 161, but fairly flattish, to be honest. U.S. markets are closed for the holiday, though we do have futures trading, which is worth paying attention to. In terms of the geopolitics, the U.S.-Iran peace talks are on hold as Tehran holds the funeral service for the former Supreme Leader Ali Khamenei. And Bloomberg is learning that President Donald Trump and his allies are renewing a push to reshape the Federal Reserve, with the Governor Lisa Cook still a target. Markets look like this. Let's give you a sense of what is happening. I just want to point out that volume is very, very, very low as we come into the afternoon here in Europe with the US out. S&P futures are a little bit higher. We're up by 0.3%. Dollar yen is doing absolutely nothing. We're keeping an eye on that. We've seen a little bit of volatility overnight. Brent crude is doing nothing as well. We're up by 0.2% as we watch what happens in the Gulf this weekend. European equities are up by 0.2%, but again, very light volume. The dollar's down a little bit on the back of the payroll number that we saw yesterday. And with the dollar down, gold is up by 1.3%. So that's kind of the basic view of what is happening with this market. For a more sophisticated view, Natalia Knezovic joins us now to take a look at what is happening. And let's start with the options picture. What are you seeing there?
So on the one hand, Guy, we see that there are some concerns about AI trade, memory stocks, momentum. We saw big decline, huge declines across momentum baskets. But the options market is telling us that people are actually bullish. So, for example, demand for upside calls on the largest ETF tracking the NASDAQ 100 is now rising faster than on broader markets. So, for example, cost of call options on technology stocks is sitting at the highest level since 2007. people are bullish. This is a signal that rotation into AI and growth stocks continues. Another thing that I would like to point out is that we see that correlation between single stocks is the lowest in almost 15 years. This is data from Goldman Sachs, but I'm sure we have something on Bloomberg Terminal as well. It tells us this is a single stock pickers market, right? So people are trying to find opportunities across single stocks as they don't, trade.
What's interesting is that it's all cancelling itself out to actually deliver a VIX, which is still relatively low. Retail? What's retail?
Yes. As we know, retail traders is becoming one of the biggest players in the U.S. stock market. We see that data from Citadel Securities shows that May and June trading volume across equities in the U.S. was the highest ever. Moreover, it was about 65% above average levels for 2025. So retail traders are participating, and looking forward, I think it's really important to keep an eye on cash balance sheets for individual traders. And again, data from Citadel Securities tells us that they have a lot of cash to deploy, so they still have the so-called dry powder that can invest into U.S. stock market.
And there's plenty of leverage in this market as well, which is an interesting factor to bear in mind as well. Natalia is going to be back. She'll keep us updated on what we need to know about these markets throughout the morning. Let's get another perspective. Huaz Chowdhury, Chief Investment Officer at Horizon Global Partners, joins us now. Folks, we're just hearing the market is buying calls on tech stocks. Is this a tech rally that is still worth chasing?
Yeah, absolutely. I don't know, there's a pullback. Momentum factor you mentioned has pulled back. There's consternation around crowding in the memory trade. But all the revisions are positive. Hyperscaler CapEx continues to be revised up. There's some concern around Meta's news flow that they are going to be offering cloud infrastructure themselves, so there are concerns around oversupply. But we certainly feel that overall compute demand is still rising, and we are supply constrained on compute demand.
Are you happy with the multiples that you're seeing with tech stocks?
Multiples are not stretched at all. I mean, if you look at S&P as a whole, 2 years out, it's only 17p. Some of the companies, the biggest companies like NVIDIA or Micron or others, 2 years out, NVIDIA is now 13.5, 14p, 2 years out. Now, I understand they're cyclical stocks and semiconductor stocks. Generally, there's concern that earnings could be peaking, so low multiple is a reflection of that. With that said, I think still CapEx revisions are positive. Hyperscaler CapEx is continuing to get revised up for next year and the year after. So I don't think multiples are stretched. Free cash flow generation is robust. So I think the buybacks will continue from these companies.
The earnings estimates are getting jacked up at a very fast pace for us, and people are saying we're in an earnings bubble, that you don't normally see this rate of acceleration in terms of earnings estimates outside a bounce back from a big crisis. You are 100% comfortable that these earnings numbers, the E, is okay?
I think you have to understand that the cyclical companies have huge operational gearing. We are in a global CapEx cycle, whether it's semiconductors, but even industrial companies, grid equipment, transformers, etc. There's a shortage of a lot of equipment out there, including memory. And then these companies, when you get pricing power, you get huge earnings growth. Now, they're cyclical. At some point, the earnings will peak. I'm saying next 2-3 years out, we know that, for example, if memory shortage or other shortages, they will continue. So at some point, the earnings will peak because it's cyclical. And because these companies have become that much bigger in the overall index, the overall index is more cyclical. S&P is now more cyclical. NASDAQ is more cyclical. Yeah. But it's not a bubble. No.
There's another word for pricing power. There's another word for shortages, and that word is inflation. How much of a challenge is that going to be?
Oh, yeah. I think the real rates are moving up to reflect this. So if you look at the 10-year real rates, they are rising. And I think that initial move in February, March, April especially, people attributed that to oil, as inflation coming from oil and the oil shock. But as the oil prices come back to $70 and the Hormuz shock has faded, real rates have stayed high. And now there's concern, which is rightly so, that it is a more demand-led inflation, not a oil supply shock. And that is because we're in a global capex cycle and there's a shortage of stuff. We're not going to see demand destruction of DRAM pricing or semiconductors at these higher price levels because it's demand-led. So this will cause global neutral rates to rise, inflation to come, and real rates to be higher. So that will constrain the ability of the central banks to be dovish or to cut rates.
Okay, so what level of interest rate hikes, and it's usually about pace and level, what would be a problem, do you think, for this stock market?
I don't think the stock market necessarily will see a problem because the companies which are the largest companies in the stock market, it's a very narrow index. And if you look at the likes of NVIDIA or Broadcom or Mac, I don't think there will be much of a pullback in their multiples because of higher rates. If we are saying that the index is more cyclical companies have lower Ps, like Micron or even NVIDIA now, and lower Ps then don't react as much to long-term interest rates. So if the index is more cyclical, yes, we should be concerned about when earnings peak, but that simultaneously, we cannot be concerned about the interest rates impacting it because the index is becoming shorter duration, not longer duration. So I don't think interest rates higher will either constrain capex or the multiple.
Okay. Do you think that the vulnerability of the US tech sector could lie elsewhere, i.e. not in the United States? I look at the Cosby. I look at the levels that have been achieved this year. I look at the narrowness of that market. I look at the leverage, the extreme leverage that is now in that market. If you were to see the Cosby roll over aggressively, what would be the feedback story back into the NASDAQ?
I think people are looking at Cosby, and within Cosby is really SK Hynix. There are only 3 companies in the world that can make memory. There's a shortage of memory. And within that, Hynix has been the only one making high bandwidth memory for a long time. And now Micron is going to start making it and delivering it. So almost every NVIDIA graphics card is basically SK Hynix high bandwidth memory. So, but that is well earned. This is a new segment for memory that opened, graphics cards for data centers. And they're at 80% gross margins. It's a monopoly pricing. So, and it's still 5P 2 years out, the stock. So they're making money hand over fist. Hynix will have $330 billion of revenues next year and higher operating profits, $250 billion operating profits, higher than Microsoft, double the amount from Amazon. So it's a very profitable business. Now, at some point it will peak, but I think they're looking good. I think Hynix is looking good. I think Cosby is looking good despite the rally.
So but you still think that the semi-sector is cyclical?
Semi-sector is cyclical. It's just a super cycle. And we're all debating how high and how large the cycle is. There's no doubt semi-sector will remain cyclical. Hynix is doubling its capacity over the next 4 years. At some point in the future, we will get an oversupply of memory. But next 2 years or next 3 years, we are still going to be constrained. No, there is no doubt that the sector will remain cyclical like it has for the last 40 years.
Absolutely. Fawaz, great to catch up. Thank you very much indeed for joining us this holiday. Fawaz Chowdhury of Horizon Global Partners. We appreciate it. Let's get you a quick update on what else you need to know this morning. Here is your Bloomberg brief. The US is pressing gasoline retailers to pass on lower fuel costs to consumers. The Treasury Secretary, Scott Bessent, telling CBS News he expects average prices to fall to $3 a gallon by Labor Day. Citi sees Brent falling to 60 to 65 a barrel by year end, and this as we see the US-Iran MOU expected to hold. We'll talk about that in just a moment. A dangerous heat wave is gripping the US East Coast as millions prepare to celebrate the 4th of July. Outdoors, the worst conditions are now underway, with many records already being broken. Cities are seeing major strain on power grids as people look to stay cool with their air conditioning in their homes and their businesses. In sports, Spain delivered a dominant performance in the World Cup to beat Austria 3-0 last night, and they booked a place as a result in the round of 16. Spain will face Portugal after Portugal's 2-1 victory over Croatia, and Argentina now faces Cape Verde later today. Australia faces off with Egypt. And that is your Bloomberg Brief. Quick check on the markets just to see where we are. As I say, we are seeing very light volume. S&P futures are up by 0.3%. Dollar yen is doing absolutely nothing. Brent crude is doing absolutely nothing. Very light volume in those spaces. European equities are a little higher, but beginning to fade now as we enter the afternoon session, where we'd normally see volume supplied by the US. The dollar is down post-payrolls. Actually, gold is benefiting on that story. Up next, we'll get back to the chip story and get more details as to what is happening there. Chip stocks posting their best quarter ever. Is there still room to run? We were just hearing from Fawaz that he thinks there is. What's the view from elsewhere? We'll find out next. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
14 minutes past the hour. Welcome back. You're watching Bloomberg Markets. I'm Guy Johnson. Let's talk about power prices and electricity grids. The national grid in the UK is looking to capitalise on the AI data centre boom. The UK utility company announcing plans to invest $1.8 billion into a firm developing power generation for Microsoft. National Grid's CEO spoke to Danny Berger following the news.
National Grid has long been invested in delivering energy through long-term infrastructure to our customers. And so in some respects, you could say this is exactly what this acquisition that we've invested in today is all about. But to your point, we are now facing that sector of the market that is growing so rapidly. I mean, the increase in power demand coming from data centers and just more generally from the AI evolving economy, it's an exciting place for us to find ourselves.
It feels like it's really rewriting things really quickly, Zoe, and I wonder how far away you think we are from being able to keep up with the demand from it.
Well, that's why I think this investment is so important for us. What we've done in investing in Juland, which is a technology-enabled energy company, is find ways to actually bring the very best that we can across different sectors to harness that innovation and get the right solutions so that we can actually get speed and scaled power to customers really quickly. And if you take a look at the specific project that we're developing, Project Kilby, you can actually bring the very best of the cultural opportunities from Microsoft, from an energy major like Chevron, through Juland, who's brought that innovation together. And that's what's giving us, I think, a real advantage, real pace to deliver the power, but also the opportunity to scale that over time.
You know, I myself lived in London for about 7 years, so I'm very familiar with National Grid. But to see you coming over into the U.S. itself is an interesting turn. Do you think this is the start of many more opportunities for you in America?
It's interesting, Danny. Most people aren't aware, but we already have quite a significant scaled position in the US. We are servicing already both the LDCs, the local distribution companies for gas, in both Massachusetts and New York. And of course, we have a very big presence there around our electric utilities as well. So we have in our 5-year horizon, as an example, about £70 billion. So let's say between 90 to sort of 95 billion US dollars, of which we have about 40% of that being invested in the northeast of the US. So we've got great capability, not just across the broader company, but already in the US that helps us to bring momentum behind this acquisition that we're announcing today.
There are many who are, see the opportunity like you do, Zoe, in trying to provide energy and different utility to data center projects. Is there any part of the market you think looks frothy?
Look, I think what we have found is that whilst the numbers of data centre in the queue are significant, that the drivers behind needing this speed to power continue to be solidified in all of the conversations that we're having. And so, of course, we have conversations across many of our jurisdictions, both with data centre developers, but also with the tech companies that sit behind. And I think it really is a challenging domain, and it's really about pace. And I think what's exciting about this investment that we're making, it's really through the Dualant vehicle, finding a way to crack that equation. It's about speed, but it's also about doing speed at scale. And I think that's what's most exciting. And that's the unlock, I would say, around underpinning those that are real projects that really want to put money behind investing versus those that perhaps are more speculative and seeing what might pan out.
How do you deal with the politics of the situation, Zoe? I was just looking, there is even a lawsuit this morning around AI, very, very different from energy and what you're doing, but specifically around Albertsons and Walmart using AI algorithms to determine the price of gasoline at their pumps. I mean, there is this real deep backlash occurring in the United States right now about this fear AI is going to be driving up my utility bills. How do you navigate that environment, especially ahead of the midterms when politicians are taking note?
Yeah, and the first thing I would say when it comes to specifically building projects is that we must do so in a way that's really deeply respectful for the communities that we find ourselves operating in. And that's the way we've always gone about our projects. There's a lot of opportunity for community consultation, to get input from the local communities, and to make sure that we're welcome in the jurisdictions that we're building in. I think that broader debate is something that, of course, will play out over the course of time, but we're really focusing on the things that we can control, where we have unique capabilities that we can bring to the story, and that's really about creating that affordable power that's reliable in the current context.
I understand the desire to only focus on things you can control, but when you can't control them, isn't that a real risk for the build-out?
Well, I think there's the potential that these things could play out at different rates than perhaps might be anticipated. But I can tell you from our own 5-year forecast, we have solidified plans around our investment in that sort of 90 to 95 billion US dollars, which is underpinned in our jurisdictions for regulatory rate cases that are firm. And so I think we can speak with confidence in the next 5 years exactly what projects we will be delivering and by when. When we come to this particular announcement today, we've also got a firm PPA in place. This is something that's been signed by Microsoft for the Kilby project. And so this isn't sort of a speculative investment. This is really underpinned by the fundamentals around customers and actually meeting that demand with the right infrastructure and energy players.
Hey, Zoe, just quickly, because you mentioned you have commitments. What do you make of those more speculative projects? There have been quite a few of, some politician leases some land, doesn't have a hyperscaler committed to it yet, but hopes that they will. I mean, do you think that those will find the right path and find the right commitments, or do you think that there maybe is some speculation that concerns you in the overall market right now?
Well, I can really speak from the jurisdictions that we're most familiar with, and I think we see that there's a project maturity that evolves over time. So inevitably, there's a lot in the queue. We find that narrows quite quickly when you start to get into establishing contracts around capacity that people will take, and that very quickly sort of starts to simplify those that are more speculative versus those that ultimately are putting money in the ground. And so I think in our jurisdictions, we actually have a pipeline that's substantially larger, but the projects that we're actually doing designing and construction around are firm projects. They've got real money behind them, and we work very closely with the integration of how the projects are being built and how those connections into the grids might take place.
The CEO of National Grid, speaking of course there to Bloomberg's Danny Berger. Let's talk about another aspect of all of this. Where are all those electrons going? Well, most of them increasingly feel like they're going into semiconductor chips, a sector that has just posted its best quarter ever, driven, of course, by the insatiable demand we are seeing for all things AI equipment. But after some recent jitters sent some of these stocks tumbling, investors are wondering how much further this rally can go. Let's try and answer that question now with Matt Bloxham of Bloomberg Intelligence, who joins us around the table. Matt, further to go?
I think definitely in the short term, the answer is undoubtedly yes. I mean, if you look at just CapEx for this year across the kind of big hyperscalers, it's up $300 billion year on year in 26. It's almost doubling, and the market expects another $200 to $300 billion of incremental CapEx on top of that. So getting north of $900 billion of annual CapEx across 5 companies in 2027. And that's kind of fueled by almost a bit of a kind of technology land grab. They're all building capacity, anticipation there's going to be runaway demand from enterprises for the capacity they're building. And so that's the big question, is are enterprise investments in AI moving from kind of proof of concept into scaled deployment? And that is this question that I think we're not going to get a clear answer to for maybe another 12 months or so. My sense would be that it was probably going to end up being a bit slower than people think. There's clearly some industries that are racing ahead, but I think assuming a kind of cross-industry-wide kind of surge is probably unrealistic, because there's still a lot of stuff to work out around the productivity gains of AI or the revenue gains of AI, and the costs are starting to creep up. You can't hide the cost of token usage for too long, and I think a lot of companies are now starting to grapple that. Anecdotally, you hear evidence of companies figuring out cute ways to reduce or limit the growth in token spend, either caching or using small language models. So you're kind of starting to see some signs that this is starting to become a noticeable cost item, and having to think about ways around that because the top line benefits aren't there yet.
What is the inflation rate for kind of chips right now? Kind of how fast is it still?
It's a good question. I mean, I think if you look, obviously, one of the things in focus is the memory chips. I'd say that, we're kind of probably looking at, 50% plus expansion in cost year on year, possibly higher. And, there's a real bun fight out there for the capacity. These companies, SK Hynix, Samsung, Micron, they can't build the capacity quick enough to meet the demand that's right now. So, we're seeing cute examples of companies, for example, Apple looking to get permission to use Chinese manufacturers for Chinese equipment. Elon Musk is talking about building his own memory chips. He's obviously got this Terafab project between SpaceX and Tesla. So people are looking at the rising costs. They're looking at the limited supply and thinking maybe it's time for us to think about different strategic answers to this issue.
The semiconductor sector is notorious for being cyclical. Yeah. And the end of the cycle is usually brutal. Mm-hmm. Is that what we are heading for at some point? I don't know when. It's hard to call.
I think you have to, if history is your guide, I think you have to kind of assume there's a good likelihood that that's where we end up. Hopefully, some of these chip manufacturers have learned that lesson, and although they've, this big, $1 trillion plus announcement from Samsung and SK Hynix early in the week, hopefully that doubling of capacity is going to be done in a phased way, so that if there is a slowdown of demand, they haven't committed too much capital too quickly, they get stranded assets. But if you look at the valuation multiples for those companies, the forward PE is a single digit. The market is not assuming this is sustainable. They're assuming this is a kind of short-term kind of phenomena, if you like, and that we're going to return to normal service at some point in the coming years.
Matt, great to catch up. Thank you very much indeed. Always appreciate the time. Matt Bloxham of Bloomberg Intelligence. Still ahead, we're going to talk geopolitics, figure out what is happening. The US-Iran peace talks remain on pause right now. Tina Fordham of Fordham Global Foresights is going to be joining us very shortly. We'll get her take on what is happening here and what the oil price is telling us. We'll do that next. This is Bloomberg.
weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
Friday the 3rd, half past the hour. Welcome back. You're watching Bloomberg Markets. I'm Guy Johnson here in London. Of course, it is the 4th of July weekend in the United States, a very special one this year, of course, but we are seeing very light volume as a result of the Americans' absence. If you look at what you're seeing in London on the AVATS sort of column on your Bloomberg, you'll see Eurostoxx 50 down by 35% in terms of the volume. If you look at the IBEX in Spain, down by nearly a half. So the takeaway basically is that you're not getting much volume out of this market. S&P futures are largely unchanged. In fact, most things are unchanged. Even dollar-yen, which we're expecting some volatility in today, is largely unchanged. Brent, we'll come back to that in a moment. European equities were up 2/3 of 1%, beginning to maybe fade some of that now. As you can see, we're up by less than 1/10 of 1%. The dollar is becalmed. In fact, one of the biggest gains this morning is gold. After the payroll data we saw yesterday, which was maybe a little weaker than anticipated, we are seeing with the dollar down, gold gaining some traction. So that's the kind of the macro top-down picture. Let's actually come at it from the other angle and talk about some single stocks and what we are watching there. Natalia is back with some details. What are you watching?
Let's start with L'Oreal. So shares are down by 3.3%. This is the second worst performing stock in European equity benchmark. JP Morgan analysts are expecting that the second quarter results will be strong, like-for-like sales growth of about 5%, but then starting from there, they say that growth might slow down as demand for cosmetics, skincare, and makeup begins to weaken in key markets in U.S. and Europe. And you know what Alex Steele would say in this case?
Skincare matters.
No, invest in your face.
Invest in your face. Also, skincare matters, believe you me. That was one of the key touch lines. What else are we watching? Pharmaceuticals, anything there?
Yes, so Abivax. So this is, I believe it's the best performing stock today. Shares are up by 9% today. So the company eased some concerns about safety of its experimental drugs, and then it reinforced speculation that it could become a target for a takeover. Shares are up almost 60% for the week after almost 1,700% gain in 2025. And then finally, I'm also watching Stellantis. Shares are down by almost 2% today. HSBC downgraded the stock. They say there are some concerns about cash outflows and potential need for destocking.
Okay, the auto sector continues to struggle. Natalia, thank you very much indeed, Natalia Knezevich, on what is happening with the single stock stories. Let's go macro again and figure out what is happening. The oil price is currently Brent 71.73, a little softer, but basically unchanged on the session. This as we watch very carefully what is happening with the peace talks that are taking place between the United States and Iran. Temporarily paused at this stage. The reason for that is that Tehran is beginning a week of mourning for the former Supreme Leader Khamenei. President Trump, though, telling reporters Wednesday there was progress between these two countries as we see negotiations, maybe proceeding, but maybe at a more gradual pace. Let's talk about how you kind of price all this in and whether or not the oil price is actually a fair reflection of the reality on the ground. Tina Fordham, founder and geopolitical strategist at Fordham Global Insights, joining us now. Foresight even, not Insight, Foresight, I'll get that right. WTI crude is currently at 65. Brent crude is currently at 71. Both those two numbers have come down really sharply over the last few weeks. Too sharply?
Well, markets are telling us that the war is over.
Yes.
The peace deal, the memorandum of understanding, is wafer thin.
Yes.
In Monty Python terms. There is a lot of triumph of hope over experience going on. I saw that my former colleagues at Citi have oil back down to 60 by year end. And, you know, what we're seeing is countries are stockpiling. But at the same time, if you look at the language that President Trump is using, he still talks quite openly about blowing Iran to smithereens, or, you know, insert choice word here. And at the same time, Iran is stronger than it was before by a certain number of metrics. So yes, markets are getting ahead of themselves, but markets are going to market.
Yeah, they certainly are. So let's talk about what could go wrong. My read of the Iranian outlook is that now they know they are determined not to lose control of the Strait of Hormuz, regardless almost of what the Americans will say. The Americans are saying, here's a load of money, keep the Strait of Hormuz open. And the Iranians are going, well, we could just charge a toll and then we get loads of money. So actually, why do we need to worry about what you're saying?
And that's why, I mean, the oil price action, the shift back to fundamentals, not surprising. You know, markets are doing what they're supposed to be doing, but the strategic context has really changed, not just in the Middle East, where, you know, the Israeli-U.S. war on Iran had an impact and changed the power dynamics in the region, just not the way they wanted them to. But this idea of monetizing the Strait of Hormuz, which was not, you know, that was not the practice of Iran before. It's a change in trend. It's a revenue generator. It's also an idea to inspire other countries sitting near choke points in strategic waterways. So this war, mark my words, will have a ripple effect, what I call a geopolitics butterfly effect, well beyond this, because Iran has ended up having a loaded gun, if you like, pointed at global oil markets.
Which other straits would you watch?
Well, the Straits of Malacca come to mind, but, you know, the Panama Canal was previously in the news. And while we are, you know, monetizing and optimizing and stockpiling and concentrating and sovereignty and autonomy, you know, the pressures on natural resources and on any strategic waterways are building. And what else do we see in response to that? More pipelines being built, diversification kind of being key.
Iran to Taiwan. Let's just kind of make that connection as well. How do you think the Chinese are? The Chinese are sending a delegation to Tehran this weekend. What lessons will they learn from the Iranians?
Well, of course, China will be and has been watching very carefully what happens with Iran. They weren't as impacted as we were here in Europe by the supply shortage. And, of course, China has done something that the U.S. hasn't, which is build up its green energy and its alternative kinds of supplies. You know, China has ended up benefiting, including by some of the, you know, softer metrics that I like to look at, including that the world trusts China more than the United States right now. It looks like a reliable and stable partner. Does that then mean that the geostrategic calculus in Beijing shifts to unifying with Taiwan? Maybe they're not in a rush, or maybe they start doing something they often do, which is use salami tactics to test the waters, because it would be immensely to China's advantage if it were able to show that the U.S. won't implement its security guarantee. And that, again, would have a ripple effect with Japan, Philippines, and other Asian neighbors, Australia.
Back to the Strait of Hormuz. What I'm hearing is that you think that the oil price should go higher from here, not lower from here.
I mean, markets are reacting to the supply dynamics. There are still, 8,000 sailors trapped. I have clients in maritime law who are not feeling confident. But, you know, it was always the case, for example, that the onset of U.S. shale would change the price dynamics of the Middle East, and geopolitical developments in the Middle East don't have the oil price impact that they did in 1974. So we've seen that demonstrated. But what we've also seen is that the United States is not able to dislodge an adversary that it has superior military power over without undertaking significant risk. And what I'm saying is that sends a message to others.
One final quick question. What is your assessment of where we are on the battlefield in Ukraine?
Well, what Ukraine has managed to pull off is nothing short of remarkable. They are holding the line in those eastern territories that Russia has had for the last few years with drones only. The death toll of Russian soldiers continues to be off the charts. The Kiel Institute published a report this week about the strain happening in Russia. And at the same time, you know, Ukraine is firing deep inside Russian territory, including in St. Petersburg, around the time of Putin's annual confab there, the St. Petersburg Economic Forum. Around Crimea, there is a reasonable chance, General Petraeus said this week, that there's a reasonable chance that Ukraine is able to take back Crimea. That would be hugely symbolic. And of course, next week, NATO leaders, including President Trump, will gather in Ankara. And these two conflicts, Iran and Ukraine, will be top of the list there. I mean, Ukraine has ended up being the strongest and best prepared army in Europe. And that was not something anyone predicted 4 years ago after the Russian invasion.
But Putin certainly didn't anticipate that. Tina, nice to see you. Thank you very much indeed for stopping by to see us. Tina Fordham of Fordham Global Foresight. Thank you very much indeed. What else do you need to know this Friday? Let's get you up to speed. Here is your Bloomberg brief. The US President, Donald Trump, and his allies are renewing a push to reshape the Federal Reserve after the Supreme Court blocked efforts to fire Governor Lisa Cook. Top officials and outside allies are exploring ways to remove members of the Fed's Board of Governors to clear the way for more of the president's own picks. Here in the UK, some in the Labour Party are worried that Andy Burnham risks repeating the mistake of not being prepared for government. A similar mistake was made, of course, by Keir Starmer. This as he delays key personnel decisions. Burnham won't announce key appointments, such as the Chancellor, until after the selection process for the party's new leader formally concludes, which effectively will put him in to 10 Downing Street, making him Prime Minister. But that will leave him and his ministers with a very narrow window to prepare for government. And Michael Burry says the Micron rally has reached historically extreme levels. In a Substack post, the Big Short investor wrote he is shorting the stock, claiming its recent gains have been driven by AI hype and investor FOMO rather than fundamentals. And you're up to speed. That was your Bloomberg brief. Quick check on the markets just to show you what is happening. It is a quiet session, as we've already indicated, as a result of the holiday that is taking place over in the United States. Volume is like pretty much across the piece. S&P's up slightly in terms of the futures picture. Dollar yen doing nothing. Brent crude doing absolutely nothing as well at 71.65. European equities have faded an earlier rally and are now up by 1/10%. The dollar is down a touch after the payrolls yesterday. In fact, the surprise this morning is that gold is finding maybe a little bit of traction. Let's get back to that story, though, or we'll come back to that story of the heat in the United States in just a moment. It is, of course, the wedding of the century. Yes, this weekend in New York, and it's super hot. Taylor Swift and Travis Kelce reportedly preparing to tie the knot in New York City in the heat. We'll find out whether they've got air conditioning next. This is Bloomberg.
anything we do in Africa is going to be more risky than the U.S. I think the approach we want to take is how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation is a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
Listen, I'm more concerned about, last month, people were tremendously excited about a big jobs number. But if you actually broke it down last month, you had I think it was 54,000 jobs in state and local, and we didn't really get anything this month. And then you had this huge bump in restaurants and in bars, and then obviously that came off significantly, although I'm surprised it actually came off that much this month. I thought it would have taken another month or two for that to come off. But listen, I think that the hiring in the country is just okay. I mean, I think it is, I think Mike McKee said it right. It's stable, it's okay, but you've got an economy that's growing at some pretty significant numbers, and the employment picture is just okay. I just don't think we are hiring that many people. And I was looking at some of the data earlier in the week, the Challenger job cuts data. You had layoffs, I think, in tech of 443,000 jobs. That's up 83% year on year of increased cuts. So anyway, I think, when you break it down and I look across industries, once again, healthcare is incredible. I mean, look at healthcare and education, 67,000 of the, 57,000 jobs. It's all healthcare and education. And so anyway, I think the hiring is stable, but I would say broadly unimpressive. And, one man's opinion, that's part of why I don't really understand, significant raises in interest rates relative to this. I think we're in an employment dynamic today that is just okay. And, I'll say one thing about, you saw that, the hiring, maybe we don't have enough people because the labor force declined, but you've seen a persistent decline in average hourly earnings or wage or earnings data. And that doesn't suggest that companies are stressed about hiring people when you're not really seeing any significant wage growth. So anyway, one man's opinion, good economy, employment, just okay.
You are one man, but you are one man we respect and happens to be incredibly brilliant. So your thoughts matter a lot, Rick. Okay, so you don't see any reason to hike based on this data, but it is at least data that should allow the Fed to hold, or do you go so far as to say with this data in hand, there is room for the Fed to be contemplating cuts this year?
I mean, I don't think contemplating cuts, at the beginning of the or the next meeting or two, I think would certainly be enthusiastic to say the least. Listen, I think you got to wait to the back end of the year or to the very back part of the year. But I don't think they're off the table for the back part of the year. I mean, I think Chair Warsh said yesterday, you are seeing, and by the way, you look at oil now under 70, you are seeing some improvement in energy costs. When you break down inflation and you look at what is the component parts of inflation today, core goods is running at pretty close to zero, 3-month, 6-month moving average, pretty close to zero. You still have service level inflation, which no doubt is too high. But if you strip out shelter, And I would argue, if we got mortgage rates down in the country, you'd improve shelter inflation. You're running at, depending on 3 months, 6 months, 2.5 to 3-ish, a little over 3. So anyway, I just think you have time. And I think Chair Warsh, and by the way, I have a huge applause for stepping back and thinking about, through task force and otherwise, the way you actually improve inflation when you've got sticky things like healthcare, education, insurance that don't really get impacted by the overnight funds rate. There are other tools you have. These things are really complex. Let's get some experts to analyze. Are we restrictive on the overnight funds rate? Well, not in housing, but maybe some other places. Or sorry, maybe you are restrictive in housing, I should say, but maybe not in other places. These things are really complex, and I applaud the fact you're going to really step back, think about what are some really complex issues, and what are the most appropriate tools to try and deal with those effectively.
Rick, there are many people who have expressed discomfort, let's say, about a Fed chair who's not more giving in his reaction function, in his understanding of how he sees the labor market, for example. Claudia Salm was talking about that with Tom Keene on Surveillance Radio just about an hour or so ago. Does that make you uncomfortable at all? Not necessarily that we're not getting forward guidance, but we're at least not getting more insight into how Chair Warsh is thinking about labor market, about inflation, about these key issues that the market needs to trade on and that matter for our economy.
And I really don't. I actually think, the way it was articulated, in that first press conference about, you want to see what the market's reaction function is to move to the dots. And by the way, if you look at historically, the forecast of the dots, particularly after you go out a quarter or so, not really very good. The fact that the markets have to pivot to those numbers or pivot to the Fed's reaction function, I actually don't think that's right. And I think there's a real elegance to, if you want to move, if you really want policy to be effective, you actually want to create change. You don't have to, particularly when you're easing, you don't have to be so prescriptive about that change. You actually want to create a little bit of energy and a little bit of surprise, because that's how you create economic and financial velocity. So, do you have at inflection points a little bit more volatility? Maybe. But I think at the end, I thought he made a statement that said, when we have something to say, we're going to say it. I like it. Like that to me is like, as long as you lay out the metrics, what are the benchmarks you're looking at, and then the markets can interpret those and make their decisions based on what those metrics and what your clear path of focus is versus the Fed having to tell you specifically, here's where we're going to go with it.
Let's talk about the market reaction, right? Because post-FOMC, it had been one of higher yields where the 10-year yield started to bump up against 5.5%. We back off of that this morning, 2-year yields declining 4 basis points. Do you think we've seen a peak in yields now?
I will say one thing. I think I did a presentation that I said it's summertime, time to get serious. Although I go on a long weekend, I'm not sure everybody's as serious. But listen, I think these real rates are pretty interesting now. We're not adding a lot of interest rate exposure yet, but you're getting to the point where these real rates are pretty interesting, particularly if you think, which we do, that you'll see some abating of inflation. You're seeing that with energy costs, et cetera. So our view today is, I don't think we're going to make a lot of money on interest rate exposure. I actually think Europe's interesting because you see growth tangibly slowing and you're pricing in significant hikes. I think Europe, days like today, you get a little bit of softness, maybe add some European duration, or maybe we did. I think that's more interesting. In the U.S., gosh, I think income, like let's just carry. And if you can keep your income up, you're in this amazing environment with these real rates and with some spread, you can create 6.5% yields or even a bit above that. And to me, that's a much better disposition than like, gosh, I think the Fed's going to cut, because they're clearly not going there anytime soon.
Well, when it comes to Bank, year to date, your total return is certainly exceeding the ag, both in the U.S. and globally. That also stands if you take it out from a wider time horizon, too. I know you were also discussing on ETF IQ this idea that IG beta is less interesting to you. So where in this American market are you squeezing out the yield?
There's a little bit of, I call it dynamic patience. There's, the new issue markets give you some opportunity. High yield is still, particularly Europe, like some of these spread markets, if you're a dollar investor, you swap back to dollars. European high yield, even European IG is pretty attractive when you bring it back to dollars. And, particularly if you believe Europe is going to have to reduce rates over time. EM gets you some yield, and there's some places to pick up some yield across emerging markets. Securitized markets, you know, there's so many things to do in securitized markets around commercial, residential, non-agency, et cetera. So it's those areas. And, you know, I think we're in one of those environments. You pick a little bit here, you pick a little bit there. There's yield everywhere. And I just find like where you get really tight trading levels like USIG when there's a lot of supply coming. Yeah, agency mortgages are just okay. You know, we trade them around a lot. But you know, I like clipping coupon in some of the high yield markets and then going global to get some of that yield.
Hey, Rick, I hate to do this to you. I only got 30 seconds, but I would just love to get your thoughts. The pace of issuance for IG, already $1.1 trillion. Is that sustainable?
It's a lot. And, you know, the markets that are blessed by huge pension demand, huge life or insurance demand, and you get a lot of cash. It's a lot that's coming. And part of why I don't think spreads are that interesting, you got to absorb a lot of that supply. My sense is, you know, could you have a little bit of indigestion? Yeah, I think so. But there's still pretty immense demand to soak this up. So I don't think it'll be that interesting. But my sense is, like, it's not really that exciting to own it either.
Rick Reader of BlackRock speaking to Danny following the payroll report that we saw yesterday, coming in a little weaker than anticipated. The United States is, happy birthday, America, enjoying its long weekend, 4th of July, it's the 3rd of July today. A lot going on in New York. There's a lot happening in New York, where officials are definitely preparing the city for Taylor Swift and Travis Kelce's expected wedding that is taking place over the weekend, Madison Square Gardens. We think around 1,000 guests are going to be there. But this is all happening with this heat dome and the extraordinary heat that we're seeing. Is New York ready for all of this? Let's find out. Miles Miller joins us from the Big Apple. Are we ready?
Yeah, we certainly seem pretty ready for it. We've got two sort of really big things happening. We've got the July 4th celebrations, and then we've got Taylor Swift and Travis Kelce's wedding happening at Madison Square Garden. As for the wedding, very self-contained in Madison Square Garden. You won't see any of the stars really going in there. They erected a big tent so that 500 vehicles can go in, get those people in and out without any hitch. We know the festivities start around 5 o'clock, a cocktail hour in the concourse area where people spill their beers and chant obscene things to fans of other teams. And then the big event happens on the arena floor, and the party is expected to go on until 5 in the morning. When that is all said and done, then the city puts on a major 4th of July celebration. It's going to be a big one for this country's 250th birthday. We'll have fireworks on both rivers, the East and the Hudson, and then that parade of ships. It's going to be quite an undertaking for New York with this heat dome over us, and so let's see how we all fare, but it is very hot outside.
Miles Miller, keeping cool, I'm sure. Thank you very much indeed. Coming up, we are going to be joined by Jessica Novoskis of Marquette Associates. Jane Foley of Rabobank will be with us as well. It's a big hour coming up. This is Bloomberg.
As an exchange, what can you do to make it more attractive to be a publicly traded company?
Talk to our customers. We spend a lot of time with our listed companies, listening to their concerns, particularly the offices of the CFO, head of IR, listening to their pain points, general counsels as well, and then act as an advocacy group for those companies to really focus on structured reform to allow a company to tell their story in the most efficient way possible and reward them for the good disclosures that they are making in the market.
Is there any sort of financial innovation that you could drive to get more companies to list? Tokenization has come up.
Well, we did announce our tokenization initiative earlier this year. We already built the technology, we've already done a variety of proof of concepts. It allows for instantaneous settlement, 24/7 trading. It importantly allows for the rights associated with a share to move into that electronic form, but is going to be a platform that runs in parallel to our more traditional exchanges.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Oh, hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
1 p.m. in London, that makes it 8 a.m. in New York. Welcome to Bloomberg Markets. I'm Guy Johnson. US markets are closed today. It is the 3rd of July today, but it is the 4th of July weekend, which Americans are enjoying. Happy birthday, America. As I mentioned just before, it is a big one for America. So they're out enjoying themselves. But it means that markets are basically very, very quiet. And we're seeing very light volume across most of the major assets. European stocks are doing very little right now. They are, though, heading for their best week since May. AI trade jitters certainly beginning to subside. European benchmarks, as you can see, are at all-time highs. And actually, we picked up over the last 10 or 15 minutes. The yen is showing some strength as traders brace for holiday intervention risk. We'll talk about that with Jane Foley shortly. The currency touching its weakest level in 40 years earlier this week. Haven't seen much volatility so far, though. And supply shocks are easing. The new Bank of France governor says the ECB is now in a comfortable situation after last month's interest rate hike. Okay, this is a quick recap of the markets just to show you where we are. As I say, I wouldn't read too much into the price action today. The reason for that is the super light volume that we're seeing. S&P futures ticking up a little bit over the last 10 or 15 minutes. We're up by 0.3%. Dollar yen is doing nothing. Brent crude is doing very little. We're down 0.2%, 71.63. European equities, we were, last time I checked, kind of up by 0.1%. We're now up by 0.3%, but these are not enormous moves, and they are being delivered on super light volume. The dollar is doing nothing. Gold, though, is up. 41.80 spot 66 is where we are now, up by 1.42%, though it has taken a battering of late. So that's the kind of top-down macro picture. What you need to look at, though, is some of the other kind of trends that we're watching within markets quite carefully at the moment, because what you're seeing is quite a lot of inter-region flows. The flow story is really interesting, and Natalia Knezovic is here with more on that story. Your team tracks all of this. What are you seeing?
Investors are actually turning away from the U.S. Stock market. We saw the most recent report from Bank of America. It shows that outflows from U.S. stock market are now happening at the fastest pace since March. U.S. stock funds had about $17.2 billion of outflows through the week, for the week through July 1st. And the mood, of course, is shifting. We see lots of concerns about valuations, etc. And then Also, JP Morgan strategists earlier this week said that extreme outperformance of U.S. semiconductor stocks versus AI hyperscalers created unsustainable valuation, and they expect it will ultimately narrow. Notably, we see that investors turned to some international stocks instead. We see some gains and inflows into Japanese equities. The biggest inflows in 7 weeks are sitting at about $2 billion. So it's kind of a rotation trade.
We're starting to see that. Talk to me about what we're getting in options.
Yeah, so options traders, this is a different part of the story.
Yes.
The market, it depends how you look at the market, right? Because options traders are really bullish on U.S. stock market. We see huge demand for call options, specifically across technology stocks. We saw that premium is much more elevated versus broader markets. Even yesterday, I spoke with options traders, and they said that they see pretty solid demand for call options on semiconductor stocks, so demand is there. And then again, this is a kind of stock pickers market, because we see that correlations across single stocks are now at the lowest level in 15 years, so it's a good environment for stock pickers.
Okay. I'm always told that this is the time for active. Maybe this is the time for active. Natalia, thank you, Natalia Knežević, on what we're seeing in terms of the markets. Jessica Novoskis, OCIO, Portfolio Strategist at Market Associates, joins us now this holiday. Jessica, thank you very much indeed, first of all, for joining us on the holiday. What do you make of this market? We are seeing, obviously, there's a real bifurcation in terms of the views that I get. Earlier in the show, we had a guest on that says, the AI rally, you just want to roll with it. You just want to make sure that you're there. Yeah, be careful, but keep riding the wave. What do you think?
I think it's an incredibly difficult market to play, because I don't think that person is alone in thinking that. I think there's so much uncertainty. There are such big numbers being spent, and this is a technology that a lot of people don't understand, don't know how to size. We don't know who the ultimate winners will be, who the losers will be. And there is so much momentum and leverage in this market that to take a stand against it and not participate has been a huge issue for folks. So you can size up the risks all you want, but to step back is to take a really big move in the market.
Okay, so if I don't want to step back, but I want to hedge my risks, or at least get some hedging in place, how do I do that?
So for us, when we build portfolios for our clients, we're taking a diversified approach. So equities are certainly a big part of that. I think it's very difficult to hedge that equity exposure specifically, but we're also building fixed income and private markets into portfolios. We're really looking for different allocations that can bring different risk factors into a portfolio, and it's at that total portfolio level then that we look for just more stable returns.
Okay, in terms of US versus international, how are you playing that picture?
Yeah, so again, for us, it's about diversification. So for a long time, we're obviously based in the US here. A lot of our clients were asking why we were invested in international stocks at all. I think last year proved exactly why we've always stayed invested. It's very difficult, right? The tariff war came and everyone thought that would be great for the US and negative for the rest of the world. And the outcome was actually the exact opposite. So it's very difficult to play regions. For our level, we look to work with really high quality investment managers that we look to navigate some of those more specific dynamics. But for us, we try to stay in line with sort of that MSCI ACWI, which is 65 US, 35% non-US. And for most of our portfolios, that works.
In terms of, are there any uncorrelated assets out there? When you try and think about what you could put in a portfolio, for a while it was gold. Everybody was like, gold is uncorrelated, it's going to be fantastic, it's going to be this great diversifier in my portfolio, and now it's not.
For us, our favorite asset class in terms of diversification is private infrastructure. So it is actually very stable. It's aligned with inflation. It can be counter-cyclical. So for us, that is one asset class that does tend to stay uncorrelated. Even real estate, right? We used to be a core part of real assets allocations, but we've seen the correlation there with interest rates, which also have a huge impact on fixed income and equity. So some of the private markets they do tend to get cyclical, especially in marks. So for infrastructure, for us is really our top diversifier.
In terms of what could happen there, Is that an absolute trade, or when you think about diversifiers, do you think about them as being absolute or relative? i.e., I'm going to lose less if the whole market goes down, or I'm actually going to make gains when the whole market goes down? When you talk about diversification, which one of those two are you talking about?
Yeah, at the absolute level, or at the whole portfolio level, it is certainly relative. Infrastructure, actually, though, is absolute. Very few times has infrastructure actually put up absolute declines. The counter-cyclicalness comes into play there. So a lot of these are toll road assets. And so when the economy is down and folks aren't flying as much, they're driving more. So it's those types of assets that really hold up those absolute returns for infrastructure.
You don't think so? What do you think about fixed income? So what normally you'd build a 60-40 portfolio, and fixed income would play a big part in that kind of that offsetting factor. Doesn't feel like it's going to do that this time.
No, it doesn't. And there's been in the last few years a number of times when that 60-40 portfolio would have disappointed. For us, fixed income is sort of that stable cash yield in a portfolio, but it's not our key diversifier. Really, private markets where they are able to make decisions not based on the economic cycle, right? Secular growth, capital sources that hopefully are uncorrelated with interest rates. Those folks have a better chance of adding value. And then again, you have to look to counter-cyclical assets, and it's not commodities anymore. You have to go deeper into the real assets.
Jessica, the biggest diversifier over the last few years has been the Federal Reserve. When markets have tanked, the Federal Reserve has stepped in and protected investors. Do you think that the Fed is still going to play that role with Kevin Warsh at the helm?
That certainly remains to be seen. So we know that the administration is sensitive to the stock markets, and we know that the administration likes to try to influence the Federal Reserve. I think when Warsh came out in that first press conference, he showed that he is not going to be a puppet, right? He's that inflation hawk that we thought he was. So I think he's going to take the approach that he needs to take to build the legacy that he wants. He's drawn a hard line on inflation. We'll see how that evolves. If the economy evolves, right, and labor becomes more of an issue, growth becomes more of an issue. But so far, we have no indication that he is going to be overly sensitive to the stock market.
Jessica, enjoy the rest of the holiday. Thanks for stepping up early for us. We really appreciate it. Enjoy the long weekend. Thank you. Jessica Novoskis of Marquette Associates. Okay, let's get you up to speed what else you need to know this Friday morning. Here's your Bloomberg brief. Iran is hosting foreign officials from key backers, including China and Russia, this weekend for the funeral of the former Supreme Leader Ali Khamenei. Beijing will be represented by the deputy leader of its top legislative body, and Russia by former President Dmitry Medvedev, who is now deputy chairman of the Russian Security Council. The US is pressing gasoline retailers to pass on lower fuel costs to consumers. Treasury Secretary Bessent telling CBS News he expects average prices to fall by $2-3 a gallon by Labor Day. Citi currently sees Brent falling to between 60 and 65 a barrel by the end of this year, as the US-Iran MOU, they think, expected to hold. And ECB President Christine Lagarde says she won't rule out leaving her current position early to participate in French politics. Lagarde reiterated that the captain of the ECB ship should stay on board during a period of turbulence. Remember, her term ends in October 2027. We have a French election in 2027. And that is your Bloomberg brief. Quick check on the markets. This is what is currently happening, and the answer, to be brutally honest, is not a lot. S&P futures have ticked up a little bit. Dollar yen is doing nothing. Brent crude is doing nothing. Beginning to roll over, actually, a little bit more, 71.50, but not by much. In terms of what we're seeing here in Europe, it is a very light session in terms of the volume picture. The stock 600 is up by 0.3%. The dollar is absolutely flat. The surprise, maybe over the last couple of days, has been some stabilization that we are seeing in the price of gold. 41.80. We're up by 1.4%. Let's turn our attention to the inflation narrative next. Certainly top of mind for central bankers around the world. We are going to hear France's interview with the Bank of France Governor Emmanuel Moulin next. That is coming up. This is Bloomberg.
world of politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Welcome to Bloomberg This Weekend. I'm David Gray.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
Minutes past the hour. Welcome back. You're watching Bloomberg Markets. I'm Guy Johnson in London. A few days ago, we were in Sintra. Now we're in Aix-en-Provence. The central bank circus has been moving around Europe over the last few days. But the south of France is now the venue for the action. And there, the new Bank of France governor, Emmanuel Moulin, has been saying that the ECB is in a comfortable situation. This, of course, after last month's interest rate hike. Earlier today, the governing council member of the ECB spoke to Bloomberg's Francine Lacroix at the Aix-en-Provence Economic Conference.
It certainly is going to make our job easier. It's true that we've been hurt by supply shock, which increased price of energy. And the point for us is that it doesn't go through, all the prices in Europe. But I think we had good news about oil and the reduction in the price of the Brent. So it makes our job maybe a little bit easier. We'll see when we meet next time in July.
What are you expecting for July? Will it be a more difficult decision than June was?
No, I mean, we are not into forward guidance, so we'll decide when we'll be there. But what we see is that at this moment and at this juncture, we're in a good position, and the balance of risk is in the right place.
I know you worry about services inflation. What can you tell us about services inflation?
Well, service inflation has been, energy is feeding into services, obviously, because they are transport, airfares, logistics, which are heavily impacted by the price of oil. But the fact that the oil price decreases will I think soften the inflation on services. But it's still, what we see is that we are above our target. And so I think the decision we made in June was the right one, because we had inflation above our target on our horizon. But the good thing also is that, we do scenarios. So we look at different scenarios and forecasts. We had a severe scenario, base scenario, and a milder scenario. And the fact that we have this scenario makes us much more comfortable on our decisions.
So where are we in the scenario factor?
Well, we will have new forecast in September. But I think, we are comfortable in our base scenario. And the news on what's happening in the Strait of Hormuz is globally good news.
I mean, overall, we were in Sintra together, Portugal, for the ECB forum. A lot of the governors were worried that there'd be second-round effects. Do you expect the decision-making of July, but also September, just to be more difficult?
I don't think so. I think that we made sure in our communication that we were not entering into a new cycle of hikes. So we took this decision in June, which was perfectly legitimate, and now we will decide meeting by meetings and data dependent. So we'll see where we are in July and in December, but we've made no commitment for these two meetings.
Governor, talking about data, so Banque de France has a lot of great data looking at small and medium enterprises, inflation. What are you seeing in the last month?
Well, we've seen, what we've seen is really soft growth. This is not very dynamic. Unfortunately, we had not a very good Q1. We see industry doing pretty well, thanks to investment in defense in particular, and in energy, electricity, and also the boom in AI. We see services much softer and construction much softer. So we don't expect a sharp increase in growth in Q2, but we'll see. We'll see. I think the fact that we have less pressure on the oil price is also good news. So it might make growth a little bit higher than we expect.
So you've been in charge for just over a month.
Yes.
What's been the biggest surprise?
Well, I knew part of the job, but monetary policy is a very serious job. We use a lot of data. We look at really a big set of data. We look at different scenarios. We have very, technical and in-depth discussion at the table of the Governing Council. We act as Europeans, not as national governors, as Europeans, and we take, the best decision in that context.
I mean, how do you look at AI in the future, what it means for, first of all, inflation? Is it automatically inflationary in the shorter term because of CapEx, and then disinflationary?
That's what we think. Now in the short term, it's mainly inflationary because you have large capital expense, so it's an increase in demand, and mainly in the US for the moment. Then we can expect that it might be deflationary because of productivity gains, but it will take some time before we see that, because we need adoption. We need that AI fits through all the production process in companies, not only generative AI, but really changing the way we produce and we manage our companies. So it will take some time.
What are some of the data points that you look at? I know you look at, services inflation, wages coming up. Is there something that you think is more indicative?
We look at a broad set of data. So we look at, inflation. We look at core inflation. We look at services. We look also at inflation at products that are not linked to the energy to see if there is, broad-based inflation. We look at wages. We don't really see second round effect at the moment. And we look also at expectation, because they are key in terms of our credibility.
And when you look at some of those figures overall, I mean, how is AI going to change what you look at in terms of models?
Well, I think, we'll be able certainly to analyze a much broader set of data. And what we need is also to make sure that we can have real-time, assessment. I was listening to Kevin Walsh that he was saying that we always look at data, which are historical data and which are in the past. And we need to project ourselves in the future and see, we do forecast, but we need also to try to gather a very broad set of data in order to make the best decisions.
Governor Mouna, I mean, France is going to go through a big year. And, the next 12 months will be very crucial because there's going to be a presidential election.
Yeah.
Do you worry about a market event, kind of, bond spreads moving as we've seen in the past?
Really, we've had a minority government for quite some time now. We had some difficulties to pass the budget, but we have a budget for 2026. And we've seen, the spreads are very stable. And we have no issue in terms of auctions of our debt. We have solid demand. We have very good bid-to-cover ratio. So I think, we need to make sure that we stick to our commitments, and the government sticks to its commitment in terms of reduction of the deficit, but I don't see a market event at the moment.
Would the ECB stand ready to act if there was a market event?
I'm not into political fiction, and we are doing scenario for forecast, but not for, for political events. So, we are following the situation, but, I think we're in a good shape at the moment.
Governor Mouna, just a final question. I mean, in the next 3-4 months, what will your priorities be as you kind of find your feet?
I'll have, priorities will be obviously our monetary strategy, and to make sure that, inflation goes back to our target. That's our first priority. My second priority is monetary sovereignty and payments. And we need to make sure, that we remain sovereign in terms of payment, that we embrace innovation, And that's what we do with the digital euro that has been voted in Parliament, and the Banque de France will be, at the forefront in order to develop the digital euro.
What is the biggest question, actually, for the digital euro? Because we don't know whether it comes in a portfolio, a wallet. There's so many questions out there.
Well, there are so many questions, but it's going to be an electronic bill. So you will be able to pay with an equivalent of cash in all, between citizens, in shops, in e-commerce, etc., which you cannot do at the moment with your cash. You have to go through either, a US provider, Visa, MasterCard, or Apple, or these companies. We will have really, central bank money, which will be available to all the citizens in the digital world.
The new governor of the Banque of France, Governor Emmanuel Moulin, speaking there at the Aix-en-Provence conference that is taking place over the next few days with Bloomberg's Francine Lacqua. Keep an eye on him over the next few weeks, months and years. Let's talk about where we are with the markets this morning. It is an American holiday. It's a very important American holiday. It's the 4th of July holiday. Today is the 3rd. There is a long weekend. It is 250 years, obviously, that is being celebrated this year. And it means that markets are a little lighter, quieter than they normally are. S&P futures are ticking up a little bit. We're still digesting the payroll from yesterday. Dollar yen is doing absolutely nothing. We're going to find out what happens next in that space, though, with Jane Foley. She'll be with us shortly. Brent crude, a little softer this morning, 71.61. Citi's out with a note this morning saying it expects 60 to 65 by year end. In terms of European equities, super light volume this morning. Stock 600 is up by 0.3%, off its earlier lows. The dollar is doing nothing, but the surprise maybe is that we're seeing some signs of stabilization within the gold price right now, as we see some weakness coming through with the dollar. But the gold story has been one of a downward spiral over the last few weeks after we hit, obviously, big highs earlier on this year. So that's where we are right now. Up next, we're going to address one of the key questions that we're trying to answer at the moment. What will the Japanese authorities do about the super weak yen that we currently have? Will we see intervention? Will we see rate rises? We're going to try and answer all of those questions. Jane Foley from Rabobank will be joining us after this. That's next. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back, half past the hour. You're watching Bloomberg Markets. I'm Guy Johnson. It is a long weekend in America. Markets are quiet around the world as a result of that. You're not seeing much action, certainly when it comes to European markets, and there's a similar story stateside, to be honest. Cash is obviously closed today. Futures are up by 0.3%. Dollar yen, we'll get to that in just a moment. Crude is a little softer, but not much, 71.54. We're watching what is happening with the negotiations around the Strait of Hormuz very carefully. In terms of the picture here in Europe, super light volume. Equities are up a little bit, but not by much, 0.3%. The dollar is absolutely flat on a sort of broad brush basis with the dollar index. Bloomberg dollar index down by 0.1%. Gold just beginning to fade a little bit. It's been up by 1.4 throughout most of the day so far, now up by 1.2%. So what are we seeing in terms of what is going on below the surface? Let's try and answer that question right now. We're going to start with the hedge funds because Natalia is back and she's been tracking what they're doing.
Yeah, so Guy, we saw that hedge funds turned into sellers of global stocks. For example, last week we saw that global IT and communication services stocks saw the biggest selling in over 10 years. And that sell-off was driven by a reducing of long positions as well as short positions. And it was led by, it's not a surprise, by semiconductor stocks. The question is why? We see that hedge funds posted the strongest quarterly gain last quarter since 2016, so they are not forced to participate in this rally.
Is this just a profit-taking story? They're just reducing leverage. Leverage was quite extreme.
And they want to maybe, sit on some gains ahead of potentially volatile rest of this summer.
CTAs, systematic funds?
Yeah, so exposure across CTAs has also become a little bit elevated, and the Goldman Sachs trading desk is now modeling that CTAs will turn into sellers of global stocks no matter which direction the market goes. So for now, selling is not going to be huge, maybe at around $6.6 billion in a flat tape, and then about $3.2 billion into a rally. But over the next months, that selling can be much more pronounced.
Has anybody told retail?
Yes, it is an interesting picture because institutionals are kind of on the bearish side, but retail traders are not. So we see that in May and June, retail traders were super active. Average daily retail cash equity volumes are now running at 65% versus above 2025 levels. And more importantly, despite this huge participation in equity in U.S. stock market, household cash has increased to 8% of total financial assets, and this is the highest level in more than 10 years.
Okay.
So they have more cash to deploy.
Yeah, they've potentially got more cash, but it's interesting that other sectors of the market definitely pulling back. Natalia, thank you very much indeed.
Thank you.
Natalia Knezevich joining us on what the internals maybe are telling us about this market setup. Let's turn from stocks to what is happening in the currency market. The yen has touched its highest level in 2 weeks versus the dollar amid rising speculation around intervention. This weekend, today, this afternoon, here in Europe, may be the perfect moment if you're the Japanese authorities to step in. Volume is very, very light out there. But I'm looking at dollar yen, and you can see it on the screen right now. yeah, we're getting a little bit of volatility, but we're not getting much. Jane Foley of Rabobank writing, there is so much speculation that the Ministry of Finance may take advantage of thin holiday conditions today to intervene in favour of the yen. That the bigger surprise may be that no action is taken. Jane, good afternoon. Are we in the latter camp now? Do you think no action is the more likely scenario?
You know, it's quite interesting because there's a lot of discussion right now that the Ministry of Finance is changing tack. And of course, if that's the case, well, we need to try and figure out what that tack might be. And of course, you know, they do want to introduce this element of surprise. But of course, if we all expect them to intervene at a certain time, there won't be that surprise. Nevertheless, there would be very thin conditions today, so they could potentially get more for their buck. Now, what we have had, I think, today, we've had more news about the strength of earnings data, for instance, in Japan. The unions, one of the biggest unions, again for the third year running, really quite strong wage inflation there. We've had, of course, a very strong Tankan report this week. We've had data such as retail sales being really very buoyant. And of course, the Bank of Japan having pointed to the resilience of the domestic consumer, the domestic corporate sector too. So from that point of view, you know, you have to ask, you know, are the factors coming together for the Bank of Japan to potentially accelerate the pace of its interest rate hikes? And I think that is going to be a crucial part of any turnaround in the end, if it can be manufactured in the months ahead.
So how high would rates need to go, do you think, to have a meaningful impact? How many more rate hikes would we have to see? What would the pace need to look like?
Well, that's all relative, and I think the key part of this, of course, is what's happening over in the US. Now, first of all, you know, we've got to say that even though dollar yen has kept on hitting the headlines recently, well, actually over the last month, the yen hasn't really gone anywhere against most of the other G10. So this is largely a dollar story, at least in the last few weeks. So, and of course, what we've had since May is this big turnaround in Fed expectations. If you go into the start, for instance, of the Iran war, the market was still expecting the Fed to be cutting interest rates, and then come May, early June, the market thought, no, you know, it's a lot more hawkish, and started to anticipate interest rate hikes. Now, that's going to be very difficult for the Bank of Japan or the Ministry of Finance to push against. So I think what happens perhaps in the July payrolls, what happens with respect to the signalling for wash, if we do get any signalling, is going to be really quite key. But it will be extremely helpful to the Japanese authorities if the market decided that maybe that US labor market strength had enough holes in it for the Fed not to be in any rush to hike interest rates.
And what do you think, Jane? Do you think the Fed's... Because at the moment, I'm looking at some people telling me I'm getting 3 rate hikes this year, and other people are telling me we're going to get none, and then we get cuts next year. The spread is quite enormous. The market's really undecided. Maybe that's by design from a Walsh point of view, but kind of where do you think we are?
Well, you know, the Rabo view is very much with nothing from the Fed this year, that they will sit on their hands. But of course, you know, I think all of us who are trying to make these forecasts know that we are focused, of course, on that economic data. Now, there were holes in that payrolls report yesterday. The headline number was disappointing. But again, you can look through some of the other indications that we had. The Conference Board survey, for instance, indicating that consumers are suggesting that jobs are more difficult to get. If that's the case, well, that's going to bear down on inflation expectations. That's going to bear down on the likelihood of second-order inflation effects. So that could feed into a slightly more dovish view. But, you know, we are, I think, more focused on that inflation and employment data and activity data in the US than we've been for years, because we know that Walsh doesn't want to give us that forward guidance. So we're sort of back to perhaps where we were even before the global financial crisis, and putting a lot of store, or more store, on that economic data. And I think given those holes that started to appear in the June labour data yesterday, that July number is going to be perhaps even more important than it normally is.
Well, how weak does the labour market need to be for it to offset the above target inflation that we have seen for not a year, but many years?
Well, you know, I think we are in a different phase of inflation than we were. And I think, we can trace this back to many really big picture macro factors. So, for instance, if we think about globalization, for 30 years, that was probably primarily responsible for bringing us low inflation. We were using goods, for instance, imported from countries that had much lower wage costs. If we are now bringing back, supply chains to a more domestic, to a closer, shorter position, then there's going to be inflationary impacts into that. There's opportunity, of course, related to that, but certainly there's a higher inflationary risk into that. So I think we are in a different scenario, and that implies higher interest rates. But then we have got higher interest rates than we had in, let's say, the post-global financial crisis era, and that will give that emphasis on inflation that we perhaps didn't have in that era. But that doesn't mean to say we're not going to have cyclical changes. We're still going to have periods when the labour market is loosening, when central bankers can focus more on that and away from the inflationary side. And I think what we need to determine over the next few months is whether or not that is going to be the case, whether or not the Fed officials can relax slightly with respect to inflation, and then concentrate a little bit more in stopping the labour market from loosening. So this is where we are. Are we in this crux, or are we indeed going to be in a position where inflation remains the standout factor for these policymakers?
Jane, always great to catch up. Thank you very much indeed, as ever, for your time. Jane Foley joining us from Rabobank. What else do we need to know this Friday, this holiday Friday? Here is your Bloomberg brief. Let us start with Donald Trump and his views on what is happening with the Fed. Certainly the president and his allies, you could argue, are renewing their push to reshape the Federal Reserve. This after, of course, the Supreme Court blocked an effort to fire Governor Lisa Cook. Top officials and outside allies are exploring ways to remove members of the Fed's governing board to clear the way for more of the president's own picks. Private credit funds are facing a relentless wave of investor withdrawal requests, with second quarter exit requests exceeding those of the prior quarter. More than $14.5 billion of investor capital is currently trapped at over a dozen funds, compared with the $8.6 billion that shareholders have been able, basically, to get back thus far. And in sports, Spain delivering a dominant performance in the World Cup, beating Austria 3-0 last night. They're now going to face Portugal. Portugal beating Croatia 2-1, a little controversial there. Argentina meeting Cape Verde later today. Australia taking on Egypt. Okay, you're up to speed. That was your Bloomberg brief. Quick check on the markets, which, as I've been indicating, certainly over the last few hours, remain very, very quiet. The reason for this, obviously, is the US holiday, and therefore we're seeing very light volume. S&P futures are up by 0.3%. The dollar is doing absolutely nothing versus the yen. Brent crude is actually beginning to fade a little bit now. 71.41 is what we are looking at. Here in Europe, equity markets are largely becalmed. We're not seeing much action. The stock 600 is up by 0.3%. The dollar is flat as a pancake. And gold, up throughout most of the day thus far, up by 1.4%, just beginning to fade a little bit. We're up by, let's call it 1.3%. Up next, we're going to talk about the weather in the United States. The heat dome that we're seeing on the East Coast, closing many facilities and causing cancellations. Many cities are having to change their holiday plans. We're going to find out what is going on. We'll do that next. This is Bloomberg.
Look at the more successful economies in the region. the key to their success is continuity. But the way our Constitution is written, it actually encourages a lack of continuity. And that's a problem. The term for local government is 3 years. When I first became a congressman, it takes you a few months to learn the business and to make your connections, to network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
.45 minutes past the hour. Welcome back. You're watching Bloomberg Markets. I'm Guy Johnson in London. So, June payrolls showing that US hiring has slowed sharply, with employers adding just 57,000 jobs, and that was well below estimates. BlackRock Global Fixed Income CIO Rick Reeder spoke with Bloomberg's Danny Berger yesterday following these numbers.
Listen, I'm more concerned about, last month, people were tremendously excited about a big jobs number. But if you actually broke it down last month, you had I think it was 54,000 jobs in state and local, and we didn't really get anything this month. And then you had this huge bump in restaurants and in bars, and then obviously that came off significantly, although I'm surprised it actually came off that much this month. I thought it would have taken another month or two for that to come off. But listen, I think that the hiring in the country is just okay. I mean, I think it is. I think Mike McKee said it right. It's stable, it's okay, but you've got an economy that's growing at some pretty significant numbers, and the employment picture is just okay. I just don't think we are hiring that many people. And I was looking at some of the data earlier in the week, the Challenger job cuts data. You had layoffs, I think, in tech of 443,000 jobs. That's up 83% year on year of increased cuts. So anyway, I think, when you break it down and I look across industries, once again, healthcare is incredible. I mean, look at healthcare and education, 67,000 of the, 57,000 jobs. It's all healthcare and education. And so anyway, I think the hiring is stable, but I would say broadly unimpressive. And, one man's opinion, that's part of why I don't really understand, significant raises in interest rates relative to this. I think we're in an employment dynamic today that is just okay. And, I'd say one thing about, you saw that, the hiring, maybe we don't have enough people because the labor force declined, but you've seen a persistent decline in average hourly earnings or wage or earnings data. And that doesn't suggest that companies are stressed about hiring people when you're not really seeing any significant wage growth. So anyway, one man's opinion, good economy, employment, just okay.
You are one man, but you are one man we respect and happens to be incredibly brilliant. So your thoughts matter a lot, Rick. Okay, so you don't see any reason to hike based on this data, but it is at least data that should allow the Fed to hold, or do you go so far as to say with this data in hand, there is room for the Fed to be contemplating cuts this year?
I mean, I don't think contemplating cuts, at the beginning of the or the next meeting or two, I think would certainly be enthusiastic, to say the least. Listen, I think you got to wait to the back end of the year or to the very back part of the year. But I don't think they're off the table for the back part of the year. I mean, I think Chair Warsh said yesterday, You know, you are seeing, and by the way, you look at oil now under 70, you are seeing some improvement in energy costs. You know, when you break down inflation and you look at what is the component parts of inflation today, core goods is running at pretty close to zero, 3-month, 6-month moving average, pretty close to zero. You still have service level inflation, which no doubt is too high. But if you strip out shelter, and I would argue, you know, if we got mortgage rates down in the country, you'd improve shelter inflation. You know, you're running at, depending on 3-month, 6-month, 2.5 to 3-ish, a little over 3. So anyway, I just think you have time. And I think Chair Warsh, and by the way, I have a huge applause for stepping back and thinking about, through task force and otherwise, you know, the way you actually improve inflation, you know, when you've got sticky things like healthcare, education, insurance that don't really get impacted by the overnight funds rate. You know, there are other tools you have. These things are really complex. Let's get some experts to analyze. Are we restrictive on the overnight funds rate? Well, not in housing, but maybe some other places. Or sorry, maybe you are restrictive in housing, I should say, but maybe not in other places. These things are really complex. And I applaud the fact you're going to really step back, think about what are some really complex issues, and what are the most appropriate tools to try and deal with those effectively.
Rick, there are many people who have expressed discomfort, let's say, about a Fed chair who's not more giving in his reaction function, and his understanding of how he sees the labor market, for example. Claudia Salm was talking about that with Tom Keene on Surveillance Radio just about an hour or so ago. Does that make you uncomfortable at all? Not necessarily that we're not getting forward guidance, but we're at least not getting more insight into how Chair Warsh is thinking about labor market, about inflation, about these key issues that the market needs to trade on and that matter for our economy.
And I really don't. I actually think, you know, the way it was articulated, you know, in the first press conference about, you know, you want to see what the market's reaction function is to move to the dots. And by the way, if you look at historically, the forecast of the dots, particularly after you go out a quarter or so, not really very good. The fact that the markets have to pivot to those numbers or pivot to the Fed's reaction function, I actually don't think that's right. And I think there's a real elegance to, if you want to move, if you really want policy to be effective, you actually want to create change. You don't have to, particularly when you're easing, you don't have to be so prescriptive about that change. You actually want to create a little bit of energy and a little bit of surprise, because that's how you create economic and financial velocity. So, you know, do you have at inflection points a little bit more volatility? Maybe. But I think at the end, I thought he made a statement that said, when we have something to say, we're going to say it. I like it. Like that to me is like, as long as you lay out the metrics, what are the benchmarks you're looking at, and then the markets can interpret those and make their decisions based on what those metrics and what your clear path of focus is versus the Fed having to tell you specifically, here's where we're going to go with it.
Let's talk about the market reaction, right? Because post-FOMC, it had been one of higher yields where the 10-year yield started to bump up against 5.5%. We back off of that this morning, 2-year yields declining 4 basis points. Do you think we've seen a peak in yields now?
You know, I will say one thing. I think I did a presentation that and you're pricing in significant hikes. I think Europe, you know, days like today, you get a little bit of softness, maybe add some European duration, or maybe we did. I think that's more interesting. In the U.S., gosh, I think income, like let's just carry. And if you can keep your income up, you're in this amazing environment with these real rates and with some spread, you can create 6.5% yields or even a bit above that. And to me, that's a much better disposition than like, gosh, I think the Fed's going to cut, because they're clearly not going there anytime soon.
Well, when it comes to bank, I mean, year to date, your total return is certainly exceeding the ag, both in the U.S. and globally. That also stands if you take it out from a wider time horizon, too. I know you were also discussing on ETF IQ this idea that IG beta is less interesting to you. So where in this American market are you squeezing out the yield?
You know, there's a little bit of, I call it dynamic patience. You know, there's, you know, the new issue markets give you some opportunity. High yield is still, particularly Europe, like some of these spread markets, if you're a dollar investor, you swap back to dollars. European high yield, even European IG is pretty attractive when you bring it back to dollars. And, you know, in particular, if you believe Europe is going to have to reduce rates over time. You know, EM gets you some yield, and there's some places to pick up some yield across emerging markets. Securitized markets, you know, there's so many things to do in securitized markets around commercial, residential, non-agency, et cetera. So it's those areas. And, you know, I think we're in one of those environments. You pick a little bit here, you pick a little bit there. There's yield everywhere. And I just find like where you get really tight trading levels like USIG when there's a lot of supply coming. Yeah, agency mortgages are just okay. You know, we trade them around a lot. But you know, I like clipping coupon in some of the high yield markets and then going global to get some of that yield.
Hey, Rick, I hate to do this to you. I only got 30 seconds, but I would just love to get your thoughts. The pace of issuance for IG, already $1.1 trillion. Is that sustainable?
It's a lot. And, you know, the markets that are blessed by huge pension demand, huge life insurance demand, and you get a lot of cash. It's a lot that's coming. Part of why I don't think spreads are that interesting. You got to absorb a lot of that supply. My sense is, you know, could you have a little bit of indigestion? Yeah, I think so. But there's still pretty immense demand to soak this up. So I don't think it'll be that interesting. But my sense is, like, it's not really that exciting to own it either.
That was, of course, the one and only Rick Reeder at BlackRock speaking with the one and only Danny Berger following yesterday's payroll data, which came a little early because of the fact that America is out today. It was payroll Thursday, not payroll Friday. Today is Friday. European equity markets are largely becalmed. US equity markets are open in the form of futures and not doing a great deal. So we're up by 0.3%. Dollar yen has done nothing today. We were waiting for some volatility there. We didn't get it. Crude is a little softer now. It's been softening up throughout the last half hour. In terms of the European story, Stock 600 are doing not much. We're up by 0.3%. In terms of the points gain, ASML is the lead there. So tech is in front. Some of the pharmaceutical stocks are a little softer. Astra, Roche, Novo Nordisk, those kinds of names are softening up a little bit today. Gold, just fading an early move, but still up by 1.3%. So that wraps things up in terms of the hours that I've been with you. We are waiting, obviously, to see what happens come Monday. There's a lot of things that are going to happen between now and then. But America is going to be enjoying its birthday celebrations, 250 years. Obviously, we're going to be watching as well what happens in New York City at Madison Square Gardens. The wedding that is taking place there will certainly cause a lot of consternation. But we're going to continue our coverage right here at Bloomberg. We'll be looking for maybe some activity in dollar yen. We'll try and get a handle on what is happening going forward with the Fed after we saw that week payroll data. All of that is going to be handled over the next few hours by Lizzie Burden, who's got some great guests lined up. Colin Graham of Rebecca is going to be joining us. Jennifer Lee of BMO Capital is going to be joining us as well. All of these great guests lined up over the next few hours. America, enjoy your birthday. We'll see you Monday. This is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, succession starts now.
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons.
Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacqua. Listen and watch on Bloomberg Television or wherever you get your podcasts.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start in the third floor or the lobby. You actually have to start in the basement.
Bringing you up to the minute news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
Bloomberg Markets. I'm Lizzie Burden in London. Well, US markets are closed for a holiday ahead of the July 4th holiday tomorrow, but here's what you need to know. Stocks rebound after 2 days of a tech-led sell-off as traders trim bets on Fed rate hikes after that weak US jobs report. President Trump and his allies are renewing a push to reshape the Federal Reserve, with the Governor Lisa Cook still a target. And a heat dome has settled over the US East Coast, pushing New York City to its hottest day since 2012. Well, let's get a check on the markets, shall we? The Stock 600 up 0.4%, but these are thin volumes around the world, given that the US is closed. We're headed for back-to-back record highs, in fact, on the benchmark European index, powering towards its best week since May. The CAC 40 in Paris is currently up 0.25%. Greater gains in Germany on the Frankfurt DAX up 0.7%, but the FTSE is down 0.1%. Now, let's turn to the cross-asset picture. We have got Brent weaker 0.3%. The dollar is also a little weaker, unsurprisingly, given what we saw on payrolls yesterday. And we are looking at treasuries closed for cash trading. But if we take the temperature in your bond space, the German 10-year at 2.93. Now, let's think a little more about those US jobs numbers, shall we? Hiring slowing sharply in June, curbing some of the budding momentum in job growth that we had seen earlier on in the year. White House National Economic Council Director Kevin Hassett spoke to Bloomberg about the labour market.
I would say that it's on an upward trajectory, that 3 of the last 4 months surprised on the upside, as you know. There were a little bit of downward revisions. This one came in a little bit below expectations, but if you lift up the hood, then the basic story that we think is animating the economy right now is that there's a construction boom.
Let's get some analysis now with Colin Graham, head of multi-asset strategies over at Rebecca. He says that despite slowing labour market growth, the overall picture is positive. So you kind of, Colin, sound a little bit like Kevin Hassett there. He's still optimistic, but that payrolls number is so far below expectations.
But I think it's also, you've got this, how do you seasonally adjust something like the World Cup? So we saw hiring accelerate before that. So again, the Fed is going to stay very focused on the labour market. So we think the US is, at Rebecca, we think it's a real high pressure economy. So rates are about right for the economy. You can't say they're too high because they're not having an impact on the economy. So you are seeing this high pressure economy in the US, which again will be good for risk assets, especially in the US.
Okay, so the market's not making a mistake assuming that this number means the Fed can relax, basically.
Yeah, I think we weren't in the camp that the Fed was going to raise rates. We saw the inflation numbers, but we thought that was a short term. And the central banks seem to be fighting the last war, which was the inflation in 2022 after COVID, rather than thinking about actually what is the situation today. So the oil price did spike, you saw inflationary pressures come through, and now you see the ECB talking about second round effects, but we think the second round effects are going to be much more lower this time than they were last time.
But even aside from the second round effects, you've still got the threat of tolls being charged by Oman and Iran in the Strait of Hormuz, so you could still have higher shipping costs. Surely the inflation worries can't go away yet.
They can't go away. They won't be dissipated. It's just whether they're important enough to change the central bank's outlook. And I don't think it is, because if you look at what's happened in the last 2 years with the amount of tariffs, that is a much bigger element to the cost of goods moving around the world than tolls will be on the Strait of Hormuz. And you're seeing that companies are looking to get around that. You saw the announcement in Canada about building a pipeline. So there is other ways, and the longer this goes on, the more ways the economy will adjust to the friction that's been put in the works.
So if tariffs are the greater risk, how should markets and the Fed be thinking about that in the second half of the year?
Well, I think that they continue to say, well, we focus on inflation, and we think that that's going to come down. We focus on consumers in the US and thinking about service inflation, and we see that is on a downward trajectory as well. So from that perspective, they should feel a lot more there's a margin of safety on the inflation, which they want. So they can really, in the US, they can really focus on the growth side of things and employment, and making sure that, as you run into the midterms, that people have jobs, people who want to find a job can find a job. And I think that's the important distinction.
I wonder how you interpreted Kevin Walsh at Sintra. We've been wondering, is he a hawk or a dove? And he kind of seemed to say things on both sides of the ledger at Sintra, saying, yes, he wants to bring inflation back to 2%, but also saying that there's been improvement in price growth over the past few weeks. Are we interpreting him correctly?
We don't know. Now he's inside the tent.
Yeah.
His views will change. We know he resigned from the Federal Reserve because he was concerned about quantitative easing and the use of the balance sheet to buy government bonds. But we know that he and Bessent are going to work closely together. So the Fed and Treasury are going to work more closely together than we have in the past.
Yeah, and he's hiring some of Bessent's aides. Does that make us even more worried? Should we still be worried about Fed independence?
I think that ship's already sailed. I think we already know the answer to that question from an investor perspective. But they will do everything they can to keep the US economy chugging along. And I think that has to be your core scenario for this year. And let's talk about, is the Fed put still there? And I said, well, it's actually I would say a Fed and a Treasury put.
Okay. And then when it comes to that communication, of course, there's loads of talk about whether they'll just completely do away with the dot plot. Never mind, Kevin Walsh just not putting his own dot on the plot. You've got the former Bank of England Governor Mervyn King coming in to head up the task force when it comes to communications. And he's basically saying, say less.
Yes.
Right? Talk about the destination, not how you're going to get there. How is that going to be received in the market?
Well, I think the market will be a bit worried because they're not going to get as much information, and they have to actually, if you like, do the work themselves. So they're not going to get as much guidance, and therefore, to me, that actually makes the whole thing a bit more data dependent, which is exactly what the Fed wants. They want people to be looking at the data and not what Walsh is saying, and how many words change between this statement and last statement. So from that perspective, I look at it and go, okay, I think this is a good thing. I think that central bankers should focus on what they're doing, and I think that's what Walsh is trying to do now. And of course, he wants to talk on both sides of the equation. But you've got to watch the hands, not the lips, on this.
Let's just talk about the ECB as well. You mentioned it. Is there any need for a consecutive hike now? We've got oil prices coming down.
In our view at Robeco, no.
Right. Okay.
They're very keen to raise rates. If we look at our assessment of the Eurozone economy, we think the rates have moved from at the top range to being tight compared to where the economy is. So for us, inflation is going to come down. We've got to focus on the growth side of things and try and get out of this sort of stagflationary twist that we're seeing within Europe.
Yeah, I mean, we were hearing from the Bank of France governor earlier on this morning, speaking to Bloomberg, and I'm sure at some stage over the next few hours we'll be playing that interview, but really his emphasis was low growth. Is that what dissuades the ECB from going again?
Well, it should be, but we have to remember it's not in their mandate.
Yeah, well, quite. That's what I mean.
So, yes, but then we've seen the ECB's mandates changed over the last 20 years. We saw Draghi says, you can't buy, it said you cannot buy government bonds. But he did whatever it took from that perspective. So if you think that, then yes, they will be looking at growth because, a certain way of getting inflation down is to have a recession. And, that's not good for any of the political parties within Europe.
Okay, Colin, you're going to stick around with me. Colin Graham from Robeco there. Thank you very much for now. Well, coming up on the programme, European nations now believe that some fees to transit the Strait of Hormuz may be unavoidable. That's next. This is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Anything we do in Africa is going to be more risky than the U.S. I think the approach we want to take is, how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation was a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
This is Bloomberg Markets. I'm Lizzie Burden in London. Well, the ECB is in a, quote, good position after June's rate hike. Bank of France Governor Emmanuel Moulin sitting down with Bloomberg earlier on today.
It's true that we've been hurt by supply shock, which increased price of energy, and the point for us is that it doesn't go through, all the prices in Europe. But I think we had good news about oil and the reduction in the price of the Brent. So it makes our job maybe a little bit easier. We'll see when we meet next time in July.
What are you expecting for July? Will it be a more difficult decision than June was?
No, I mean, we are not into forward guidance, so we'll decide when we'll be there. But what we see is that at this moment and at this juncture, we are in a good position, and the balance of risk is in the right place.
I know you worry about services inflation. What can you tell us about services inflation?
Well, service inflation has been, energy is feeding into services, obviously, because they are transport, airfares, logistics, which are heavily impacted by the price of oil. But the fact that the oil price decreases will I think soften the inflation on services. But it's still, what we see is that we are above our target. And so I think the decision we made in June was the right one, because we had inflation above our target on our horizon. But the good thing also is that, we do scenarios. So we look at different scenarios and forecasts. We had a severe scenario, base scenario, and a milder scenario. And the fact that we have this scenario makes us much more comfortable on our decisions.
So where are we in the scenario factor?
Well, we will have new forecast in September. But I think, we are comfortable in our base scenario. And the news on what's happening in the Strait of Hormuz is globally good news.
I mean, overall, we were in Sintra together, Portugal, for the ECB forum. A lot of the governors were worried that there'd be second-round effects. Do you expect the decision-making of July, but also September, just to be more difficult?
I don't think so. I think that we made sure in our communication that we were not entering into a new cycle of hikes. So we took this decision in June, which was perfectly legitimate, and now we will decide meeting by meetings and data dependent. So we'll see where we are in July and in December, but we've made no commitment for these two meetings.
That was the Bank of France Governor Emmanuel Moulin speaking to Bloomberg's Francine Lacroix. Now let's come back to Colin Graham, Head of Multi-Asset Strategies at Robeco. Colin, we've talked about inflation. Let's talk about the stock market. Of course, it's a holiday stateside today, but how are we setting up for next week? I'm looking at futures in the US, up over 1.1% for NASDAQ futures right now.
Yeah, I think we're in a bull market. So, anything that falls. And I think this week has been characterized by, we've got a long weekend coming up, so take a bit of risk off the table. So I think we'll see more buying next week. And, don't want to predict the market because that's very difficult. But we've got earnings season coming up. We expect that to be, again, very, very strong. And, despite high expectations, we will probably see good numbers on top of that.
So you don't think we're in an earnings bubble then, that earnings expectations are just creeping up, not even creeping, but like running up too fast?
Yeah, so when clients ask me, they say, why are you long equities? It's so expensive. Shiller P, we're back to high levels, which suggests you're going to get 2% maximum from the S&P over the next 5 years on a per annum basis, so much below the average. And I say, well, that's fine, that's valuations. But if you also made that point a year ago, and the earnings have grown into the valuations, so as long as the earnings delivery continues, for us, that's that's a nice safety. And you heard Rick talk about credit spreads, and as long as credit spreads remain very tight, there's no credit accident going to happen. So you've got earnings and you've got credits, fine. So from that perspective, then equities is your natural choice in that environment.
But you saw a 6% drop on chip stocks yesterday. Doesn't that worry you? Like, if chips go down, wouldn't they drag the rest of the market down with them?
I'm not sure, because if you think about would Samsung, if it was listed in the US, would have fallen as much?
Yeah.
I'm not so sure.
Okay.
Because Korea and Taiwan are such small markets, then it's and the US is so huge, any small move in flow between a very large capital market and a very small one is going to cause these big ructions that happens. And, you know, it's not just Taiwan and Korea. We've also seen it in Japan, which is a much bigger market as well. The volatility over the last few weeks in Japan has been huge as well.
And you were saying to me that there's too much of a focus on the Kospi and not enough on the Nikkei.
Yes, absolutely. And then you've got the yens come into this as well.
Yeah.
And there are, you know, fundamentally good things happening in Japan, but it feels like it's all the same trade at the moment.
Well, who are the winners going to be then in AI?
Who?
Yeah. Not individual stocks necessarily, but where are you along the chain?
So we talked to our underlying stock analysts. They're saying, you know, you've got to be across the chain. And we don't necessarily want to pick a winner right now. And as we've seen in previous tech bubbles, there are plenty of people and companies that were big names at the time but did not succeed. And so we've got to be aware that that is the case. And, you know, what percentage of the pie are these big hyperscalers going to take? What percentage of the pie of the chips people are going to take? And the question I'm asking our analysts is, are you pricing a chip cycle here, or are you saying that the semiconductor chips is no longer a cyclical market and the innovations have stopped? And, you know, what happens when the next chip comes out with all that stockpiles of chips? Do they become obsolete, or, you know, what's happened there? So those are the types of things we're looking at and trying to avoid those pitfalls in particular sectors, in particular companies. But that's our analyst's job.
Okay, Colin, thank you so much for walking us through all that. Colin Graham from Robeco, really great. Robeco, great to have you on this holiday. Thanks for coming in to see us. Well, coming up on the programme, European nations are accepting now that the Strait of Hormuz transit fees may just be inevitable. We'll get to the geopolitics next. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up. Sorry.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
This is Bloomberg Markets. I'm Lizzie Burden in London. Well, some of the leading European powers are now accepting the fact that ships transiting through the Strait of Hormuz will have to pay transit fees. And those payments would likely be required by both Iran and Oman. We can get some analysis now with our Bloomberg opinion columnist, Mark Champion. He joins me now for more. Mark, if there could be fees on goods going through the Strait of Hormuz, how can Trump be saying that Iran's agreed to just about everything we need? Surely this isn't agreeable to the White House.
No, I mean, but I think we have to very heavily discount at this point what the president says about the state of negotiations. I mean, all along he said, that they'd won, that it was a victory, that the Iranians will do anything we say, that, so I think we have to discount that. The talks are going slowly. It's a 60-day period. We've had a couple of bouts. The last one, the Iranians refused to be in a room with the Americans, and it's pretty clear that all they really discussed was issues around Hormuz. They didn't get into the nitty-gritty of nuclear at all, which is what this is all supposed to be about. So, and Trump has said, and predictably, he said that he's willing, or he's told officials that if it goes beyond the 60 days, that's fine. It can take longer. So, I mean, his main concern is not to restart the war between now and the midterm elections, and to keep stuff flowing through Hormuz so that you have the price of oil stays low.
Okay, so damage control before
It's
the midterms,
damage control.
basically. And on looking at the Gulf states, of course, who didn't want to be part of this war but were badly dragged into it at the start, let's say in this 60-day period there is a deal. What do you think it would look like for them?
Yes, I mean, they're going to be very sensitive to the terms, and their sort of real unhappiness is that, before the war, which they didn't want, there was no problem getting their goods, their energy in and out of the strait. Now there is. And then the question is, are they going to be subject to some kind of new arrangement in the Gulf to control shipping? They have two problems there. One is money. I mean, the Iranians are kind of spitballing $40 billion a year that they would like to, raise from this traffic. Now, that's ridiculous. There are arrangements like this where, fees for services are, actual transit fees are illegal, but fees for services are raised. Strait of Malacca, I think Singapore said that they raised about 22 million last year from fees there for services. In the Bosphorus Strait and the Dardanelles, the Turks raise about 250 million a year. So here we're talking about 40 billion. That's not going to happen.
Right.
So then the question is, so what will it be? And so how much money? And then an even more important issue for the Gulf is, because the money is doable, right? Maybe not at that level, but, you can, these are expensive products that are going through. The other issue is, do they have control over who goes in and out? Can they make problems for us? Can they, use that as geopolitical leverage anytime they have an issue with the Saudis, and that's what they're going to want to avoid.
Exactly. I do wonder whether Iran will use those fees for leverage to force those Gulf states to look away from the US and more to Iran. But Mark, you'll be coming back on later in the programme. So for now, Mark Champion, thank you very much, our Bloomberg opinion columnist. And you can find Mark's latest column on the terminal at OPIN Go. But coming up on Bloomberg Markets, leisure and hospitality led the slowdown for US hiring in June. So we'll unpack the jobs data next with Jennifer Lee. This is Bloomberg.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the US or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
Welcome to Bloomberg This Weekend. I'm David Guerrero.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
This is Bloomberg Markets. I'm Lizzie Burden in London. Well, investors are scaling back bets on Fed rate hikes, though they continue to expect at least one hike this year. Bloomberg's Danny Berger asked National Economic Council Director Kevin Hassett about the US labour market and how he thinks the Fed should operate under new leadership.
If you lift up the hood, then the basic story that we think is animating the economy right now is that there's a construction boom. It's the biggest construction boom we've ever had, in part because in the Big Beautiful Bill, we allowed people to expense factory construction. The president talks about all the time about all the commitments to onshore U.S. activity, and that's showing up in construction employment, which was up a lot this month. But the factories have to be turned on before the jobs go back up into the 200,000 range. And so I actually have been a little surprised on the upside by the job market because it's been north of 100 quite a bit. And because we don't have a massive inflow of illegal immigration, then that makes the break-even job number a little bit lower. And so I think this is a really strong, healthy job market, and that this was a little bit on the other side of expectation, but the trend over 3 or 4 months is consistent with our view that, again, that we were growing about 3%, and that we're going to have a better second half of the year as those factories turn on the lights.
You've been consistent on that, but you've also been consistent on this. You were saying this just a month ago. The Fed is behind the curve. Plenty of room to cut. What you're describing does not sound like an economy that needs a cut.
Mm-hmm. Well, I think that again, what one has to do, and right now, you know, we've got Kevin Warsh there. It's different leadership, and we very much respect the independence of the Fed. I think that Kevin will watch the data and do what he thinks is right, and we'll support him in that. I think that as an abstract principle, you know, going back a month ago on the show or anywhere else I've been speaking, I've been highlighting the fact that the old-fashioned Phillips curve that says if you have growth, you have to raise rates, doesn't apply in situations where there are big positive supply shocks. And so if there's a big positive supply shock, you know, like you have an economy with an apple tree, you plant another apple tree, now you got a lot more apples, the price of apples goes down. And with AI basically increasing productivity of firms all across the country, then that's increasing their output. We're seeing it in real GDP numbers, but not putting upward pressure on prices. Now, on the other hand, if you mailed checks to people, as Joe Biden did, then they all of a sudden, you know, open up their mailbox so they got a few $1,000s, then they go out and spend it, but the supply doesn't go up with it. That's where you get the inflation that we saw.
Well, to be fair, I mean, the president also, I remember getting a check signed by President Trump as well, and we also had the One Big Beautiful Bill, so both parties doing that. But Director Hassett, well taken on your point of Fed independence. I wonder why then you made these comments on Fox yesterday. You basically said that there are a majority of members over at the Fed who are voting not because they're patriotic, but rather because they want to get Trump. Director Hassett, that sounds like trying to sway the Fed or challenging their independence by you with such a big part of this administration with such a senior role making a comment like that.
We've said over and over that we think that the previous version of the Fed had made a bunch of moves that looked to us to be partisan. And a lot of the people who decided to cut rates right ahead of the last election, to raise rates the minute that Donald Trump was inaugurated, a lot of those people
hang on, Director Hassett. I got to push back because they cut by 175 basis points from late 2024 through the 2025. That doesn't seem like something that's moving against Trump. That's allowing that's giving the White House effectively what it wants.
They're moving towards normalcy, and I hope that they continue under the firm and solid leadership of Kevin Warsh. I hope that they now move into a direction where they're data dependent.
National Economic Council Director Kevin Hassett there speaking to Bloomberg's Danny Berger. And for more on the US economy and the Fed, we're joined now by BMO Capital Markets senior economist Jennifer Lee. Jennifer, thank you so much for making time for us on this US holiday. You were hearing Kevin Hassett there. He's not worried about the labour market. Are you?
Good morning, and thank you very much for having me on. I don't think I'm as enthusiastic as Mr. Hassett is. I was actually a little taken aback, quite frankly, after when I saw the headline number of just a 57,000 gain. I was pretty disappointed overall. That was my instant reaction, and even when I went deeper into the numbers, I'm still disappointed. Obviously, at the same time, we have to remember all these numbers get revised all the time. So I'm very curious what's going to happen to this 57,000 in a few months' time. Are we going to see like 100 in front of one in front of it? So we'll have to see. But as it stands, we were seeing still some, most industries are still hiring, but it's definitely at a slower pace. And it was interesting that 4.2% jobless rate as well, just because there is not only just about 500,000 people unemployed now in the household survey, but a lot of people left the labor force as well. But so, there's just still jobs to be had, but fewer people, which is bringing down the jobless rate. So overall, still a tight labor market. I don't think 4.2% will definitely define that. But broadly, just some of the details, a little bit discouraging.
Yeah, I mean, you mentioned the downward revisions. We already saw downward revisions for the 2 months before this, 57K for June. Mm-hmm. So does 57K change the Fed story for you?
No, I mean, again, I was just sort of tongue-in-cheek when I was like, at least we saw a plus sign in front of the number. But I think overall, we are still seeing steady-ish job growth for sure, but it's just coming down. Things are slowing down. People are, most of the people, or a lot of people are leaving the labor force, as we saw. Even when you break it down between native-born workers and foreign-born workers, that is also declining on a year-over-year basis. So the labor force is starting to shrink, and it already, actually, I should say starting, it's actually been shrinking for some time now for all these different demographic reasons, including retiring baby boomers and, and of course, low fertility rates. So this is, again, just a smaller job market in terms of supply. Demand is also slowing as well. And then we'll have to see what happens, from here. So there could be potentially some upward pressure on wages. So keep an eye on that one too.
Okay, I mean, when it comes to the inflation picture, I do wonder how much the Iran war is really distorting the picture, whether lower oil prices could be masking something else going on, stickier inflation elsewhere.
That's a good point. So I have been a bit more on the hawkish side, and I think there are so many different views out there, but I've been a little bit wary of inflation. Of course, we started off the year at $60 per barrel oil, and then it went up to over $100, and now we're back down to about 68 or so. So at least it's kind of back down in the right direction. We probably saw the peak in inflation probably in May. I will say that now, but at the same time, before the war in Iran began, there were already some pockets of sticky inflation for various factors. We had Of course, the tariffs were driving various prices of goods and services higher. Demographics, as I mentioned, just last year with all the deportation of the illegal immigrants, that also caused a lot of pressure for certain sectors like agriculture and construction and leisure and hospitality, who rely a lot on those workers. So potentially, again, some pressure on wages there. Climate change and all those, different wacky weather. We've got El Nino potentially, and that's pushing prices higher for various food products. This is like a global phenomenon, obviously. And of course, what happened with the Strait of Hormuz didn't help. We've had a lot less fertilizer to deal with. Of course, AI, that's pushing prices for utilities higher. So there's still a lot of, I think, underlying inflation pressures that we still have to be wary of. Having the war in Iran pushing energy prices so much higher did not help, obviously. That's coming back down, so that's a good thing, but it doesn't mean that we're all clear on the inflation front either.
Well, you mentioned tariffs. I mean, I wonder for businesses how much it's going to add to pressure on them that the US isn't renewing USMCA.
Yeah, I think, again, another piece of disappointment for the week. I don't think it was a shock, but, given especially for Canada, given that, 75% of everything that we export head to the U.S. Over half of everything that we import comes from the U.S. At the same time, Canada and Mexico is, the combined are still the U.S.'s biggest trading partners. About a third of all their exports head to both Canada and Mexico. So this is going to be a problem, especially for all these businesses to do all these cross-border business activities, especially the auto sector as well. This is going to be an issue. Obviously, the best case scenario for these businesses would have been, some sort of certainty over the next, decade or so. But now we're going to be living off of a year-by-year basis, and I think that'll be very difficult for businesses to make any kind of investment decisions, just given that unknown scenario. Even the ISM manufacturing survey that was just out on Wednesday, I think all the respondents' comments. Every single one of them made a comment about either the Middle East war or the uncertainty with tariffs, either or both mentions of those two factors, and that's going to be obviously still adding to their list of concerns over the next half year.
Okay, Jennifer, thank you very much. Jennifer, do stay with us. You'll be coming up in just a moment again, and we're going to be playing the latest from the ECB, because central bankers there saying that the biggest inflation risks from higher energy costs may yet be still ahead. That's next. This is Bloomberg.
We should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data.
Yes.
We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
This is Bloomberg Markets. I'm Lizzie Burden in London. Well, ECB officials say that the inflation shock from the Iran war isn't over yet. Chief economist Philip Lane sat down with Bloomberg's Francine Lacqua at the ECB Forum on central banking in Sintra, Portugal, to discuss the modest increase in confidence levels as oil prices fall.
For the economy, it's only been, a few weeks. So clearly what's changed is the oil market and that is moving quite a bit in the weeks since we've made our decision. And so let's see how that percolates across the economy. So what we have seen is in terms of confidence indices, there has been some improvement, but not a return to the pre-war levels. So it's not the case that there's been this very rapid rethinking of how investors and consumers feel. I mean, I think probably they need to see this current peace agreement convert into something more durable. And as you know, every day there's, plus and minus signals. And that needs to settle down, I think, before consumers and investors take a more decisive revision of their views.
I mean, this is really the concern, right, is that we're not really sure what these ongoing talks will bring. Madame Lagarde yesterday was really talking about no forward guidance, but scenarios. So with these ongoing talks, are we closer to the milder scenario or base scenario?
So I think the most important fact that we see is right now the oil prices reverted to pre-war levels. Yeah. But the view of the market in terms of 2027 and 2028 is that it will be well above pre-war levels. So in other words, over the next couple of years, maybe because around the world, energy firms, governments will want to rebuild inventory, that maybe demand for oil for restocking purposes will keep the oil price high compared to the pre-war level. Mm-hmm. So from our point of view, it's very welcome that we see this decline in the price of oil, but in terms of the overall inflation impulse, the fact that we do have maybe for a couple of years oil prices above the pre-war level, that essentially is a cost-increasing impulse to the economy.
So it's very clear that the ECB wants everyone to know that the last hike was not an insurance hike. Will the next hike be an insurance hike?
So I think it's important that we are clear on our terminology, if you like. So as President Lagarde said last night, we feel that the June decision was a robust decision, that we looked at it from every angle, and even from the angle which we did anticipate of having, if you like, this more rapid decline in oil prices. Even under that kind of more rapid normalization, it made sense because of 4 months of high oil prices to raise the rate from 2 to 2.25. What I think is important to say is as we go forward, as we evaluate the kind of pros and cons of different rate decisions, we will be, if you like, mainstreaming the concept of how does this decision look like under uncertainty. Yeah. Now, for me, I would reserve the phrase insurance hike to a situation where there's a tiebreaker, that maybe you could at least stay where you are, maybe you could hike, and the risk considerations will push in one direction. But that was not the June decision. That was a clear decision, robust across a wide range of scenarios.
Yeah, I mean, given the wide range of scenarios and the uncertainty and the second round effects, is it better to hike in July or September?
Well, again, the way you phrase that question is maybe overly narrow. So what I would say is, before we get to the second round, I mean, for me, the second round effect is probably going to take some time. What I'm really focused on is the indirect effects. So even though now, like, fuel prices are falling, what we need to look at is how the 4 months of energy cost increases percolate into food inflation and into services inflation in particular. And that channel is maybe where there's still uncertainty. And it's essentially the tension between these many firms have been absorbing higher cost increases for a number of months. Whether they can recover those cost increases by raising prices, or whether, especially in the context of now the fuel prices reversing, it's absorbed in profit margins, and there's less by way of the indirect effect. And only after that can you start to have a vision of how strong the second round effects on wages might be, which will be later this year and into next year.
So you're telling me my question is too narrow because you could not hike at all?
I think, as you very well know, we're very much committed to basically going one meeting at a time, to not boxing ourselves in by kind of speculating about rate decisions, and essentially focusing on, at the time of the meeting, when we look at everything, what makes sense.
So that was the ECB chief economist Philip Lane speaking to Bloomberg's Francine Lacroix. Let's bring back Jennifer Lee, senior economist at BMO Capital Markets, for her take. Jennifer, you heard a cautious Philip Lane there. You're not so cautious. You say that it's likely the ECB is one and done. Why? When we were talking about the tariff risks earlier, and he was flagging the continued geopolitical uncertainty around the Middle East.
So, first of all, I would hate to be a central banker these days. Very tough questions. To me, I mean, he was doing the right thing, just trying to temper expectations. He's definitely not going to say, yeah, we're done. That's it. Like, oil prices are back and we're okay. You know, the ECB, as President Lagarde had pointed out in Sintra, you know, they had the benefit of being in a very good position before everything began. They had basically inflation at target. They were sitting pretty, and that was great. And then, of course, everything happened. So I don't know if I could actually say, you know, that it was a mistake. You know, hindsight is going to be 20/20, of course, but I think right now they just have to be cautious. And just like looking at any one economic indicator, like U.S. payrolls, you know, you sort of have to take it. It's not the be-all and end-all. And we've seen some very encouraging June inflation numbers out of Europe. You know, France, for example, they just landed back at the 2% target. You know, who would have thunk that? And of course, everyone else is coming down to about 2 or 3 month lows. We need another month at least of better inflation data, I think, before we can make a firm decision on what the ECB is going to do, just given the fact that you know, that the tankers are starting to move through the Strait of Hormuz and oil prices are coming back down. We'll take that as a win, and that's a good thing, and that's going to help inflation keep coming down. So, you know, I think most likely, I say this now, that the ECB is probably going to be finished. It looks like it's going to be a one and done deal. But of course, just as quickly as oil prices have come down, they could also easily go back up. So again, we need to see another month's worth of good inflation data.
And let's see what happens at the end of the 60-day negotiating period as well. Jennifer, thank you so much for being with us this afternoon. Jennifer Lee with BMO. Thank you. Well, coming up on Bloomberg Markets, a sweltering heat wave threatening parts of the US East Coast, ahead, of course, of the country's 250th anniversary. We'll talk about that next. This is Bloomberg.
week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Welcome to Bloomberg This Weekend. I'm David Gurr.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
This is Bloomberg Markets. I'm Lizzie Burden in London. 2:53 p.m. here in London. Well, President Trump's gearing up to visit Mount Rushmore for Independence Day as a heat wave scorches the east coast of the country. Bloomberg's Miles Miller joins us now for more. Miles, I hope you're keeping cool. Let's start in New York. What are you seeing?
Yeah, New York is very hot. We are on about day 2 or 3 of this heat wave here in New York. And, you know, the mayor has put out this call for everyone to conserve energy. You know, AC is clearly not a big thing in Europe. I was just in Paris and experiencing the beginning of that heat wave, so there'll be some commiseration about how hot it is here. But he asked everybody to keep their temperature up on their AC, which caused some consternation. But yeah, we are going to be experiencing really hot days leading up. So this day and then tomorrow, leading up to the July 4th holiday. There are so many people in town for the July 4th celebrations, the celebration of America's 250th birthday. And so there's going to be a parade of ships on the Hudson River. We'll have the fireworks on the Hudson River and East River. And then we will also have folks who are here for the World Cup. And then folks who are here for Taylor Swift's Hush Hush wedding. All of that with the heat causes big issues, and it's not just here in New York, it's happening in Washington and Philadelphia too, 2 places essential to America's 250th birthday, having big celebrations, but will be very hot, and they may wind up changing some plans because of it.
And Miles, the wedding's supposedly taking place at Madison Square Garden, not seemingly to a Brit the most romantic of venues. What's security going to be like?
Yeah, I mean, imagine a wedding at the O2. That'd be a little strange, or Wembley, you know, like it just, you know, I like, and I don't want to say too much because, like, I don't want to say it's tacky, but it kind of is. Yeah, no, security is quite something. 140 cops have been assigned to Madison Square Garden for this wedding that's happening. Yesterday was the rehearsal dinner, went off without a hitch, no problem. I was over at Madison Square Garden yesterday. The entire area had police barricades around it, and then tonight starts the big shutdown outside Madison Square Garden and the surrounding streets so that 500 cars can show up and deposit 1,000 guests into the world's greatest arena for America's royal couple. How about that?
Lovely. Well, Miles, I'm sure you'll be covering all of the events over the weekend for us. For now, thank you, Miles Miller. And coming up, Miles mentioned the aircon pressures. We're going to talk about energy next with David Energy CEO and co-founder James McInnes. That's next. This is Bloomberg.
Anytime you have an industry that grows like that, there will be pockets where things are more difficult. So if they're smaller companies, it's harder to deal with tariffs, it's harder to deal with labor and with rising interest rates. So there you may see some poor performance. That doesn't necessarily mean that lenders will lose money, but it may be more difficult. And then pockets of software, everybody's been worried about how will that play out. I think there was a lot of capital that was put in from very smart private equity and very smart institutional investors into software really in the 21-22 vintage that was pretty highly priced. And that, as that works its way through the system now 4 or 5 years in, you may see pockets there. But I also think that the need for income, people want income in their portfolio, and they can get that in many ways. You can get that from the treasury market, you can get that from a bank, you can get that from high yield right now is pretty good. High yield has very little exposure to software. And then you can get it from private credit where you maybe get more return and a little less liquidity. And so that, I don't see that going away. In fact, I see investors wanting more of that and wanting it from real estate, wanting it from real assets.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on Salar de Uyuni in Bolivia, and this is Bloomberg.
Welcome to Bloomberg Markets. I'm Lizzie Burden in London, where it's just going to be 3 p.m. Well, US markets are closed for a holiday ahead of the July 4th holiday tomorrow. But here's what you need to know this afternoon. Stocks rebound after 2 days of a tech-led sell-off as traders trim bets on Fed rate hikes after that weak US jobs report. Elsewhere, President Trump and his allies are renewing a push to reshape the Federal Reserve, with Governor Lisa Cook still a target. And a heat dome has settled over the US East Coast, pushing New York City to its hottest day since 2012. Well, let's get a check of these markets. Happy Friday, by the way, and it is green across the screen for European stocks this afternoon. Although it is thin volumes given the US is closed, you've got actually the benchmark stock 600 powering towards its best week since May. The DAX in Frankfurt outperforming, the FTSE in London underperforming, and the CAC 40 in Paris somewhere in between. But let's take a look at the cross-asset picture as well. The dollar a little weaker today, which is perhaps unsurprising given what we saw in the payrolls numbers yesterday. Gold up for a third day as the jobs data weighs on Fed hike bets. We're still at $4,164 a troy ounce. Brent steady here as the tanker traffic through the Strait of Hormuz picks up and the talks between the US and Iran continue. $72 a barrel on oil. And given that treasuries aren't trading in cash today, let's take the temperature in the bond space. German bunds on the 10-year at 293. Now, talking of that US payrolls report, hiring slowed sharply in June, curbing some of that budding momentum in job growth that we had seen this year. White House National Economic Council Director Kevin Hassett's been speaking to Bloomberg about the labour market.
I would say that it's on an upward trajectory, that 3 of the last 4 months surprised on the upside, as you know. There were a little bit of downward revisions. This one came in a little bit below expectations, but if you lift up the hood, then the basic story that we think is animating the economy right now is that there's a construction boom.
Well, our next guest says that inflation remains a pressure on the US consumer. Ethan Devitt, the Global Wealth Managing Director at Moneta, joins us now for more. Ethan, thank you for making time for us today. I wonder how much weight you place on the jobs report.
I don't place a lot of weight on the jobs report, actually. This is really in the sphere of a rounding error. We've had positive numbers in the last read, and then just Friday, this week, we've had slightly negative numbers. We know that they are prone to being revised, and probably a function of the seasonal movements as we have now moved firmly into the summer. So definitely there was a little bit of puncturing of expectations around the interest rates, a little bit of a sense that the economy was not as vibrant as before, but I don't think this is really going to change the direction direction of travel, not going to change the momentum around equity markets.
Well, yeah, we've gone from higher for longer to maybe no more hikes. Has the market swung too far then?
If they are believing no more hikes, I think that is a little bit too far to swing based on one jobs number. Remember, we were looking at cuts not too long ago. Then we had this exuberant market performance. We've also had the inflation being pushed up. We do know now that the oil factor of this inflation is subsiding. However, the consumer goods factor is rising. We saw that through the price of Apple recently. So all of that points to quite a mixed picture for inflation, but definitely erring on the side of rising. So I would say that given we are finding it very difficult to read the new Fed chair, it is really anyone's guess at this point what his preferred approach is likely to be.
Yeah, I mean, is he a hawk or is he a dove in your view, given what we heard at Sintra?
Well, what we do know, he's playing his cards very close to his chest. He's certainly not giving anything away in terms of telegraphing. We've seen the phrase tight-lipped being bandied about in relation to him. And that's probably with a view to probably not revealing his hand, shall we say, too early. He's definitely minded to not intervene, in my view. I don't think he wants to make the mistake that may have been made in the past, preemptive intervention. There's that moral hazard of propping up the market too early. But however, he knows what the president's overall desire is. And there will come a time as elections near when that pressure may rise.
And indeed, we may see more volatility as we head towards those midterms. We've just had a pretty stonking quarter. Does it get uglier from here?
I would say we're going to have some moments of revision of the numbers we're seeing, and we're going to be digesting once the 4th of July holiday is over, because for now everyone's at the beach. I think they're dealing with the heat, they're at the beach, they're not focused on this right now. But we did have a fairly seminal, I'd say, statement by Alex Karp around the balance of power with the frontier models and CEOs and their proprietary data. And that may have been said to be the quiet part out loud. Maybe it wasn't even the quiet part as far as many market watchers were viewing it. But this is suggesting that this is not necessarily for the frontier models necessarily to gain ground here. There is a suggestion that we see some retention of sovereignty by the large corporations, and that this could well be putting pressure on those companies, on Anthropic, on OpenAI, right around the time they are finalizing their paperwork around a potential IPO.
What did you make of the hit to chip stocks yesterday? Is it kind of a healthy rotation? Is it the start of cracks in the AI trade, bigger cracks?
For now, I'd say it's a bit more just rotation, profit taking. I think we have not yet really got the full narrative of what the cracks in the AI trade would look like. What we do know, though, is that the pressure on compute is immense, and there is going to be a lagging factor. There have been orders put in, there have been basically orders not even fulfilled, and I suggest that when we see a slackening in demand, that will not immediately factor into a slowing of orders. So that's going to be something to digest. So I'd say now it's really, there has been so much froth, so much positive momentum here. We've come to the end of the second quarter. That's a time to take profit.
And do you think that we're in an earnings bubble where earnings expectations are just going up too fast? We're about to start another season.
Well, that was definitely a headline today, that these earnings are simply too high. Are now expectations have been set regarding that. I'd say that the earnings have continued to surprise everyone. We've seen a slower consumer, but yet that's not being reflected in earnings. And we know that inflation has been an issue for companies too, and that has not been reflected in earnings. So I'd say, can this be sustained, remembering that earnings numbers are backward looking? I think they will come under pressure. But what we do know from previous quarters is that companies are very quick to telegraph well in advance. No surprises is the order of the day. And as we're coming, you mentioned volatility as we approach the midterms. There's going to be more volatility. We know there's some surprises in store. We're not out of the woods yet around geopolitics. I don't think that CEOs want to instill more volatility by not managing expectations around their earnings.
Well, yeah, you kind of wonder if there's a pullback when it comes to AI capex in the future, whether that becomes a macro risk.
Well, certainly there is a lot intertwined in the AI trade. And if we look at, just take, for example, the South Korean markets, how much they are riding on the AI and semiconductor trade. And we know that other Asian markets similarly have been lifted in that way. That's why the rotations have been so healthy when they have occurred. We've seen a rotation into healthcare. Healthcare has done well over the past month of June. And we know that financials have also had their time when they've been doing well. Certain stocks have not done so well. But if there is a pullback in CapEx, that will, I believe, send a chill through the markets. All things will sell off initially, but then we'll start to see the green shoots come through in those sectors that have been overlooked, that really have not even priced in any productivity gains from AI, and there will still be productivity gains. So that's still to come.
Okay. So a healthy spreading out perhaps in the pipeline. Ethan, great to see you. Ethan Devitt there, Global Wealth Managing Director over at Moneta. Thank you. Well, coming up, David Energy CEO and co-founder James McGuinness will be joining us to discuss surging energy prices. That conversation coming up next. This is Bloomberg.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
This is Bloomberg Markets. I'm Lizzie Burden in London. Hope you're keeping cool wherever you are. If you're stateside, hope you're having a good holiday. Now, the UK-based National Grid is looking into the cash into the AI boom. It's investing nearly $2 billion in Julant, which is developing a natural gas-fired plant to power AI. And we sat down with the CEO, Zoe Yunovich, earlier on this week.
National Grid has long been invested in delivering energy through long-term infrastructure to our customers. And so in some respects, you could say this is exactly what this acquisition that we've invested in today is all about. But to your point, we are now facing that sector of the market that is growing so rapidly. I mean, the increase in power demand coming from data centers and just more generally from the AI evolving economy, it's an exciting place for us to find ourselves.
It feels like it's really rewriting things really quickly, Zoe, and I wonder how far away you think we are from being able to keep up with the demand from it.
Well, that's why I think this investment is so important for us. What we've done in investing in Juland, which is a technology-enabled energy company, is find ways to actually bring the very best that we can across different sectors to harness that innovation and get the right solutions so that we can actually get speed and scaled power to customers really quickly. And if you take a look at the specific project that we're developing, Project Kilby, you can actually bring the very best of the cultural opportunities from Microsoft, from an energy major like Chevron, through Juland, who's brought that innovation together. And that's what's giving us, I think, a real advantage, real pace to deliver the power, but also the opportunity to scale that over time.
You know, I myself lived in London for about 7 years, so I'm very familiar with National Grid. But to see you coming over into the U.S. itself is an interesting turn. Do you think this is the start of many more opportunities for you in America?
It's interesting, Danny, most people aren't aware, but we already have quite a significant scaled position in the US. We are servicing already both the LDCs, the local distribution companies for gas, in both Massachusetts and New York. And of course, we have a very big presence there around our electric utilities as well. So we have in our 5-year horizon, as an example, about 70 billion pounds. So let's say between 90 to sort of 95 billion US dollars, of which we have about 40% of that being invested in the northeast of the US.
So that was the National Grid CEO speaking to Bloomberg's Danny Berger. She's missed in London, by the way. But staying with the energy story, we've got New York power prices surging as a sweltering heat wave threatens to overwhelm US grids. We can discuss what rising prices mean for business owners now with James McGuinness, CEO and co-founder at David Energy, who joins me now. Thank you so much for making time for us, James. So how much stress is the heat wave putting on the grid, first of all?
Thanks so much for having me, Lizzie. Yeah, so we are actually seeing pretty historic prices in New York City right now. For context, about the amount of power that a home would use in a given month, they may pay $1,000 or $2,000 for that, just given the prices in the real-time markets yesterday and today. There's obviously not paying that directly, but it just gives you a sense of how high the prices are right now.
But I mean, every summer we hear warnings about demand overwhelming the grid. Are we getting better at dealing with this now?
I think we are, yeah. You know, there's a lot of new technologies coming to the grid that David Energy is actually at the forefront of. And so if you look at AI coming, electrification, demand is really rising, and the U.S. is struggling to build enough capacity and keep up with building the infrastructure to keep prices down for customers. So in New York City, our customers have seen their prices rise probably 67% over the last couple of years. And what we do for these businesses is we actually come and we are installing a totally new type of battery called plug-in batteries. They plug in directly to 120 volt outlets, you know, just your standard wall outlet. And we install a few of these on site at customers like laundromats, gyms, restaurants all across New York City. And during high price times like these, we can actually discharge those batteries to avoid using power at high times and actually pay our customers get them savings during these times instead of paying out of pocket.
So how quickly can a customer expect to see a return on that investment?
Yeah, so for us, we actually don't charge the customer up front for the battery at all. We install it for free, and there's no ongoing payments that they actually have to pay us. We're actually the power supplier for these customers, so we're selling them the energy as well. And what that means is that we can install the batteries for free, and our promise to them is that they'll start saving money on day one. So the first bill they get, the first month, they will see that they're paying less than the local utility. And so there's really no CapEx or, the ROI starts for them on day one.
I mean, you mentioned you work with laundromats, you work with all sizes of business from, small restaurants to the likes of McDonald's. How are the energy problems different for businesses of different sizes?
Well, I think there's certainly different problems for customers that own many locations. Some of our customers own 40, 50 locations across New York City. so they'll have much higher spend on power than others. And then some of them are just, single location, small business, restaurant owners. I think what's consistent across all of them, though, is that they feel like they have no control on their power bills. They're seeing AI in the headlines and the power demand there. Their bills are going up. They're not super happy about it. And so we come in and help alleviate that pressure from them. And I think it's particularly acute in times like these when, the heat wave is ongoing and things are in the headline, like you saw the European Commission. There's a lot of controversy that they turned the AC off on some of their lower floors and not the higher floors where the executives work. And then here in New York City, you have Mayor Mamdani saying to turn your thermostat up to 78 degrees. And while we can obviously appreciate trying to alleviate the pressure on the grid during these times, it makes our customers feel like not only are they paying more and they don't have control, but they also don't get to enjoy the benefits of the power grid and get AC when they need it. And so the thing that we focus on across all of these businesses is that we're going to help them save money. We're going to let our batteries during these times, and they can keep their AC cranking.
But do you think that the conversation is turning away from climate to economics as clean energy becomes more and more politicized?
Yeah, and I don't think that's necessarily a bad thing. I mean, from day one, we've actually believed that clean electrons are the cheapest electrons. So our mission as a business is run the grid 24/7 on clean energy. And we think that the more solar and batteries we get out there on the grid, the cheaper our customers' rates are going to become. And not only that, just like in times like these, the grid is also going to get more reliable. And so these are incredible new technologies coming to market. We think there's a performance benefit. And so while some of our customers care about clean energy, and we're happy to talk about that with them, a lot of them do not. They're focused on their pocketbook. And so we sort of believe in a future where there isn't a trade-off, where you can have clean energy, it's cheaper, it makes the grid more reliable, and that's really what we're after. That's our mission here at David Energy.
So 5 years from now, what looks completely outdated that we have now that won't exist then?
I think especially with these new types of plug-in batteries and solar coming to market, I mean, I think in Europe, they call it balcony solar. That's a big trend coming to the US that we're at the forefront of, and really one of the few companies installing these types of assets. And what it's really doing is democratizing access to these technologies. So if you're a small business, if you're a renter, you can buy solar, you can buy batteries, you can even self-install it or get a company like us to help you connect it and then connect it to energy markets. But I think what that means is we're just going to see this. We're going to see solar and batteries everywhere. I mean, I think solar and batteries should be on every home and building in the U.S., and that's going to do a lot to lower prices and fight the climate crisis at the same time.
Makes sense. It's hot and sunny, isn't it? James, thank you for making time for us. That's James McGuinness, CEO and co-founder at David Energy. Well, still ahead, the ECB striking a dovish tone after hiking rates in June. That's next. This is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
It's true that we've been hurt by supply shock, which increased price of energy, and the point for us is that it doesn't go through, all the prices in Europe. But I think we had good news about oil and the reduction in the price of the Brent. So it makes our job maybe a little bit easier. We'll see when we meet next time in July.
What are you expecting for July? Will it be a more difficult decision than June was?
No, I mean, we are not into forward guidance, so we'll decide when we'll be there. But what we see is that at this moment and at this juncture, we are in a good position, and the balance of risk is in the right place.
I know you worry about services inflation. What can you tell us about services inflation?
Well, service inflation has been, energy is feeding into services, obviously, because they are transport, airfares, logistics, which are heavily impacted by the price of oil. But the fact that the oil price decreases will I think soften the inflation on services. But it's still, what we see is that we are above our target. And so I think the decision we made in June was the right one, because we had inflation above our target on our horizon. But the good thing also is that, we do scenarios. So we look at different scenarios and forecasts. We had a severe scenario, base scenario, and a milder scenario. And the fact that we have this scenario makes us much more comfortable on our decisions.
So where are we in the scenario factor?
Well, we will have new forecast in September, but I think, we are comfortable in our base scenario, and, the news on what's happening in the Strait of Hormuz is globally good news.
Overall, we were in Sintra together, Portugal, for the ECB forum. A lot of the governors were worried that there'd be second-round effects. Do you expect the decision-making of July, but also September, just to be more difficult?
I don't think so. I think that we made sure in our communication that we were not entering into a new cycle of hikes. So we took this decision in June, which was perfectly legitimate, and now we will decide meeting by meetings and data dependent. So we'll see where we are in July and in December, but we've made no commitment for this to.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
This is Bloomberg Markets. I'm Lizzie Burden in London. It's just coming up to 3:30 p.m. here. Of course, it's a holiday stateside, but let's get a check on these markets. Thin as volumes are given that holiday. And if we focus on Europe, the Stock 600, the benchmark European index, powering towards its best week since May, led by tech and utilities, following the gains that we saw on South Korea's Kospi earlier, and with Nasdaq futures pointing higher as well. Turning over to the cross-asset picture, the dollar is a little weaker, unsurprising after payrolls yesterday. Gold up for a third day as that jobs data weighs on Fed hike bets. Brent pretty steady, $71 a barrel as we monitor the talks between the US and Iran. Citi actually saying that oil could slump to $60 a barrel a day by the end of the year as the war shock fades. And given that treasuries aren't trading in cash, we're looking at the 10-year bund yield at 2.93. So, as I say, it is a holiday stateside. Americans gearing up for one of the largest shopping days of the year. Lucky them. Let's discuss consumer trends now with Jill Kress, Chief Marketing and Experience Officer over at Babylist, who I'm pleased to say joins us now. Jill, really good to have you with us. I'm 5 months pregnant, so this is a conversation that's of particular interest to me. Babylist, of course, expanding its remit. You're known for baby registries, but you've moved into family finance. Why do that now?
Well, first of all, thanks so much for having me, and congratulations. It's certainly one of the most exciting and overwhelming moments for a parent to think about welcoming a new baby. I'm excited to talk about Babylist and our new early investor product. Most people know Babylist for its registry. We see the registry as an entry point into a long-term relationship with Babylist. 40% of new parents in the US use Babylist, and through that list and registry, over 10 million people gift on Babylist. That's an incredible testament to the social graph and how powerful that is. Babylist is having incredible growth. Last year, we posted $750 million in revenue, and we're on track to do $1 billion this year. I think those numbers are important to understand the scale and context of Babylist. There's really no other brand that understands the purchasing power, the behavior, and the shopping intent of new parents. And with that, we know that becoming a parent is overwhelming in many ways. And one of the biggest concerns that parents have is, how am I going to pay for my child's education? And on the eve of the launch of the new 538 Trump account, the American government is giving $1,000 in seed money to babies who were born during this administration. And this is an amazing opportunity for parents to start to invest. An early investor is the product that we've built to be the conduit to make it just as easy to gift a contribution into a child's education as it is to give another gift to a baby.
So are we seeing a broader shift from buying gifts for babies to investing into their future then?
One of the things that we're seeing is this normalization of people asking for cash contributions. We have seen an increase in cash as part of the baby registry, and we're excited about the opportunity through our early investor account for parents to have a tool to ask for the thing that they, in many cases, want as much as a gift, which is a contribution into their child's financial future. And Early Investor makes it really easy and seamless to do that. I worked at Venmo for a long time, and one of the things that Venmo did really well was it took the ick and the awkwardness out of asking someone to pay you back. And we think Early Investor is an opportunity for that same thing to play out, which is for parents to, yes, lean into that trend of asking for the thing that they really want, which is more contributions to their baby's financial future.
Well, yeah, your customer base includes nearly 40% of first-time American parents. What are they telling you about the financial pressures of being a parent in 2026?
Yes, we know that there are many financial pressures. It costs a lot of money to bring a baby home. And one of the things that is top of mind is how am I going to pay for my baby's education? And we hope that with Early Investor, we can take some of that stress off of their plates. The other encouraging thing is that we know the community that surrounds the baby, grandparents, friends, and family, are very interested in making these kinds of contributions. The challenge is it hasn't been easy. And so with the Early Investor product, it's really simple for a parent to register and create a link that can do a one-time contribution or an ongoing contribution into their child's either 529 college savings account or the new 538 Trump account. The exciting thing about that is when people make the gift of a contribution, it will really compound and grow with the baby. The compounding interest piece of it is something that's really, really powerful for parents as they think about setting their baby up for long-term financial success.
And Jill, you talked about the rapid rate of growth of your business, approaching $1 billion of revenue. What's been the main driver of that growth?
Yeah, so our core product is the baby registry, and we see incredible growth in that product, and we continue to add more features, including things like cash contributions to support things like meals when the baby arrives. So we continue to make that registry more and more functional. We've added new verticals. We expanded a few years ago into a health vertical. That is a way for us to help new parents get the things that they need to support their baby's health, like a breast pump and other supplies. And now we're expanding into our third vertical, Baby List Money, and excited to be launching the Early Investor product. So again, I think with this audience that we have, 40% of new parents, we've really already established this incredibly trusted relationship with new parents at this very overwhelming and exciting moment for them. And so through that relationship, we listen to them, we understand what's top of mind, and then we work on building a product roadmap that will deliver the solutions that they need, whether it's making the registry work harder. The registry will now start to create wish lists so that they can use that same functionality for other milestones like birthdays and holidays. The advent of health and now in what we're doing with money just allows us to continue to do the work of ensuring that the registry is just an entry point into a relationship with Baby List, and that we can continue to do more jobs for parents through the life of their child.
Well, speaking of milestones, what milestones do you need to hit before you IPO? Are you still on track to do it next year?
There's a lot of energy around Babylist growth. I can't make any comment about a potential IPO. We continue to strive to do those jobs for the parents that are so important and trust us, and make sure that we continue to be the most trusted brand when it comes to preparing for every stage of a family's journey.
All right, Jill, good luck on that journey for the company. Jill Kress of Babylist there. Great to have you on. Well, coming up on the programme, tech stocks hitting a bit of turbulence, with investors concerned about just how much further this rally can go. We'll talk about that next. This is Bloomberg.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. It doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start in the third floor or the lobby. You actually have to start in the basement.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bloomberg Markets, I'm Lizzie Burden in London. Well, it's been a roller coaster year for Qualcomm already as the chipmaker looks to keep up with the ever-evolving world of AI. Qualcomm's CEO spoke to Bloomberg's Romain Bostick and Ed Ludlow last week to discuss the company's sky-high expectations for the future of data centers.
$5 billion in fiscal 27. It's a high confidence number that we have based on customer engagements we have right now. Most of the revenue is from custom ASIC engagement that expanded since the acquisition of AlphaWave. And you started to see in their revenue some of this innovative technology we came up for accelerators that doesn't require HBM memory is our high bandwidth compute. And as we keep executing on those customers, we're excited to see that revenue going to about $15 billion in fiscal 29.
I am curious, Cristiano, when it comes to those longer-term targets and the bridge between the short term, so what you have put out there for 2027, is there any sense, I know you haven't named the customers that get you over that bridge here, but is that going to fill the hole of that $5 billion based on the $1 billion that we already know is out there?
Look, the $5 billion, as I said, it's, I'll give you the composition. I think what I can say right now, I think, as you'd expect, a lot of those contracts are governed by non-disclosure. We have one large hyperscaler customer in the United States, one large hyperscaler customer in China, and then we have some other engagements that we had on a data center. That is all into the $5 billion. So the $5 billion it's a very high confidence forecast to which we have the customers, the capacity, the memory allocation, and everything. As we think about the engagement we have today, and also we talk about a contract that we have with Meta, also for 2 generations of the CPU, especially as we position ourselves for the agentic CPU opportunities, that those engagements are into the $15 billion number. For Qualcomm, as a new entrant, those are great numbers, but really, when you look at the scale, what's happened in a data center, you would imagine as we execute and we show our differentiation, there could be upside, but we're just, being focused on the engagements we have today.
I do have to ask, though, and investors seem pretty pleased with what they heard yesterday about you articulating this longer-term data center strategy. But I'm curious, I mean, you famously exited the data center business back in 2017, 2018, and I know there were a lot of reasons for that went beyond your operational control. But there was a lot of competition then. There's probably even more competition today. Why do you think you can get it right now compared to what it was 8 years ago?
Yeah, look, the circumstances, I think, when we started on the CPU, actually, I know people talk about data centers as a general term, but we started a long time with an ARM-compatible ISA CPU very early. There was a big software barrier. This was before AI. And, at the time, I did not, the market wasn't ready for it, only until later. So it was kind of probably the right decision for Qualcomm at the time. This is a different conversation. It's a different data center right now. This is about AI. But it's a valid question, right? So I will give you the same answer that I gave when we entered the automotive business, when we entered the industrial business, and everything that we have been doing to diversify the company. Those are fast-moving markets now, changing with technology. So where we really focus is not what the data center is doing today, but what the data center is going to be doing tomorrow. The data center is now moving to agentic. That's why you see CPU companies on the rise. You see demand on the rise. The data center is being disaggregated. It's not one single GPU that does everything. You have different hardware. And we're coming out with a comprehensive portfolio. We have a CPU. We have a new memory solution that is not a memory from the memory provider. It's actually been designed by Qualcomm that doesn't require HBM. We have a different accelerator for the disaggregated compute, and we have our semiconductor scale, which is good for custom ASICs. So that's what we're doing. And, if technology matters and you have fast innovation cycles, there's room for Qualcomm.
So that was the Qualcomm CEO speaking to Bloomberg's Romain Bostick and Ed Ludlow. And sticking with tech, chip stocks kicked off 2026 by posting their best quarter ever. But after recent jitters sent the stocks tumbling, we've got investors wondering how much further that rally really can go. Matt Bloxham of Bloomberg Intelligence joins us now with all the answers. So, Matt, before we talk about the sustainability, just tell us what's driven the rally so far.
Yeah, I mean, we had a little bit just there from the Qualcomm CEO. We had this kind of massive surge in investment in data center capacity, and we're starting to see kind of real new demands put on the chips and the processors, and this is where the kind of memory is coming in, because the NVIDIA chips in particular, real big consumers of high bandwidth memory, and so that kind of whole ecosystem is kind of really benefiting. And if you look at the CapEx projections, 2026, the kind of big 5 US hyperscalers are going to spend maybe $650 to $700 billion on technology, mainly towards data centers. That's almost double year on year, and the market thinks that number is going to go above $900 billion next year. And so a lot of that money is going into chip technology, and that's kind of where we've seen this kind of surge in share price come. I think it's kind of caught the market a little bit by surprise. quite how important memory is to the AI technology revolution.
So you had semi-suppliers kind of caught off guard, but when it comes to the sustainability question, is it just going to be inevitably eventually a repeat of the boom-bust cycle?
Yeah, I mean, I think the market's a bit split. I mean, if you look at the multiples for the big ones, so SK Hynix, Micron, they're trading on kind of single-digit PEs. That tells you the market thinks that we are going to ultimately go through some kind of boom and bust. This isn't a sustainably higher level. Yes, they're benefiting from short-term, massive short-term boost of profits. That's probably not going to fade next year. Probably 2028 might be the year where, if there was some kind of slowing in the pace of AI demand or there's a bit of a pause, that's where you would start to see it. And that's what the market's pricing in. So, if that's wrong and actually we continue to see this kind of tsunami of AI demand come through the corporate system, then, there could be upside to those valuations from here.
You mentioned NVIDIA as a buyer of the chips. Yeah. Why is their share price lagged so far this year?
Yeah, I think you probably almost have to classify NVIDIA as one of the kind of the first movers, the first wave of the AI bubble. If you look on a 5-year view, NVIDIA is up massively. And so I think it's kind of paused for breath a bit over the last 12 months because the market's already got to a point where it's pricing in significant forward growth for that company. And then you've had the second wave, this new bottleneck, which is memory supply. And that's where the investor community has shifted, taking some profits perhaps out of NVIDIA and putting it into the second wave.
Okay, Matt, thank you so much for that. Matt Bloxham of Bloomberg Intelligence, thank you very much. Well, we are looking actually at tech as one of the best performing sectors in Europe today. It is currently in 4th out of 20 place and it's up 1.5%. We already saw gains in the Kospi in South Korea earlier on today, so reversing the picture that we saw yesterday. We're looking at NASDAQ futures higher as well today, up 1.2%. Of course, the US is on holiday. This is for Monday, but we're seeing a generally positive story for tech on this Friday. And we're going to continue the story about tech next and ask the question, can AI replace experience? The Ford CEO, Jim Farley, says not quite yet, and we'll bring you that interview next. Stay with us. This is Bloomberg.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is Bloomberg Markets. I'm Lizzie Burden in London. Well, Ford's quality comeback wasn't driven by AI alone. The automaker brought back hundreds of veteran engineers to help train its AI systems, a move that helped propel Ford to the top of J.D. Power's latest initial quality study. Bloomberg's Matt Miller spoke to the Ford CEO, Jim Farley.
It took us 4 years of hard work to be an overnight success story. You know, it's been just an amazing culture change at Ford. Literally, Matt, every one of our engineers has been in the plant. Every one of our supply chain teams are in our suppliers. We are paying attention to every detail. It has taken a few years to get there, but I think it's really about the culture of putting quality before profits, before anything else. And that really is what's exciting about this, because now what I'm seeing is the team really focusing on long-term durability.
So what was it, your team, was it an employee, a labor issue? Was it, technology? Did you use AI? Was it factory processes? Like, can you get into specifics of how you did it?
Yeah, if you were to visit today the Rouge plant where we make the F-150, Matt, what you would see is a whole control center around data and quality data. So we measure the torque of every one of our fasteners. We have AI tools for vision systems. But most of all, it's just old-fashioned hard work of our team members all working together to pay attention to the very small details that will make a difference between a perfectly built Ford and an okay built Toyota. It's just an incredible attention to every single detail.
So, I mean, it's interesting now that we're in the age of AI and we're talking about this technology killing jobs, but it seems like in your case, it's really experienced human workers that made the big difference.
It did. I have to say, the process coaches, the area coaches, you know, they get up every morning, they look at the last shift's quality data, we look at how many vehicles are repaired, and we work that process every moment of every day. Every employee walks into any one of our plants, they know exactly, are we winning or are we losing yesterday and today? Everyone is fully aware of where we stand. We know exactly where Toyota is. We know exactly how to, where we need to get to beat Tundra and Super Duty better than any of the other domestic competitors. And so everyone is aware exactly the quality that's coming out of our plant in any particular shift every 50 seconds. And that human motivation to pay attention to everything is amazing. Look, we make 85% of our vehicles in the U.S., Matt. That means these are U.S. factory workers versus even our domestic competitors. They're some of the biggest importers in the U.S. We're not building these vehicles in South Korea or Japan. These are American workers beating Toyota and Hyundai and our domestics who import their vehicles. We beat them all with American workers with the attention to detail.
Well, that was the Ford CEO, Jim Farley, speaking to Bloomberg's Matt Miller. Well, on a quiet day in markets, thin volumes given the US holiday, I just want to bring you some breaking news, focus on a single stock, and that is Continental. We had a hot headline crossing the terminal that Conti has nearly finalized the sale of its Conti Tech industrial unit to Lone Star Funds. That would complete the manufacturer's shift to focus on its tires business. And so this story confirms a Bloomberg scoop from last month. Of course, it comes against a backdrop of private equity funds increasingly targeting industrial assets that they see as more likely to benefit from AI than to be rendered obsolete by it. And we're seeing Conti shares, as you can see there on the screen, higher 1.8% as a result. Now, looking across the sectoral basket here in Europe, industrial goods and services are in fourth place, up 1.6%. They're behind tech, construction and utilities, about 3/4 of sectors in positive territory, but green across the screen for European equities this Friday. Coming up, Air Chief Marshal Sir John Stringer, Deputy Supreme Allied Commander of Europe, joins us ahead of the NATO summit. That conversation.
called an ideological lunatic or a bunch of left-wing nut jobs?
You know, I've been called worse things than that.
You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. You know, when you're hot on the trail of something, you know that it's very exciting.
What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it Paradise Ahead or Gattaca?
Maybe somewhere in the middle.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome back to Bloomberg Markets. I'm Lizzie Burden in London, where we're just coming up to 4 p.m. US markets, of course, are closed for a holiday ahead of the 4th of July tomorrow. But here's what you need to know. Stocks rebound after 2 days of a tech-led sell-off as traders trim bets on Fed rate hikes after a weak US jobs report. Meanwhile, President Trump and his allies are renewing a push to reshape the Federal Reserve, with the Governor Lisa Cook still a target. And a heat dome has settled over the US East Coast, pushing New York City to its hottest day since 2012. Well, let's get a check on these markets. It is quiet, thin volumes across the world given the US is closed. European stocks, though, headed for back-to-back record highs on the Stoxx 600, powering towards their best week since May. The DAX in Frankfurt leading the gains, the FTSE in London bringing up the rear. And if we flip to the cross-asset picture, the dollar a little weaker, as you would expect, given the payrolls print. Gold up for a third day as that data weighs on Fed hike bets, and Brent steady as the tanker traffic through the Strait of Hormuz picks up. Treasuries aren't trading in cash, but you've got the 10-year Bund yield there at 2.93, currently up 3 basis points. Now, that's what's happening in your markets. Let's turn to the geopolitics, because NATO members are set to gather next week in Turkey, where Europeans are hoping to ease tensions with US President Donald Trump. Air Chief Marshal Sir John Stringer, the Deputy Supreme Allied Commander of Europe, I'm pleased to say, joins me now from Brussels. Thank you so much for making time for us ahead of the summit, sir. Really good to have you on the programme. We've had the NATO Secretary General presenting President Trump with big spending figures in the Oval Office. I wonder how that has actually translated into war-fighting capabilities so far, and what you expect to hear from this on this regard at the NATO summit.
Yeah, I think it's one of the 3 big things that you're going to see coming out of the summit. So it's progress towards what was agreed at the Hague summit last year, historic rise in defence spending for the defensive alliance up to 5%, to check progress on it, and also, to your point, really to make sure that the money and the increased spending is being converted into tangible and, importantly, credible military capability to keep the 1 billion people across the 32 nations of the alliance safe and secure.
I mean, how vulnerable do the cuts that the US has announced to the support that it would give to Europe in case of war make us?
Yeah, I think there's 2 points, if I might, on that. The first is the reality is, sadly, we are not living in happy times at the moment, and that's zooming out from Europe and looking globally. And therefore, the need for the US to rebalance its commitments is not something of the last few weeks or months. It's been a factor for years. The second point I would make is, and I am responsible for sourcing forces for SACEUR, is that European allies have definitely stepped up in terms of backfilling the adjustments in the US forces in Europe. And I think, importantly, you are seeing this as a real demonstration, not just of stronger Europe in a stronger NATO, but this is absolutely NATO nations building the NATO 3.0 that you may have heard a number of people talking about over the last few months.
Well, do you know when the 5,000 troops that Trump said will be withdrawn from Europe will go? And do you expect even more to be withdrawn on top of that?
So I won't get drawn into to numbers across domains. You'll understand that I can't. What I can say, though, is if you look across whether it's maritime or air or land, in terms of the capabilities that we need to deter and defend, those are steadily building now, as they have been over time. And I think you'll find that the injection of spend, around 130 billion extra this year, 20% increase over planned figures from a few years ago, is being turned into deliveries of equipment, material, and of course the important spend on things like training and exercises for all of our forces.
Okay, you won't go into numbers, but can you be confident that the cuts will be driven by military logic and not by politics?
So, yes to military logic. And that's absolutely where we have gone to find the forces to backfill against the American force adjustments and the capabilities that they need for the alliance.
I mean, the US is fundamentally asking for the balance, the burden to shift within the NATO alliance. Does that mean that there'll be more power for Europeans within NATO?
Well, NATO, quite rightly, has been an alliance since its inception. 12 members, first off, remember, in 1949, 32 members now. That it is an organization that is driven by consensus on all the really big issues, on getting the 32 nations to agree. And as a European, I look at European and Canadian forces stepping up over just, the 3 or 4 years that in 2 NATO appointments I've been in, as a very clear demonstration of them stepping up, of acquiring additional capability. And so that burden sharing or burden shifting, which, as I said, was going to be a thing anyway, is now being done in a sensible, proportionate way, absolutely driven by military logic.
Okay. Well, I mean, what's new is you've got the US Defense Secretary Pete Hegseth talking about NATO with benefits. If you pay more, you get more out of the alliance. What do you think those benefits and penalties on the flip side are going to look like?
Well, you'll understand I won't speak for Secretary Hegseth, but what all of the alliance members agreed to in The Hague was the lift in spending to 5% by 2035. Some nations are already there. And that equivalence of spend, all of the nations stepping up, means that actually, the really important questions are answered in terms of nations stepping up to the requirement, developing the additional forces and procuring the additional forces that they need and turning it into capability. But the other thing I would offer is what you're also seeing is, again, frankly, overdue investments in our industrial base, and most obviously the defence industrial base, to make sure that we can actually develop, produce the systems, the weapons, and wider capabilities that the nations need to buy.
Let me also ask you, sir, as a Brit, we know that Keir Starmer lost his Defence Secretary John Healey because Healey perceived defence spending as inadequate here in the UK. Does the UK need to spend 3% on defence by 2030?
So let me answer it as a NATO officer. Let me answer it as DSACR, which is all of the nations, all 32, agreed that they would get to 3.5% by 2035 and have a credible path to get there. So nobody gets an opt-out on that one. That's what we agreed, and that obviously includes here the UK. The thing I would reflect on, both as a Brit and as a NATO officer, is the areas of investment which I see the UK having announced in the last week or so are absolutely aligned with where NATO sees our forces needing to go to be able to be credible in deterring and defending, as I said, the billion people under the NATO umbrella, but absolutely recognising where technology, let alone the lessons, sadly, from current conflicts, are indicating the direction of travel for us.
And from the NATO perspective, you're confident that defence will be a priority under a Prime Minister Andy Burnham?
So again, I can't put words in a Prime Minister's mouth. I wouldn't do it for any of the nations in NATO. But the UK has made the statements that it has done this week, and NATO will expect all nations, including the UK, to live by their commitments.
Would Keir Starmer be a good NATO chief?
Well, not for me to judge at all. It's going to be some way off in the future, and I'm sure there'll be a bunch of highly capable and credible candidates.
There's also comments from Mark Rutte that NATO could play a role in Hormuz if asked and if useful. What would that look like?
Well, I think NATO nations would accept and state two things. The first is clearly the Straits being open benefits everyone, not just, by the way, the 32 nations globally. That is a truism. Second is that Iran cannot be allowed to have a nuclear weapon. So if NATO nations are in the position to assist with the Strait of Hormuz mission, and you will clearly know the Anglo-French initiative, not, by the way, a NATO initiative, an Anglo-French initiative. So there are many discussions going on about what that might look like, but I think people are clear on the need to make it happen.
Just finally, what should we make of the replacement of Army General Chris Donahue with a lower-ranking general as the top commander from the US for Africa and Europe? Is it obvious to you that politics were at play?
Well, I'm not going to comment on that. Again, it's an American thing. But let me, an American national thing. But let me just say one thing, if I may. Chris Donahue is a great American, a great leader, a great man, and he's been a superb commanding officer in NATO. And he's a very good friend.
Okay. Air Chief Marshal Sir John Stringer, we really appreciate your time ahead of the NATO summit next week. Thank you so much for joining us on Bloomberg. Well, coming up, strategist Rob Hayworth of US Bank says that the bull market still has room to run despite Fed and inflation risk. He'll join us next. This is Bloomberg.
At what point do you say, we made a mistake and we're getting out? How long do you give it before you say, this isn't working?
That's one of the most critical differentiators between great investors and just mediocre investors. Because on one hand, you have to have confidence and conviction in all the work you've done, the decision you've made, that if you have a little stumble here and there, if you immediately are selling out, you're never really going to fully realize that the depth of potential long-term success. And yet, on the other hand, if you're stubborn and you refuse to admit I'm wrong, you continue to think the market's wrong and I'm always right, then you'll get caught in some very, very difficult positions over time. So that ability to have a fresh perspective, take in the new information, even when things aren't going the way that you'd expect or to hope, and to really understand from this price point today, is this still going to be one of the most compelling investments or not?
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Only on Bloomberg.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
We think that the previous version of the Fed had made a bunch of moves that looked to us to be partisan. And a lot of the people who decided to cut rates right ahead of the last election, to raise rates the minute that Donald Trump was inaugurated, a lot of those people are still around.
National Economic Council Director Kevin Hassett there on sharing his take on the Fed. The jobs report leading more investors to bet that the Fed will hold rates this year. Well, let's discuss the labour market now. We can bring in Rob Hayworth. He's Senior Investment Strategy Director over at US Bank Asset Management. Good to see you, Rob. Thanks for joining us. Wonder how much weight you put on this jobs report. Does 57K for payrolls change the Fed story for you?
Yeah, no, we don't think, it's great to be here. We don't think that 57,000 jobs changes the story very much because it's still a very constructive labor market. Jobless claims remain quite low. 57,000 still puts us in that realm of meeting population growth, meeting what we need to do from a growth perspective for the economy. So, yes, we're averaging slightly below 100,000 new jobs a month in this year, but that compares so favorably compared to last year when we just averaged 10,000 new jobs a month. So we're still seeing this as very constructive from a labor market perspective. I think the Fed's attention is very much on inflation, and that story is starting to change.
And if the Fed stays on hold, is that actually the best outcome for equities, to both be cautious and perhaps seem more credible?
I think it is a solid outcome for equities. I mean, certainly the market would cheer some rate cuts if it wasn't a softer economy, right? Lower borrowing costs are always somewhat better for businesses. But the Fed is fairly close to what they're thinking of as a neutral interest rate between 3.5%, right? They're at 3.5 to 3.75 right now. So we're in a good spot where the market can still press ahead, especially given all the investment demand that is going on coming out of artificial intelligence spending.
Yeah, but what about the oil market and the fragility of it if the Strait of Hormuz stays disrupted? We're trying to see what happens in this 60-day negotiating period. We're also getting the news today that some leading European powers reckon it's just inevitable that Oman and Iran are going to be charging transit fees in the Strait. Surely that would add to inflation risks, not just for going through the Strait, but setting precedents around the world.
I think tolls in the Strait of Hormuz would be very much a challenge. It is one of the factors, that opening of the Strait of Hormuz, that we continue to keep an eye on. With oil prices moving below pre-crisis levels, right, I think the market is getting a bit of a reprieve. But one of the things we are concerned about is you've seen a significant drawdown in U.S. inventories, especially the Strategic Petroleum Reserve, and that has happened in countries around the world, which does mean that we may not be as resilient in the event of a new crisis, meaning oil prices could spike much higher. I think the good news is we're not in that crisis yet, and hopefully negotiations take hold and we end up in a good place. Certainly the president has some incentive to get these negotiations done as we head into midterm elections, because it has been challenging for the U.S. consumer to deal with these much higher energy costs in the economy. Hasn't been a bad thing yet, hasn't hurt economic activity, but I think the longer this goes on, right, the more that will weigh on the voter as we get into midterm elections.
Well, yeah, you still like US large caps into year end. What's the biggest risk before the end of the second half?
Yeah, I think before the end of the second half, I mean, you've highlighted one, oil prices are one of the things we're keeping our eye on. Two, we want to make sure that the labor market stays solid, and that seems like it's the case, but that's the second thing we'd pay attention to. And the third thing would be the consumer. Consumer resilience has been such a hallmark of this first half of the year, and we've kind of eroded some of that resilience as we think about higher energy costs, taking away some of the stimulus we got from tax rebates here in the U.S. or tax refunds here in the U.S. So we have to watch that consumer resilience as we move into the back half of the year. For now, that all looks good, but we're closely watching weekly jobless claims to make sure layoffs don't tick higher. We're going to watch the oil market. That's an important price every day. And hope for the best that second quarter earnings season ends up fairly solid here as we head into that season starting July 14th.
Yeah, do you think that there's been a bubble with earnings where expectations are just getting really out of control every quarter after every quarter?
It doesn't seem like out of control yet, because we can tie this back to the investment spending that's happening for artificial intelligence. So I think from our perspective, we're doing okay. We're not yet in a bubble. I think we're a long ways away. We're still in such early innings when it comes to the artificial intelligence build out and usage, right? And that's kind of the next key thing that we have to see, is not just getting this built, getting this funded, but then use cases, and we're starting to see some of that already in healthcare. We're seeing it in other businesses, right? But that productivity growth has to be kind of that next phase that we see as we get into 2027.
Okay, Rob, thank you very much for your insights this afternoon. Rob Hayworth with US Bank Asset Management. Well, coming up on Bloomberg Markets, President Trump saying that the US is still negotiating with Iran, but, quote, thinks they've agreed to just about everything we need. We'll dive into the geopolitics next. This is Bloomberg.
Anything we do in Africa is going to be more risky than the U.S. I think the approach we want to take is, how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation is a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend. This is Bloomberg Television.
This is Bloomberg Markets. I'm Lizzie Burden in London. Well, peace talks between the US and Iran on pause as Tehran begins a week of mourning for its former supreme leader. President Trump telling reporters on Wednesday that there was progress between the two countries in negotiations. Let's see if we believe him. Bloomberg opinion columnist Mark Champion joins me now for more. Mark, you've got President Trump saying that Iran's agreed to just about everything we need. And yet we report that European nations, some of them are convinced that fees are going to have to be paid to Iran and Oman to transit the Strait of Hormuz. Surely the White House wouldn't agree to that.
Yeah, so I think we're a long way away from a deal. This is something President Trump has been doing for some time. He's actually been very good at it, managing expectations, managing the market, keeping things smooth, in order to, keep the markets happy. Just sort of lower the tensions around, the risk which still exists that this gets out of control again and that we're back at war. But yeah, it's going to be a while.
So he's saying what he has to ahead of the midterms, essentially.
I think so. And, long weekend, what's the upside to, getting people worried?
But then at the end of the 60-day period, if we get a deal, you wonder where it would leave the Gulf states. And you've been writing about that in your latest column. I'm wondering what the role for China might be.
Right.
Is China going to be the protector of the Gulf states when they have, frankly, learned that relying on the US didn't work before?
Yeah, I mean, there's no sign yet that the Chinese want to take responsibility in the way that the US has, and, to put military base. They have one military base abroad in Djibouti. But they don't show any real sign of wanting to be, to get their head above the parapet in these areas where they would then, start having to make the kinds of decisions that the US has been making. No sign of it yet. There's no doubt that, all of these countries trade very heavily with China. And there's no doubt that they talk to the Chinese. They would like the Chinese to get involved, to talk to the Iranians, because the Chinese have good contacts there. But so far, we haven't really seen them want to play a big diplomatic role. They did do that one thing where they helped the Saudis and Iranians to, reconcile a bit. This is long before the wars, a year or two ago. But not during the crisis, they kept their heads pretty low.
So maybe not China, but you made the point earlier that so many of these Gulf states rely on the Strait of Hormuz for their own exports. Do you think that this threat, potentially, of fees to go through the strait charged by Oman and Iran is a way of having leverage to say, come back to us and we'll protect you?
Yeah, so the Iranians want that leverage.
Yeah.
So they want to be able to, as soon as there's two parts. One is the fees, that's money, and the other part is simply the physical control that you have. Let's say that you start charging fees. You don't call them transit fees. You might call them insurance fees. You might call them environmental fees or whatever.
Tolls by another name.
Yes, exactly. But what the advantage to that is that when you have a ship and you decide that you want to mess with it because the country whose oil it is isn't doing your bidding, you then say that there's some environmental problem where they haven't sort of got the right piece of paper or they haven't done the right thing, and suddenly that ship is sitting in harbour costing money every day, not getting to where it's supposed to be, and that's what the Gulf states really don't want to see.
Okay, Mark, thank you very much. That's Bloomberg opinion columnist Mark Champion, his latest column you can read at OPIN Go if you've got a terminal. Well, coming up, wealth advisor Nancy Dowd shares in her investing playbook for the second half of the year. We'll be speaking to Nancy next. This is Bloomberg.
We should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data.
Yes.
We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome to Bloomberg Markets. I'm Lizzie Burden in London, and it is approaching 4:30 p.m. here in London. Let's get a check on these markets. So the Stock 600, as we get to the close, up 0.7%, powering towards its best week since May. And if you look across the breakdown across the continent, the CAC 40 up 0.5%. The leader here, though, is the DAX in Frankfurt, up 0.9%, and the FTSE 100 in London up 0.2%. If you break it down by sector across the continent, we've seen about 3/4 of them in positive territory. Utilities leading the gains today. Bottom of the basket, though, travel and leisure. And then flipping cross-asset, as you can see, that dollar weakness continuing in the session. Unsurprising after the payrolls print yesterday. We've also seen that data weighing on Fed hike bets, so gold up for a third day, up more than 1%. Brent steady. We've talked about the geopolitics. Talks between the US and Iran continuing. Citi saying that oil could slump to $60 a barrel by year end as the war shock fades. And you've got the 10-year Bund yield there at 2.93, so currently up 3 basis points. Now, going back to that jobs report, we've had Wall Street really processing these payrolls numbers that showed a drop in hiring for the month of June and revisions for the 2 months before. White House National Economic Council Director Kevin Hassett's been speaking to Bloomberg about the state of the US labor market.
I think this is a really strong, healthy job market, and that this was a little bit on the other side of expectation, but the trend over 3 or 4 months is consistent with our view that, again, that we were growing about 3% and that we're going to have a better second half of the year as those factories turn on the lights.
Well, the labour market's just part of the story. The S&P 500 has reached an all-time high 23 times in the first half of 2026. And our next guest says that the second half of the year could see sustained momentum. We're joined now by Nancy Daoud, private wealth advisor over at Ameriprise Financial and CEO of Opus Advise First. So really good to see you, Nancy. Thanks for making time for us on this US holiday.
Thanks for having
I wonder
me.
if the Fed's on hold for longer, how much relief does that offer to US equities?
Well, you know, it's been such a great, it's entirely possible that the markets will do just as well in the second half as it did in the first half. And we really believe that investors should just stay invested and continue the course. There are some variables out there that are looming over us, like the inflation and the job reports, but they seem to be pretty steady. And of course, the geopolitical risk. Although here in America, the gas prices have already come down significantly, and we're hoping that that will continue. And lastly, of course, the midterm election that's getting closer and closer. So we will, in general, we'll probably feel a bit of noise and volatility throughout that period, but largely the market will, it'll be agnostic for the markets.
Okay, so the geopolitics and the midterms creating risks, but you're still positive, Nancy. Are we basically going to forget about the Fed as soon as earnings season arrives?
Well, that's, you know, the biggest question I get from most of my clients is how can the market continue to do so well when there's so much craziness around us? And the answer really is very simple. It is earnings. We expect Q3 earnings to be just as good. There's no reason why they shouldn't. The fundamentals are very strong. The market is very much driven by the AI boom, as well as, believe it or not, because consumer spending. Consumer spending is still reasonably high in relation to everything going around us. Now, there are some things that could really change the course of the market, but not yet. Not that we could see in the near future.
So when you see dips like yesterday, you buy them?
I'm sorry, I didn't hear that.
So when you see dips like yesterday, particularly for chip stocks, is that a sign to buy them?
Yes. Oh, yes. I think that whoever is sitting on the sidelines should absolutely get in. However, it's very important to remain very focused on what is the time frame and the appetite for risk for the investment. And I think some of the fear here for as a new investor entering the market for the first time, we've had such stellar returns in the past 3 or 4 years, that a new investor might actually think that this is the norm and just walk into this without ever thinking there's going to be a down market or a decline at any time. And that's quite the danger there.
Well, let's say that you want to focus on AI. How do you pick the winners and losers? Because it seems like it's no longer enough to just say that, oh, we're experimenting with AI and being vague about it. How are you picking out who will be the winners?
Well, there's really no way to do that. This is such a race, and there will certainly be winners and there will certainly be losers. And anybody who thinks that they can figure out which ones will be the winners and the losers is literally speculating. I think it for someone who doesn't want to deal with the stock picking, maybe an ETF or a mutual fund in that arena might be more appropriate. But I think it's more reasonable for a longer-term investor to engage with the larger companies because everybody's engaging in AI. If you're not engaging in AI as a company, you're becoming a dinosaur very quickly. So you're catching the upside of that just by broadening or diversifying your portfolio anyway. But we have yet to see still. Time will tell how all of this will fall out because we are still in the initial phase. We do have to look forward to what the outcomes will be.
Just finally, I mean, it's interesting that you like Japanese stocks. How confident can we really be about where's next for the yen?
But, the confidence comes from how stable and how, looking at the economies, I think Japan is a good opportunity. I think UK is becoming a better opportunity. But why speculate and why go for more uncertainty when the US market has so much opportunity for growth? So we tend to underweight overseas and overweight US more. Mainly because we're in the business of meeting long-term goals for clients, not speculation.
I'd love to know why you think the picture's improving in the UK, but Nancy, we've run out of time. Nancy Daoud there, private wealth advisor over at Ameriprise Financial and CEO of Opus Advice First as well. Thank you so much. Well, coming up, a check-in on the box office as hits like Minions and Monsters and Toy Story 5 could help Hollywood have its best summer in years. That's next. This is Bloomberg.
tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas.
The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
This is Bloomberg Markets. I'm Leslie Verdon in London. Well, Hollywood's set to have its hottest summer in years with hits like Minions and Monsters, Toy Story 5 and The Odyssey. Tom Rothman of Sony Pictures says that he agrees with industry estimates that the box office is on track to reach $10 billion domestically this year. And he's been speaking to Bloomberg's Romain Bostick and Katie Greifeld.
This year, the box office is roaring.
Yeah.
It is roaring.
Yeah, I think Bloomberg says we're going to get to $10 billion this year.
Knock on wood, but I would agree with that.
All right.
And part of it is what you said, in contrast to the nattering nabobs of negativity who said that, and a point for anyone who knows where that reference is from, but that young audiences would not come back to the theaters.
Yeah.
The movies you talked about, and I think it will be the case with some of the big movies coming later. You've seen it now this past weekend with the enormous success of Toy Story, and we have Spider-Man coming up later, that young audiences will indeed come back to the movie theater. In fact, there's a lot of sense now that young audiences that really do want to get off their phones. They want to have a true social experience live. And that's the one thing that movies in movie theaters do that all the, TikTok and streaming in the world doesn't. But you're right, we have to speak to them in the aesthetic that's relevant to them, and that's what these new movies have done.
Well, I hear what you're saying, that, younger people especially do want to get off their phones. But, I mean, that being said, you think about how some of the trio that you outlined in this guest essay, Backrooms, Iron Lung, Obsession, Were Source, going back to YouTube, does that change how Hollywood is going to be looking for its next films? I mean, are you going to be looking on YouTube
I hope so. I hope as I'm sitting here that we're looking that back in LA, that's what our people are doing. Yes. But as I said, I don't think, and as I said in the essay, it's a different source now. YouTube is, for all of its enormous success, is a relatively new phenomenon. But the phenomenon of new talent coming into Hollywood or into any artistic discipline is not new. What we need to do as the institutional representatives of Hollywood is to be sure we're looking everywhere, we're looking in new places, and to be sure the door is open, that the door is open to new talent, and that we're willing to take the risk on them. I mean, you refer to K-pop. That's the classic example of something that, in retrospect, is a great success. When we started on it, there weren't a lot of believers.
It looks like this summer box office is going to be pretty fantastic in terms of the numbers here. And I wonder, what is the takeaway? What is the lesson that, you can bring into 2027 from that?
It's not, in honesty, it would be too easy to say, if you build it, they will come. No. It's that if you got to make it great. I haven't yet had a chance to see Toy Story, but I know that the reviews and the audience response
got a Taylor Swift song in it.
Well, there you go. You can't. Well, that's one answer. If you get Taylor for everything, you'd be fine. But I think the answer is that we have to create cultural urgency. We have to make you feel you have to get up from your couch, and then it's got to be great.
So that was Tom Rothman of Sony Pictures speaking to Romaine Bostick and Katie Greifeld. And we can get more now with the box office company Senior Vice President Daniel Laurier. We heard it there from Tom Daniel saying you've got to make it great. I wonder who you think's going to do it best, because we've got loads of blockbusters potentially in the next few months. We've got The Odyssey, Spider-Man Brand New Day. Which title do you think has the biggest opportunity to exceed expectations and really keep the momentum going in the second half of the year?
Well, I'm not sure it's going to be exceeding expectations, because the expectations are quite lofty for Spider-Man Brand New Day, coming from Tom Rothman's own studio, Sony Pictures Entertainment. We're expecting this to be the highest grossing film of 2026 in terms of calendar year. We've got the Avengers coming out in December. Most of its money is probably going to come somewhere in 2027 in that holiday period. But for the calendar year, that Spider-Man sequel is really looking like it's going to be the cornerstone of 2026. Right now, we're tracking an opening weekend above $200 million in the United States. That would be the biggest opening weekend of the year so far.
Yeah, the new Avengers comes out the same day as the new Dune. Is that healthy competition, or are they cannibalizing each other's studios increasingly now?
That's a great question, Lizzie. 2 months ago, I'd probably follow that up with a question of my own. I wasn't really sure myself on how that would play out. But after we saw what happened with two movies that are very similar, going for the same audience demographic in Obsession from Focus Features Universal and Backrooms from A24, they came out, I think, 1 or 2 weekends apart in May. And we saw those feed off each other and build each other up to fantastic overperformances. That makes me think that the market is going to benefit from having these two big titles benefit, having them side by side. So it's not just an opening weekend game. It gives folks the option to go back to the movies after enjoying one of them. This holiday season, by the way, looks fantastic. There's going to be something for everyone, and we expect it to be a very strong finish to what I think everyone agrees to at this point could very well be a $10 billion year at the domestic box office, the first time we hit that mark since the pandemic reopenings.
Wow, okay. But you see studios leaning heavily on established franchises, event films. Is that just where the economics of theatrical releases is at right now? Or can we start to expect some more original releases?
I hope we not only expect, but get more original releases. We know that they can be risky, but I think if they are budgeted and marketed responsibly and effectively, they can really make a difference. And we saw that impact in that last weekend of May, in that last period coming into June, where something like Disney's The Mandalorian and Grogu, a Star Wars spinoff, nothing can get more franchise than that. That did okay on opening weekend, but kind of tailed off. It didn't perform, I think, along expectations, but we didn't really feel an impact from it precisely because these original titles like Obsession, like Backrooms, were able to carry the ensuing weeks and eventually surpassed it in terms of box office. So I think it's probably too early to say that it's a post-franchise era in Hollywood. I don't think that's accurate, but it is fair to say that a successful formula moving forward for this industry is one that balances big IP tentpoles, big blockbuster and franchises with original films that can get moviegoers excited to see something new and exciting back at the movies.
But Daniel, even with this year's recovery, you've pointed to the impact of media M&A. You've talked about how the Paramount-Warner Brothers deal is going to lead to fewer theatrical releases. How significant an impact could that be in the coming years?
Massive. We can't underestimate the impact of what this merger would mean for the industry and its eventual recovery and like, let's say, success moving forward. We talk a lot about the pandemic's impact at the box office, calling things pre-pandemic, post-pandemic. That's actually a mislabeling of what we should be calling it. We should be calling it pre-Disney Fox and post-Disney Fox, a merger that was announced before the pandemic and that really came through, was realized in 2020 and beyond. So the impact here in recovery isn't the pandemic recovery. A lot of that was done in 2022, 2023. A big part of that recovery is this industry still trying to get back on its feet and find its sea legs after losing a major studio and all those properties going to another major and seeing the ensuing decrease in theatrical releases that we saw as a result of that. If we have a similar scenario with Paramount and Warner Brothers, I'm afraid that could be a major obstacle in the continued success of this industry and the great momentum that we've been seeing over the last 12 months. I think it's going to be a huge sticking point, and it's not just folks here in the United States saying it. I know there's a lot of concerns all over the world, and even in the EU, on what this could mean for the industry at large.
Okay, Daniel, really great to get your thoughts today. That's the Box Office Company Senior Vice President Daniel Laurier, whetting my appetite for a weekend of cinema. Well, coming up, a sweltering heat wave threatening parts of the US East Coast ahead of the country's 250th anniversary. That's next. This is Bloomberg.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start in the third floor or the lobby. You actually have to start in the basement.
Tune in to Bloomberg Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
This is Bloomberg Markets. I'm Lizzie Burden in London. President Trump is gearing up to visit Mount Rushmore for Independence Day as a heat wave scorches the east coast of the country. Bloomberg's Miles Miller joins us now for more. Miles, let's start in New York. What are you seeing?
Yeah, it is currently 36 Celsius, so 96 Fahrenheit here in New York, going up to 101 degrees today. And the only way to beat the heat would be to go to a pool or a cooling center or to stay home. But people, there are not that many people out today. You know, as I drove by parks and stores and stuff, not that many people out. They are getting the preparations ready here for the 4th of July holiday. You've got police barricades out here along the promenade because that's where you can get the best shot to look at the fireworks and the ships that are making their way towards the Brooklyn Bridge later on today and then also for tomorrow. It is so hot that I brought out the Bloomberg neck fan. It's perhaps the only way to keep cool. And as you know, we are having big troubles with AC and with power supply in the United States. And so, you know, to conserve energy, people are using fans, not like these ones, but it's a nice help when you're out here in the blazing heat.
Work in the merch. I'm so pleased to see that you've lost the tie since we last spoke, Miles. It looks far too hot for a suit. I also want to ask you about the story that everybody in New York must be buzzing about, and that seems to be the wedding of Taylor Swift and Travis Kelce at Madison Square Garden. Why have they picked that venue?
You know, what it seems like, based off of what some of my reporting led me to yesterday, is that this is going to be something that's going to be filmed for some later release. And so Madison Square Garden gives you the ability to have privacy, but also a great place to film a wedding video, a wedding, not video, I want to say like a wedding performance. And because of that, you have all the privacy, you have ways to get celebrities in and out, and it's a familiar venue for her. You know, I think MetLife Stadium or New York, New Jersey Stadium in New Jersey, where she had performed during the Eras Tour. You know, it's a little busy with the World Cup, so next best thing was the world's most famous arena. And what better way to say, welcome to New York.
She never stops working. Thank you, Miles. That's Miles Miller in a very hot New York City. Stay cool for us, Miles. That does it for Bloomberg Markets. I'm Lizzie Burden in London. And coming up tomorrow, don't miss a special edition of Bloomberg This Weekend live from the Intrepid to commemorate America's 250th birthday. Have a great holiday if you're celebrating. This is Bloomberg.
what point do you say we made a mistake and we're getting out? How long do you give it before you say this isn't working?
That's one of the most critical differentiators between great investors and just mediocre investors. Because on one hand, you have to have confidence and conviction in all the work you've done, the decision you've made, that if you have a little stumble here and there, if you immediately are selling out, you're never really going to fully realize the depth of potential long-term success. And yet, on the other hand, if you're stubborn and you refuse to admit I'm wrong, you continue to think the market's wrong and I'm always right, then you'll get caught in some very, very difficult positions over time. So that ability to have a fresh perspective, take in the new information, even when things aren't going the way that you'd expect or to hope, and to really understand from this price point today, is this still going to be one of the most compelling investments or not?
To the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
There are certain days that change the world. Brexit was one of those days.
British people will have the final say in an in-out referendum.
Watch out, here we go.
One story dominating the news today, and it is Brexit. Brexit. But what has been one of the most divisive votes?
It was staggering.
History unfolding before our very eyes.
The population at large doesn't trust the establishment.
The bastion of independence.
Brexit changed the way that politics is done, not only in the UK, but beyond that too.
People want to take their country back.
Passions that are not unique to Britain.
Vote out NHS. It was a real once-in-a-lifetime moment, but also sort of manifestly an act of economic self-harm.
Thing is, not everyone and their dog arrived at the polling station with an economics textbook in hand, or poor.
It was not even the main thing that mattered to a lot of people who voted to leave. A cosmopolitan elite had been trying to redefine Britain as a multicultural, multiracial, multi-ethnic society. And the Brexiteers said, no, we are a particular people, a product of a particular history with a particular set of roots.
We need our country back.
And so on the 23rd of June 2016, more than 33 million people cast ballots on a relationship that had shaped Britain's laws, trade and politics for almost half a century.
Yes is now showing at 67%. The British people have spoken, and the answer is we're out.
By a margin of 52 to 48, they said Britain should exit the European Union.
Huzzah! Independence Day!
It might have felt shocking, but it wasn't quite as surprising as I think a lot of people look back and say that it was.
But it was a political earthquake whose aftershocks were felt around the globe.
It shifted the world from a world which seemed to be getting ever closer, in which globalization was the dominant theme, into a world that was becoming ever more fragmented.
Brexit has ushered in a decade which has left Britain, Europe, the West in a worse shape than it started it. The issue is, would it have done much better without it?
And it is possible to work that out. To understand what happened, we can compare it with a model of what didn't. This is that story. Why Brexit emerged, what it cost, and what might come next.
I remember the day when we voted on Brexit. I took my dogs for a walk to the local voting booth. The dogs, I think, were pro-Brexit. Dogs tend to be pro-Brexit. I was anti-Brexit.
Do you want me to say that I voted Leave? Because I did. The main thing I remember from the actual day is being woken up by my husband very early and him saying, "You've got to go to work," because the result isn't quite what we expected.
Phenomenal events taking place here.
No one expected this result.
Everyone is stunned.
I'd written an essay called The 20% World, which pointed out that if the odds on Trump being elected, on Brexit, on Corbyn being elected, and Le Pen being elected in France, they were all around 20%. What was staggering was two of them were going to happen in 1 year.
Brexit was not just a British upset. It was an early warning light on the dashboard of globalization.
When the results came in, there was shock. People were not expecting this. The markets weren't expecting this.
The smart money thought that it was Remain.
I was sat at my desk watching the pound plummet as the results rolled in.
The pound has taken a thumping. Every single industry group's trading in the red.
I realised that we were at the beginning of a very profound historical change.
I do not think it would be right for me to try to be the captain that steers our country to its next destination.
There were some in the European Union who looked at a result like that and thought, surely this is going to have to be rerun. It's such a narrow margin of victory.
I quote, "Damn a bad day for Europe."
The UK is no more part of the club. I regret that very much.
People said that the money was smart. The money wasn't smart.
Virtually every economic expert told the British people that this would be a very painful thing to do, and yet people still voted for that.
The campaigns in the run-up to the vote were unexpectedly aggressive.
I really remember when the MP, Jo Cox, was murdered in her constituency. It felt symptomatic of the febrile state of UK politics.
May we and the generations of members that follow us in this House honour Jo's memory.
Fury seemed out of all proportion to what our relationship with the EU actually was. It was not a fiscal union, it was not a military union.
At the heart of the Brexit debate was a disconnect between the winners and the losers of the global economy. The winners didn't understand how much the losers had lost, and they didn't get any sense of what you lose when you lose a stable manufacturing job.
You all come to work to be better off for your family, don't you? Now, I'm not sure if I've got that stability anymore.
A few days before the vote, there was a big broadcast audience event on the BBC. I was part of the presenting team, surrounded by people who I didn't know which way they were going to vote. And there was a moment when Boris Johnson said,
"I believe that this Thursday can be our country's Independence Day."
And I saw and felt half of the room erupt around me. And it was really then that I realised how strong the sentiment to leave the EU was.
But there was a snag.
We voted to leave, but we didn't know what voting to leave meant. It was a sort of blind Brexit.
People voted saying they didn't like the status quo of Europe. They wanted to go out, but they never got a vote on what the alternative was.
The Leave groups were disparate, not connected, and in many cases looking for different things.
One vision of the future was a sort of Little England vision. We'd retreat to a sort of Hobbit world.
You had a group of people who thought this would be a chance to pump more money into the NHS, put up walls to immigrants, and so on and so on.
The other view of Brexit was that we would be a global power.
10 years later, we can begin to assess what actually happened and compare it to what didn't. Don't worry, that'll make sense in a minute.
The economy immediately after the Brexit vote was much more resilient than people expected.
We were told that the housing market would collapse, that there would be apocalyptic consequences for the economy.
But actually consumers, who are the biggest part of the UK economy, continued to spend.
You can argue about the economic effect relentlessly.
Well, that is a relief since we're about to, but it's complicated.
And the reason for that is that you've had a lot of economic shocks hit the UK since then. The pandemic, the energy crisis,
various government policies that have also been very bad for the economy in particular are energy policy. It's impossible to say that having the most expensive energy in the developed world hasn't made a significant difference.
So disentangling the Brexit effect from all those other effects is really, really difficult.
But perhaps not impossible. And here's how.
What we've done is bring together a sample of 23 OECD countries and pick out the economies most similar historically to the UK, and use those countries as a guide for how the UK might have been expected to perform.
Had it remained in the EU, that is. And that's what you're seeing here. The red line being the UK's actual GDP, the white one what our model initially suggests it could have been.
And what we see is a 10% hit to the economy.
Which for the UK's £3 trillion economy means £300 billion. So clearly that's pretty massive.
But if you look beneath the hood, it shows that most of it is driven by the performance of the US and Irish economies.
Now, the latter's GDP is heavily impacted by the activity of multinational companies, so there's a case for removing it.
So if we exclude Ireland, we reduce the hit to 6%. And then there's the question about the US economy. It accounts for about 4 percentage points of the total gap. But a lot of that is nothing to do with Brexit. The US didn't experience an energy shock in 2022.
It also benefited from significant fiscal stimulus and AI investment. And so if we adjust for all that too,
we get down to a number between 2 and 4% of GDP, which we think is a reasonable estimate for the hit to the economy.
This figure is far away from the initial 10% calculation, which we've shown to be too great. But even so, 2 to 4% is still a hit.
No matter which way you cut it, it's quite hard to come up with a positive number for the impact of Brexit.
It would be very foolish to say that leaving the EU had been an absolute negative, just as it would be very foolish to say that being a member of the EU had been an absolute positive.
On all the things to do with AI, Britain has probably benefited a little bit by being outside the European Union, which most of the tech giants in America are slightly scared of. And of different days of the week, Britain's been quite good at getting on with Donald Trump.
Financial services in particular have done pretty well in the years since we left the EU, much better than goods exports, for example.
We're a massive destination for VC funding. A large number of the investment funds that are based in the EU are run out of London. We're a massive centre for derivative trading in the euro.
But there's no denying it. Brexit did put us on a different trajectory. There were some real economic impacts and potentially some much larger political ones.
The most surprising thing that happened is the degree of political chaos it has unleashed.
This Parliament is a disgrace.
The political infighting was extraordinary, cross-party and relentless.
For goodness sake, Prime Minister, won't you just go?
This government has no mandate for the vicious form of Brexit it is pursuing.
You know, the economic impact, it almost seems like a sideshow relative to that.
We've had, I think it's 5 prime ministers since Brexit.
Cameron didn't try and deliver Brexit, he simply resigned. Theresa May tried to deliver it and resigned. Boris Johnson tried to deliver it and resigned. Liz Truss resigned, and Rishi Sunak was eventually defeated in the elections.
What's interesting about Brexit is it redivided British politics along completely new lines. And it's ended up the two main parties, particularly really the Conservatives, being very wounded by it.
The fragmentation is clear when you look at how people said they'd vote in 2016 and compare it to how they said they'd vote this year. The pie has become notably more colourful. Good news for chart designers, less so for members of Parliament.
I think there is a link between the divisions within and what we see now, an age of greater multi-party politics in the UK.
Brexit still governs a lot of the kind of dividing lines in Britain.
It has contributed to the stagnation that leads to popular discontent.
Those who had previously been trusted to make decisions sitting in Westminster, they're learning to live with much reduced credibility and much reduced room for manoeuvre.
Is time running out for you, Prime Minister?
We lost our ability to focus on the really fundamental things that matter. How to improve our productivity, which is dismally low, and how to improve the quality of our government.
our policies around our tax regime, around our energy regime, how we employ people and how we pay to employ people, our social care.
I think one big lesson of the last few years, and indeed the whole Brexit experience, is that economics is not the only thing that matters.
Brexit was a big moment for expansive political promises about the golden horizons that lay beyond the result.
We will do a new deal, a better deal.
And for many people, that has not been delivered.
The Brexit vote was driven to a very, very considerable extent by the fact that immigration was rising in this country and the fact that the political elite was constantly promising to control immigration.
Enough is enough.
And failing to deliver on that promise.
In the decade before the referendum, migration climbed towards record levels, reaching a peak just ahead of the vote.
What many people thought when they were voting for Brexit was that there would be a reduction in numbers.
One of the great expectations was that a fall-off in immigration would improve employment prospects and wage prospects in some of the left-behind areas. But of course, what actually happened, there was a massive increase in immigration.
That increase is what you're seeing here. But what's important to note is origin. Since 2016, the proportion of those originating from the EU has decreased, but the number of arrivals from non-EU countries have gone up.
They went up for practical reasons because Boris Johnson, as Prime Minister, was desperate to fill a lot of gaps in the labour market that had been left after COVID.
In recent years, small boat arrivals became a defining symbol of the Brexit era, convincing many voters that the country still hasn't taken back control.
And this is why Brexit has become this self-reinforcing process, because as the number of immigrants have increased, the people who voted for Brexit have felt cheated.
People were made big promises by leaders who largely did not stay the course to deliver them. And I think that has had a widespread impact in unleashing a disillusionment, a frustration.
A fuller picture now emerges. Brexit was a promise of control, prosperity, and more money for things like the NHS. Three of Britain's great pillars, after tea, the monarchy, and apologising.
I'm so sorry.
And so far, the data show the results of that promise to be a bit underwhelming. Meanwhile, pandemics, wars, and energy crises exacerbated resentment and frustration that everything's just a lot worse and a lot smaller than it used to be. And not just in Britain. Brexit was domestic politics with foreign policy consequences.
What it did was to set off a sort of populist revolution that spread around the world.
There is a new sheriff in town.
We want a piece of ice for world protection.
Because of the world that Brexit ushered in, a much more nationalistic one, and one where America's tried to go in a different direction and Europe's going in a different direction, competing nationalisms are suddenly to the fore. The idea of the West uniting to deal with, most obviously, Ukraine, now that has all gone somewhat into reverse.
I've empowered you to be a tough guy. And I don't think you'd be a tough guy without the United States.
Europe and America together is a very, very hard thing for anyone to stand up against. But when they're running in different directions, it's not a great look.
The forces that Brexit unleashed created not just a more fragmented world, but a world which is divided into big trading blocs. The European Union, the United States, and to some extent, Asian countries. And that leaves Britain out, isolated on its own.
There's less reason to talk to us if you're the US, for example, because we're not that way into Europe as a route to influencing Europe. There's less reason to pay attention to us in the United Nations.
You look at political debate, it has always been full of emotion, anger, many different things which really involve the heart more than the brain. I think what's interesting about politics across much of the West since the vote is that it's come much more about anger, injustice, people protesting about a world they often don't understand.
And the strange logic of this anger is to demand madder music and stronger wine. So instead of saying, well, perhaps populism is a mistake, perhaps we ought to be a little bit more pragmatic, you say, well, let's try harder to deliver these impossible dreams.
In Britain, politicians who speak the language of betrayal and unfinished Brexit business have found a large audience.
The single politician, Nigel Farage, who had most involvement in making that Brexit happen, is the favourite to win the next election and be Prime Minister.
And that is completely shaking up British politics.
Because they're an absolute disgrace.
The prospect has opponents, therefore, pushing ever harder in the other direction. Some advocate rejoining the EU, something a recent poll suggested 52% of the British public would now support.
In the last 4 years, two Prime Ministers, Rishi Sunak and Keir Starmer, have sought to bring the UK closer to the EU with agreements and attempts at agreement in different areas that really matter: defence, security, immigration, economics.
Many of the easy solutions to the Brexit problem, which are Britain having a closer but still rather loose relationship with the European Union, seem very attractive, but they're not actually all that practical.
Any move closer to the EU also runs into two familiar problems. Britain still dislikes being told what to do, careful, and Europe isn't especially keen to start convincing it otherwise.
It is time to leave Brexit behind.
My guess is that Britain ends up with some kind of version of an associate membership of the EU. And yes, that would involve Britain having to take some rules in a way that it might object to, but it would give it access to that much larger market, and it would help the European Union as well.
One of the other tragic consequences of Brexit is that the European Union has seen one of the biggest economies in Europe leaving, and leaving for very specific reasons to do with free movement of people, and has not learned anything from it.
I think the most optimistic version of what you could say is you could say, well, this was a test case for democracy. A country votes to do something that it knows to be a sort of act of self-harm, and yet still there is no challenge to the idea of democracy. It's still the core of everything that Britain does.
Perhaps over time, we'll be able to see it as a moment that reshaped alliances and relationships, and that is a necessary thing for nations and regions over time.
The future has to involve leaving the arguments about Brexit behind and focusing on the things that are really holding the UK back today.
I think the big lesson for economists is that, yeah, there's more to life than economics. The sort of chastening lesson for policymakers was that even when you think the economy is doing well, you think people are being well served, if you're leaving a significant chunk behind, given the chance they will punish you, they'll punish the system, and you won't necessarily get a do-over.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
For decades, Nike had the simplest advice in sports: just do it. But the company that turned confidence into a slogan is now stuck explaining why its comeback is taking so long.
Nike is also declining this morning, around 10% down.
Anytime that we come through with a new strategy, new approach, and a new leadership, and dimensionalizing the brand, we're having to look to where we reposition resources.
Nike hired this new CEO, Elliott Hill, who had been an executive at Nike for decades, and he was completely beloved by employees. But even under Hill, who has had so much expertise with the company, Nike is still really struggling.
Hill was supposed to be the insider who could bring Nike back to itself.
Before Elliott Hill took over Nike, Nike was being run by John Donahoe. Nike prioritized its direct-to-consumer channels, so it pulled out of a lot of those retailers. It really strained some of those relationships. Shelf space opened up in those retailers, and newcomers like On and Hoka filled those shelf spaces and really took over some of that running market share.
After years of fairly steady dominance, Nike's trio of flagship brands, including Jordan and Converse, have all suffered decreasing market share since 2023.
Donahoe really prioritized the lifestyle shoes, so Air Force Ones, Dunks, and really flooded the market. They lost their cachet, and Nike fell behind in areas like running that were so key to the business.
Make the logo bigger.
Under Hill, Nike has really focused on regaining its dominance in sports, rebuilt relationships with a lot of the retailers. The running business has seen growth again. Nike is getting back on track in North America, but other parts of the business are still really struggling. Nike's China business continues to show decline. Its Converse business has reached a decade low.
On top of sales, banner moments in sports that Nike used to own are going to other brands.
Adidas, they had 2 runners that broke the 2-hour marathon record. So this was a huge moment for Adidas and one that really left Nike behind. Nike also put up an ad at the Boston Marathon that was quite controversial. It said, "Runners welcome, walkers tolerated." Nike eventually had to take down the ad.
In addition to winning back athletes, Nike needs a deep bench.
One structural challenge at Nike is their succession lines. There was a big talent exodus. They're missing that kind of middle ground of people who've been at Nike for years. Shareholders have been really disappointed with Nike's results. Investors are getting really impatient to see Elliott Hill's plan show more progress.
Hill's plans include halting heavy discounts to restore premium pricing, repairing relationships with wholesale retailers, and focusing on sports instead of fashion. With arguably the world's biggest sporting event on the horizon, Nike will have another chance to prove itself, though its first attempts have been wide of the goal.
Nike released their World Cup jerseys. People started to notice that these jerseys had a major flaw. The shoulder of the jersey kind of puckered up, both on players and with fans. June is going to be a huge month for Nike. The World Cup begins in North America, and the company shares its next quarter results.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television. Good morning, this is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Hello, welcome to Bloomberg Tech, Decoding the Future. I'm Emily Chang. We've returned to San Francisco to bring together leading CEOs, investors, and innovators who are harnessing technology to change the world around us. And over the next half hour, we'll bring you some of the biggest conversations from this stage about the technologies attracting the most talent, the most capital, at perhaps the highest stakes.
Momentum, migration, massive scale. The race for AI dominance is intensifying. With capital and code at the center of it all.
We are going to give you more powerful technology. There's going to be responsibility that goes along with that.
The latest frontier models. Vast energy needs.
Cool, we even have that whopping $21 billion deal with Meta.
Everything in the world runs on NVIDIA.
Investor appetite and attention.
I think the future is about building many more higher quality things than we've ever built before.
The landscape is shifting beneath our feet. For business, it's all about growth, scale, disruption, and pressure to produce. But at what cost?
Some of the early companies that we gave this to said things like, this is a super weapon. You should have to own a gun license to use it.
Artificial intelligence has moved from research labs into workspaces, governments, and daily life. But as companies race to build more powerful systems, questions remain about safety, regulation, who stands to benefit. We begin with one of the people helping to shape that future, Anthropic president and co-founder Daniela Amodei, with Bloomberg's Shireen Ghaffari.
There's a lot of potential upside with AI to cure disease or lower the cost of consumer goods, but also real fears that AI could potentially wipe out half of all white-collar work. Do you agree with that? And if so, what's the solution?
I don't necessarily think we know the future. So exactly what the type of disruption that might happen a year or 3 years or 5 years from now is unknown. I do think it's important for companies to be open about and study what we're seeing today, which is part of why we publish our societal impacts research. We say, hey, here is how people are using AI. Is it displacing jobs? Is it supplementing jobs? What we found so far is that in 2025 and 2026, replacement is a tiny, tiny, tiny fraction of what AI is doing. And really where we see that is mostly in jobs that are overseas and mostly in customer support. And so these are jobs that are sort of already being automated by more traditional ML, non-generative AI systems. Could that change in the future? Absolutely. And I think we're a little bit unusual in the sense that we talk about it a lot. We say, hey, this might happen. But I think there is this just broader, again, sort of societal challenge. AI is going to be able to do so many productive things that humans can do today. What does that mean for how we find meaning, how we earn income, how we relate to one another? And again, I think the default will be to treat it like past technologies and say, okay, we're going to integrate this into existing workflows, and that's sort of the end of the story. I personally believe there's a real opportunity here for us to say, how do we accelerate and sort of accentuate the parts of doing work and finding meaning that only humans can do? I have this very fundamental belief that humans like to spend time with other humans. We like to create things together. We like to relate to one another. Sometimes we like to disagree with each other. And I don't think AI will fundamentally take that away from us, but we have to figure out how we apply that within the existing economic infrastructure so that people can still find meaning in their work and so that people have a way to earn a livelihood. Again, I think there could be a lot of different ways to structure that, but I think this is an important moment for us generally as a society to say, like, what are the lives that we want humans to be able to live, and how do we work closer towards that future?
2 months ago, Anthropic unveiled and restricted access to Mythos, your most powerful model, right, citing significant concerns about its potential to wreak havoc on critical software by spotting and exploiting security vulnerabilities. Now, Anthropic plans to release these Mythos-level AI models more widely. Can you help us understand what's changed in the past 2 months? Are you confident that these models are different now in any meaningful way from the version before? Are they safer?
This is a great question. We actually just expanded the set of customers that have access to Mythos. I think it's about an additional 150 organizations around the world in 15 different countries. And really our approach to Mythos has always been, there's a time component to it. So we released it initially to cyber defenders. So some nonprofit groups, some governments, some organizations that are critical infrastructure for protecting against potential cyber attacks. And what we found is, just like in any kind of security vulnerability situation, you have to give the defenders a head start. The technology, AI models are going to keep advancing. If it's not us, one day releasing a Mythos-level model, another AI company will. But it actually matters who you give access to first and how long they have to patch some of the vulnerabilities that Mythos was capable of revealing. And so we're taking this very cautious, very tiered approach, which I know in some ways is frustrating because people really want access to the model. But I think, again, as a company that's founded on these principles of being ethical, being responsible, we felt it was important to give access to the organizations that were capable of really helping us defend against some of these risks, and then slowly widening that circle to more and more critical infrastructure until eventually we feel it's safe to release it more widely.
Where do you think the industry is being too pessimistic and too optimistic? What is Mira Muradi's vision for the future?
So, predicting sort of a dystopia or a utopia, to me feels very, very simplified, because the truth is we actually have a lot of agency in how we build this technology, in the tools that we're building, how we're deploying it, and so it's not a predestined outcome. There are certainly those risks. We all understand the potential for greatness that comes with building frontier AI systems, and that's why we're working on them. And I think there's been a lot of talk around the uncertainty, around the downsides, and I agree with a lot of these risks. And perhaps where I might disagree or take a different path is that I think we have a lot of agency. Like this period of time where both humans and AI systems have their hands on the wheel and we can collaborate is very important time to get right. And the more that we can reduce the discontinuity that comes from new capabilities and huge change in capabilities, the better. And this is why we took this approach with Thinking Machines and why the company exists.
So you say the goal is to keep humans in the loop, but is there ever a point where humans don't need to be in the loop?
It is possible. It's more about aligning. At that point, it's more about aligning intent and aligning values. But if you sort of reduce progress to removing humans from this loop of development already now, then I see very little future possibilities that we can get this right in the future when AI systems are even more capable. And so I think the more likely path and more durable path to advance AI in a way that enables and advances civilization is by keeping humans in the loop for as long as we can and really making sure that this period is actually very meaningful.
Talk me through your vision for how ultimately agents will reach all of us. We really believe that people are probably going to have one, maybe two, maybe a small handful of agents that they rely on, and maybe they have a personal agent that's focused on things like their health and maintaining their personal relationships and helping them be a better parent and be better with their friends and family. And then perhaps they use that same agent in their work lives, especially if they're working in a small business or they're an entrepreneur or working within a smaller organization. And then, maybe there's worlds where if you work within a larger enterprise or a larger company, then these become bifurcated and separated. Yeah, we think that ultimately it should be, agents will be something that become deeply personal and should be things where over time you find yourself being able to rely on them more and more and more for more and more of your personal life, more and more of your work life. And that'll be a process that, all of society goes through it together.
Are people going to be willing to, trust a meta agent with the personal tasks of their life that you're describing?
Yeah, I think that this is like one of the most important societal question for agents writ large. This is definitely something that we're taking very, very seriously, and we're being quite thoughtful about. And ultimately, we're excited to, show the world what we've built. But yeah, we think that this is not even just a meta problem. This is an industry-wide problem as we build more and more powerful agents. I think it is a redefinition of humans' relationship with technology in many ways, and that's something that we're all going to have to think through and work through together.
I think job loss in general is probably like one of the biggest fears with AI. What's your view on that? Is if AI goes the way that everyone envisions and we reach super intelligence, is there a world in which that can operate and live alongside all of us staying employed?
I mean, I think it's something that we should pay a lot of attention to, and I think that we should track closely and try to understand what the impacts are. I think one thing though that we never, I think rarely talk about, but is also happening that's very exciting is that AI is enabling the creation of more businesses than ever before in the world. And we see this in our data. I'm sure many companies see this in their data. There are more new companies being started today, through use of AI tools than ever before, and those numbers are only growing. And I expect as AI tools become more and more powerful, we'll see more entrepreneurs, more small businesses being started. And so I think there's, the economy is a complex, machine. And one of the things that we see within our data today is that there are more small businesses being started. There are more entrepreneurs. There's more opportunity for entrepreneurs. And so, And we're really excited about that. We're excited about supporting small businesses throughout the world.
Coming up, when you have $1 billion to deploy, where do you look for the next breakthrough? One of Silicon Valley's top investors is looking around the corner. That's next.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas.
The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
This is Bloomberg Tech, decoding the future. I'm Emily Chang. Every technological revolution needs capital. As billions of dollars pour into AI, digital assets, next-gen financial infrastructure, investors are deciding which technologies will define the next decade. Few investors have a better view of where that capital is flowing than Katie Hahn. After raising $1 billion for her latest venture funds, the former federal prosecutor turned investor is expanding her focus beyond crypto and placing bets on the technologies she believes will shape the future. Here's part of our conversation.
So let's talk about the intersection of digital assets and finance and enter AI.
Yeah.
Like, where is all this going?
Yeah. I think two categories that we're looking at the intersection of. One category is agentic commerce and the need to be able to transact. And you're talking about agents, agents don't have banker's hours. They don't stop working on the weekend. They don't observe wire cutoffs. And they're also going to be able to need to do things like micropayments globally, instantly. Think about querying an LLM. Think about the kinds of things that they're going to be able to need to do. And we're talking about agents. We're not even talking about sub-agents. So that's one area and one category where there's a really big intersection. And then the second area where there is a large intersection between what we've been doing for the last 4 years and where we see the world going, I have 4 words for you. And it's privacy, it's identity, it's reputation, and it's provenance. And what do I mean by provenance? I mean, where did something come from? It's the who, the what, the when. This in an age of AI, it's already important today in the digital world, but in an age of AI, provenance, we think, is going to become even more important. And it turns out that some of the blockchain-based technologies and distributed systems have been looking at this. This is the technology story, not the market story of digital assets. Blockchains are actually pretty good distributed immutable systems for proving provenance, for proving when something came into existence. This is really important in an age of AI. So too, I think, is privacy really important in an age of AI. And folks in the cryptography field have been working on technologies like zero-knowledge proofs. And it used to just be people in the digital asset space that were talking about zero-knowledge proofs or fully homomorphic encryption. And now we're hearing AI folks talk about those concepts. So I think there's a lot of synergies that people don't really realize at the intersection of these two very frontier technologies.
I think there's all sorts of different ways that you can approach venture capital. I think for some people, they really want to focus on kind of growth and doing diligence. There's other people that are pure intuition, that are just like, measuring founders to make early stage bets. The kind of strategic slice that I've found that works best for me, given my own personality, is I'm an operator at my core. Like, I'm much more comfortable working at a startup than I am working at an investment firm. But that's actually a really interesting lens into the startup market, because I have exposure every day to what software are we using that works? What are the strategic challenges that we're encountering as it pertains to the rise of AI? These are questions that I'm dealing with on the company level. And so when I have the ability to interact with other startups, I think I have the ability to kind of identify areas where, wow, that would actually be really helpful, or I've seen 3 or 4 other things that approach this in a way that I think is better.
The firm has 12 investing partners. Could you just explain how it works with Peter? Peter right now is in Argentina, but like, does the firm do the classic Monday morning meeting thing? Does he Zoom in? Are you constantly, the 12 of you, talking to each other? I think there's still a mystique there.
Yeah.
About how it actually works.
I'll be honest, there's still a mystique to me. I'm not really sure how it works either. We don't do Monday meetings. Why don't we do Monday meetings? It's not because we're lazy. It's because when you create a process, a tracking system for how you move something from step 1 to step 2 to step 3, you end up making relative rather than absolute judgments. So you're like, well, this is the best company I met with this week, so I'm going to bring it to the partnership. And then they say, like, well, this is the most interesting company that we have as a fund have seen this month. And so by the time it gets to the end of the process, you're like, well, it's made it this far, maybe we write a small check. There's just like not a lot of conviction that's built into that. So we have created a ton of friction in the process of getting a deal through, because we have no standing meetings. And so if you want an investment to be made, you have to go and wrangle all of the other people that are required to get that deal done. And
you mean internally with each other?
Internally with each other. And any one person can basically torpedo a deal. And so you have to go charging in as hard as you can with really high conviction. And what that means is that we make, as a fund, significantly fewer investments by number, not by dollar amount, than any other venture fund of our size, but we're highly, highly concentrated into the bets in the fund. So, call it 40% of every fund is concentrated in just a couple of companies. And I think that really is because we've created an enormous amount of friction. It's just really hard to get anything done.
Up next, the AI boom is fueling one of the largest infrastructure build-outs in modern tech history. We hear from the CEO helping to power it.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
This is Bloomberg Tech, decoding the future. I'm Emily Chang. The artificial intelligence race isn't just about building smarter models. It's about building the infrastructure to power them. Tech giants are spending hundreds of billions of dollars on data centers, networks, specialized chips. Few companies are more central to that effort than Broadcom. The company has evolved into a critical supplier to the AI ecosystem, helping to power the next generation of computing through custom processors and networking technology. Leading that effort is CEO Hock Tan. Here he is with Bloomberg's Tom Giles.
Does the AI revolution sort of temper the need for you to supplement growth using mergers and acquisitions? Are you kind of entering a post-M&A phase, or is that the wrong way to think about it?
No, you hit it right on, Tom. And it's an interesting question. It's a very valid question because it crosses my mind and that of my boards on an ongoing basis, not regularly, as do we do M&A. So I'll be very flip and give you a straight answer. In the last 2 years, between 24 and 26 this year, I would be doubling my revenues. I would create over $50 billion per year, annualized, on revenue. I'm looking around, what can I buy? They even come close to that. And that's the tricky part. I mean, it's a distraction. All M&As are distraction to acquire, go to regulators, further distraction to integrate. Another year. Meanwhile, organically, this phenomenon we call generative AI and our ability to ship them picks and shovels the compute capacity into this demand, which is almost insatiable, makes it very hard to choose M&A over focusing and succeeding in generative AI compute.
I'd be remiss if we didn't talk about the other businesses that Broadcom is known for, and networking in particular. You know, your gear has become, you know, increasingly important to the modern AI era. We're starting to see other companies like Cisco wanting to kind of play in the areas that you have dominated, and I'm just curious what you think of the prospects for them to kind of, you know, create competition for you there.
We have been in semiconductor for 20 years, and we have accumulated a portfolio of about 17 semiconductor product divisions in specific core areas, where we are literally number one or we're not in. We're number one and we continue to invest. And about 5, 6 of those divisions happen to be very important in creating AI chips and AI clusters.
Right.
So it all became that way. And one of them is networking, as you say, for switching gear. And that's taking off like a rocket. But we also try to be, as we always have been when we sell our products, to be very, I like to call it strategic. When we look at the customer, are they using for a particular purpose? Are they sustainable? Do they want not just one generation, the next and the next and the next, sustainable? And so we prioritize our products to those kind of strategic customers. And demand, as I said, for AI and AI networking today is just massive. So it's okay for us that with such strength and the way we look at businesses, the overflow, I'm happy for it to go to Cisco.
How do you see AI changing gaming and game development in the future? Like, where does and doesn't AI belong when it comes to games?
Look, I think the biggest thing that I'm thinking about is how do we just make sure it's solving problems. On the game development side, I've gone to a lot of our studios, you know, big and small, and I'm blown away with how they're using AI in the production pipelines, how they're using it for iteration and prototyping. Look, that's not production ready, there's still work. And so, you know, 30% of game development is software, and so there's the traditional applications that we see in enterprise. At the same time, I do not think AI will replace AAA games. I think it's entirely possible, though, that AI represents a new category of games and a new type of development and enables more people to create and participate. And we'll keep an eye on that, and we'll see how we best serve that.
And that's it from Bloomberg Tech, Decoding the Future, here in San Francisco. You can always find more of these interviews and stories on the Bloomberg Terminal and Bloomberg.com. I'm Emily Chang, and this is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Every weekday, Bloomberg puts a spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
We collectively, including the fund, did not appreciate the backlash against globalization that came from the fact that, yes, the world economy is doing better as a whole, but many communities were held out because their jobs disappeared and there was not enough attention to them. I'll tell you what I'm very keen not to see repeated is the same with artificial intelligence.
I'm Francine Lacroix, and this is Leaders, the podcast that explores what drives the world's most influential people. Be sure to follow and subscribe so you never miss an episode. This week, I'm speaking to Kristalina Georgieva, the managing director of the International Monetary Fund, one of the world's most influential global institutions. The IMF is like a financial advisor and emergency lender for countries. With a lending capacity of just under $1 trillion, the fund helps governments manage economic problems, prevent crises, and recover when things go wrong. Since taking the helm in 2019, Georgieva has navigated one global crisis after another, from the COVID-19 pandemic to Russia's full-scale invasion of Ukraine and the latest conflict in the Middle East. Georgieva is a person responsible for bringing together the IMF's member countries. So I wanted to understand what leadership looks like when success depends on consensus, how she approaches difficult decisions, and how the fund is thinking about some of the world's most complex geopolitical challenges, including Russia. MD, thank you so much for joining us on Leaders. Now, institutions like the IMF live in this crossroad of politics, consensus, and competing interests. So how do you see it? Is it a politician's job that you have or a leadership job?
It is service to the membership. My job is to keep 191 countries together and get them focused on what is happening in the world economy, why it matters to them, and what they can do. And I can tell you, it is not an easy job. The world today is more complicated. There are tremendous transformations taking place. The desire to come together, especially when uncertainty is so high, is incredible.
I mean, it's just a lot of people, right? If you have 190 people, is it all about compromise? How do you get people to talk to each other and actually agree on things?
The best ammunition we have is objective analysis, so they can see where the world is headed. When we do our job well, that is, when it is clearly a global public good, we have a huge responsibility to say it as we see it, to rich countries, to poor countries, to big, to small. It is not the service of some and not others. Then we have the credibility and we have the trust of the membership. You know, one thing people don't understand is, what does the fund actually do? What we do is we care about the health of the world economy, like a family doctor. So we go to countries, we take their vital signs, and then we say, okay, maybe you have to do a little bit more of this and a little bit less of that. We also have an emergency service. Countries get into trouble, we can come to their rescue. And we have done that for half of our membership almost over the years of our existence.
But MD, so when I go to the doctor, I usually follow, the advice. Not everybody does that. So you could go to a country and say, like, look, I'm worried about inflation, I'm worried about this, and they can say, thank you so much, bye-bye.
What we find is that countries that take seriously advice, like people who are following their doctor's prescriptions, do very well. Look at Europe. At one point, we had countries in deep crisis: Portugal, Ireland, Greece, Iceland. They followed what needs to be done. They took on very difficult reforms. Where are they today? The best performing economies in Europe. So listen to your doctor.
But on the doctor analogy, what you're prescribing is not a syrup, right? It's really hard. It's austerity.
Sometimes
it's job
it is,
losses.
yes. First thing is they need to trust that it is in their interest. But to trust, there has to be an engagement and an explanation, bringing them on board. They have to feel that they can provide input in this decision, and then the decision may become different as a result. And then to do everything in your power to reduce the negative impact, to recognize that zeroing in on the most vulnerable in society not only saves lives, but it improves the likelihood that people would move forward with less resistance, resentment, and cost.
What's your favorite quality in a leader?
It is the buck stops with me. That ability to confidently say, I take responsibility to lead. Ultimately, I will make a decision. It may not be popular, but if it is the right decision, I would lead with it. And I see that in many countries happening, and I see in countries where there is hesitance, what would the public say? And I believe that strong leaders don't think about what next in elections. They think what is best for people. And actually, one feature of a good leader, and I embrace it wholeheartedly, is never ask people to do something you're not prepared to do yourself. I have this memory when Fukushima happened. And in the first days, it was very dangerous. I sent a team of emergency responders from Europe. I had to go to the European Parliament. I told them, as I was sending them off at the airport, I'm on the next flight.
Why did you decide to go?
Because I was sending a team to Japan at a time when no foreign dignitary would go. And I felt that sending the team was good, but not good enough. I should be also able to do that. And this is how that sense of we are going to do what is right is reinforced when those responsible stand by their decisions.
Are you worried that there's just one crisis too many? In the last 6 years, we had COVID. That was 2020. Then you have the war in Ukraine. Then you have the tariffs. And this year you have the Middle East war.
Yes, I'm concerned that we are not completely internalizing yet that this is how the world is going to be. We are not going to get to a place where shocks are gone. And what should we do? I have been telling our members time and again, look, there are things you cannot influence, but how you take care of your own country, how you build the foundation to withstand these shocks, it is in your hands.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
I always find it interesting to ask leaders about times when they've had to pivot from an initial call or backtrack on a decision. And in September 2024, Georgieva had to do just that. The IMF announced it would conduct their annual review of Russia's economy for the first time since the full-scale invasion of Ukraine in 2022. Now, that decision was really met with backlash. Reporting by the Financial Times revealed that several European countries, including Sweden, Denmark, and Norway, criticized Georgieva and the IMF, saying the visit would be taking a step towards normalizing relations with the aggressor. Now, ultimately, the IMF decided not to go to Russia, but I wanted to know what the thinking was behind the trip. I want to talk to you about Russia, because in 2024, there was a decision to go to Russia. Russia is one of the members. And then there was a backlash. What was that moment like for you?
When we brought a program for Ukraine, for support of Ukraine, what impressed me was that we got full support, of course, with the exception of one country. And what it demonstrated was that there is a recognition that the fund bears a responsibility to support countries in difficult position, especially when they are not necessarily the source of this difficulty. There was a discussion whether we can do an assessment of the Russian economy, the regular assessment, and at that point it was a very tricky moment because bombing was going in both directions. We decided to delay. I think that at some point we will have the regular assessment restarted. Let's see when this point would be.
So was your decision not to go to basically look at the economy because of the bombs or because of the backlash amongst members?
When we had to make this decision at that time, there was a bombing in Russia. I can say that I would have not responsibly sent a mission at that time. There was also a very important consideration. Can we objectively get all the information we need to complete this assessment? And the honest answer was no. We need to collect data on trade, import, export. Russia was very reluctant to provide this data, and that makes an assessment handicapped.
But do you feel sometimes like you're politicized more than you want to be?
In that particular case, no. Majority of our members, feel that The invasion of Ukraine was a watershed moment for the whole world. Never in our wildest nightmares we would think that a military power in Europe would attack another country. Never, but that happened. And that watershed moment brought the membership at the fund together to recognize that we have a duty of care for Ukraine.
Is there something in the psychology of people that's changed for, multilateralism, for the elite, for institutions like the IMF?
What I can tell you is that we collectively did not appreciate the backlash against globalization that came from the fact that, yes, the world economy is doing better as a whole, but many communities were held out because their jobs disappeared and there was not enough attention to them. I'll tell you what I'm very keen not to see repeated is the same with artificial intelligence. I hope we will have learned this lesson, and as we move very rapidly into this world of artificial intelligence, we will pay attention of who benefits and who doesn't. So
whose job is that? Because it's very difficult. It's going so fast.
I can tell you how we define our job. Number one, impact of AI on productivity. Number two, impact on labor markets. Number three, impact on financial stability. And in these three areas, we offer very sound analysis, and we offer signals of what may be coming for everybody to use.
So if you just focus on leadership and AI, this is a very tricky situation because you're either an optimist and you think that politicians are here for the good of the people or trying to make a difference. You're either a pessimist on politicians and you see, okay, they just want to be popular and be reelected. But now you've given the power of AI to companies that are here to make money. So
it's hard to say we have given them the power. The honest assessment is that they have moved very rapidly. We need to have more attention to the fact that three different regulatory models are emerging with regard to artificial intelligence: the European, the American, the Chinese. It has to be the responsibility of the United Nations system to bring these three models so they can coexist and we can run the developments in artificial intelligence more responsibly.
But does it change, you think, the leadership of countries or the leadership of prime ministers and presidents? Because they don't have any control over they don't have the levers even to do anything about this.
They actually do have levers. We should not give them a pass. They have regulatory authority over data. They have regulatory authority over how the profits from AI can be distributed in society. So exercise it. One thing that excites them and gets them to move is risks to financial stability, something that we have responsibility to identify and then offer solutions. What can we do?
Anything we do in Africa is going to be more risky than the US. I think the approach we want to take is, how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation is a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The IMF isn't your typical organization. It's a global institution serving nearly 200 countries, balancing politics, economics, and competing interests. So how does such a broad and diverse group of stakeholders shape the way you lead?
You have many employees at the IMF. It's not really like a business sense like we're in the City of London, because it's more bureaucratic just by the nature of it. Have you changed it? Does it change the way you work in terms of flows?
Well, there are two things I hope when I'm out of the fund they would still stay. The first one is that very simple message that policies are for people. I grew up in Bulgaria on the other side of the Iron Curtain. My mother lost all her savings because of hyperinflation. I remember queuing 4 o'clock in the morning to buy milk for my daughter. I saw firsthand how devastating bad policies are for people. And the second thing I hope would stay is a team culture. Of all the places I worked, this has the highest degree of discipline. It's like a small army. Once a decision is taken, we move. There was, when I came, I had that sense that there are structures within the army that act on their own, but there isn't enough collective engagement, and we are not making best use of the totality of our skills. So we have built that sense of a team that, especially in these difficult times, comes together, we make decisions together.
How did you change that? Because it's something very difficult, right? It's almost in the DNA of any organization that it's collaboration, but that people feel they want to be part of it.
You have to invest in bringing the team together. We have regular meetings of the senior management team. We have leadership training, something that was seen when I came, was seen like, we are wasting our time. No, bring people together. You are leaders. You have to solve problems together. Put your minds on that by making sure that we respect every opinion. When I came, that's very interesting. So I'm sitting in my conference room. People come in, some sit at the table, some sit behind. I'm saying, why is that? Why isn't it first come, first serve? Well, this level of seniority at the table, this level of seniority in the seat behind, making the younger generation feeling that their voice is heard, that really matters. And then bringing a degree of informality. When you're in a crisis, you have to feel comfortable to reach out to everybody, including to the managing director. I'll tell you, I do things that are non-conventional. We would go out and we would dance. It is everything that break the barriers helps. When you do this, and you as a leader, people can see you, you're there, everybody shows up, and that creates a very different dynamic. Doesn't happen overnight.
Looking back at your career so far, is there anything that you would do differently? Is there a problem that you wish you could have solved? Is there a country that you could have helped sooner?
The most impactful of my jobs was being Commissioner for Crisis Response and Humanitarian Aid. The one thing I regret is that some of the lessons I learned on the way, I didn't learn earlier. The most beautiful lesson I learned from a 13-year-old girl, Syrian girl, in Lebanon. I was talking to her and I was asking her, what does she want? And she said, I dream to go back to Syria and go back to school. And at that time, my answer was, I really hope you can do it. And then I walked out and I said, wait a minute, my hoping does nothing for her. So I put all my energy to create a program for Syrian children. Look, Francine, I spent too many years sitting in rooms of very important people, listening to what they say and thinking, well, you know, they're so important, they must know better. And sometimes being shy to speak up. What is the moral of this lesson? When there is a problem, own it, embrace it. If you can work for a solution, do it. Do not hesitate.
In a profile written back in 2022, you described being late to recognize the importance of gender equality as one of your, I guess, regrets. I mean, what shifted your perspective?
Oh, yes. Well, what shifted my perspective was being time and again the only woman in the room and looking around and saying, this is not going to change by us just waiting for change to happen. Actually, since I came to the fund, guess what? We are now just about 40% women in senior positions. We were at 25 when I started. I came to this recognition also as a good economist, because when we don't have women in the labor force, when they don't add their smarts to decision-making, we all lose.
I mean, at last year's Fortune Most Powerful Women Summit, you also said that Christine Lagarde broke the glass ceiling,
yes.
and that when you stepped in there were no scratches left. So what did you mean by that?
When I came as the second woman to lead the IMF, half jokingly, one of the men said, are we going to ever have a man managing director? To which my answer was, well, if you want to average it, you will have to wait some 60 years, and then it is again your turn.
MD, thank you so much. I have some rapid-fire questions. Are you ready?
Of course.
What's the most important question you ask or tactic you have in an interview to figure out if they're the right person for the job?
I ask, what would the person that doesn't like you say about you? And what would the person that likes you say about you?
If I asked you that question, what would you say?
The persons that don't like me are likely to say she is too pushy, she interrupts people when they speak, she's too impatient. So yeah, that's what I think.
And the people that like you?
They would say that I'm fun to work with.
What's a job you did not get that you would have loved to have done?
I can tell you a job that I ran for, I didn't get it, and later on I was delighted I didn't. I went to Australia to apply for a position as a professor in a Australian university. I didn't get it, and just a month later, I went to the United States, to MIT, and the rest is history.
What keeps you up at night right now?
I wake up worried that not yet people understand that we have to think of the unthinkable, because the unthinkable has happened and it will happen again. I worry what is the next shock to hit. I don't know what it would be, I just know there would be one. And I worry that I'm not doing enough to get people to say, wake up.
Kristalina Georgieva, thank you so much for joining us.
Thank you.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world. And I thought, okay, I can rise up. I can play this game. And I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
We should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data.
Yes.
We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas.
The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
If you look back at the history of not just BHP, big companies in the sector, one of the lessons is that when a company gets boxed into a corner where it has to pursue M&A, that leads to all sorts of untold problems. I know how bad things can get when people chase after something, or if you get worried that failing or being rejected on a transaction becomes a reputational issue, you end up in very deep water then and can cause yourself all sorts of problems.
I'm Francine Lacroix, and this is Leaders, the podcast that explores what drives the world's most influential people. This week's guest is Mike Henry, the outgoing chief executive of BHP, the world's largest mining company. It's a pivotal moment for the industry. Now, global demand for critical minerals driven by the energy transition and the AI boom is soaring, and major producers like BHP are finding it challenging to keep up. Mike Henry has led the company through a particularly active and transformative period, spinning off its petroleum business, collapsing its dual-listed structure, and giving the green light to the vast Jansen Potash project in Canada. We spoke in January before he announced he would step down about leading a mining giant at such a consequential time, what it's like when big acquisitions don't go your way, and how he's thinking about succession. Mike Henry, thank you so much for speaking to Bloomberg.
Thanks, Francine. It's great to be here.
We're in a peculiar moment for the industry because so much is changing. Do you feel like you're in a different moment?
Different, but good different. But I've spent my whole career in resources. And for most of that time, nobody really wanted to talk to miners. You know, it was not seen as being an industry of today, perhaps. But what we've seen over the past 3 or 4 years is this awakening to the importance of metals and minerals. You know, you've got policymakers now trying to figure out how do they go about securing critical mineral supply chain resilience? Is there going to be enough copper? How do they go about facilitating that? And so mining has gone from a back burner industry to now being front and center of some of the big conversations that are happening globally.
But how do you respond to being in this moment? Is it a lot of pressure? Do you feel responsibility, or is it only with hindsight that you realize how crucial this period will be?
No. So I and others definitely recognize how crucial this period is, and to the extent that I feel pressure, it's well more than offset by the opportunity. If you look at copper, for example, copper demand is going to almost double over the next 25 years because it's needed for the broader economy, it's needed for the energy transition, the AI revolution, and yet copper is becoming harder and harder to find. And people are now cottoning on to that, and they're saying, well, wow, if we don't do anything, we're going to see super high copper prices or shortages at given times. And so the policymakers are now weighing in with industry to figure out how do we go about ensuring that that's not what happens.
Can you tell me about a meeting where you felt all of that, coming together?
A fellow CEO and myself were called into the Oval Office to meet with the President and the Secretary of Interior, Secretary Burgum, because we have a specific copper project that we're trying to develop in the U.S. This project could supply 25% of the U.S.'s copper demand for decades to come. Having that level of attention on our sector, that level of support, and what that symbolizes then for other governments has been such a big difference from where we were a few years ago. And it creates uncertainty, pressures at times. But big picture, this is a net positive for the sector.
Mike, tell me a little bit about how you transformed BHP.
First of all, I've been with BHP since 2003. Became CEO right at the beginning of 2020. And within 3 months, we were into the middle of COVID. And so, you were asking earlier about whether I feel pressure. The pressure of today is nothing compared to the pressure of the big decisions that we all needed to take in the face of the uncertainties that COVID brought. But as the impact I and the team have had on the organization over the past 6+ years, we've reshaped the BHP portfolio. So at the time, we had about 80% of our EBITDA being generated by combination of oil and gas, thermal coal, coking coal, and iron ore, so steelmaking raw materials, in a world where over the long arc of time, we should expect the world to decarbonize, and we're going to see peak steel in China, beyond which we'll start to see the iron ore market shrink. So we needed to make sure that we had a portfolio that was fit for the future. We've spun out our oil and gas division. Yeah. We've halved the size of our coal portfolio, now only focus on the best coals for steelmaking.
You changed the listing.
We collapsed the listing into one. We had a bit of a funny structure. It was called a dual listed company, 2 primary listings, 2 head offices and so on. Collapsed that. That was a big value unlock for shareholders. And we've grown markedly in copper and potash. We've grown copper by 30% over the past 3 years. We're the world's largest copper producer. In addition to that, we've improved operational excellence. We've gone from being a laggard in the sector to being best in class and from an operational perspective.
Jansen, right? I mean, did you feel the need to go at speed? Who you were listening to? Was it your gut or other people?
I've learned actually to rely more on gut over time, but these were all very well thought through. You don't trigger an investment decision the size of Jansen on gut alone. And
did you feel the need to do it in 1 year? So when I'm often told that actually when you become chief executive, you have a short amount of time to make a big difference that people will accept, because then it gets lost.
So I've never been one to coast in my career. Whatever role I've gone into, you have to bring energy to it. I also believe, though, coming back to your point, that there's never a better time to drive change when everything's up in the air a little bit. I had a very clear view of what was going to help drive value for the company over the next 20 or 30 years. We were then able to trigger a series of decisions. Actually, on the same day, we announced that we were collapsing the corporate structure. We were spinning out our oil and gas division. We were selling down parts of our coal portfolio, and we were investing in Jansen, the first phase alone, biggest ever capital project for BHP.
Right. A lot of shareholders could have pushed back against these individually, but by the fact that you bundled them,
yes,
it like everything was like, okay. Was that a strategy to communicate at the same time?
We knew all of the things that we wanted to do, but we also believe that by being clear with the market, particularly around the spin out of oil and gas and the investment into potash, that we could make it clear to our shareholders how we were thinking about the shaping of the portfolio and why one decision needed to be seen in tandem with the other decision, for sure.
Is that how you get your nickname, Meticulous Mike?
So sometimes your reputation outgrows you. You know, I am somebody who pays attention to detail, high sense of accountability, and I think maybe that's what sits behind the moniker.
Do you think when we talk about this new world order, is it being overstated or understated?
Oh, I certainly don't think it's being understated. So things are definitely more uncertain and more volatile. So it's worth pointing out that in terms of our sector, the decisions that we take, these are 10, 20, 30-year decisions. And over that time horizon, we know for sure that demand for some commodities is going to increase, and that then informs our selection about which commodities we want to be involved in. Now, how you operate in that environment, of course, that's informed by all the turmoil that we see in the world around us.
Can you talk to me about how difficult that is to make decisions where you actually don't know where this new world order ends up?
Look, it's increased the need for us to be planning through scenarios. So rather than trying to predict a specific individual future outcome in 20 years' time, we've, continue to reinforce our ability to develop different scenarios that we then test our decisions against. And one of the things that will allow us to be successful is making decisions that are as resilient as possible under a range of different scenarios. It is an added complexity, creates higher stakes in some instances to the decisions we take. But this is the world that we have. And as I said earlier, on a kind of net basis, this is a real opportunity for the sector.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
The mining industry is in a major consolidation phase, with many players pursuing M&A to beef up their metals portfolios. While BHP is no different, their success has been mixed. Mike Henry tried and failed twice to acquire Anglo American. Not only did they say no, but the British mining company is teaming up with BHP rival Teck. Now, with all of this happening in the public arena, I wanted to know how Henry handled the bid, whether he had any regrets, and how he stays focused in the face of rejection. You tried to buy Anglo American twice.
We did, yes.
But failed. What did you learn from those failures?
So why did we pursue Anglo American in the first place? It's because we like copper. We've grown in copper by 30%. We've developed four big internal copper growth options, but we're BHP. We have the ability to do even more. We thought that there was a great opportunity to unlock value for both sets of shareholders through bringing the two companies together. It wasn't to be the first time around. Second time around, we were faced with the decision of, well, we, of course, for all the same reasons as we engaged at the first time around, do we reapproach, see if there's any more interest now, given that they had progressed some of their strategy, or do we hang back for fear of being told no again? I would back us any day of the week to do the bold thing, which is to reapproach. And in both times, we showed discipline. I know how bad things can get when people chase after something.
Money-wise.
Money-wise.
That you just want something so badly that you're prepared to buy it at any price.
Or if you get worried that, failing or being rejected on a transaction becomes a reputational issue, you end up in very deep water then and can cause yourself all sorts of problems. So we went into both approaches with a clear sense of we will only do something that we believe creates value for BHP shareholders. And if we can't see that, then we'll step away.
How did it feel like at the time?
You approach those things with a sense of optimism, a sense of pressure, but coming away from it, momentary disappointment, but alongside that, the confidence that we've done the right thing by way of shareholders, and confident that we've made the right decision.
How did you manage through it? So you still have staff that you need to speak to, morale that you need to boost or at least keep steady?
We've got such a professional team, and so it's perhaps a little bit less disruptive inside than people might think looking outside in. People are very clear that they like the boldness. So the fact that, you know, BHP is willing to back itself and go after opportunities when it spots them, that's motivating for people. They also like the fact that we are super disciplined and that we're confident enough in ourselves and our existing strategy and our internal growth options to back away if we don't think that we can create value for shareholders.
How much time do you have to spend on that? So is it all consuming?
No, unfortunately, when you run a business like BHP, you have to be able to walk and chew gum at the same time. Now, I do have a team that is very high performing. These are all big leaders in their own right. As CEO, I don't need to spend a large proportion of my time getting in and solving day-to-day business problems. The business is running so smoothly, and when problems do arise, the team's on it on their own. I continue to need to tend to other relationships outside of that particular focus. So it increases in the amount of time that you have to take, but it can't become all-consuming for the CEO.
After the first bid that didn't go through, did you already know that you'd go after it a second time if the opportunity was there?
No, not at all. In fact, the board and I have been very, very deliberate about crafting a BHP strategy, and that would never be dependent on M&A. Right. If you look back at the history of not just BHP, big companies in the sector, you know, one of the lessons is that when a company gets boxed into a corner where it has to pursue M&A, that leads to all sorts of untold problems. And so we've been very deliberate about saying, first and foremost, we have to be able to get more out of the resources that we have. And that then enables us to be quite discretionary about whether we want to pursue an opportunity. So when we backed away the first time, we said, our prime focus is this. When we spotted a further opportunity, or where the question arose for whether we should approach again, it was the same attitude. We don't have to, but because we believe there's value to be created for shareholders, it's almost incumbent on us to make an approach. And if there's not a meeting of minds, then fine. We know we've got a great strategy in our own right, great growth ahead of us in the right commodities, so we'll stay focused on that.
Do you think there was a way of getting it? I don't know whether soft power, you know, the critics say that actually had you spent more time, you didn't want the South African operations, right, of Anglo, but had you spent more time in reassuring them or spending more time with the Australian shareholders, maybe something could have moved more in your direction. Is that fair criticism?
We will never know. I'm very comfortable with the way that we attempted the original structure. If we had have structured it differently, would that have made a difference? Maybe, but that would have run up against the main objective here, which is to create value for BHP shareholders. So I don't have any regrets over having approached the way we approached the first time around or the second time around.
What's the right way of approaching some of these transformational deals? You have to have like a clear strategy, and I don't know how you would describe it. So
you have to be very clear thinking. And if you think about the Anglo deal, it was wholly consistent with the strategy that we had laid out as a company. The commodity that we wanted to grow in, how we thought about M&A, the sort of assets that we were willing to acquire. Where you get into trouble is if you're not clear on what your strategy is, or you start chasing after a deal to get a deal done, or because you don't have all alternatives.
So you almost have to set that strategy as soon as you take over.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Some chief executives change strategy. Why do you think that is?
Well, when a business isn't performing well, or when the world is changing in a way that demands a rethinking of strategy, of course, then the CEO should get in and rethink it. But with ours, we remain confident in the strategy that we have and in the commodities that we've chosen.
That's bold, isn't it? It's kind of like sticking to a strategy.
You have to be bold in these roles. It's kind of an informed boldness. Our sector is such a dynamic, important sector that if you're not bold, that's where companies go off course, or they fall, they fail over time. And so when I stepped into role, I told myself I needed to be bold.
But I also like the fact that it's no regrets, because otherwise you could procrastinate about things that you could have done differently or you should have done.
So we faced, this was a key point that we faced in the second approach to Anglo. Some people would say, well, do you really want that to be seen in public again the second time around? Of course you don't want it, but when faced with that choice of, well, do we take that on but do what we believe is right by shareholders by reapproaching and have that level of boldness and confidence, or do we stay away from it because for fear of of it looking like another failure, we back ourselves.
I mean, industry rivals or industry players are now actually coming together. If you were to be number 2 mining company in the world instead of number 1, does that make a difference?
Makes no difference whatsoever. It's no, I don't worry at all about losing the bragging rights of being the biggest miner by market capitalization, both because it doesn't actually lead to greater shareholder value in my view. But secondly, I know that the minute that we get into a headspace that says we have to chase something just to be number 1, that's where things become much, much riskier. It's never a good idea to pursue a transaction because somebody else is pursuing a transaction.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start in the 3rd floor or the lobby. You actually have to start in the basement.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
When I spoke to Mike Henry in January, there had been rumors circling that after 6 years, he was preparing to step down. Since speaking, those rumors proved to be true, and he plans to hand over the reins on July the 1st. Knowing that his departure could be soon, I wanted to hear more about how he handles the day-to-day while also preparing for succession. What do you hope your successor can learn from the last 6 years?
My successor is going to have the opportunity to learn from all of the work, both of my time and role, as well as from the long arc of BHP's history.
I imagine it's difficult, right, thinking about succession. One of the most important roles for a chief executive is to make sure that you think about succession, but also it's difficult to figure out the time to go.
Well, so interestingly, day one, literally day one, as in when the board made the decision to appoint me into the CEO role, my chair at the time sat down with me and said, succession starts now. And it was made super clear to me that one of my biggest accountabilities was developing that next generation of leaders. So that's always been front and center for me.
It's hard, though. Is it hard?
Of course it's hard. In particular, if you become complacent and take your eye off the ball. And you don't continue to invest in people and giving them different roles, expanding roles, and if you're not providing them with the right support. And the other part of your question, so Francine, was, well, what's the right time to go? If you have the luxury of making that decision on your own, because there's plenty of CEOs who don't make the decision. It's always hard. It will, I'm sure when that day comes, it'll be a combination of personal perspective, but also what we believe is right for the business. I love BHP. I know that there will come a time where fresh energy, perspective, and so on will also be a positive for the organization. I'm a big believer in renewal, and that applies to companies just like it does ourselves.
When you talk to other chief executives, does succession come up?
So it comes up more regularly than some people would think. In terms of in some cases it's been their own succession So as they're leaving role, I always like to get their reflections on things as you have new CEOs taking up the role. So, for example, when I first was appointed CEO, one of the very gratifying things that I hadn't recognized was the case was a lot of other CEOs reached out and provided a bit of coaching or said, "Welcome to the club, and we've all been through this experience. If there's anything we can help you with." And I try to do that with others as well. I've had discussions on succession, sometimes prompted by me, sometimes prompted by them, about the topic or the concept of succession, how we go about building capability in BHP with CEOs from many other industries.
So what's the guiding thought on leadership? If somebody were to be appointed chief executive today and you call them, what do you tell them?
It would, of course, be around some of the things that we discussed about being clear on strategy, aligned with board, keeping your strategy consistent, don't get blown off course. But I think most people stepping into the CEO role would know that. What I think sometimes CEOs would be at risk of missing is the importance to long-term success of how you go about engaging and enabling your people, and doing so in a way that isn't reliant upon the CEO of the day or the management team of the day, embedding in the company's DNA a culture and an approach to how you go about leading your people, enabling your people, that stands the test of time. Because over a long enough time horizon, the incremental value, the incremental reliability, which builds trust with shareholders and other stakeholders, the value of that over time is certainly well in excess of the value that you're ever going to get through developing an individual mine or undertaking an individual M&A transaction.
What's been the most unexpected or surprising thing about leading the company?
Well, probably a couple of things. One, of course, nobody knew that we were going to encounter COVID early on in my CEOship, so that certainly falls into the unexpected category. Other unexpected things have been just how rapidly, as somebody who's spent many, many years out there talking about the importance of metals and minerals, sometimes feeling like our advocacy was falling on deaf ears, to see how quickly the world has pivoted on this issue and how this is now much better understood.
You've also put a stop to pointless meetings. Was there a pointless meeting where you said, enough is enough, I need to change this?
Well, this is probably been a lifelong passion of mine. So I recognize how valuable time is. We say to people that we want to engage them better to make sure that their work is meaningful, that their time is better allocated, and that day to day they're able to pursue improvement. It should be no different for senior management. We have to have impactful meetings, and that means not holding meetings that we don't need to have, not having people in the meetings who don't need to be there because that's disrespectful to their time. And then for the people that are there, we have to ensure that the meeting is as efficient and impactful as possible. And so we have very clearly set out requirements around meeting objectives, meeting preparation. You want everybody showing up at the meeting, having done the reading, well-informed, able to bring their view to the table. And then we put in place a continuous improvement process around that, where I get feedback on whether I've done a good job or a bad job, where I've fallen short in my chairing of that process, so I can then improve.
One of the big debates right now is that do you tolerate tempers in people around you in the business world because it means passion, or is it something that is not tolerated?
Temper, if you mean somebody banging on the table and throwing objects, clearly not tolerated. Should people be transparent about when others have fallen short or when they believe that others aren't upholding the values of the organization and so on? Yes, and sometimes there'll be a sharp edge to that, but only to a point. But you can't have an effective, high-performing company if people are always shying away from being clear about their views on performance and so on, for fear of being seen to be too passionate on issues. So it's a difficult one, Francine, to answer in a black and white fashion. Certainly, the disrespectful behaviors, no tolerance for that whatsoever. But being clear with people, look, I don't accept this level of performance. There has to be space for that.
What do you think defines bad leadership?
Lack of listening. There's this quandary for leaders in that you get into these leadership positions because you've got, a certain ability to absorb information, make decisions, a certain level of boldness. Carried to the extreme, that can result in arrogance, overconfidence, which will then lead to poor decisions at some point. There might be a series of great decisions, but if a leader is always just making decisions on their own, not listening to others, at some point they won't have the benefit of either the checks and balances that come through listening to others or the improvement of decisions through gaining perspective of others. that's a very dangerous space to be. So leaders that don't respect their people, who are overconfident and don't really listen and invite challenge, that's certainly not going to lead to the best possible leadership.
Mike Henry, thank you so much for joining us.
Thank you, Francine.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
You know, I've been called worse things than that.
You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. You know, when you're hot on the trail of something, you know that it's very exciting. What magazines were you reading as a kid? I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it Paradise Ahead or Gattaca?
Maybe somewhere in the middle.
At what point do you say, we made a mistake and we're getting out? How long do you give it before you say, this isn't working?
That's one of the most critical differentiators between great investors and just mediocre investors. Because on one hand, you have to have confidence and conviction in all the work you've done, the decision you've made, that if you have a little stumble here and there, if you immediately are selling out, you're never really going to fully realize the depth of potential long-term success. And yet, on the other hand, if you're stubborn and you refuse to admit I'm wrong, you continue to think the market's wrong and I'm always right, then you'll get caught in some very, very difficult positions over time. So that ability to have a fresh perspective, take in the new information, even when things aren't going the way that you'd expect or to hope, and to really understand from this price point today, is this still going to be one of the most compelling investments or not?
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
I love this library.
It is an absolutely beautiful library.
Are you a big reader?
You know, I mean, I read a lot in general. I don't know that I've had that much time over the last year or so.
Dario Amodei is an unlikely AI celebrity. He's known for warning the world about the risks of artificial intelligence. Now, his company is an AI frontrunner, valued at nearly $1 trillion. You're shipping so much so fast. How are you doing that?
We use Claude, you know, across the product development cycle, and it allows us to release very fast.
Founded by a team of OpenAI defectors in 2021, Anthropic started out as an underdog lab. Today, it's the breakout star, wiping billions in value off software stocks, going head-to-head with the Pentagon, and creating models allegedly powerful enough to burst through the walls of modern cybersecurity.
Some of the early companies that we gave this to said things like, this is a super weapon. Please don't release this.
Guiding Anthropic through this is a sibling duo. Dario, the brother and visionary, and Daniela, the sister and operator, who puts Dario's swirling cosmic thoughts into action.
Dario and I, we've always been really close since we were little, but I think we always really wanted to do something big together.
Okay, but when you argue, who wins?
No one.
No one.
As the AI arms race escalates, the Amadeus are eager to establish themselves as the good guys. But Anthropic's technology could have profound implications for how humanity works, learns, thinks, even fights wars. Enormous responsibilities for a young, fast-growing startup.
All of this technical safety research that we do, it's to make the products more aligned with human values, to make sure that we're not building something that could cause societal issues that previous technology companies have accidentally caused.
The name Anthropic actually comes from the Greek word for human, which speaks to their mission to build responsible AI for the long-term benefit of humanity. Can you actually do that when you're building the most powerful technology in the world? You're at the center of the AI universe right now. What does that feel like?
The experience I've had for my whole career, and certainly the whole time at Anthropic, is that there's this kind of smooth exponential. And the experience of the smooth exponential is nothing's happening, nothing's happening, nothing's happening. Little things happen, and then zoom, it goes crazy. So, I was watching this graph for a while, and I said, oh yeah, we'll probably become the AI company with, the most revenue and the most valuation sometime around this time. And indeed it has happened. We're just keeping in mind all the things we usually keep in mind. How do we train good models? How do we put them in good products? How do we make sure that everything's safe?
What were you like as a kid growing up in San Francisco? I know your dad was a leather craftsman, your mom worked in libraries. How did that shape you?
The whole, first, internet revolution was happening around me, and I had absolutely no interest in it. I was just interested in doing math and scrolling things. I was interested in understanding the universe. I was interested in science fiction. I think I just felt a lot of curiosity about the world.
What was it like growing up with Dario?
He was so smart. He was taking, calculus when he was, in, I think, middle school. He took math classes at UC Berkeley when he was in high school. I was actually more into reading and arts, so we were almost like complete complements in that way.
Dario studied neuroscience before turning to AI at Baidu and later Google, while Daniela started out as an early employee at Stripe. They lived together in San Francisco, along with Daniela's husband, Holden Karnofsky. Then, in 2016, Dario joined the newly formed OpenAI, followed by Daniela in 2018. The company began as a nonprofit that promised a safe, more open path to superintelligence.
I think we need to think right now about how we want this deployed, how everyone gets to benefit from it, how we're going to govern it, how we're going to make it safe and sort of good for humanity.
At OpenAI, Dario developed the concept of scaling laws, predicting that large language models would improve simply by adding more data and computing power, even if the underlying algorithm stayed the same.
At that point in time, I know it sounds crazy now looking back, not a lot of people believed, hey, scale up is the way that these models are going to get smarter and better. That was sort of an unusual, countercultural, scientific perspective that I think was really held by our, founding research team.
That approach helped supercharge OpenAI's models, paving the way for ChatGPT. But the Amadeus reportedly clashed with Altman over the company's direction and values. Altman has said, "For all the differences I have with Anthropic, I mostly trust them as a company."
Your decision to leave OpenAI has become Silicon Valley lore. What did you disagree on?
Look, I'm going to say it. I'm going to say it very simply. There are many valid disagreements to be had on safety. We certainly had some of those disagreements with them, but people, that alone is not sufficient to leave. When you feel that you can't trust someone, when you feel that their values are not what they say they are, when you feel that they're not honest, that makes it very hard to continue to work with the company, to continue to trust the company. And look, at the end of the day, why argue with someone when you don't have the same vision and you don't trust them? The way to resolve it is you go off and do your thing, they go off and do their thing.
So this is Precita Park. When Dario and Daniela decided to leave OpenAI to start Anthropic, this is where the early team would get together. It was during the pandemic, so the story goes, and a bunch of early employees would come here, they'd pull up a chair on the grass, they'd have lunch, and they'd talk about what they were building.
When we started this company, there were 7 co-founders, of which me and Danielle are 2. And now, you know, we're basically the only company in the space that has all of its co-founders still here. You don't get to, you know, be a company of the size and scale that we are with that happening. Like, that almost never happens.
From the start, Anthropic pitched itself as the ultimate safety-conscious AI company. Dario has published long essays with names like Machines of Loving Grace and The Adolescence of Technology, musing on the miraculous potential of AI, as well as the worst-case scenarios. Anthropic's chatbot, Claude, has been trained to follow a set of principles called a constitution, intended to keep it on the straight and narrow.
Claude has a very distinct style and feel, a human name. What are you trying to convey?
I think when people interact with Claude versus, you know, other systems, there is more of a feeling of, I like to describe it as professional warmth. So the goal is not for it to be your best friend, but it's not for it to be sort of cold, rote, calculating. It should feel approachable, but distant, right? Professional.
Anthropic has talked about teaching Claude to be good. What is a good model? What is a bad model?
You don't want a model that lies accidentally or intentionally, right? Lying we call hallucinations. It makes something up. The models are just trained to predict the next word, so sometimes they don't know, and they just invent something. Models sometimes, as we've shown in our research, can purposely try to deceive you. We have to make sure that doesn't happen in production models that we expose to customers. And then there's a lot of work around harmlessness, just making sure that the model is not accidentally producing, you know, information that is wrong or harmful or could cause someone to do something bad.
Whose values are being put into Claude? Like, is there a universal good? There's so many religions, so many different beliefs. Like, how do you even decide that?
So, of course, there's no universal standard for what makes something helpful or harmless, but there are founding documents in human history, like the UN Declaration of Human Rights, that we can use to train Claude's character. And I think, you know, interestingly, on the religious front, we've actually started to have a lot of conversations with religious leaders around how should we think about, you know, Claude the entity, and how can we bake in some of the kind of core values that are consistent across religions, types of belief, that really just transcend, you know, a specific worldview, but that are really things that human beings have been grappling with for millennia.
Have you tried to give Claude a trait that didn't take, or was there any trait that emerged that surprised you?
I think in the early days, it's funny to look back on them now, the kind of early Claudes, Claude 2 era, sometimes Claude would be almost a little bit nanny-ish. Claude was like, I'm really concerned about you. And you're like, Claude, I was asking for the weather, right? It was something really benign. Thankfully, we didn't, you know, release most of the most egregious versions of those. But I think it is, you know, it is, when you think about it, it's like tuning a dial. And so our researchers have this very fine needle to thread in order to land at the center of that.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas.
The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Whatever Anthropic is doing with Claude, it seems to be working. Anthropic's revenue has skyrocketed over the past year, making the company profitable for the first time. That's largely thanks to the company's focus on more lucrative business tools. Claude Code, a major leap that automated large chunks of software engineering, and Claude Cowork, which gave that power to everyone else.
Now, early on, others focused on fun, splashy consumer apps. You made a bet on coding and enterprise. Why did you make that bet? Was it a values decision or a business decision?
look, if you pick a business model that fundamentally conflicts with your values, you're going to have a hard time, right? Either you betray your own values or you become irrelevant. And so when we thought about it, we said, look, you know, we've seen the world of social media, the consumer world, it really seems to, you know, encourage engagement, even addiction, you know, the slop we've seen with AI video models. It's like, what's going on is they want to maximize the number of minutes that you're paying attention to, because that's the advertising revenue-driven incentive. Whereas if we look at enterprise, look, I mean, you know, we want to make these models useful to people. We want to use AI to, you know, cure diseases that we couldn't cure before, right? Well, that's working with biotech, it's working with pharma, it's working with academic research groups. All of those are enterprises, right? We want to use AI to, like, you know, to make energy cheaper and more efficient. That's all enterprise. And so I think it served us well to have this business model that largely aligns with our values.
Soon after Claude Cowork was released, $285 billion in market value vanished overnight. Traders called it the SaaSpocalypse.
This kind of white-collar wipeout story in the software sector, terrifying.
Some of those are down for 9 days in a row, so clearly the tension is building.
If AI continues improving at this pace, how much of traditional software gets replaced and how fast?
I think with AI, like, the pie is getting bigger, right? So the existing incumbents may be smaller in relative terms. Some of them may go down in value. Some of them may even go out of business if they don't adapt in the right way. But, like, I would guess that the software industry gets larger, not smaller, although there will be some big losers. Those who don't kind of see what's coming, who don't identify the moats they have, they're going to have a really hard time.
Anthropic's recent growth spurt might not have happened without this man, Boris Cherny, the engineer behind Claude Code and Claude Cowork. When Anthropic hired him in 2024, Cherny was living a very different life in rural Japan.
There was a lot of farmers markets, like very slow. We were making miso, sort of the big hobby. And I remember using the first AI chatbot that I'd ever used, and it just took my breath away. And I was just like, oh my God, I have to just be a part of this. And I'm also just such a big sci-fi reader. And so I just know how bad this thing can go. Like, this technology is incredibly powerful. And so we moved back.
You created Claude Code. You led the development of Claude Cowork. What problem were you trying to solve?
If you look at the coding products, they were all pretty simple. It was sort of like, you know, like complete the word, complete the sentence. That was the extent of AI in coding. And we just wanted to make a way bigger bet. And our bet was, we think actually a coding agent can do all of it. A year and a half ago, you wrote the code by hand. And sometimes you press tab and it would autocomplete a line. Now I talk to my Claude and it writes the code. And then while it does that, I talk to the next Claude and it writes some code. And at any point, I have either, you know, like a few Claudes running and up to a few thousand Claudes running, doing things.
How much code is Claude writing internally for engineers here?
It's writing almost all of it. On my team, so for me personally, it's been writing 100% of my code for at least 6 months. The work of engineering has just completely changed. I feel like I suddenly have superpowers. I have like a jetpack. And engineering has never been this fun.
Can we give Claude a spin?
Yeah, let's do this.
All right.
All right, so let's make like a little recipe app. So make a recipe app. What do you want it to do?
I would love it to suggest meals for the week.
So, you know, this is going to take maybe a few minutes, and let's just see if Claude builds this.
All right. Ooh, it gave me some options. Let's do...
These look pretty tasty, actually.
I could do a Greek chicken power bowl. When I click on a recipe, I want it to show me how to do it. Thank you.
I'm sure Claude appreciates it.
I always try to say thank you.
Yeah, I always try to be nice too.
I don't know.
A recipe app might not be the most mind-blowing demo of Anthropic's technology, but what Claude Code just did in minutes used to take hours or days. For some, that looks like a big opportunity.
Are you, like, nervous about next week, or is it like...
What's next week?
Your developer conference.
Oh, yes, yes. There's so many things happening every week.
Year over year, API volume is up nearly 17x on the cloud. In the last 12 months, we shipped 8 frontier models to developers and users.
Welcome to the second annual Code with Claude conference, where where Claude superfans come hoping to get a glimpse of the future.
We're having a lot of fun. There's a ton of adrenaline.
This is the first year we've grown faster than the exponential. In the first quarter of this year, we saw, if you were to annualize it, 80x growth per year.
I use Claude every day in the form of Claude Code to do all sorts of stuff, not just write code.
I write way more code than I did 5 years ago. I've got the confidence of, I don't know, a 22-year-old with VC money. I'm not 22.
My friend invited me, and it's amazing as someone that's not really technical. I think it's really interesting just to see what everyone's working on, what's out there.
I think the concerning part and the exciting part is, hey, they can do things that we couldn't dream of and timelines we couldn't ever expect. But the kind of alternate side of that reality is you really have to be prepared because they will really be 1,000 times more productive.
All of this raises an obvious question. Will engineers be the first casualties of the AI they're building?
It's been revenge of the nerds for a while. Is that over?
I think we all become nerds.
But what happens to the actual nerds?
I think the actual nerds, well, they have to figure it out. Yeah, I think for a lot of them, the skill that they had before is going to help them in the future because they sort of have a pretty big head start. They do a lot of things that are not coding. Engineers also have to talk to users. They have to plan. They have to think about what's next. So I think these are still parts of engineering that are going to stick around.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Silicon Valley may have AI fever, but elsewhere, the mood is less upbeat. 70% of Americans think AI will kill jobs, and nearly a third worry theirs will be one of them. Dario Amodei has been outspoken about this issue, and some of his predictions don't exactly sound reassuring.
I think we could have this very unusual combination of very fast GDP growth and high unemployment, or at least underemployment, or low-wage job, a lot of low-wage jobs, high inequality.
You've been really direct about job loss. AI could eliminate half of all entry-level white-collar jobs in the next 1 to 5 years. That was a year ago. AI has moved incredibly fast. Is it still 50% or is it higher?
I don't know exactly, but I'm still pretty concerned. I'm still the same order of concerns. We are seeing right now that AI is making people more productive, but that's the usual hump. You automate 90% of the job, great. People are 10 times more productive in the other 10% because they're 10 times more leveraged. But eventually it gets close to 100%. Now, the sequel to that is, well, then you have to find something else for them to do. Right now, AI makes the software engineers more productive, even though AI writes all the code or almost all the code. But we're already starting to see the beginning of there may be some people that it's not making more productive, that it's better for the AI to just do the thing.
How does that sit with you?
It's very uncomfortable. I think this is the reason why I chose to go to Anthropic, and I think this is the reason that a lot of people here chose to go here. Is artificial intelligence is this force that is far bigger than we are. But here we can hopefully make it go a little bit better.
Do you feel like it's your job to do something about that, or is that someone else's problem?
I think it's a thing that we have to talk about. We have to advocate for it. Ultimately, it's up to society to solve it. This is bigger than one company.
There has been a lot of pushback on, and I know you've said you're trying to warn people, but that, Jensen Huang said you're conflating tasks with jobs.
AI is creating jobs. Anybody who is saying that AI is wiping out jobs is scaring people.
Other folks have said this, it's sort of doom marketing that benefits Anthropic.
So I want to be really clear and push back hard against this. In every interview, I talk about the possible ways to address these risks, from tax and macroeconomic policy to what the new jobs are. In the adolescence of technology, I have like 5 pages where I lay out the difference between tasks and jobs, why this time is different than other times. But social media, which I detest as a category, people have these 3-second clips from a year ago. I've written much more carefully about these things where I talk about the risks. So these are the idea that this is cheap marketing is itself cheap marketing. I think it's part of the disease of Silicon Valley. It's been caught up in this social media world of 3 seconds. And so my message is just definitely not doom is coming. My message is like, this is something, that we should see coming, that we're worried about, and that we need to actually respond to positively.
Beyond the software industry, the potential impact of AI on jobs seems harder to predict. Anthropic has published a paper estimating which fields could make the most use of AI in the near future. If its predictions are right, management, finance, and legal jobs could soon look very different.
Which jobs go away, who gets replaced, and what new jobs are created?
So no one knows for sure, because, the economy is unpredictable, right? The thing that we have going for us here is the pie is going to expand a lot. And so because the pie is going to expand a lot, there are probably going to be places where people can go. It's just a matter of finding them fast enough.
So play this out for me a little bit. You wake up in 5 years, what does this country look like? What are those people doing?
Yeah,
because if there's that much unemployment, is that not how revolutions start?
Yeah, no, this is the outcome we want to prevent. This is absolutely the outcome we want to prevent. I think there's a few places. None of them are guaranteed, we're not sure, but there's the physical world. We need a lot of more people to make, build, manufacture things in the physical world. Anything that's human-centered, I think that's going to be a big deal, right? People, or at least some people, want to talk to humans. So these kind of human relationship-driven jobs, I think those are going to be important. And I think there'll be some effort by the humans to kind of direct the AIs, right? At some level, it has to be in line with someone's values and someone's intentions. And so I think there's going to be some role there, although I don't know how thin versus how thick it will be.
I think I feel a little bit more hopeful that humans will continue to find ways to leverage AI to be productive, to do the parts of the work that are meaningful to us that only humans can do. I think the human-to-human interaction will never fully go away. The example I often reach for is what will happen in medicine. Today, we hire doctors who are expert diagnosticians. I think AI is going to soon be pretty good at telling you what the suite of options of things that are wrong with you and what tests to run, and you won't need a doctor to do that. But an AI can't physically examine you and say, hey, does it hurt when I press, here? Mm-hmm. They can't have a bedside manner with you that says, tell me how you're feeling about this. How are you coping with going through this process? Mm-hmm. And I think we're going to pivot something like medicine to be much more focused on the interpersonal, because the diagnostic tools are going to become much better. But the interpersonal human part, that's not going to change.
AI is a technology that touches almost every part of life. So there's more to get into, a lot more. Next time, AI and the Future of Warfare, Anthropic's scarily powerful new model Mythos, and riding the exponential while avoiding dystopia.
I understand one of your favorite books is The Making of the Atomic Bomb.
That is correct.
Do you see parallels between yourself and Oppenheimer?
The figure I most identified with was Leo Szilard, who was the one who first had the idea that there could be a chain reaction. Look, my view is we're not going to get through this with larger-than-life personalities or figures who try and be at the center of everything. In some ways, I actually see Oppenheimer as a failure case. as what should not happen. There's a lot of powerful actors who have interests here, and the only way it's going to end well for everyone is if there's basically checks and balances everywhere.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the US or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
Anything we do in Africa is going to be more risky than the US. I think the approach we want to take is how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation is a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Explain this to me. Daniela runs day-to-day operations. All the leadership team reports to you.
Yes.
No one reports to you. That sounds like a pretty sweet job.
It's incredibly freeing. It lets me do all the things that I do much more easily than I would otherwise.
Because she does all the work? Is that what you're saying?
If you had to go through the things I had to go through during DOW or no.
Out on the world stage, Dario Amade has adopted a dual role, moving between newbie captain of industry and steward of this consequential technology. He's not afraid to blast his competitors.
There are some players who are YOLOing, who pull the risk dial too far, and I'm very concerned.
Who is YOLOing?
So that's a question I'm not going to answer.
Or critique the U.S. government and Anthropic's own partners for selling AI chips to China.
It's a bit like
I don't know, like selling nuclear weapons to North Korea. I've been very outspoken about the need for export controls on chips to China. I say this because I think it would be really bad for America, for the state of democracy in the world, for China to be ahead in AI capabilities. And it's like some of the chip makers obviously don't agree with that view, but it hasn't stopped me from saying it. Even after we've signed more partnerships, I'm sure they wish we didn't say these things, but these things are what I believe. And so, look, we're all adults here. We can work together on one thing while disagreeing about another thing.
Amadei's statements about geopolitics date back to his days at Caltech. As a sophomore physics student, he developed a reputation as an anti-war advocate who believed scientists shouldn't sit in ivory towers. It's a worldview that would later define Anthropic's position on the future of war.
You've had a long-standing anti-war stance, and yet you were one of the first AI companies to sign a contract with the Department of Defense to operate on classified networks. These are the networks that the U.S. uses to fight wars. Explain that.
Look, I mean, the world changes. Like, my view of this technology, when I see Russia invading Ukraine, when I see the risk of China invading Taiwan, it worries me that we have a kind of resurgent authoritarian bloc, that they're very aggressive and that we need to defend ourselves. I may not agree with every policy of either administration, but, that's why we've generally been supportive of this.
You've been working with Palantir since 2024.
That's right.
Their technology is used by ICE, police departments in Gaza. Is Claude being used for surveillance in other ways?
We don't work with ICE either through Palantir or anyone else. We don't work with CBP. I don't believe we work in Gaza. We're very careful about, scoping our engagements to things that we believe in.
In 2025, Anthropic, along with OpenAI, xAI, and Google, won a $200 million contract with the Pentagon. Anthropic framed it as an opportunity to become the leading AI vendor for the government. Claude was reportedly used by the U.S. military in the operation to seize Venezuelan President Nicolas Maduro. Weeks later, everything started to unravel.
We bring you breaking news from Anthropic. The Department of Defense demand that Anthropic allow full use of its AI technology without guardrails.
Anthropic drew red lines, refusing to let Claude be used for mass surveillance and autonomous weapons, putting the company on a collision course with the Pentagon.
The tech giant facing a deadline today to accept conditions or be blacklisted.
Does a commercial entity have the right to determine how their products are used by the military?
Lawsuits were filed, and Anthropic was banned from the Pentagon, underscored by strong words from President Trump and Defense Secretary Pete Hegseth.
Anthropic is run by an ideological lunatic who shouldn't have
But that's not my question. My question is AI
decision-making
writ
over
large.
what we do.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
I've been called worse things than that all the time.
What does winning this fight actually look like?
I won't even call it a fight. This is more a debate about what the proper use of AI by the government is. And AI is an emerging new technology. We don't understand the ways in which it's reliable or unreliable. We don't understand the ways in which it promotes our values or undermines our values. And so one of the things that I thought was important was to establish a precedent on some of the use cases we think are good, which frankly is most of them, and some of the use cases that we're concerned about.
A U.S. official has said, with the help of LLMs, the U.S. military has gone from being able to hit 1,000 targets a day to 5,000 targets a day. That means Claude can help kill more people more quickly. Are you comfortable with that?
Basically, you're asking, like, do you believe in this country, right? Do you want this country to be a more powerful actor rather than a less powerful actor on the world stage? I do. I'm a patriot. It's not up to me. If we provide a technology, it's not up to us to say you can do this military operation and you can't do that military operation. Now, I might privately believe that this military operation makes sense and that military operation is a bad idea, but we're not going to deny the technology. You basically have to, you have to leave policy in the hands of the military decision makers.
Bloomberg has reported that Claude is being used by the U.S. military in the war in Iran to do AI-assisted targeting via a platform made by Palantir, Maven Smart System. In February, a U.S. missile reportedly hit a girls' school in Iran, killing more than 150 people, most of them children. Did Claude play a role in that strike?
We don't know exactly how, these models were used. Obviously, these things that mistakes that happen in warfare are really, really terrible. Like, this is a really terrible thing to happen. We were willing to risk the future of our company to limit how, these models are used. And, what you're talking about is a use case that doesn't even violate our red lines. We're worried that there will be 100 times as much, with use cases that do violate our red lines. Now, again, I would say I think overall the use of these models is appropriate. I think it's good on net. But military decision makers make terrible mistakes. Even at the best of times, and I don't know if we're in the best of times. What we've seen here is Claude assists, but a human makes the final call. So a human made that final call, not Claude. Imagine if you had a world in which, not Claude, because we haven't allowed it, but someone else's AI model, the AI model just makes the decision and the human never sees it. That's what we were standing up for. That's what we were fighting against.
This school had a website. You could have found it in a Google search. Shouldn't Claude have spotted that? And does it speak to a scarier issue about using technology as a shortcut in war?
The principle that was obeyed here is a human makes the final decision. I don't know what role Claude or any other AI had, but if this isn't an illustration why that principle is so important, I don't know what is.
Is AI warfare more likely to stop World War III, a war between the U.S. and China? Or is it more likely to make it happen?
I would say on balance, it is more likely to stop it. But if we have no limits on how it's used, then I think, it could be more likely to cause it. You've seen Dr. Strangelove, right? The premise of it was you have a doomsday device that automatically fires nuclear weapons when it thinks nuclear weapons are being fired at it. What could go wrong, right? I think the way conflicts happen is that, the two sides jump at each other. They misunderstand each other. And when we don't have proper oversight of this technology, I think those kinds of accidents are more likely to happen. Now, I think if AI is used in an appropriate way in not even warfare, but think of just intelligence collection, let's say we're able to, predict an invasion of Taiwan or a new movement in Ukraine, our adversaries will think twice about conducting some kind of invasion or military operation if we know everything that they're doing.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
AI's role on the battlefield raises difficult questions, even for a company willing to debate the ethical dilemmas of its own technology. It's a conversation Amadei seems eager to have in public.
How do you handle the pressure?
I try very hard to communicate and always be straightforward and honest. I get up in front of the company every 2 weeks and just talk for an hour about just what's on my mind, what's going on in the industry, what's going on in the outside world. It's totally uncensored. And not only does it build trust, it's very freeing for me, where I feel that I have 3,000 people who are on the same page as me. That is an incredible amplifier and is one of the most useful things in handling the pressure. Then when we have to confront an external challenge, stand up to, some very difficult situations that we've seen in the last few months, that is what allows us to have a consistent and coherent position. And I think it's an incredible advantage because I never feel like I'm alone.
Lurking in the background at Anthropic's headquarters was the surprise development of a new AI model called Mythos. A model so powerful, it spooked everyone.
Anthropic's making headlines almost on a weekly basis, and most notably now around Mythos.
The company believes it's this enormous threat.
Imagine a world where everyone had a nuclear bazooka, basically.
Mythos identified thousands of cybersecurity vulnerabilities, exposing potential flaws in every major operating system. Anthropic signaled that if fully released, Mythos could hack banks, pry open state secrets, and cripple critical infrastructure.
I think the thing that surprised me most about it was the models had been climbing in their ability to find vulnerabilities. It was a particularly large jump. Some of the early companies that we gave this to said things like, this is a super weapon. You should have to own a gun license to use it. Please don't release this.
In an initiative called Project Glasswing, Anthropic gave select organizations access to Mythos. Even federal agencies like the National Security Administration clamored to use it, despite Anthropic's blacklisting by the Pentagon.
I think the future is this kind of cat and mouse game where we need to make sure that the good guys have the tools that they need to defend. And then at some point, the bad guys will have it too. And at that point, we have to make sure the good guys have an even better model so they can be ready for this.
Is it possible to stay ahead of the bad guys? Really, though?
That's what we hope.
The criticism is you're effectively deciding who gets access and who doesn't. Why should anyone be comfortable with that kind of concentration of power?
It wasn't like, oh, it's so powerful and let's decide who gets the power. It was a very specific concern around cybersecurity. And so the way that we decided who to give the model to was grounded in that specific fear. There's obviously nuance to decide, like, where do you draw that circle? I think that's really complicated. I think we've tried to be as publicly open as possible to say, we're trying our best to make this decision well, but like, we might not do it perfectly.
What about the folks who say this was just good marketing?
You know, we have suffered enormously commercially from not releasing this model. This model has incredibly accelerated research within Anthropic and production of the next models. It would do the same in the outside world if we were to release it. This has hurt us enormously commercially.
Have you had to make trade-offs already that you're not entirely comfortable with?
Throughout the entire history of Anthropic has been trade-offs, right? In some ideal world, you would prefer to, before you release the first chatbot, you could spend years studying, every possible thing that could go wrong with it. Now, we did delay the initial release of Claude, but, we did it for a few months. So everything is a trade-off. Now that we're in, what I would describe as a commercially leading position, we can afford to move the dial even further towards being careful, right? That's what the Mythos release was about, right? It's very hard to do something like that if you're not the leading player.
There's this argument, why wouldn't the government take you over? Why would they let a private company control technology that's so powerful?
So I actually think that's a very serious question, and I share those concerns. I don't think the government should outright take us over. Every previous powerful technology we've seen in history was either built by the government or originated with the government. So nuclear weapons, obviously, initially built by the government. The internet, GPS, cell phones. AI is the first technology that's been built in the private sector, and where government has not really had a serious role and is coming in late to the game. I think that's actually a dangerous and unstable situation. It is not the situation I would have chosen. This technology, I'm scared of companies having it, but I'm also scared of government having it. And then, we need basic regulation of the technology. More and more, as I've seen what we've seen with Mythos, I think we need to start doing pre-release testing, required pre-release testing and auditing of the models.
This was an approach the White House rejected initially. On his first day back in office, President Trump, with the help of former AI and crypto czar David Sachs, dismantled President Biden's AI executive order seeking guardrails, instead favoring a hands-off, let Silicon Valley do its thing approach.
We believe that excessive regulation of the AI sector could kill a transformative industry just as it's taking off.
But with Mythos and its national security implications proving hard to ignore, the White House now seems to want to gatekeep the world's most powerful AI.
It's very funny to me how there's a particular group of people in the tech world in Silicon Valley. They started with a position of like, you know, even having transparency around this technology, even export control, you know, this is all, you know, just totally, it'll apocalyptically destroy our potential to create the technology, it'll kill innovation. And then as soon as they see the first real danger, which I've been expecting all along, there's all this talk of like nationalization and the government should just seize it. Come on, folks here, you're yo-yoing from like the most extreme anti-regulatory, if you look at us the wrong way, you're destroying the industry, to, you know, this completely communist, the government should grab it all. We need a more sensible, moderate approach. That's the one we've been favoring all along because we've understood the power of this technology. We're not panicking, we're not denying it. We see the smooth exponential and we're responding to it appropriately.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Raffiti. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Raffiti. We're tracking breaking news today from Wall Street to Washington.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The reaction to AI right now, it's intense. Anthropic has built this really loyal following. There are some people who just love what they stand for, but there have also been protests right outside their office. There's a lot of anxiety, a lot of confusion. There's some real anger right now about what's happening, and it actually feels like it's escalating.
Artificial intelligence is the next industrial revolution.
If you look at the data, people are more concerned than excited about what's going on. They think the risks outweigh the benefits. And the truth is, if you talk to the people who are building this, even they will tell you they don't fully know how it's all going to play out. How do you think about the weight of this moment?
I worry that something will go wrong. You know, are we doing literally everything we can? We're certainly trying our best. We're certainly trying very hard. What I want is to create a situation where if this set of people can't do it, it couldn't be done. You can't guarantee success, but maybe you can guarantee that.
It's getting personal. Sam Altman's home down the street has been attacked. How is that affecting you?
It was really scary to read that. I mean, we were obviously extremely relieved that he and his family were okay. In general, I think this is a time, you know, technologically, politically, where unfortunately there's just a lot more rhetoric and words that I think can lead to bad outcomes and bad things happening. I hope that this is a topic we can all just debate, you know, as peacefully as possible.
It was scary to me too. I mean, you know, this is like a less savory aspect of the exponential, right? That as AI gets more and more of a big thing, like, you know, it becomes just such a big deal to society. There's more attention on it.
There's been massive backlash against social media. Countries are starting to ban it. Could that happen to AI?
I think it's absolutely possible. If the social media companies could go back in time and see the world that they see today, would they do anything differently? I like to think the answer to that is yes. I don't know. If we sort of project some of the challenges that the social media companies have faced around child welfare, mental health, election integrity, all of these topics, we're really lucky that we're second. we view it as our job to try and proactively think about all of the things that could go wrong. Because if we don't, who's going to?
You know, I don't know that they actually set out to do the right thing or make the world a better place. And so I don't think if they were going back, they would, even knowing what they do, and they certainly should do things differently, I don't know if they actually will. But we can't. This is why we're trying to get this right the first time, instead of waiting for things to go wrong, then scrambling to justify why it's all okay. The main way I could see AI being, you know, banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
You have technologists saying it's going to be amazing and others saying it could be awful. Where are you on that spectrum?
I hope the best, but plan for the worst. For me, this is the most important work I've ever done. For some people, it feels like this is the last job, because this is sort of, for other people, it's, you know, like maybe it's not the last job, but it's existential to get this right. And so there's just this